So let's begin. And the book whichever I told, this is purely the concept book. And as I told already, it has 95% accuracy from the ICA book. Literally, if you compare this with ICA book, you will not find much difference. Just that this is a colored version, that's a black and white version. And here in every concept, for every sentence almost, we have given one side heading to it to reflect that, like what exactly we are, what exactly that concept is conveying. So we have given in the form of side heading or like that. So it will be easy for you to quickly revise later. And coming to the syllabus coverage, which I told with respect to this particular revision class, as I already told in that particular launching video, the same syllabus I'm sticking to. I'll try my level best to cover one or two more chapters in addition to it. Okay. And this book is also available for sale at this counter. Here itself they will have a counter. If any of you want to, if at all you want to take up this book, you can take. And I think it is 400 rupees is the price. Just the book alone. Concept book. And question bank will also be there. That we didn't bring anyhow. You can take a print of it. The PDF is free on our website. You can open our website, Rest of a CACMA. There is a website. So inside that you can find the PDF here. You can find here latest new edition 2025. Nothing but they are applicable absolutely for November attempt also. And the same is applicable for May 25 and November 25. Now, in this question bank is also given, where the question bank will contain all the previous exam 6 attempts questions, RTP, MTPs. That too, wherever there is a repetition, we try to avoid our best the repetition. And at few places still the questions might get repeated. Standard wise breakup we have given. For each standard wise, qualitative questions, very qualitative questions only we retained. Not every question that is there in the past exam you are supposed to read, but there are few questions which are not covered as part of the main material of ICA discussion, which will not be covered generally in any other material that you follow. Those kind of questions that were asked in MTP, RTP question papers, maximum of those types of questions we retained. Getting it? That's the question bank. And MCQ booklet, like for your reference, I'll just show you the question bank also. Now, some of you might get a doubt. Should I upgrade to this material? Not required. Technically speaking, not required. As long as the concepts which I'm covering, the content which I'm covering, if at all it is directly reflected, briefly or at least in a moderate level, if it is reflected in the book that you're following, you need not upgrade. If at all the book that you're following does not contain or missing so many concepts, then I recommend you to upgrade. The main reason people fail in audit is, there are two reasons. One, they don't understand the subject. Two, the books they are following does not contain full syllabus. Many books that are there in the market that are not containing full syllabus. They are avoiding almost, I can say, 40% of the content. 40% of the syllabus they are skipping. Like for example, in the old scheme, like up to November 23 exams, we have a separate ICA material. If you look at that ICA material, if you recollect, there is a standard called 402. There is a standard called 402. 402 discussion itself is not there in the ICA book. So that time, many authors, by using judgment, depending upon their judgment, what are all points according to them important in 402, taken from the pronouncement and kept in the book. You're getting it? That time I discussed directly from the pronouncement book instead of risking it. Now in the institute book itself, 402 is fully in-depth explanation has been given. Except a few contents of the standard, most of the content is given under 402 from the pronouncement. Institute book itself is containing. SQC 220, for example, no more standards you take. SQC 220. Earlier in the previous ICA book also, SQC 220 discussion is not there. Old scheme ICA book, you see, there won't be a discussion on SQC and 220. So that time, brief discussion on SQC and 220 will be given in the old books. But now, that's an in-depth discussion that is there in the new ICA scheme book. Now when old scheme to new scheme transition happened, what many others did is they just upgraded their old book rather than developing a new book altogether. The right process to be followed so that books in the preparation of book the mistake can be avoided is from the scratch as per the new scheme material we should prepare. Especially there are so many chapters except some 8 or 10 chapters, except some 8 or 10 topics. Rest all other topics scratch to, like from the institute book you should develop that. Only then none of the concept will be missed. So this is one important observation you should keep in mind. So you follow whatever I'm going to cover, what are the concepts I'm going to cover. 99% if at all the material, your material contains a reflection of that concept, enough. You need not upgrade to any other book. And remember, stick only to one book. As already we are just 2 months away from exam, hardly 2 months. Now preferably don't change the book if at all you're already flexible with the book that you're following. If at all you have not yet started preparation, now after this session, like while we are going through this session, then you decide whether you need to upgrade or not. Getting it? So that's it. Now let's begin the session, Advanced Auditing Assurance and Professional Ethics. Inside this, directly I'll start with this first chapter called Audit Report. So here, if any terms comes, if any terminology comes, we have something called fundamentals also. We have something called fundamentals also. There, where we need to understand certain fundamental terms, without understanding which you can't understand the predominant portion of the audit syllabus. If you recollect, we have in the ICA book, chapter number 1 to chapter number 11. They are all dealing with standards. They are all dealing with standards, engagement and quality control standards. First chapter is the one which is dealing with quality control, but that standard is something that we should not read at first beginning. If you read at the beginning, you don't understand anything. So you need to read that standard, and there are 2 or 3 more standards that you need to read at last. The first to 11, they are all completely standards discussion. We totally have 46 standards. All these 46 standards, one is quality control, 45 engagement standards. All these 46 standards were discussed over these 11 chapters. And in the ICA book, there is another chapter called 19th chapter that deals with professional ethics. So these are the 2 main portions that we need to cover. And if you look at the weightage of chapter 1 to chapter 11 alone, the weightage will be close to 65 to 70 marks. The weightage will be 65 to 70. Only standards weightage I'm talking. All these 46 standards put together, the weightage will be close to 65 to 70. I'm telling on a minimum, this weightage is on a minimum level. As per the institute, it is minimum 45% to 55% of the paper. If you take an upper limit, it will be 75 marks. If you take a lower limit, minimum 55 to 60 marks. That's the minimum scale of standards. Then on the other hand, we have ethics, where you will have a weightage from 14 to 20. So if you are very strong in the standards and ethics, you are almost covering close to 80 marks of the portion, 85 marks of the syllabus. Rest all other chapters, entire other syllabus put together, the weightage is 40 marks. And that's how the paper is for 120. And out of it, 30 marks is for MCQ, 90 marks is for descriptive, within 90, 20 marks is choice. And if you look at the paper setting pattern, you will be given 30 marks MCQ and you will be given 90 marks descriptive paper. And out of this 90 marks descriptive, you will be having totally, I think 6 questions will be there. Not 6, in fact, yeah, 6 questions will be there. You are supposed to write totally 6 questions. And these 6 questions will have question number 1, for which choice will not be there. Question number 1 will not be having any choice. And remaining 5 questions will be there, out of which 4 you are supposed to attempt. So 1 plus 4, totally 5 multiplied by 14 marks is equal to 70 marks. This is how the weightage of the paper will be splitted. Now, in this 1 question choice will be the right. Within this, approximately 18 marks they will be asking. I mean, it may be within the choice question or other question, whatever it is. Within one particular 14 marks question, they will give another alternative 4 marks option. And somewhere in another option, they will give 2 marks alternative option. Or they will give 3 marks alternatives in 2 different questions. That's how they will give 20 choice. Now each question, if you see the composition of each question, question number 1, question number 2, question number 3, all that, if you look at the each question composition, suppose you see question number 1, it will have roughly 3 questions, 5 marks question, 5 marks question, 4 marks question. This is how the composition. Or another composition is 4, 4, 3, 3. This is how the maximum weight. These are the 2 models of composition of each descriptive question will be like. So either 4 plus 4, 3 plus 3, this is the weightage, or 5 plus 5 and 4. Generally, this is the weightage. Very rare. Sometimes what they do is 4, 4, 3, 3. Within this, they'll ask 2 plus 2. Within this, they may ask a 2 plus 2 question. And coming to the number of points, all that you are supposed to write. First, always write relevant answer. Whatever you know, don't write. Whatever is asked for that question paper, you are supposed to write. We write correct answer, but not for the question which is asked for. So, out of 4, 2 plus 2, if it is a 2 marks question, you are expected to write the provision and a simple conclusion. Provision, generally the provision size will also be 2 to 3 lines or 4 lines. Generally, the relevant discussion under the standard or the context, whatever it is, generally it will be 3 to 4 lines concept only, and conclusion will be 1 or 2 lines. So 4 plus 4, 3 plus 3. For a 4 marks question, generally you are supposed to write at least 5 to 6 relevant points. For a 4 marks question, at least you are supposed to write 5 to 6 relevant points. Generally weightage will be, if it is a 4 marks question, 1 mark for each point. I'll tell you how paper will be evaluated. What is the scheme of valuation? I'll gradually tell you, like how the weightage will be distributed within the answer. So this is how the question paper composition will be. So maximum a 5 marks question. So if a particular concept is so lengthy, you need not worry. You are not supposed to present entire that concept. In that subparts only will be asked. Entire concept they will not ask. Only subparts will be asked as a question. So that's about the paper, question paper, like how the question paper will be set, the composition of question paper, all that. So now let's begin this chapter called Audit Report. 13th question, the 13th page. So Audit Report. Now this is one of the most important topic which contains discussion of approximately 12 standards. Like if you cross verify with institute material, this material, the concepts will be shuffled here and there. In this book itself, I have given clearly the mapping with the ICA material. I have given table of contents. Like for example, what is the chapter number? This is the chapter name, chapter number as per ICA in the same order. In now, what is the topic covered in that book? Where in our material it is covered? So we have given a mapping of each and every concept reference. So you will get an idea whether we are covering 100% of the concepts or not. So like this audit report chapter is one of the fundamental chapter where we are discussing in our book covering 12 standards. Almost 12 standards will be there in audit report. For me, as per our whatever the material we are following, there are only 3 lengthy chapters. One is audit report, another one ethics, another one standards on auditing. We have a chapter called standards on auditing which will not be there in ICA book. In ICA book it will be there, gap, quality control, like that names will be there. Some 4 or 5 chapters put together is what standards on auditing chapter in our book. So those 4 or 5 chapters we merged into a single chapter. So anyhow you will see that in the book's initial, that's not an issue. In the index it is there, and even mapping also, all that we have given. Very fundamental chapter, very important chapter where you can understand remaining standards only if you understand this particular chapter. Without understanding this you can't. Even in the May attempt, they are asking drafting related questions. In the May attempt you see, they didn't ask you whatever the question you generally predict. They asked you draft an opinion section of the audit report, which I always highlight. Because they were either asked as an MCQ or asked as a descriptive. So they were asking, how do you draft an audit report with respect to 2 sections of the audit report? Don't worry, we'll discuss one by one. So don't expect the question paper is going to be like this, like that. No. Without expectation. Never think about result. First, look at this process, set right your process, set right your preparation automatically. Any question paper you can handle. Only easy question paper, anybody can handle. But if a question paper is tough, only few can handle. Prepare yourself like that. Prepare yourself to face the worst scenarios always. Don't expect everything will be smooth. So, we'll begin audit report. So, what is the objective of the auditor, by the way? The objective of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements or whether financial statements are prepared in accordance with applicable financial reporting framework and to report thereon. Correct? This is the objective of the auditor. So, 1 minute. So that's the objective of the auditor. So the objective of the auditor is to obtain reasonable assurance. We know very well why we obtain reasonable assurance. You might have studied in CA Enter because of inherent limitations of the audit. So that's the reason we only get reasonable assurance. Whether financial statements are free from material misstatements. What do you mean by financial statements? They are nothing but historical representation of economic resources of the entity and obligations of the entity over a period of time or changes therein. That's the definition. Components of financials are what? As per Companies Act, there are 5 components: balance sheet, P&L, cash flow, notes, and statement of changes in equity. So we need to give opinion on the financial statement. We need to obtain reasonable assurance on the financials. First of all, we have 2 types of financial statements. One is general purpose financial statements. Another one is special purpose financial statements. Special purpose financial statements are those which are prepared using special purpose framework. General purpose financials are those which are prepared using general purpose framework. Now, how to do audit of special purpose financial statements? We have some standards called 800 series. Actually, special purpose financial statements audit, how to do audit? We have total auditing standards that start with 200 series and end with the 800 series. The standards on auditing are from 200 series to 800 series. Now, out of which up to 700 series, predominantly they are discussing about general purpose financial statements. But that doesn't mean for special purpose financial statements, these standards do not apply. No, let's not interpret like that. Even 200 series to 700 series, whatever principles outlined in these standards, we can also apply to special purpose financial statements audit wherever possible. Now, then what is 800 series says? They are not talking about how to do audit of special purpose financials. They are talking about what special considerations you should keep in mind while auditing special purpose financials. So what are the special aspects you need to focus on? I think you might have studied something called suitable criteria, applicable criteria, acceptable criteria. So the standard 800 series talks about what are the specific points you should consider when we are doing audit of special purpose financials, when we are doing audit of single financial statement element of the financial statements or summary financial statements. When we are doing audit of, when we are reporting on summary financial statements. You see 810, that's not audit of summary financials, reporting on summary financials. We don't do audit because audit is already done. Audited financials are already ready. So entire special purpose framework related financial statements, if at all we are doing audit of those financial statements, those financials are called as what? Special purpose financials. These special purpose financials are prepared as per the requirement of a specific user. They are prepared as per a requirement of a specific user. When companies are going for mergers, generally the purchasing company want to look at the real position of the selling company, where purchasing company might be asking the selling company to prepare financial statements using some methods which purchasing company will decide. Not, I don't want your gap financials. Of course, I take them. I take just like any other user, I also look into that. But these financial statements will not contain so much of sensitive data belonging to the company. So I want to see whatever sensitive data. I want to see some various analysis. So please prepare for me exclusively a separate financial statements. I will give you the rules and regulations, and that framework is called as what? Special purpose framework. And if the financials are prepared using that framework, that's called as special purpose financial statements. Then what is general purpose financial statements? If the financial, it is nothing but general purpose framework. General purpose financial statements are prepared in accordance with a general purpose framework. If the financial statements are, you're all okay with this flow? Clear? Yeah, if the financial statements are prepared using general purpose framework, we simply call it as general purpose financial statements. General purpose framework is nothing but it's a financial reporting framework. What is it? It's a financial reporting framework which is designed keeping in mind various varieties of users. keeping in mind wide needs of users. What needs of the users? Financial information needs of the users. The financial statements which a company annually prepares, where they prepare the financial statements. Tell me, when everybody is asking you what business you are doing, like generally what are the questions, like if you are telling anyone that I'm doing so and so business, what are the questions generally people ask? What business you are doing, how much capital you invested, where and all you invested, how much revenue you are generating, what are the expenses, and what is the profit, or are you making loss? And right now, what is the position of the company? What is the performance of the company? Generally, this is what everybody asks about the business, right? Whether it's an insurance company, whether it's a banker, whether it's a government, or a shareholder, or investor, prospective investor, or my employees, or debtors, whoever it is, they want to know these common data about the company so that whether they can continue transacting with the company or not. These are called as financial information needs. What are they? Financial information needs. Which financial information needs general purpose framework generally addresses? Common financial information needs. What are they? Common financial information needs are what general purpose framework addresses. General purpose framework will not keep in mind any one particular user. Specific user, he want to know something about the company. No, I will not give that data. I will give common needs of the users. That data I will give you. Since public at large is interested in general purpose financial statements, lawmaker will generally involve in designing this framework. That's why we have Ind AS. That's why accounting standards. That's why we have Schedule 3, all that. Because these are all applicable for which financial statements? General purpose financial statements. Because the format is, these financial information is going to be used by thousands of users. Now, this general purpose framework or special purpose framework based on presentation, it is again subclassified into two categories. Based on presentation of information, it is again subclassified into two types. Fair presentation framework, compliance framework. What is it? Fair presentation framework, compliance framework. Compliance framework means you just have to comply with the framework. That's it. See, both are financial reporting frameworks. This is a financial reporting framework. This is a financial reporting framework. What is a financial reporting framework? Framework means rules and regulations. Financial reporting means preparation and presentation of financial statements. Financial reporting framework refers to what? Prepare rules and regulations for preparation and presentation of financial statements. That's called financial reporting framework. Correct? So, if at all the rules and regulations are drafted in such a way that you have to prepare financial statements exactly as per the rules, you cannot deviate, whether they are true and fair or not. Whether the rules and regulations result in fair presentation or not, whether rules and regulations are drafted in such a way, they may result in fair presentation, they may not result in fair presentation, irrespective of the result of the framework. Irrespective of the result of the fair presentation, if at all you have to blindly follow the rule. That is how the rule and regulation is drafted, and that is how you have to prepare the financial statements. We call such a concept of framework as what? Compliance framework. Suppose rules are given in a way that explicitly they are permitting you to deviate. If the rules are drafted in such a way that explicitly you are permitted to deviate, why are you deviating? To achieve fair presentation. Why are you deviating? To achieve fair presentation. For example, a simple layman example we will take. Suppose, Ind AS 24, related party disclosures. Okay, in that, there is a, for example, there is a disclosure related to transactions with government entities by government entities. Transactions with government entities by government entities. In Ind AS 24, different government entities that are owned commonly by government, they are all related parties. But you need not specifically disclose. What are the transactions you did with them. What is the outstanding balance that is there available with them. You need not disclose, though they are related parties. Even if you look at 550, related party definition as per auditing standard, there is an exception. There is a point which says that entities that are under common control by a state, entities that are under common control by a state, by a government, they are not treated as related parties. Ind AS says it is treated as related party, but no need to require any disclosure. However, in the Ind AS 24 itself, they said one more point. Any significant transactions with the government entities there, please disclose it. Or multiple transactions you did with various government entities, collective effect and quantitative disclosure you give. Collectively, you give a qualitative and quantitative disclosure you give. Now you see here, they are specifically, first of all, they are saying no need to give any disclosure. Now, you cannot straight away say, no, though we are related parties, you cannot straight away say that we are not interrelated. For fair presentation, are there any significant transactions that we entered with another government department? Because they are anyhow at the end of the day related parties. Generally, transactions will not be happened at normal market terms and conditions, correct? Because we are related parties, government entities, transactions will happen at a different terms for sure. So, to achieve fair presentation, to show the real picture of the company, to show the real intent of the transaction, you are supposed to show significant transactions, even if Ind AS is silent. Even if Ind AS is silent, you must show. If at all you are considering the needs of the users as the ultimate priority, what information is useful for him, let me give that information. Whatever method is suitable, let me use that method, not what standard says, not what regulation says. I will try to follow the law and regulation as much as possible. But if law and regulation is not resulting in fair presentation, by following the law, by following the regulation, by following the framework, if at all I will not get fair presentation, if the particular law under which I am preparing financials, if the particular framework under which I am preparing financial statements, if that framework explicitly allows deviation for achieving fair presentation, then that framework is called as fair presentation framework. If at all that framework explicitly or impliedly permitting me to give additional disclosures beyond the requirement of the framework, then also it is called as what? Fair presentation framework. You see, that's why fair presentation framework definition will have explicitly or impliedly contains disclosures beyond the requirement of the framework, or explicitly permitted to deviate from the requirement of the framework so as to achieve fair presentation. They use this word explicitly, implicitly, which many students don't understand the context of the discussion. Are you clear? Generally, can I deviate from an accounting standard? Yes, you can deviate only if it is explicitly permitted. Can I give additional disclosures? Whether explicitly it is permitting or it is silent, impliedly, you can give additional disclosures. For giving additional disclosures, no restriction. Explicit requirement may not be required. When you are not supposed to give additional disclosures, if the framework specifically prohibits it, if the framework explicitly prohibits giving additional disclosure, then you are not supposed to give additional disclosure. If there is no prohibition like that, you can give additional disclosures by default, no problem. So that's fair presentation framework. Understood? Now, what is it? Whether the financial statements are prepared in accordance with the applicable financial reporting framework. Applicable means what? We need to check whether the financials, if it is general purpose, whether they are prepared as per general purpose frameworks. I need to check. If it is special purpose, I need to check whether they are prepared as per special purpose framework. That's it. Correct? Now, one more way of one more assurance what you should get, whether the financial statements are free from material misstatements, whether they are free from material misstatements. Misstatement means what? Misstatements can happen in 4 different ways. It can be in amount, it can be in classification, it can be in presentation, it can be in disclosure. Misstatement can happen in 4 different ways. Difference between amount, classification, presentation, disclosure that is reported in the financial statements, and amount, classification, presentation, disclosure that is required as per applicable financial reporting framework. That we call it as what? Misstatement. How a misstatement can happen in amount? In amount, misstatement can happen in, like for example, inventory valuation itself you take. Suppose company has to value inventory at cost or NRV, whichever is lower. We can take accounting estimates, all that. But instead of taking that complex example, basic example I'm taking always, a classic simple example. Inventory has to be valued at cost or NRV, whichever is lower. But the company ignored NRV principle. The company ignored NRV. They only valued at cost. Technically, they are supposed to value at NRV. So what they reported in the financial statement item, cost they reported. As per applicable framework, what they are supposed to report, cost or NRV, whichever is lower. If the difference is material, then the difference is first of all called as misstatement. Whether it is material or not, we'll discuss later. So the difference is called as what? Misstatement. Now another way of misstatement can be classification. Investment property. Suppose a company purchases a land and building. By default, land and building is not fixed asset. You need to look at the intention behind the land and building. Is it purchased for office purpose, factory purpose, for what? If it is not for that, for rental purpose you purchased, for investment purpose you purchased, then that comes under investment property. You should classify it as an investment, not as a fixed asset. If at all you wrongly classify it as a fixed asset, or a fixed asset wrongly classified as an investment, it will result in interpretations, ratio analysis, decision making of the users. The way the decision making of the users will vary depending upon, because they will compare asset turnover ratios of multiple companies, and they will see which company's operating cycle is very fast. They will do asset turnover comparisons and all. Which company is frequently rotating the assets, rotating, like how much they are generating turnover. So accordingly they decide which is an efficient company, which is not an efficient company, all that. In order to properly interpret this classification must be proper. Getting it? Then another way mistake can happen is presentation. Presentation means, we all know, for example, you say revenue from operations. Revenue from operations, which is there in the profit and loss account. How you should present that in the notes to account? You should present revenue from operations in the notes to account in 3 ways. Revenue from goods, revenue from services, and any other operating revenue. Correct? Revenue from services, revenue from sale of goods, revenue from sale of services, and any other operating revenue. This is a presentation requirement for the revenue from operations that you showed in the main profit and loss account. If you do not follow this presentation as it is, then that's a misstatement in presentation. That's a misstatement in presentation. Then misstatement can be in the form of disclosure. For example, Ind AS 24 says significant transactions with the government entities you must disclose. The company is not disclosing. That's a misstatement in the form of disclosure. So what you ultimately reported in the financial statements, what is required as per the framework, if there is a difference between what you are supposed to do and what you actually did, if there is a difference, we call it as what? Misstatement. Simple. With this, fundamental discussion is over. Now let's begin into the audit report the discussion. So in this audit report, we are learning the chapter objective is very simple. Once you completed this chapter, you must understand how to prepare audit report. If you don't understand how to prepare audit report, even after reading this chapter, means you didn't understand this chapter. That's it. So how to prepare audit report? So that's the objective of the chapter. Like audit report, like any other report, any letter will have a structure, right? The same way, audit report is also having a structure. Like there will be a title. There will be a title for the report. What should be the title of the auditor's report? Independent Auditor's Report. The title must be Independent Auditor's Report. You cannot use some other title. Independent Auditor's Report. If at all the report is on whether it is general purpose financials or special purpose financials, in both the cases the title remains the same. Next, addressee. Next one, addressee. One important point I want to clarify at this moment. If you look at 800 series, in that also audit report format is given. That format is different from this format. 800 series, the format is different from this format. Until 17-18 financial year. Until 17-18 financial year. Even under SA 700, there is another format of audit report which is same like 800 format. Like in 800 format, if you see, first they talk about introductory para. Then they talk about responsibilities of management. Then they talk about responsibilities of auditor. Then they talk about opinion. Then basis for opinion first. Then opinion section. Then emphasis of matter, other matter paragraph. Like that will be there. So opinion section will be somewhere in the middle of the report. Basis for opinion is above the opinion para. That's the old format of audit report. 17-18 financial year. Even in 700 also the same format is there. Now in 18-19 financial year onwards, the audit report format has been revised, where the first paragraph in the audit report is what? Straight away opinion. The second paragraph is what? Basis for opinion. This format has been revised. Now even this format, latest format, whatever we are following in 700 is also implemented in 800. But for November 24 attempt, the same old format is applicable, because for November 24, whatever study material they gave you, applicable study material, that only contains old format. New format is not there. Are you clear? So if you look at ICI notifications, 800 series new standards were released. 800, 805, 810. Those standards will not apply for November 24 exams. Whether they are applicable for May 24 or not also, ICI has not given any clarification. Right now we discussed 800 series in the same old format. Even in a regular class for May 25. If at all ICI comes up with a supplementary material saying these are the structural changes that you need to make a note, then we will just revise that. You are getting it? So title, what is the title? Independent Auditor's Report. Addressee, generally addressee is who? In case of general purpose financial statements, the members of the entity. In case of special purpose financial statements, generally the appointing authority. Whoever have appointed you, that authority. Opinion section, the first and foremost important thing is opinion section. We know that, see, there are broadly two types of opinions: unmodified opinion, modified opinion. What are they? Unmodified opinion and modified opinion. There is another discussion called unmodified report, modified report. There is another discussion called unmodified report, modified report. What is unmodified report, modified report? I'll discuss later. Because in summary financial statements and all, unmodified report context is used. People generally confuse with unmodified opinion. No, unmodified report is different, unmodified opinion is different. Unmodified opinion means dealing with only opinion para. Unmodified report dealing with the total format. The total format of the audit report. Unmodified report is different. Modified report is different. Modified report may contain unmodified opinion. Remember this. Modified report may contain unmodified opinion only. Getting it? But we are modifying the report format. We are modifying the report format. That we will discuss later. When the time comes, that time I'll tell you. So, opinions are broadly two types. What are the opinions? Opinions, yeah. Modified opinion, unmodified opinion. Suppose I am the auditor of the entity and I have been appointed to verify whether the financial statements are true and fair or not. Remember, in most of the standards, in our entire standards discussion, we are discussing preparation and presentation of financial statements as per fair presentation framework. We are discussing all the auditing standards in the context of fair presentation framework, that too in the context of general purpose financial statement. This should be one of the fundamental assumptions that you must keep in mind. So whenever you are reading all the standards in auditing, we are reading it from the context of general purpose financials and fair presentation framework. What about special purpose financials and compliance framework? These 2 points we should keep in mind when we are doing 800 series. So these 2 points we should keep in mind when we are doing 800 series. From 200 series to 700 series, we are understanding the subject from the context of general purpose financials, which are prepared using fair presentation framework, where true and fair is ultimate importance is given, where fair presentation will be given ultimate importance. So unmodified opinion. So I have verified the financial statements. I have been appointed as an auditor. I issued engagement letter. I obtained acceptance letter, all that appointment, everything, formalities and all. I saw all the formalities, whatever is required under professional ethics. Yes or no? You have clause number 9. Auditor has to ascertain whether he has complied with the provisions of the Companies Act. Correct? So all that I ascertained and then accepted the audit of the company. And moreover, one more thing, we are discussing audit from whose context? Company entity point of view. Technically, all these standards are applicable whether you are doing audit of a partnership firm, audit of a sole proprietor, audit of a company, any entity you are doing audit. These standards are common, but we are discussing the audit provisions from the context of company, because that is the way, that is where public interest is generally involved. Yes or no? So I verified the financial statements. I conducted audit for some 50-55 days, almost 10 to 20 team members, where we spent more than 500 to 1000 man days. Totally we spent, and like we are at the conclusion stage. We identified we verified all the aspects of the financials, like we verified assets, we verified liabilities, we verified incomes, we verified expenses, we verified going concern aspect, we verified so many things, and finally concluded that whatever the financial statements board of directors want to publish, whatever the financial statements board of directors want to publish, the draft financials are already given to me. That this is a draft, sir. Once you are okay with this, tell me, we will publish. The draft financial statements, when I see, I felt they don't require modification. I felt they don't require any modification. What do you mean by don't require any modification? They are true and fair. They are true and fair. They are completely true and fair. Therefore, my opinion also will be unmodified. My opinion will also be unmodified. What if the financial statements given by the board of directors contains so many mistakes? What if They contain so many mistakes, like some amounts, classification, presentation, disclosure. Directors have to change it. I immediately told them, sir, you have to change these and all. These are all misstated. This will mislead the people. People will take a wrong decision based upon this. This is giving a wrong picture about the company. Board of directors said, no, sir, I will not change. This is already finalized. We just have to approve it. We just gave you draft financials just for your reference. No, we don't want to change. Means, according to me, the financial statements which require modification, they are not modifying. Which means I will give modified opinion. Okay, you don't modify the financials so that I can give unmodified opinion. No, he is not ready to modify. I will give which opinion? Modified opinion. Now, unmodified opinion will be given by the auditor. If at all auditor has obtained sufficient and appropriate audit evidence that the financial statements are true and fair. That the financial statements are true and fair. More clearly speaking, if the auditor has concluded based on sufficient appropriate evidence that financial statements are prepared in accordance with the financial reporting framework, then auditor will give unmodified opinion. When we will give modified opinion, two circumstances I will give modified opinion. If I conclude based on sufficient and appropriate audit evidence, if I conclude based on sufficient and appropriate audit evidence that financial statements contains misstatements, like nothing but if I concluded based on sufficient appropriate evidence that financial statements are not free from material misstatement, then I will give modified opinion. Second scenario, suppose if I have to conclude, are they right or wrong? You must give me so much of information. Management has to give me information, whatever I ask, background information, because the financial statements are containing so many assertions. You are asserting so many. The directors are asserting so many in the financial statements. So I want to know whether these financial statements are the true and fair or not. I am asking for information. So many places they are unable to show me the data. Since they are unable to show me the data, can I say that is wrong? Can I say the company is presenting misleading picture? No. Or without data, can I say they are true and fair? No. People will, the regulatory and all will punish me if I don't verify. Yes or no? Recent cafe coffee day, you see the fraud. The auditors have not verified. Significant transfers between related parties, which resulted into a fraud of so many crores. So they didn't verify that. So non-availability of evidence or non-verification of the information that happened somewhere in 1819 resulted in punishment in 24-25. You're getting it? So 1819 the audit is related to performed by KPMG. Now it was punished. 2 firms were banned. 10 crore penalty was levied. So if you are not getting information, you cannot give opinion. Yes or no? Suppose depending upon the severity, we'll discuss what exactly to be done. If you are unable to obtain, when you will modify, if you are unable to obtain sufficient appropriate evidence, then also I will give modified opinion. If I got the evidence and I have a proof that it is not free from misstatement, I will give modified opinion. If I am unable to obtain evidence, then also I will give modified opinion. These are the two circumstances where I will give modified opinion. Unmodified opinion is also called as clean opinion, which is also called as unqualified opinion, If the financial statements, they are showing too worst, the company performance is worst, huge losses, the position is worst, but they honestly disclosed everything. They accounted everything correctly. They showed their assumptions, business plans, everything honestly. Tell me which opinion I'll give. Unqualified opinion. Unqualified opinion means the financial statements information is true and fair. You can trust it, don't worry. Modified opinion means the financial statements are not showing true picture. Do not trust it. That is the meaning. Getting it? Now, again, this modified opinion, we are having 3 types. What are they? Qualified opinion, adverse opinion, disclaimer of opinion. Qualified opinion, adverse opinion, and disclaimer of opinion. Qualified opinion is given in 2 circumstances. Why modified opinion is given in 2 circumstances, right? Yes or no? Qualified opinion will also be given in obviously 2 circumstances. Tell me one circumstance. Evidence is available. You have obtained sufficient appropriate evidence and you concluded financial statements contains misstatements, but and the misstatements are material but not pervasive. The misstatements are material but not pervasive. You have obtained sufficient appropriate audit evidence where the auditor shall express a qualified opinion. The auditor, having obtained evidence, concluded that misstatements are material. Misstatements, how do I consider? Should I consider only individually or should I consider only aggregate? Either individually or aggregate of insignificant individual misstatements. Individually, if at all materially misstated, then also you'll give modified opinion. Suppose individually it's small, but aggregate of the misstatements are material. For example, if the mistakes which I find so many are less than performance materiality level, but aggregate of mistakes are exceeding performance materiality level, I conclude that aggregate of mistakes are more than material level. Therefore, it is treated as materially misstated. Either individually or aggregate, they are material, but not they are not pervasive. What do you mean by pervasive? Pervasive means all the elements of financial statements are affected. It is not one element. All the financial statements elements are affected. Or there can be a circumstance where only one element is affected. But that one element is not just significant. It is substantial. What is it? It is substantial. There is a difference between material and substantial. Material means it's of course significant. Substantial means beyond material. So generally, when do I say pervasive? When we will say pervasive? In auditor's judgment, the effect of an event, on the financial statements, we consider it as pervasive when the effect is not related to a specific element. It is not related to a specific. Means, what does it mean? Not related to specific means what? It relates to multiple elements in the financial statements. Then we call it as pervasive. Or if so limited to a specific element. If so limited to a specific element. In such a scenario also, when do we say it is pervasive? Even though it is a specific or single element. If that single element is a substantial portion. Suppose a company prepared standalone financial statements, only investment, whatever the investment alone contains a material misstatement, but that investment value is 90% of the net assets value of the company. That investment value is what? 90% of the total assets of the company, net assets of the company. That value itself is completely materially misstated. Though it is a single item, remaining inventory, current assets, fixed assets, liability, everything else is right. But look at this quantity. It is 90% of the asset. Therefore, it is pervasive. Therefore, the misstatement is deemed to be pervasive. If at all, it is less than 90. Or misstatement you found in a single or multiple elements, but as a whole, they are just a material, but not pervasive. Then we will give which opinion? Qualified opinion. You have obtained a sufficient appropriate evidence that misstatements are material, but not pervasive. Or you are unable to obtain sufficient and appropriate evidence and concluded that when we don't get evidence, how do we analyze generally? When we don't get evidence, what should be our thought process? Okay, evidence is not there, fine. Should I give opinion without even considering evidence? No. First check. What if this is completely wrong? What if this is completely misstated? What if means, am I talking about reality or possible effect? What is the possible effect of? Is there a misstatement which I detected? No, undetected misstatement. What is it? Undetected. What is the possible effect of undetected misstatements on the financial statements will be? If I do not get evidence, I will think about what? I will think about possible effect of undetected misstatement, if any. If it is material but not pervasive, then also I'll give which opinion? Qualified opinion. Yes or no? So, if at all the auditor is unable to obtain sufficient appropriate evidence and determined that the possible effect of undetected misstatements on the financial statements could be material but not pervasive. Suppose I got evidence right, first scenario, and I found a misstatement right, and the misstatement is material but not pervasive, so I gave qualified. What if the material is pervasive? What if the misstatement is pervasive? I will straight away give adverse opinion. If the mistake is material and pervasive, I will give which opinion? Adverse opinion. Suppose I am unable to get evidence. You are unable to get an evidence not for material alone. For a pervasive item, you didn't get evidence. Pervasively, you didn't get evidence. How can you give opinion? Suppose a mechanic brought a bike and car and asking you, how is this car and bike? Everything is good except engine. How come you say that's a substantial portion, right? If at all, the substantial portion of the financial statements, if the substantial portion of the financial statements, you are not getting evidence. You are not getting evidence for multiple elements which represent substantial or single item which could be substantial. You are not able to get evidence for this. Then I will not give opinion at all. Substantial portion, I don't know. I don't know whether it is right or wrong. How can I give opinion on the remaining portion? I have to give financial statements opinion as a whole. Yes or no? Tell me, we should give opinion as a whole, right? We should not give opinion, okay, purchases is true and fair, sales is not true and fair. I cannot give like that. I should give opinion as a whole. If I have to give opinion as a whole, predominant portion, I am not getting evidence. If I am not getting evidence on predominant portion, I am not in a position to say whether they are right or wrong. In such a case, what I do? Disclaimer. What I will do? Disclaimer of opinion. Yes or no? When the possible effect of undetected misstatement, when the possible effect of undetected misstatement is material and pervasive. You know, when it is adverse opinion, how the wordings will be? When the effect of the misstatement is material and pervasive. If you have an evidence, you can talk about the reality, effect of it. If you do not have evidence, you talk about an imaginary situation called possibility. Understood or not? When the word possible effect will be used in case you do not have evidence. When the word actual effect is used when you have an evidence. That's how the definitions were framed. Qualified opinion, adverse opinion, disclaimer. So qualified opinion will be given in two circumstances. Adverse will only be given in one circumstance. Disclaimer will only be given in one circumstance. That's why the definitions of adverse opinion, qualified opinion are just a single line, single para. Whereas qualified opinion will have 2 points. Are you clear? Now tell me, do we give a disclaimer of opinion? No, we generally give it in rare circumstances which involves multiple uncertainties, and due to their potential interaction, due to their possible effect on the financials, generally rarely the auditor consider expressing disclaimer of opinion. And in 705 you have a requirement. Whenever you want to give a disclaimer of opinion, just like that you can't give a disclaimer of opinion. If at all you are unable to obtain, if at all the auditor is unable to obtain sufficient appropriate evidence due to management imposed limitation after the auditor has accepted the audit. After you accepted the audit, management is restricting you to give information. They are not cooperating you. Then what you have to do? Request management to remove the limitation. Try to cooperate. Try to resolve the situation amicably. Discuss with the management. You see, you know, the auditor shall request the management to remove the limitation. If management refuses, means they are not listening to you, they are not ready to cooperate to you, then communicate the matter to audit committee. Those charged with governance means what? Audit committee. Beyond the board of directors, whoever is there, they are those charged with governance. If in a company beyond the board of directors nobody is there, then board of directors are those charged with governance. In some entities, those charged with governance and management both are one and same. SCA 260 standard introduction contains who is, what do you mean by those charged with governance? Those charged with governance means what? Those who are having authority, those who are having accountability, both. In an organization, who are having authority and who are also accountable for the affairs of the entity. People who are accountable and having authority, these people are generally treated as what? Those charged with governance. In a company form of organization where there are some 3-level management is available, low level, middle level, top level, who are having accountability, ultimately top level management. They have authority, they have accountability, they constitute those charged with governance. 260 says, why you have to interpret? Ask the appointing authority, who is those charged with governance? They will tell you. Are you getting it? Next, suppose, so I will discuss with those charged with governance that there is a limitation, all that. Even, and I will try to perform, I will try to get the evidence alternative ways if possible. Alternative, suppose no, companies restricted me, sir, you should not send external confirmation, 505. They're asking me, don't send external confirmation at all. We already have some disputes with the vendor or creditor, customer, whoever it is. Negotiations and all going on. If you suddenly send a confirmation request, it will affect our negotiation process. So don't send confirmation request, they are saying. I asked reason, show me proof. Nothing is showed. Means management is restricting me to obtain evidence through external confirmation. I felt management is not reasonable. And I tried to look at whether creditor balance, debtor balance on balance sheet is correct or not. I tried to verify subsequent receipts like that. Alternative. Subsequently also nothing is there. So I am unable to apply alternative procedures also. I am unable to apply alternative procedures also. Ultimately, I end up with a situation where there is no evidence. Alternative procedures also unable to perform. And top management is not, they are limiting my power. If at all, the possible effect is material but not pervasive, I will give qualified opinion. If the possible effect is material and pervasive, I will withdraw first. What is it? I will withdraw from the audit where permitted. I will withdraw. If at all the auditor concluded possible effect is both material and pervasive, withdraw from the audit where practicable and possible. If at all withdrawal is not practicable, disclaim the opinion. When withdrawal is not practicable, when it is not permitted, for example, you have SEBI LODR regulations, listed entities, where they say just like that you can't resign. We have this SEBI regulations, LODR regulations we have. What the LODR regulation says, if at all an auditor of a listed entity want to withdraw within 45 days from the end of the quarter. See, if you want to withdraw before the quarter completion, shall we withdraw? Happy. But once quarter gets completed, which quarter? Any quarter. Q1, Q2, Q, don't apply that. You suppose auditor want to resign on 20th July. Before 20th July, which quarter completed? 30th June. Are you wanting to withdraw within 45 days from 20th June? Yes. Give report for that. Give limited review report for that quarter and then resign. Suppose you want to withdraw after 45 days from the end of a particular quarter. You want to withdraw after 45 days from the end of a particular quarter. I want to resign on August 20. August 20, before August 20, which quarter got completed? June 30. From June 30 to August 20, what is the duration? More than 45 days. Therefore, I want to withdraw more than 45 days from the end of the June quarter. In this case, in this example, based on the date. If you want to withdraw after 45 days from the end of a quarter, you should give review report for that quarter and the next quarter. And an auditor who has given review report for 3 quarters must give annual audit report also. Which means, if a company is limiting you, where you already gave one, you want to withdraw at this moment, you cannot withdraw just like that before you give review reports as per the LODR regulations. Are you clear? So that is what called as where withdrawal is not permitted or possible immediately. In that case, now I have to give report. What should I do? Our evidence is not there. They are asking me report. What should I do? Then I will give disclaimer of opinion. Then I will give what? Disclaimer of opinion. Disclaimer of opinion means what? Not expressing the opinion. We do not provide an opinion on the aforesaid financial statements. So not providing opinion is called as what? Disclaimer of opinion. Clear or not? Now just a minute. Is this flow okay for everyone? Yes. So that's about opinion, different types of opinions that we understood. Now, how to draft these opinions? How to draft these opinion sections alone? Remember, I'm still discussing only one element of the audit report. Title we understood, addressee we understood. How to fill the title, how to fill the addressee. Now, how to make the opinion? So just to recollect, if at all you're having pronouncement book, later on you just watch pronouncement book after based on this understanding. First opinion section, right? Opinion section will have two paragraphs. Opinion section will have 2 paragraphs inside that. See, actually, title, addressee, opinion, basis for opinion. These are all sometimes referred as paras in the audit report. or more accurately, these are referred as sections in the audit report. Opinion section, basis for opinion section, key audit matter section, like that. Opinion will have two subparas inside that. First para is like an introductory para. First para is like introductory. Who are you? First you should tell. No, people don't know. We have audited financial statements of so and so entity comprising balance sheet, P&L, cash flow statement, which are prepared as per GAAP, which are prepared as per Companies Act, like that. Something you should give, reference you should give. You should tell what you did. We have audited. Yes or no? Then second, this section is actually what? Opinion section. Talk about your opinion. In our opinion, to the best of our information, according to the explanation given to us. In our opinion, to the best of our information, according to the explanation, no other negative things. The aforesaid financial statements are true and fair. The aforesaid financial statements are giving true and fair performance and position of the company in the manner so required, as per applicable financial report, as per applicable financial reporting framework. That's it. No, nothing, no nuisance. Simple, plain, clean opinion. Correct? Suppose if you are giving qualified opinion. If you are giving qualified opinion, I think it is better for me to take that. Just a minute, direct I'll download it. So if you open final book, in auditing and assurance, you have module 3 open. At the last pronouncement link is given. Inside that we have to download two standards. One is 700. One is 700. Just this discussion alone I'll complete and then we'll go for a break, okay? So like the opinion paragraph I'll directly show you briefly. So you see, what is this actually? Title, there is a title called Independent Audit Report to the members of the entity. Then this first paragraph in the audit report is what? Opinion. And sometimes you may have to talk about regarding which financial statements this audit report is dealing with. Suppose the company which you are doing audit is preparing both consolidated financials and standalone financials. You may have to give opinion on both. You may have to give a report. You should give report on both standalone and consolidated. So in that way, in such a case, this report is dealing with what? So this report is dealing with the standalone opinion. We have audited all that matter. In our opinion, to the best of our information, according to the explanation given to us. See, this is a reasonable assurance clause directly. In case of reasonable assurance, you should give like this drafting. So, to the best of our information, according to the explanation given to us, the aforesaid financial statements give information required by the Act in the manner so required and give a true and fair view in conformity with GAAP accepted in India of profit, all that. Getting it? Now, look at SA 705, for example. So inside this, we have some illustrations on qualified opinion and adverse opinion like that. You see how qualified opinion will be given. Here what happened is company, some inventory is there that is materially misstated. It is supposed to value at cost or NRV, whichever is lower, but the company valued only at cost. That's the reason. But first you see opinion section, same title, Independent Audit Report to members of the company, side heading itself reflecting what opinion they are giving, qualified opinion. Now, in the second part, you see, in our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements give information required and giving a true and fair view. Qualified opinion also is a positive opinion, but it's a conditional positive opinion. That's why it's called qualified opinion. Qualified means what? I have a reservation, I have a remark in that. Getting it? So what are they saying? In our opinion, to the best of our information, according to the explanation, the aforesaid financials are true and fair, except for effect of the matter described in basis for qualified opinion section. Here they are saying effect of the matter. What does it mean? Evidence not there, evidence there, but misstatement found. Evidence is there, misstatement found. That's why it's called effect. Suppose evidence is not there, misstatement is not found, but material but not pervasive, then possible effect of the matter. They talk about what? Possible effect of the matter. They'll give you MCQ. They give a situation of not evidence is not found. What should be the suitable opinion paragraph draft? Option A, B, C, D. They exactly give here possible effect word. One option they'll have just effect word. Another two options will be with a different terminology. Unless you observe this, you can't make a mark in that. You're clear. So, except for the effect of the matter. What is the matter? There is a matter except that effect. What is it? It is described in basis for qualified opinion section. Where it is? Here itself. In our report, no, there is another section, basis for qualified opinion section. Except the matter described there, the aforesaid financials are true and fair. That's it. Now you see, adverse opinion. How they give adverse opinion? Here adverse opinion is given due to material misstatement. Misstatement means effect only, right? Yes or no? Misstatement means effect of the matter. Same you see, report to the title, title addressee. Adverse opinion, side heading itself will contain. Straight away you see, in our opinion, to the best of our information, according to the explanation given to us. In our opinion, to the best of our information, according to the explanation given to us, negative words directly. The accompanying financial statements do not give true and fair view. They are straight away saying they're not true and fair. Why? Is there any exception? No, not exception. So many were there. Because of significance of the matter discussed in basis for adverse opinion section of our report. Because of the significance, we are giving this adverse opinion. Clear? Now let's see disclaimer of opinion, how it looks like. Opinion section alone I'm showing the remaining contents I'll show next in the when I started them. Disclaimer. You see disclaimer. In qualified opinion, adverse opinion and unqualified opinion, the opinion pair side heading opinion. Unqualified opinion means side heading is simply opinion. Qualified means qualified opinion, adverse opinion. Disclaimer means disclaimer of opinion. Correct? Now, in all the three opinions, no, you are actually giving opinion. Unqualified means you are saying they're right. Adverse means you are saying they're wrong. Qualified means everything is right except so and so. You are giving an opinion. Disclaimer means you are not giving opinion. When you give disclaimer of opinion, when there are multiple uncertainties, when you concluded that you cannot get evidences, when you have not got the evidences, have you audited? No. So we were engaged to audit. What is it? We were engaged to audit. Whereas in the remaining paragraphs, we have audited. Here it is, we were engaged to audit. We didn't audit. That's why I'm giving disclaimer of opinion. We were only appointed as an auditor. We have not audited. Yes or no? Straight away. We do not express opinion. Straight away we say we do not express. In our opinion, we don't have opinion. No, not like that. So we straight away say we do not express opinion. Why? What happened? Because of significance of the matter described in basis for disclaimer of opinion section of our report, we have not been able to obtain evidences to provide a basis for the opinion. In order to give an opinion, we must have some basis. That basis we didn't obtain. Why we did not obtain? Sufficient appropriate evidence. That's it. Opinion discussion over. Understood? All of you? Then we need to start about basis for opinion. Then we need to discuss about basis for opinion. If these two sections of the audit report is completed, major audit report chapter is over. Major discussion in the audit report will be over. In the sense, contents of the audit report, major discussion will be over. Only these two sections takes little time. Then the next section that will take little more time is going concern. Another section that takes little time is what? Going concern. That's it. Are you clear until now? Shall we take a break? Or continue? Okay, continue. We'll take after half an hour. Basis for opinion also will complete and then we'll take a break. Yes. So, basis for opinion. What is basis for opinion section? Basis for opinion means what? What is the basis on which you gave this opinion? They're asking you. People don't want to see you are giving after opinion. I want to know on what basis you gave. Only then I will trust your opinion. Because the basis upon which you give opinion, maybe for you, you arrived that opinion on that basis. Same basis, if I know, I may not conclude the same opinion. So I just don't want to know your opinion. I want to know on what basis you gave this opinion. So that I will interpret my own. I will take my own decision accordingly. Yes. So basis for opinion. You see, basis for opinion section. What are they saying? Suppose this is unqualified opinion. Unqualified opinion, what basis will be there? See, if I gave a qualified opinion, I can say there is a misstatement. Adverse opinion, I can say something is wrong. For unqualified, what is the basis? Very simple. I conducted audit as per standards on auditing. We are independent of the company. We have obtained sufficient appropriate evidence to provide a basis. We have obtained sufficient appropriate evidence to obtain a basis. And in between, we also say that we have complied with, we are independent together, and we have fulfilled our responsibilities. We have fulfilled our responsibilities as per code of ethics. So if you are asking me what is the basis, I did audit as per standards. As per the standards, there are so many responsibilities are there. You want to know about responsibilities? In our report, there is a separate section. Auditor responsibilities for audit of financial statements. There is a section. Go to that section, see what are all my responsibilities. For me, they are as per standards. I cannot sit and explain here itself all the responsibilities. If you want, go there and then read. As per those responsibilities, I fulfilled. That is how I gave an opinion. That's the basis. Are we telling the people like how we do audit or not? Yes or no? Yes, sir. Suppose no, I gave qualified opinion. I gave qualified opinion. And I'm telling as it is like this. Will people accept? They want to know exactly where the mistake, right? Yes or no? They want to know where exactly the mistake is. So, in basis for opinion, if at all you are giving qualified opinion, basis for opinion will have the standard discussion. We conduct our audit as per standards audit, that will be there. But in addition to that, specifically you have to explain why you gave qualified opinion. Why you gave qualified opinion, you have to specifically explain. In this example, the company inventory in balance sheet is carried at 100 crore. The management has not stated inventory at lower of cost, whichever is lower. If at all, you see here, but stated only that at cost, which is a departure from the accounting standard. The company records indicate that if at all, had means what? If at all management valued at lower of cost, an amount of 20 crore, NRV is 80 only, but cost is 100, but company showed in books at 100. They're supposed to value at 80. If at all management value at 80, what is the impact on the balance sheet or P&L? The amount of 20 crore should be required to write down the inventory. Shareholder funds will be affected by this much. Profit will be affected by this much. Tax liability will be affected by this much. Means you are not only required to tell where the mistake. You are also required to tell quantification, effect of the mistake also you should tell. What is its financial effect on the financial statements also. So not only qualifying, quantifying is also important. Are you clear? So this is our basis for qualified opinion section. So now let us look at basis for adverse opinion section. Basis for adverse opinion section. Now as usual, we have see, because no, in qualified opinion, adverse opinion or unqualified opinion, in all these three cases we have conducted audit. So how you conducted audit, you should explain them. I conduct audit as per standards. As per the standards, we have responsibilities. Those responsibilities are described in auditor responsibility section for the financial statements. So there it is there. Responsibilities are discussed in the auditor responsibility section for financials. We are independent of the company. We complied with them. Whatever evidence we obtained, no, they're all sufficient and appropriate. Only based on that I gave this opinion. So you should tell them. In addition to that, why you gave adverse opinion, you should specifically tell the people, right? So as explained in so and so note, the company has not consolidated a material subsidiary, because this is an opinion on, this is a report on consolidated financials. The consolidated financials ignored one material subsidiary. Ignoring a material subsidiary, can a consolidated financial shows the true group picture? No. Therefore, I am giving adverse opinion. So auditor specifically highlighted, and you know here we should not only qualify, we should also quantify it. By if at all company consolidated that, what are the items in the balance sheet, what are the items in the P&L will affect? Every item will affect. Can we determine that effect? Not possible. We are here to give opinion. We are not here to prepare consolidated financials and give it here again. Yes or no? We are only here to give opinion. The effect of non-consolidation could not be determined. The effect of non-consolidation could not be determined. If you are able to quantify. If you are unable to quantify, say that you are unable to quantify. Clear? Next. For that, we have a theory on that. Corresponding theory is there. I'll discuss that also. So, disclaimer of opinion we are giving. For example, disclaimer of opinion I'm giving. Now tell me, disclaimer of opinion section itself, modification changes. We were engaged to audit. Basis for disclaimer. See, if you ask me, if I gave an opinion, you ask me what is the basis for the opinion, I'll tell you what is the basis for the opinion. Even if you ask me basis for qualified opinion, I'll tell you specifically the reason as well as general reason. What is the basis for disclaimer of opinion? I didn't get evidence. Just that fact alone, if you describe enough, right? Now, in basis for opinion, you have another para. We conducted our audit as per standards on auditing. You have not conducted your audit. Why people want to know what are your responsibilities? Your primary responsibility is to give audit and give opinion. Opinion itself you are not giving. So, when you are giving disclaimer of opinion, we have conducted audit as per standards on auditing, that para will not come. That para will not come. Moreover, when you are giving disclaimer of opinion, auditor responsibility section, what are all the responsibilities of auditor? You are responsible for risk assessment, you are responsible for internal control verification, you are responsible for verifying accounting policies, you are responsible for verifying going concern, you are responsible for verifying overall presentation structure, reporting of the financials. These are all your responsibilities. When you give opinion, people want to know about your responsibilities. You didn't give opinion. People are not bothered about your responsibilities. So, when auditor gave a disclaimer of opinion, the auditor responsibility section will be changed. Our responsibility is to conduct the group consolidated financials in accordance with the standards. However, because of the matter described in basis for disclaimer of opinion section of our report, we were not able to obtain sufficient appropriate. By the way, we are independent of the group. We have complied with code of ethics, everything. All these points, where are we discussing now? Auditor responsibility section for financial statements. Inside that section, we are reporting. When we are reporting these ethical requirements, independence requirements, all that, disclaimer of opinion, if it is given, we will report you. If at all disclaimer is not given, some opinion is given, these points, majority of these points will directly come in basis for opinion itself. Are you clear? That's it. Next. So now let's look at the corresponding theory. Now tell me, when you are giving unqualified opinion, not a big deal. But when you are giving modified opinion, basis for opinion will undergo so many changes, correct? When you are giving modified opinion, basis for opinion section will undergo so many changes. Like what changes? Suppose financial statements are containing material misstatements. What you have to do? You have to qualify. Not only qualifying, you should also quantify the effect unless it is impracticable. Suppose it is impracticable, you are unable to quantify. If it is not practicable, the auditor shall mention the same. Right now we have seen non-consolidation, the effect is impracticable, so we didn't decide. Like that they showed. Suppose if there is a material misstatement, misstatement can not only be in amount, it can be in the form of disclosure. Suppose the company made a material misstatement in narrative disclosure. Narrative disclosure means in notes to account, some theory points will be there in company. Paragraphs, revenue recognition policy, what they followed. Fixed asset recognition, fixed assets recognition criteria is what. Like that the company gives so much of theory content in the notes to accounts. Along the way, apart from the breakup of the figures. Now, in those narrative disclosures, they made a mistake. Like they are disclosing wrongly narratives. If the misstatement is narrative, what auditor has to do? The auditor shall include in the basis for opinion section an explanation of how the disclosure is misstated. How so and so note point wrongly drafted. You should explain that in basis for opinion. If at all misstatement is in the form of a narrative disclosure, sometimes misstatement may be in the form of non-disclosure. That is something which company has to do, they didn't disclose. Now what you have to do? That is also a misstatement, right? Now what you have to do in basis for opinion? Of course, I know you will modify, qualify, disclaimer, all that fine. But in basis for opinion, you should tell people that something is not disclosed, right? How do you tell that? First, discuss with the top management what is the significance of non-disclosure. What is the nature of omitted information, segment information, or related party disclosure? What is omitted? And unless prohibited by law, include the disclosure in the audit report if it is practicable to do so. Company did not give the entire AS 17 or segment reporting standard, they didn't follow. Primary reporting, second reporting, all put together comes to 5 pages. Should I give that entire 5 pages in audit report? Should I sit and prepare? They didn't prepare because they didn't understand that standard. Getting it? Should I sit and prepare? No, it is not practicable unless it is practicable. Generally, I will describe nature of omitted. I will just describe nature of. I will say that segment information required as per so and so accounting standard, the company did not present. It is not practicable for us to give the disclosure here. Are you getting it? That's it. Suppose you are modifying because you didn't get evidence. We have seen if at all you are modifying because there is a misstatement, you should qualify and quantify. Now I want to give a modified opinion because I'm not able to get evidence. For that reason I want to modify. In that case, what auditor has to do? The auditor shall include in basis for opinion reasons for the inability. Why you didn't get the evidence? Who restricted you? Give the reasons. Next, suppose when the auditor is disclaiming the opinion, the audit report shall not include the following element. The audit report shall not include. Audit report means which part of the audit report? Basis for opinion section. By the way, more clearly, basis for qualified opinion or basis for disclaimer of opinion. Nothing but. Because qualified opinion also we will give, when we are unable to obtain evidence, there is a possibility that we may also give qualified opinion. Correct? If we are unable to obtain evidence which is pervasive in nature, then we will give which opinion? Disclaimer of opinion. Correct? Now, so when auditor disclaims the opinion, the audit report shall not. A reference to section of the report that describes responsibilities of the auditor. Generally, basis for opinion, you see, we conducted our audit as per standards on auditing. Our responsibilities are referred under so and so. Like that para itself will not come. When you gave disclaimer of opinion, generally, yes or no, when auditor disclaims the opinion, basis for disclaimer of opinion should not contain such a kind of statement. Basis for opinion shall not say that we have obtained sufficient appropriate evidence. Correct? Generally, basis for opinion, you see, last line, we believe that evidence obtained by us is sufficient and appropriate. That's how the opinion will be, real opinion. I mean, real drafting will be. When you are giving disclaimer, how come you give a statement that we have obtained sufficient and appropriate? So, basis for opinion section shall not contain responsibilities related discussion reference, statement that auditor obtained sufficient appropriate. These 2 points it should not contain. Even if the auditor has expressed adverse or disclaimer, the auditor shall describe in basis for opinion reason for any other matter which auditor is aware of. And same way, suppose you are giving disclaimer, how auditor responsibility section will vary. Suppose you are giving disclaimer, how auditor responsibility section will vary. For your information, how auditor responsibility section will be given, I will show you. You see, auditor responsibilities for financials, so big, almost 2 pages. We tell them very clearly, our responsibility is to obtain reasonable assurance. So the financials are free from MMS or not. By the way, audit is not a guarantee. Reasonable assurance is a high level of assurance. There will always be a possibility of some mistakes we may not detect. So materiality concept also we will explain. And what are all, as a part of audit, as per standards, we exercise judgment to maintain skepticism. Auditor responsibility sections will contain 3 components. Again, primary responsibilities explanation, responsibilities under standards explanation, communication responsibilities. Auditor responsibilities are various. Primary responsibility to give opinion, what opinion, reasonable assurance, high level, all that. Second, responsibilities under various standards. What responsibilities? We are responsible for doing risk assessment. We are responsible for understanding internal control. We are responsible to verify appropriateness of accounting policy. We are responsible to comment on going concern basis. Further, in case of fair presentation framework, we should verify overall presentation is how, overall structure is how the content in the financials, how the disclosures are given. Are they all giving underlying transactions and events? Are they disclosing underlying transactions and events so that achieving fair presentation? All this I will talk. In which section of the audit report? Auditor responsibilities. Further, we will talk about communication responsibilities. We have to communicate planned scope and timing of the audit, significant audit findings, significant deficiencies, 260, 265 responsibilities, we tell them briefly. So in the audit report, so many we communicate. Under responsibility section, this and all is not required when you are giving disclaimer of opinion. When you are giving disclaimer, you need not give all this. Then instead of that, what you will give? You will give a statement that your responsibility is to conduct audit as per standards. and a statement that because of the matter described in basis for disclaimer of opinion section, we were not able to obtain sufficient appropriate, and we just tell them we are independent of the company, we have complied with the ethical responsibilities. Yes or no? A real audit report also contains the same, right? That's it. Clear? This is how basis for opinion paragraph undergo various changes. In exam, they will ask you how, suppose the auditor identified material misstatement by way of a non-disclosure. What should be the requirement under basis for opinion paragraph in such a scenario? 3 marks question they'll ask you. Or they'll give you 2 situations. Auditor found a material misstatement in the financial statement. Basis for opinion paragraph shall contain some modifications relating to it. What are they? Comment in light of 705. This point you have to write. Unable to quantify you have to write. And narrative disclosures you have to write. All the 3 points you have to write. This can be asked as a 4 marks question. Anyway, it can be tested. Are you getting it? Last time or that before time, they have asked this question. November 23 or May 23 somewhere. What should be the auditor responsible? What auditor has to describe in the auditor responsibility section in a scenario when auditor has disclaimed this opinion? They have asked this for 4 marks question. You're getting it. You can just check it out. Previous 3-4 attempts you will find one of this question. So, and again, don't say that, don't think like last attempt or that last attempt it is asked, this time it will not be asked. No, nothing such. Every time paper setter will change. His mindset will be different. If at all a question came in the last attempt, don't blindly think that will not come this attempt. No, never study like that. Study in the right process, follow the right process. Never think about result. You will always get the result as a byproduct. Are you clear? All of you? That's it. Okay. Now we'll take a break and get back. Yeah, let's continue. We have completed discussion on basis for opinion and opinion section, right? Like, for example, let's go back to the elements of the auditor's report. Let's go back to the elements of the auditor's report. See, by the way, if you see, there is a chapter arrangement which I cleverly did that. You should study audit. Any book you follow doesn't matter. First, you should study audit report chapter. Without understanding that, you cannot understand remaining standards. Because in every standard, they talk about implications of various requirements of that standard on the reporting. In every standard, they deal with reporting. Without understanding the reporting, you can't understand. You must first understand where is your destiny. Then you should lay the route. You're getting it? First we are laying the route and then finally reading destiny. That should not be the correct way. Quality control and all, you should never study at first place because it's very advanced. At the level, at the first stage itself, if you study that quality control standard, you don't understand anything. You just feel like reading sentences, translating with the dictionary meanings like that. You just feel like that. Fine. So we completed, title, addressee, opinion section, basis for opinion section. Now in exam, sometimes I'll ask you, what are opinion sections contains? What are the contents of opinion section they'll give you in exam. So what opinion section contains? Generally opinion drafting is different. What opinion section contains is different. Drafting part we have seen. What actual opinion section says, it identifies the entity. It says that we have audited, but we cannot mention that point in disclaimer. And we need to identify title of financials. We need to refer to the notes. We need to refer about the date and period covered by the financial statements. And ultimately, F point, another F point, which is not given in the institute book also, but ultimately you should also give the opinion that you are expressing. These are the elements of the opinion. Same way, what are the elements of basis for opinion paragraph? We state that we do audit as per standards. We discuss about responsibilities of auditor that referred in some other paragraph. We say that we are independent. We say that we fulfill the responsibilities. We state that we obtain sufficient and appropriate evidence to provide a basis for our opinion. Then if you give a modified opinion, how this basis for opinion paragraph will be modified? 705 contains the discussion. That also we have seen, correct? Next, now you see here, wordings of unmodified opinion. They have given this material. I told right, explicitly, implicitly, all that, remember? So that entire discussion, I think the concept discussion is there in the above. Fair presentation framework or compliance framework. I think this is enough technically. This is enough. I think definitions, definitions are not given. Definitions were there in the fundamentals chapter itself. If you see the original, this one, it will also contain the word explicitly, implicitly, all that. I have already given the explanation for that. Now, let's again continue with this discussion. So these elements we have completed. Now let's cover the next element, that is emphasis of matter paragraph. Emphasis of matter paragraph, that is so emphasis of matter paragraph. So 706. Right now what we have discussed is 700, forming of an opinion and reporting on financial statements. Forming of an opinion and reporting on financials. The 700 addresses two issues. One, reporting on financials. That reporting part is what we are actually reading. Forming of an opinion. Before forming an opinion, the auditor has to evaluate two elements: qualitative aspects of entities' accounting practices, specific evaluations about financial statements. The auditor has to evaluate two elements: qualitative aspects of entities' accounting practices and specific evaluations. Specific evaluations, what are they? Whether accounting policies are appropriate, whether accounting policies are consistent, whether accounting estimates chosen by the management are reasonable, whether the content shown in the financial statements is correct, regular, not misleading, yes or no, whether the terminology used in the financial statement is appropriate. Like this, they have given specific evaluations. In exam, they'll ask you, what are the specific evaluations the auditor has to make before forming an opinion? So that answer. Sometimes in exam, they'll ask you, write about evaluation by auditor of qualitative aspects of entities' accounting practices. These are all there at the beginning itself. In 700 it will be there. In 700 it will be there at the beginning itself. If those two elements also you understand, 700 will be completely over. 705 will contain additionally what? Pervasive definition I discussed. Pervasive means what? Effect. Pervasive effect are those in auditor's judgment. They were not confined to specific element of the financial statements, or if so confined, they represent substantial portion, or it may be related to disclosures that are fundamental for users' understanding of financial statements. This is the definition of pervasive. You can see in ICA book also very clearly. Before 705 discussion it will be there. They didn't highlight specifically with any side heading. They just discuss it as a paragraph with these points. Yes or no? No, that's pervasive. Then in SA 705 heading is what? Modifications to the opinion in the independent auditor's report. In the independent audit report, modification to the opinion. That modification, how will you modify? What are the elements of modification? What are various types of modified opinion? How to give basis for modified opinion section? So they're all giving that. You're getting it now. So except that, there is no much other discussion in 705. Even in 705, I told you, if auditor is unable to obtain evidence, what auditor has to do? Because of management is imposing limitation, discuss with them, ask them to remove, try performing alternative procedure, and if at all inability to obtain is for some possible effect is some material but not qualified, possible effect is material and pervasive, then withdraw from the audit. If withdrawal is not possible, then you have to give disclaimer. When withdrawal is not possible, LOD or all that we have seen, correct? That is what entire 705 discussion is mainly about. Then now 706. What is the 706? In the audit report, in the independent audit report, emphasis of matter paragraph, other matter paragraph we are including. Emphasis of matter paragraph and other matter paragraph in the independent audit report. What points auditor has to check? Now, what is an emphasis of matter paragraph? It is a paragraph in the audit report. It is a para included in the audit report. That refers to what? A matter appropriately presented or disclosed in financials that in auditor's judgment is important for fundamental to the user's understanding of the financials. So auditor is referring to a matter. What matter? That is presented or disclosed in financial statements, which it is important for the user to understand financial statements, to interpret the financial statements. Now you take any financial statements, Tata Motors, TCS, Maruti Suzuki, you take any company financial statements, the financial statements are spread across to 60 to 100 pages. They are spread across 60 to 100 pages. I'm talking only about one set of financials, standalone financials. Consolidated financials will be somewhere around 80 to 150 pages. Somewhere around 80 to 150 pages. Definitely, auditor must and should read the 100% of the financial statements. Agreed? We may not cover 100% of the items in the financials, but we should read the financial statements to know, to get an evidence whether they are prepared, presented, disclosed as per applicable framework, correct? Format and all we should check. 100% notes to accounts we should check. We cannot do sampling in that. And when I'm reading the entire notes to accounts, I felt there are some important note points. Note number 28, note number 22, note number 54. Like that, some note points were there, which are sensitive issues, which are dealing with contingent liabilities, which are dealing with recently happened fire accident after balance sheet date. They're disclosing something, which are dealing with some subsequent events. So some important information is presented in these points. I know company honestly presented, honestly disclosed, everything is fine. On those points, I don't have any objection. But I want every shareholder, every reader of the financial statement should read these 3 note points. I want every one of them to read these 3 note points. These are the matters that are presented or disclosed in financials. How they are presented or disclosed? Appropriately presented. Appropriately means what? Are they containing any material misstatement? No, they're appropriately presented. I want everybody attention on this point. What can I do? Highlight it. If you want attention on that, highlight it. Highlight means what? Emphasize it. Emphasize it. That is called emphasis of matter paragraph. So it's a paragraph in which we draw attention to the users of the financial statements to the matter presented or disclosed in the financials, which from auditor's judgment important for users' fundamental understanding of the financial statements. That's an emphasis of matter paragraph. Clear? Now, when you decided to use an emphasis of matter paragraph, how to present it, what conditions are to be complied so that you can use emphasis of matter paragraph, you have to comply. It is not required to modify, means the matter that you want to highlight, on that your opinion should be unmodified. The matter which you want to highlight, on that your opinion should be unmodified. Unmodified means what? When on a particular matter my opinion will be unmodified. If on that matter I got sufficient appropriate evidence, my opinion will be unmodified on that. Indirectly they are saying the matter that you want to highlight should be free from material misstatement. That is what reflected in the definition itself, appropriately presented or disclosed. Are you getting it? They are not simply saying auditor should highlight emphasis of matter paragraph to matter referred to the matter presented or disclosed. They said to the matter appropriately presented or disclosed. Now, another condition, when you decided that matter as a key audit matter, when auditor decided that as a key audit matter, then also you should not use emphasis. Indirectly, emphasis can be used. Only emphasis of matter paragraph, what matter you can talk, that matter presented or disclosed in financials, that does not require modification of the opinion, that is not determined as a key audit matter. What is key audit matter? We'll come back later. Then what is the circumstance? For example, some fact known to the auditor after the date of audit, subsequent event, uncertainty related to some litigations, major catastrophe that had occurred, or some financial reporting framework to alert the users that the financials are prepared as per special purpose framework. Generally, if at all financials are prepared using special purpose framework, we generally, as per SA 800, we mention a separate side heading called basis for accounting. We mention a separate side heading called basis for accounting. So that is enough to highlight. Again, emphasis is not required. So this point is example. They just said an example. So suppose a financial reporting framework, this example many don't understand. Some financial reporting framework, as per that company prepared financials, but that's actually not acceptable. In light of fair presentation, that is not acceptable. But the fact that it is given by the law, the company followed. If you want to highlight that explanation, that these financials may not be that useful, but because of the law regulation, we prepared like this, then also you can use it under emphasis. Under emphasis, you can highlight that these financials are prepared as per so-and-so requirement, which may not be acceptable in light of these circumstances for various users. You may alert that. Whatever it is, you want to highlight something that is there in the financial statements, then you can highlight. Suppose if a point is nowhere, it is there in the balance sheet, P&L, cash flow notes, nowhere it is there. Can I use emphasis of matter paragraph to talk something else? No. Are you clear? Emphasis of matter paragraph is not a substitute for modified opinion. Emphasis of matter paragraph is not a separate opinion. Emphasis of matter paragraph is not a substitute for disclosures in financials. What does it mean? Company forgot to disclose something. They're asking you, sir, we forgot to disclose segment reporting. You disclose it in emphasis of matter paragraph. No, this is not a substitute. You didn't disclose segment reporting. That's a non-disclosure. That's a material misstatement. I will give modified opinion. Clear? That's it. Emphasis of matter paragraph is almost over. How should you present emphasis of matter paragraph? What is the manner of presentation? For example, I'll just show you this audit report. Just a minute. Here in the audit report, best example. This entirely is audit report only. Sorry. This is a compliance certificate in case of listed entities. That's why it's so lengthy. Yes, you see, Air India has given which opinion? Qualified opinion. Yes or no? Now some students are having confusion. Sir, when qualified opinion is given, emphasis shall not be used. No. No, it's about a specific matter. Whatever matter, you see how Air India presented emphasis of matter paragraph. You see, they gave a separate side heading for qualified opinion, separate side heading for basis for, separate section only given. No. So emphasis of matter paragraph shall be presented in separate section with a side heading emphasis of matter, and the auditor has to draw attention to the note point or the item that is described in the financials. At the end of the emphasis, auditor has to mention that his opinion is not modified in respect of the above matter. The same thing is there in the book, you see. What is the manner of presentation of emphasis of matter paragraph? The manner of presentation is the auditor shall include it within a separate section. Express the matter being emphasized, give reference, state that your opinion is not modified. They may give you an exam. Write about emphasis of matter paragraph, give 2 examples. What should be the manner of presentation of emphasis of matter paragraph? 5 marks question. It was tested many times. Clear? Over. Emphasis is over. Now let's discuss other matter paragraph which requires a lengthy discussion. When I'm discussing other matter paragraph, I'll be discussing 2 standards called 299 and 600 as well. Now, yes sir. So other matter paragraph. What is other matter paragraph? Look at the definition first. Look at the definition. Other matter paragraph is a paragraph which is included in audit report that refers to a matter, that also refers about some matter other than presented or disclosed in financials. Why? If it is presented or disclosed in financials, emphasis is there, na? Anything else you want to talk other than presented or disclosed, you can talk about in other matter. About what? About audit you want to talk. About audit responsibilities you want to talk. Or about audit report you want to talk. Regarding these 3 elements you want to talk, then you can talk about that in other matter paragraph. About audit, auditor's responsibilities, audit report. If these 3 related issues you want to talk about, which is not there in the financial statements already, then you can explain that in the other matter paragraph. For example, I will give this my popular favorite example. So let us imagine a scenario of State Bank of India. Getting it? State Bank of India Limited is a banking company registered under Banking Regulation Act, obtained banking license from RBI, which is engaged in banking operations. Getting it? So SBI Limited is having 12 joint auditors. They are having how many? 12 joint auditors, central auditors we call them as. 12 joint auditors were there to audit and report on overall State Bank of India financial statements. And the State Bank of India Limited is having 22,000 plus branches. Number might vary, plus or minus 1,000 or 2,000, some number, but approximate number I'm telling you. It is having close to some 25,000 branches. It is having some close to 25,000 branches. Out of this, 19,000 branches were unaudited. 19,000 branches were unaudited. They are exempted from audit as per RBI circular. Whereas remaining 6,000 branches were audited by branch auditors. Remaining 6,000 branches were audited by branch auditors. Now, whereas overall auditors were how many? Overall, total how many auditors? 12 joint auditors. Let us call them as P. Let us call them as Mr. P. Nothing but principal auditors. According to me, they are what? Principal auditors. Whereas these 6,000 branches are who? Branch auditors. Now, this SBI Limited has to prepare standalone financial statements, right? What is the standalone financials? Nothing but head office plus all branch Yes or no? Head office plus all branches, assets, liabilities, incomes, expenses should be consolidated, not consolidation as per accounting standard. I am talking about branch consolidation. Total bank position they should show, correct? Head office plus branches. Do SBI release branch financials to public? No. SBI will release overall financials of the SBI Limited to public, standalone financials. Now for standalone financials, who should give opinion? Mr. P. Nothing but a collection of 12 joint auditors, they should give opinion on this. Whereas Mr. Branch auditors, no, 6,000 branch audit reports were there, which are prepared by branch auditors. These reports will be forwarded to principal auditors. Principal auditors, while giving opinion on the branch, while they are giving opinion on the entire standalone financial information, they use the audit reports of branch auditors and then give opinion. Agreed until now? Now, along with this, State Bank of India Limited is also having more than some 10 subsidiary companies, 5 associate companies. Example, some 3 joint ventures and all they are having. Now, State Bank of India, since they are having subsidiaries, associates, joint venture, they also prepare consolidated financials. For example, SBI Cards Limited. There is a company called SBI Cards Limited, which deals with credit cards. So that's one of the subsidiary of the State Bank of India. That's one of the subsidiary of the State Bank of India. Now, this subsidiary company is audited by Mr. Yes. Let us assume the subsidiary company is audited by Mr. Yes. Now, since State Bank of India is having subsidiary, it also prepares what? Consolidated financial statements. Now, when State Bank of India is preparing consolidated financials, on consolidated financials also audit report shall be given, right? On this consolidated financials, who shall give the audit report? State Bank of India Limited auditors only. Means these 12 joint auditors should give audit report on that. Now, there are 2 audit reports. Audit report on consolidated financials, audit report on standalone financials. Consolidated financials is nothing but standalone financials of SBI, standalone financials of subsidiary companies, associate companies, joint ventures. That's called consolidation. Whereas standalone financials of SBI Limited is what? Head office plus branches, correct? Now, if you look at inside this standalone financials, inside this standalone financials of entire SBI is audited by 12 joint auditors. Head office alone is audited by 12 joint auditors. However, joint auditors are giving the entire audit report on the entire financial statements, which is going to be released to the public. But these joint auditors, these principal auditors, they have not audited 6,000 branches, correct? They have not audited approximately 20 companies which are included in consolidated financials. They didn't audit that, but still they are only giving opinion on them. How are they giving opinion even though they have not audited? Because other auditors have audited that, their reports are forwarded to us, and while forming our opinion as a whole, we formed opinion by using their report. But if at all something goes wrong in those other auditors related requirements, who is responsible? They are only responsible. Division of responsibility. How can I be responsible? I just use their report just like how we are using my audit report. I use their audit report. Based on that, they are saying everything true and fair. I also calculate everything true and fair. Head office is true and fair from my point of view. Branches are true and fair from branch point of view. True and fair plus true and fair, true and fair. Are you clear? Now, I should tell people that branches and all not audited by me, but by other auditors, whose reports are given to me. Based on these reports, my opinion on the overall standalone financials was formed. I should tell this point, right? Where you will tell this? Other matter paragraph. Auditor responsibility. Where you will tell? Other matter paragraph, you will tell about auditor's responsibility like this. Same way, on consolidated financials, you are giving audit report, right? In that audit report also other matter paragraph is there, right? Inside that you will tell branches are audited by branch auditors, subsidiary companies, associates and joint ventures were audited by those respective auditors. They all forwarded to us their reports, and our opinion is based upon their reports also. You should tell this or not? Further, you should also tell in other matter paragraph. You should also tell in other matter paragraph how many branches were not audited. How many branches were not audited? That also you should tell in other matter paragraph. How much of the financial information is not at all subjected to audit? How much worth of asset? How much worth of liability? How much worth of income? How much worth of expense? How much is not audited? Also you should tell in other matter paragraph. In bank audit reporting requirement, this point is there. Auditor not only has to tell about number of unaudited branches, he should also quantify total worth of assets, total liabilities, total interest income, total interest expenditure. How much is audited by other auditor? Quantification also he must do. This is a reporting requirement in bank audit chapter. You have a chapter called bank audit. Inside that it is there. Now this is one responsibility of the auditor where there is a division in the responsibility. The division in the responsibility has to be explained by the auditor in other matter paragraph. This is one example of auditor's responsibilities where we refer about other matter paragraph. Now other matter paragraph definition: audit, auditor responsibility, audit report. Audit report, what is example? Very simple. You all know joint audit, right? Joint auditors, all of them shall arrive common conclusion and shall give a common report and shall express common opinion. However, if there is any joint auditor who disagrees, that joint auditor can give a separate audit report. When the joint auditor is giving another audit report, multiple audit reports is there, each joint auditor in their audit report should refer about other joint auditor report. Where they will refer this? Other matter paragraph. That's about auditor's report. Example of auditor's report. You know, right? SA 510 or SA 710. If preceding financial statements, previous year financial statements were audited by another auditor, predecessor auditor, you should tell about that also, right? That about audit. You can talk about audit there. You can take that example. That previous year financial statements were audited by other auditor, and other auditor has given some so and so opinion, that just comparative information in the audit, comparison of audit report of the last year, that is about audit. So other matter paragraph is a paragraph that contains auditor's description about some matter that deals with audit, that deals with auditor responsibility, that deals with auditor's report. Now until now what we know, as per SS 600, principal auditor is not responsible for other auditors, correct? All of you. Now let's look at this 600 directly. Let's look at the 600, then I'll come back to other matter paragraph. 600. Now you see, there are definitions. Division of responsibility. The principal auditor is not responsible in respect of work entrusted to other auditor, except you found suspiciousness. Right now, recently, there is a Cafe Coffee Day case which was detected, fraud which was detected, in which KPMG failed to perform necessary due diligence. Getting it? We have a standard parallelly called ISA 600, International Standards on Auditing. In that standard, division of responsibility is there to some extent, not fully. Principal auditor has to verify competence of other auditor. Principal has to verify working papers of other auditor. There is a duty on the principal auditor, whereas in Indian Standard on Auditing 600, there is no such duty. Saying that, this KPMG and all arguing, we are not responsible to verify other auditors' opinion, all that. But NFRA do not agree. No, that is completely the very basis purpose of the audit itself is deceived. Even though it is audited by others, you should verify. Like that, some big entire issue is going on. I already made a video in the YouTube regarding this one title. Just yesterday or day before I posted this video. So 50% of the listed entities market capitalization value is audited by three network firms. So like that, there is a title is there. You can watch that for your understanding. What exactly the issue, you can understand that. Fine. So now this is going to be affected. Don't worry, until November 2025 also this will not apply. Getting it? If that issue, one student messaged already, not this time, last time, 800 new standard released. When it was released is February or March month before May exam. Sir, is this applicable to me? You study. For you alone it is applicable, is it? For others it will not apply. For you it will be applicable. Common sense. 6 months before. Yes or no? Exam before, any 6 months before, exam before 6 months, preceding 6 months, any issues or notifications comes, it will not apply. Moreover, if at all they apply also, they will give you through supplementary material, right? If they did not cover in supplementary material, what does it mean? It is not applicable, right? Even though this fellow will have a doubt. Fine. Are you clear? Now, when the principal auditor has to base his opinion on financial information of the entity based upon reports of other auditor, principal auditor shall clearly state the division of responsibility for financial information of the entity by indicating how much components, how many components, what is their share. You should indicate that in other matter paragraph clearly. Are you getting it? Now you see, the most crux part in the standard is definitions and acceptance. KPMG was penalty. KPMG was levied penalty because they violated this requirement. Can you accept as a principal auditor for a company if they call and ask you? You can accept only if you check the following elements. How much materiality of the portion that you are auditing? Being a principal, you must have authority over major material portion of the financials. Suppose one of the entity is there, in that case, major 80% of the business is happening through one subsidiary company. That company you are not auditing. You are auditing a normal holding company, which is just a holding company. Getting it? It does not have any business. Now saying subsidiary company is audited by other auditor, how come I am responsible and you gave negligently the report? You are getting the point. Predominant portion is audited by other auditor. When predominant portion is audited by other auditor, then why did you accept principal audit position of this company? This is the clause on which NFRA levied penalty. Getting it? So what is the materiality of the portion of financials that you are auditing? Principal auditor's knowledge regarding components. You must have knowledge of business that is happening in components. How much knowledge you have? Risk of MMS, performance of procedures that are given under SA, this standard, whatever procedures that are given in the standard, how far you can execute those procedures. If you think in all the cases, yes, then only accept principal auditor position. What do you mean by principal auditor position? The moment I am accepting as an auditor of a company which is required to prepare consolidated financials, then the standard is applicable. The standard is applicable in two cases. When you are doing audit of consolidated financials, which includes standalone financials audited by other auditors. When you are doing audit of the standalone financials, which includes branch financial statements, which is audited by other auditors. In these two circumstances, this standard will be applicable. That's why you see, who is an other auditor? Other auditor means an auditor other than principal, with responsibility for reporting financial information of a component. They are only responsible for financial information of the component, which is included in financial information audited by principal auditor. Who is principal? He is an auditor for the entity. Principal auditor is an auditor for the entity, where that information includes information audited by one or more component auditors. Component, why they use the word component? Why they did not use the word branch? See, for consolidated financials, standalone financials of subsidiaries are component. For standalone financials, branch financial information is a component, correct? So component means what? Component means it's a division or branch. This is from standalone financial statements point of view. Component means subsidiary, joint venture or another entity. This is from consolidated financials point of view. Component is a division or branch from standalone point of view. Subsidiary, joint venture from consolidation point of view, whose information is included in financial information which is audited by principal auditor. If you are accepting as a principal auditor, you should decide first, do you have that eligibility criteria to accept? You will have eligibility criteria only after you evaluate these elements, correct? Once you satisfy all this, you are normally entitled to rely upon the work of other auditor. You need not doubt, because other auditor is also a chartered accountant with a COP. You need not doubt, correct? Now, once you accept as a principal auditor, once you become a principal auditor, there are some responsibilities for you. What responsibilities? At the planning stage itself, tell the other auditor how his work is going to be used by you. Make sufficient arrangements, special considerations. Tell other auditors what are the special areas they need to focus on. In the KPMG issue recently which has happened, principal auditors argued, KPMG argued, whatever standard requirement is that I followed. The NFRA said, you followed everything except this. Because the partner did not study this question, important question is not there. Getting it? Principal auditor's procedure, he did not study, he did not verify. First of all, you are unfit to accept a principal auditor of a holding company, where there are entire businesses carried through subsidiaries, for which auditors are separate auditors. Suppose you are only auditor for subsidiaries, you are only auditor for holding, happy, do it. Predominant business is done in subsidiaries, and that you are not auditing, and you are saying that they did audit, how come I responsible? But you are giving the report on the group. As a group auditor, you have responsibility for intergroup component transactions, everything. You need to verify. And again, he says, working papers, I don't have access. Working papers are property of the auditor as per SQC. They are not giving me. ISA 600 says you have to take. Are you getting it? So now SA 600 is being aligned with ISA. I am not going deep into it. I'm only giving you a brief idea of what happened in Cafe Coffee Day case. Are you clear? Close to 3,000 crore fraud, I think it is. 3,000 crore worth of fraud. Diversion of funds. Fine, it's okay. I'll connect it at another place. Now, at the planning stage itself, principal auditor should tell other auditor what reporting requirements apply. Because other auditors may not aware of CARO applicability, other auditors may not aware of IFC reporting applicability, they are not aware of it. So as a principal auditor, I should know what are reporting requirements applicable for the company, so that the branch auditors also follow the reporting requirements, correct? Then what else principal auditor can do? He might discuss with other auditor what procedures to be applied, and I can ask him a review. I can review a written summary of what are all he did, and I may visit the other auditor also. The standard gave me a right. Nature, timing. Now tell me how far I interact with him, how far I discuss with him. These are all dependent upon the circumstances, knowledge of competence of the other auditor. So what is the knowledge I have about other auditor's competence? Depending upon that, should I discuss with him, how many times I should discuss, should I visit or not? All this will be discussed. Principal auditor's procedures. Principal auditor should at the planning stage tell the other auditor how his work is going to be used, tell him what are the special areas to be focused on, tell him what are the reporting requirements, discuss with him, visit the other auditor, whether how much extent, what kind of way you do this, to what extent you do this, how many times you do this, depends upon principal auditor's knowledge of the circumstance, knowledge and competence of the auditors. Simple. Next, now tell me, there must be a proper coordination, right? In order to execute principal audit procedure, there must be proper coordination. What is coordination? The other auditor knowing the context in which his work is used by principal auditor. Other auditor should understand how his work is going to be used by principal auditor. Accordingly, he should bring to the principal auditor's attention any matters that are relevant at consolidation level. Other auditors are also liable to bring to the principal auditor's attention at consolidation level, and they need to follow timetable for audit. Yes or no? Because if principal auditor has to give audit report on time, other auditors have to complete the audit report much before the principal auditor, and he should ensure that compliance with relevant statutory requirements. Similarly, principal auditor also has a responsibility to coordinate with other auditor. If I came to know some suspicious transactions, if I think they may also be there in the branches, I should tell branch auditors, I should tell subsidiary company auditors, nothing but component auditors. Principal auditor should bring to the attention of component auditor any matters that are relevant at component level. I should also tell him. So we must work like a husband and wife. Next, when considered necessary, principal auditor may also send other auditor a detailed questionnaire. And asking him to give, and the other auditor should reply to principal auditor on the questionnaire he is asking. You're getting it? All these elements NFRA verified in KPMG. Next, suppose if at all there are key findings in other auditors, suppose significant findings were there in other auditors, what principal auditor has to do in this case? Remember, this entire standard is drafted from the point of view of principal auditor. So if at all discuss with the management of the component, discuss with the other auditor, do supplementary test if you require. If you require, do supplementary test. Document how many components were audited by other auditor, what is the significance of those other auditors components to the financials, how much percentage of turnover, how much percentage of expenditure, how much percentage of assets, how much percentage of liabilities were audited by other auditors. Significance, that's called significance. Names of the other auditor, what decisions you have reached. Principal auditor should AC poiducha? Is it there? And I'm getting tired. The principal auditor should also document procedures performed and conclusions reached. Suppose, sir, other auditor, they gave modified opinions, sir. What principal auditor shall do in the overall audit report? If at all that branch is immaterial, if at all that component is immaterial to the overall financial statements, even though the component auditor gave adverse opinion, that component is an immaterial component. No business happened in that. I will ignore that. Suppose other auditor gave adverse opinion, other auditor report, component audit report. Should a principal auditor also give adverse report? No. See what is its materiality to overall consolidated financials, overall standalone financials, how far that information is material. If it is material but not pervasive, he will give qualified opinion. If it is material and pervasive, principal auditor also will give adverse opinion. Suppose if I am unable to use the reports of other auditors, management is not letting me to use the reports of other auditors, qualified opinion or disclaimer of opinion. That's it. Over. SA 600 is over. Clear? All of you. Then let's look at 299. Let's look at 299. Joint audit of financial statements. 299, the standard heading is what? Joint audit of financial statements. Joint audit of financials. Very simple. Joint audit refers to appointment of one or more than one auditor. Appointment of two or more than two auditors. Getting it? Two auditors means what? Two different sole proprietary firms or two different partnership firms or a combination of sole proprietor and partnership firm. If you are appointing two or more than two auditors for the same entity, for the same financial year, for the same scope of work, we call them as what? Joint audit. Generally, when joint auditors are appointed, why joint auditors are appointed? To enhance the quality of audit, to reduce the burden on the auditor. That is the main reason why joint auditors are appointed. For banking companies, joint audit is compulsory as per RBI directives. Now, the responsibility of the joint auditor. How the responsibility of joint auditor? They have a divisible responsibility. They have an independent separate responsibility. When the work is divided, based on assets or liabilities, income and expenditure, geographical areas, identified units, period. They will ask you, write about responsibilities of joint auditor. They'll give a case study. They'll give you below, in the light of the above case scenario, describe what are the responsibilities of joint auditor and comment in the given case how the responsibility will be shifted by them. Getting it? But there are some cases where joint auditors will have a combined responsibility. When the combined responsibility will be there, when the work is not divided, or when the decision is taken by all the joint auditors, or matters brought to the notice by all the joint auditors. Matter brought to notice by which date? Before audit report date, correct? If at all any matter is brought to the notice of other auditors after the audit report date, the joint auditor who failed to report this, that fellow is responsible to give an answer on that. Or for verifying disclosure requirements in financials, can notes to accounts, 100 pages is there. Joint auditor one, you see 5 pages, you see 5 pages, you see 5 pages, you see 5 pages. Can I divide the work like this? No. For presentation and disclosure requirement, whether financials are prepared as per applicable framework, for that all the joint auditors will have a combined responsibility. For ensuring that audit report complies with the relevant statute, to ensure that audit report issued is as per the statute, as per the reporting standards, ensuring that audit report follows the audit report given is as per the format applicable. So for that also all joint auditors are responsible. In this, one important point is there: coordination among joint auditors. One point. Coordination among joint auditors. Joint auditors shall coordinate with each other. In sense, if joint auditor during the course of his work, tell me, can a joint auditor rely upon the other joint auditors' work? Suppose other joint auditor came and said, sir, purchases, liabilities, everything is true and fair. I saw. You can trust him. You need not verify his workings. He is also a CA like you. So you both, he said everything is true and fair. In your areas, you felt everything is true and fair. Both of you together will give opinion. Sir, what if tomorrow it is wrong? That's why all of us are signing the audit report. That's why we are documenting the developed audit plan. The work allocation between joint auditor shall be documented. Why you are documenting work allocation? Tomorrow if some issue comes, who did that work? Accordingly, that fellow is only responsible to answer. Correct? So a joint auditor is entitled to rely upon the work performed by other joint auditors. At the same time, if a joint auditor identifies any scenario that affect other joint auditors' work, immediately he should bring it to the notice of other joint auditor on or before the date of audit report. That is called coordination among joint auditor. That point is missing. Coordination among joint auditor point is missing. Please make a note of it. Coordination among joint auditor. Further, in this standard, there is an objective. What is the objective of joint auditor? That we have given in question bank. At very few standards, not even few, 1 or 2 standards only, 1 or 2 elements we directly discussed in question bank rather than discussing it here. That's it. One standard is joint audit. That's it. Rest all other standards, 100% content given in the ISO book is kept here. Clear? Next. Now, audit reporting. How joint auditor should report? Generally, all the joint auditor will arrive common conclusion and give a common opinion through a single audit report. However, a joint auditor is not bound by majority. A joint auditor is not bound by, actually here you remove not. No joint auditor is bound by majority. Getting it? If at all there is a difference between joint auditor, the joint auditor who is disagreeing should give a separate audit report. In such a case, each joint audit report should contain reference to another joint audit report in the other matter paragraph. Why such a reference should be there? Multiple reports are there. Now shareholders will follow which report? They will read both the reports. In the both the reports, opinion, basis for opinion, they will read. Whoever basis for opinion is convincing to them, they follow their report. Simple. That is their choice. You need not worry. Clear? Now, what are the special considerations? Many times this was asked from the joint audit. If at all the exam question is coming, that either comes on special consideration, that either comes from responsibilities or from coordination. From these three areas only, generally you will get questions. Special consideration. What joint auditors? All the joint auditors should establish jointly the strategy and develop a joint audit strategy. And they should develop joint audit plan. When they're developing plan, no, they should identify division of areas and common areas. They should identify reporting objectives. They should communicate significant factors. They should consider results of preliminary engagement activities. These are the same points that are there in audit strategy chapter for you. What are the points to be considered before forming an overall audit strategy? Consider the result of preliminary engagement objectives, considering the reporting objectives. Remember, this is reporting objective, not reporting requirement. Reporting objectives means communication objectives, nothing but what? Reporting objectives means communication related responsibilities. Okay, and communicate significant factors identified with each joint auditor. So each joint auditor should communicate with each other significant findings that is affecting the other joint auditor, and the joint auditor should develop a joint audit plan that contains separate areas, combined areas. So all the areas should be covered in the joint audit plan. They may ask you only a 3 marks question on this. Joint auditor shall discuss and develop a joint audit plan. What are the points to be considered while developing a joint audit plan? And remember, all the joint auditor shall do risk of material misstatement. Risk assessment must be performed by all the joint auditor, and they should document all the procedures performed. All the joint auditors should document whatever procedures performed, whatever evidence gathered for individual areas, combined areas. If it is combined area, all of them has to document. The soft copy, all of them has to maintain. Hard copy may be multiple. How many ever joint auditors were, that many copies will be taken. Getting it? Work allocation should be documented. They should obtain common engagement letter. They should obtain. Actually, they say obtain. It's not obtain, we should give. Engagement letter is something the auditor will give to the company, and they should obtain common representation letter, MRL, from the management. Common representation letter they will get. Under 580 we will discuss what is a representation letter, all that. Clear? Joint audit is over. Other matter paragraph is over. Clear? Now look at other matter paragraph. I'll just conclude it. So, when to issue other matter paragraph? If in auditor's judgment, the matter is relevant for understanding of audit, auditor responsibility, audit report. You can use other matter paragraph if it is not prohibited by law, or if the matter is determined as a key audit matter. If it is not determined as a key audit matter, use it. If it is a key audit matter, discuss it key audit matter directly. Manner of presentation. You should present other matter paragraph in the audit report as a separate section. Under separate section you present. Correct? Like for example, I'll show you this State Bank of India audit report directly. Yes. This is the State Bank of India auditors report. You see other matter paragraph. We did not audit the financial information of so and so. They mentioned, right? Now, actually, in other matter paragraph itself, they should also talk about who audited branches, all that. But State Bank of India, on the face of the opinion, below the opinion section itself, they are taking the advantage of the standard and giving here, instead of giving somewhere in the other matter paragraph, which is last. They are giving in the first itself. What are they saying here? The branches audited by us and those branches audited by others were selected by bank so and so. These unaudited branches are so and so. Just a minute. I think in consolidated financial statements related audit report, it was there. Yeah, here it is there. Other matter paragraph. We did not audit the financials of 6,000 branches whose total assets are 23 lakh crore, whose total revenue is 1.7 lakh crore. This and all is included in the balance sheet P&L. This much assets and already. Extra assets we audited. This much asset, this much revenue we didn't audit. Who audited? The financials of these branches were audited by branch auditors, whose reports have been furnished to us, and our opinion as it relates to these amounts is purely based on branch auditors. Our opinion is not modified in respect of the above matter. By the way, I'm not objecting. I'm just telling you these are the branches audited by other auditors. What do you mean by 6,000 branches? You will not understand the impact. No. So I'm telling you total assets how much belong to 6,000 branches. Total revenue belongs to 6,000 branches. How much? This is audited by other auditors, and our opinion on total financials is based upon these reports. Clear? That's it. So with this 600 is over, 299 over, 700 over, 705, 706. 5 standards are over. Clear? Next. You're able to connect all of you. Next. So next we will discuss material uncertainty related to going concern. What is it? Material uncertainty related to going concern. So other matter paragraph is also over. Other matter paragraph is also over. Now we are going to discuss material uncertainty related to going concern. You all can take a notes along with this. Along with me, you can take a note of this if you want to. Check whether preliminary assessment of going concern is performed by management. In going concern, you should check first whether preliminary assessment is performed by management. If the answer is no, why they didn't perform? If at all they are not at all performing, we will give a modified opinion. We will give which opinion? Modified opinion. If at all management is not doing preliminary assessment. Yes, they performed. Check whether events and conditions are identified. If the answer is no, no events or conditions identified, auditor just have to verify preliminary assessment and express unmodified opinion. It's right away, no problem. Auditor will assume that going concern is appropriate. Verify the preliminary assessment related workings, and going concern is appropriate. Auditor will think that going concern is appropriate. Don't worry, first I'm drawing the diagram, then I'll explain you. Getting it? Then suppose no events and conditions are identified, some symptoms are identified that may cast a significant doubt on the entity's ability to continue as a going concern. If events or conditions are identified, if so, auditor has to do further audit procedure. Auditor has to do further audit procedure. Why are you doing further audit procedure? To determine whether there is a material uncertainty. To determine whether there is a material uncertainty. Suppose if there is no material uncertainty, even some symptoms were there. Sometimes company there may be a loss possible. There is a possibility of loss sometimes. For some years loss will be there. Loss in P&L account, negative cash flow. These are an indicators, right? Financial indicator for going concern, right? Yes or no? So financial indicators will be there sometimes, but that doesn't mean company will stop. So parts and parcel of the business, losses something. So events or condition identified, but no doubt about the future. No material uncertainty. When there is no material uncertainty, auditor has to check whether applicable financial reporting framework require disclosure of those events or conditions. Check out whether the company disclosed or not. Check out reporting requirement is there in the framework to disclose these events and conditions. Company disclosed it. Unqualified opinion. Correct? With respect to going concern. Suppose no events and conditions are there, but uncertainty, going concern are not affected. But financial reporting framework says company has to disclose the events, but company did not disclose. What we will give? Since they did not disclose what is required in the framework, we give which opinion? Modified opinion. This point standard is silent. Or they just ask the auditor to check whether applicable financial reporting framework requires disclosure of the events or not. Check it out and see whether they disclosed or not. What if they did not disclose, standard did not tell? We should understand. Clear? Suppose if material uncertainty is there, investigate the other evidences. You investigate whether this uncertainty can be resolved or not. Suppose not just uncertainty, company completely about to, company management decided they can't resolve. The company management decided they can't resolve the situation at all. No prospects at all. Company cannot recover from this uncertainty. For sure they will fail within next 12 months. That is what the evidence indicated me. No, already negative cash flows. Employee strikes are going on. Company operations are halted. Everything is stopped. Literally business is not happening. Going concern assumption is completely inappropriate. But still financials are showing going concern is appropriate. Which means a disclosure related to fundamental to the users is misstated. It's a pervasive. Which opinion auditor has to give? Right away auditor has to give what? Suppose going concern is inappropriate. After material uncertainty evaluation, you decided you decided going concern is inappropriate, and financial statements are not disclosing this. The financial statements are not disclosing it. What auditor shall do? Straight away adverse opinion. In basis for adverse opinion, give the reasons. Suppose going concern is inappropriate. Company also agreed, acknowledged, and they prepared financial statements on that basis. Financial statements they prepared on liquidation basis. Financial statements are prepared on liquidation, and in the financial statements they clearly highlighted that we are no more going concern, but since the timeline for reporting comes, we are preparing the financial statements, but company is not able to revive the operations. The liquidation process, all that will start very soon. Right now this is the status of the company. They honestly disclosed that inappropriateness related information in the notes to accounts. Then auditor will give which opinion? Honestly they disclosed everything. Unqualified opinion plus notes to accounts talk about this entire situation company is facing, right? Highlight that in emphasis of matter paragraph. This is what asked in recent May 2024 exam question number 1B. Are you clear? This is not there anywhere except in the pronouncement. This is not there anywhere except in the pronouncement, but I tell this point generally in class. This is what asked in May exam. Many students wrote material uncertainty related to going concern answer. That's wrong. That when it will come, I'll show you now. Understood? Clear? Right now what I'm discussing, going concern is inappropriate. Getting it? And the company disclosed financial statements are adequately disclosing entire the situation clearly. They prepared on liquidation basis. They presented clearly what is the basis of accounting. Everything they honestly presented. The auditor shall give unqualified opinion, and in emphasis of matter paragraph, auditor shall highlight what is the basis of accounting for preparing these financials, because the financials are prepared not as per GAAP. They are prepared as per some liquidation basis, because going concern assumption is missing. Clear? Suppose no material uncertainty is there, some symptoms are there, uncertainty is there. When I did further audit procedure, company is giving me all the future plans. The company is explaining me all the future plans. Superb, the plans and all are superb completely. Material uncertainty is there. You know, where company is proving me, sir, don't worry, sir, right now it is appropriate. I know we are having losses. I know we are paying lately to the creditors, all that. But we are honoring, sir. Within the timelines, we are honoring. We are borrowing loans, sir. We are raising extra funds, sir. Forget about it. We are having accumulated loss, sir. All that forget. Are we functioning properly or not? Yes, you are functioning properly. And these are our future plan of actions to revive this situation. So company showed future plans, assumptions, everything they showed. I verified all these assumptions and all. I felt now in the next 12 months, company will not dissolve. But there is a uncertainty. We don't know what will happen in the next 12 months, but I cannot say that it is inappropriate, because right now company is functioning properly. Just that they're having accumulated losses so much, just that the net worth is negative, just that the working capital is negative, but still company is honoring plus or minus with some 10-20 days due date. They're honoring, but in the next 12 months, I don't know whether they will be the same situation or not. I don't know. Even on the date on which I'm giving audit report, still the company is honoring every payment. There is no strikes that and all going on. From balance sheet date, next 12 months, I don't know whether the same situation continues or not. Material going concern is fine right now, but material uncertainty exists. But material uncertainty exists. Here material uncertainty is what kind of uncertainty? 100% not uncertain. 100% not certain. Somewhere in the middle. So 50-50 chances. Company may revive itself, may not revive itself. Company is finding some private placement, equity, some private investor they're going. So they're going for private placement. If they get extra fund, they will revive the company. Otherwise, they may not revive. This situation, company, going concern is appropriate, but material uncertainty exists. Now what auditor shall do? The auditor shall do the following. The auditor shall do, if going concern is appropriate but material uncertainty, I will simply ask the company, please disclose that entire situation in the financial statements. The company not disclosed. Company is not adequately disclosing material uncertainty related to going concern. They said going concern is appropriate, but this uncertainty is there, right? They are not disclosing in the financial statements. They are not disclosing in the financials. What auditor has to do? Qualified opinion or adverse opinion? In reasons, basis for qualified opinion, basis for adverse opinion. Correct? All of you. Generally, if the situation comes in reality, we directly give adverse opinion. If at all company going concern related disclosures are wrong, we straight away conclude it is pervasive. You can treat it as adverse opinion. Suppose company, they clearly mentioned. For example, you look at Air India. The Air India, the financial statements clearly mentioned. The financial statements clearly mentioned. The company has incurred a net loss of 7,000 crores in the current year. 70,000 crore accumulated losses is there, because of which complete net worth is eroded. In spite, which may cast a doubt on going concern, the management is of the opinion that going concern is appropriate in view of support from Government of India. Though there are 70,000 crore negative, though the cash and bank balance are negative, working capital is negative, the company still feels going concern is fine. Why? Because Government of India is supporting. So then why? What is your problem? How long Government of India will support? That's the problem. When they will withdraw, we don't know, right? As long as it is supporting, you're fine. When they will withdraw, we don't know. This is the uncertainty with respect to Air India situation. And what the company has disclosed everything honestly. Note number 53, everything is highlighted in note number 53, this uncertain situation. Now when everything is highlighted, what opinion auditor will give? Unqualified opinion. But why they give qualified opinion? Here the qualified opinion is given on some other issue, not related to going concern. With respect to going concern, here matter is not there. In basis for qualified opinion, going concern issue is not discussed, which means on going concern point, what opinion auditor gave? Unqualified opinion. Correct? So auditor will give which opinion? Unqualified. But see, if at all this point is not explained by the auditor here, how do people know that there is some important issue? So what auditor can do? In note number 53, he has to highlight, where he can highlight? Emphasis of matter para. But emphasis of matter paragraph is only normal para where it highlights important issues. But this is life and death issue of the company, like a continuity of the company. So highlight it with a separate name called material uncertainty related to going concern. Many students wrote this answer for the question which is asked there. May 24 attempt. You are getting the point? May 24 attempt, they asked this question. Which is there in the pronouncement. But many students wrote this answer which I am going to tell now. So yes, if going concern is appropriate, material uncertainty is there, and yes, financial statements are adequately disclosing that, then which opinion auditor will give? Unqualified opinion, and highlight that under not emphasis. Dedicated para they gave to highlight. Remember, material uncertainty related to going concern. This is a section in the audit report, right? This is also an emphasis, right? This is also an emphasis of paragraph kind only, because here also you're just highlighting, you're not talking anything. But here you're specifically talking about going concern. Draw your attention to so and so. You see Air India, we draw attention to, so like having regard to so and so fact, and our opinion is not modified. Same EOMP requirement only. Our opinion is not modified. All these points, where it will be there? EOMP. Clear. That's it. 570 is over. This is what there in the entire 570. If you look at entire 570, the standard will have these components. So first of all, what is the significance of going concern, which is an accounting related content. Then they will talk about what preliminary assessment management has to perform. Management has to perform preliminary assessment. For example, what they need to perform? Actually 570 is not there. 570 is not discussed in depth for you in CA final. It is there only in the CA intro. 570 discussion is there only in the CA intro. In CA final only diagram is given. There is a chapter called completion and review. Inside that there is only one diagram which is given, but questions will be asked very in depth. For that, you need to refer CA Interbook Going Concern Matter. CA Inter Going Concern page is 4 pages discussion. Going Concern 4 or 5 pages is there. Discussion on Going Concern. Approx 5 pages is there. That much and all again not possible at final. Yes or no? So what I did is I gave a mediocre content, like not giving that detail, at the same time not ignoring like institute. So I gave a medium content. So auditor has to check whether management has performed preliminary. Whose responsibility to assess about going concern? Management is responsible. They should do this preliminary assessment. First they do basic assessment, like they will look at nature and condition of the business. Are there any external events that are affecting business? Are there any operational forecast foreseeable future data is available that shows company going concern is affected? Are there any big events, transactions happened that affect going concern? So preliminary assessment they will do. If at all in all these cases the answer is no. No events and conditions are identified. No events and conditions are identified. Auditor also will verify these, whether management did this assessment. He just verify the workings, he'll directly proceed, give unqualified opinion with respect to going concern. Suppose if in the preliminary assessment management identified some symptoms, management identified some events or conditions. What do you mean by events or conditions? Events and conditions are broadly categorized into financial indicators, operating indicators, and other indicators. For example, like indicators are what? These are the events and conditions that cast a doubt on the going concern. They are only indicators. That doesn't mean going concern is for sure affected. If you find the indicator, you need to do further audit procedure. If you find this indicator, what further audit procedure you should do? You should do further audit procedure, like whether first of all company has a policy of going concern assessment. What is the management plans for future actions to deal with these events? Whether entity prepared a cash flow forecast. If so, what is the data they are using? Whether assumptions are reasonable or not? Whether any additional information is available to the auditor, because management did this assessment 4 months ago. Now as on audit report date, I should once again check. Remember, CARO clause number 19. Yes or no? Material uncertainty point only. On the date of audit report, do you still think whatever liabilities that were there on balance sheet date will company honor? Think about it on date of audit report. So on the date of audit report, do you find any additional information available related to going concern? Check out and get a written representation from management. Ask them to give a declaration that you are going to implement these plans. These plans will revive the company. Give me a declaration. Are you clear? Have you studied this? No? Fine. Suppose now when material uncertainty exists, what auditor has to check? Events or conditions are there. Uncertainty is there. You just have to check whether financial statements are disclosing clearly that. Suppose no events or conditions there, but it does not result in uncertainty. That's just a normal loss. This year alone we got a loss. That too because of some extraordinary activity, some extraordinary item. In that case, see whether financial statements provide adequate disclosure as requirement of applicable framework. Same the diagram which I told. So no. Suppose if material uncertainty is there, material uncertainty is there, events or conditions identified that resulted into uncertainty, and that uncertainty is like highly uncertain in the sense you felt that going concern is inappropriate. You felt that going concern is inappropriate, but still company prepared using going concern basis. The auditor shall express adverse opinion. Suppose going concern is appropriate, but material uncertainty exists. Financials are not disclosing this. For example, auditor will give either qualified opinion or adverse and indicate the reasons in this. Suppose going concern is there, material uncertainty is there, Air India. Which auditor will give which opinion? Unqualified opinion, and draw attention to the readers to the specific note point with a heading called material uncertainty related to going concern. When this has to be done, if auditor concluded that financial statements adequately disclose material uncertainty that may cast a significant doubt on entity's ability to continue with going concern, and management should disclose clearly that entity cannot realize its assets and liabilities in ordinary course of business if at all going concern is missing. That fact also they must disclose clearly. If everything is disclosed clearly like this, then I will give unqualified opinion. Highlight that point in audit report. Under which section? Material uncertainty related to going concern. But the CA Institute book, CA Inter book, nowhere they spoke about going concern inappropriate. Company also prepared, you not using going concern, liquidation basis they prepared. What auditor has to do? Pronouncement only contains that discussion. Getting it? So what auditor has to do? Auditor will express unqualified opinion. Auditor shall draw attention to the basis of accounting followed for preparing financials without using going concern in a separate, in under emphasis of matter paragraph. Auditor has to draw attention to emphasis of matter paragraph. This is the question which exactly was asked in May 24, question number 1B, 4 marks question, so 5 marks question. Clear? That's it. Going concern 570 is over. By the way, what are the indicators? Financial indicators. Net liability position, borrowings and all coming towards maturity, but I don't have money. Negative cash flows, adverse ratios, operating losses, dividends we discontinued just because we don't have cash. We are unable to pay creditors on due date. Cash, until now they used to give credit, now they are only giving on cash on delivery basis. Inability to launch a new product. These are all indicators of going concern. Financially, we are unable to do. Sometimes there will be operating indicators, loss of key management, loss of major market, labor difficulties, highly successful competitor is emerged. In all these cases, we have questions. Other indicators, non-compliance with norm, Paytm, which has not complied with KYC norms, Paytm Bank, RBI suspended their license in Jan or February month. Pending litigations, if at all successful against the company cannot discharge that liability. Environmental litigations and all will be there. If at all company failed in that litigation, they have to close the business. Changes in law that affect adversely the company business. Changes in law which is affecting adversely the company. Uninsured, underinsured catastrophe. Some catastrophe occurred, my machineries and all were destroyed, insurance is not sufficient. Then also going concern will affect. That's it. The standard is over. And by the way, you have to communicate. The auditor shall communicate. They may ask you this itself for 4 marks. What are the communication requirement to those charged with governance in relation to SA 570? The auditor shall communicate whether events and conditions constitute material uncertainty, whether management use of going concern is appropriate or not. Auditor should verify and communicate to the management again. And adequacy of disclosures, implications for audit report. So before finalizing audit report, you first tell them, this is what I'm going to do. Because of so and so disclosure, you have to do all this. You didn't do that. That's why I'm going to do this. If at all management reply, no, don't do that. We will revise the financial statement disclosure so that it's true and fair. Then you will give which opinion? Unqualified opinion. Are you clear? That's it. 570 is over. Next. By the way, in this 570, they may ask you about preliminary assessment. This itself can, this is when, these are further audit procedure. When we will do this? When events and conditions are identified. Why we do this? To know is there a material uncertainty. To know whether there is a material uncertainty. You see the diagram? That's what I told. You see, so first auditor has to check whether management is doing a preliminary assessment. If yes, check whether events and conditions identified. If so, further audit procedure. If at all there is a material uncertainty, see is it inappropriate or still appropriate. No material uncertainty, check the requirements of the framework whether disclosures are made. Suppose material uncertainty not disclosed, adverse opinion. Going concern is inappropriate, not disclosed in financials, adverse. Disclosed in financials, unqualified, emphasis. Suppose going concern is appropriate. But material uncertainty exists. Whether the financial statements are disclosing it, yes, unqualified opinion, highlight it in the material uncertainty related to going concern. Suppose it is not adequately disclosed, give qualified opinion or adverse opinion and highlight the reason in the basis for adverse or qualified opinion. Clear? You're all. So that's about going concern. 570 is over. In the ICA book, the standard is not given. They only gave a brief or diagram. They just gave a diagram which is not complete. Clear? So 570 is over. Material uncertainty related to going concern. Now we need to discuss what? Key audit matter. So material uncertainty related to going concern is over. Now let's discuss what? Key audit matter. Okay, 2 minutes, I'll continue. There is a question on 570, SA 570. Suppose, I will show you one question that is asked in May 24. I already highlighted that point to you. Suppose question number 1 you see. I think this 1B only, no? Sorry? 4th question. 5. Question number 5 adu. No. That's a review related engagement. That's a review report. We have not yet discussed that. We'll discuss that later. At that time I'll tell you. It's a review related, but anyhow that issue I will address. See, the question is, SA 570 we discussed, right? Whether, how to figure out whether going concern is inappropriate versus appropriate but a material uncertainty exists. Going concern is appropriate but a material uncertainty exists. How to figure out the difference between this and that? Like you take Air India itself, in their 1920 audit report, they clearly mentioned the going concern is appropriate. However, a material uncertainty exists. This is the situation Air India presented. What they mentioned is, so the company has a current year loss of some 7,000 crore, accumulated losses of so many crores, 70,000 crore, and the firm is already having negative cash flows, but Air India management chosen going concern is to be appropriate in light of continued support from Government of India. That's what they said. Like government is giving the funds whenever they have to pay salaries, whenever they have to pay creditors, whenever they have to pay rents, whenever they have to pay any, like whatever fees, remuneration, whatever they have to pay, Government of India is supporting them. So they are fine, running smoothly now, even though they have an adverse situation. Now this situation, management is saying what here? Management is saying, since government is supporting, we don't have any problem, we will continue. However, my question is, how long Government of India will support? Already there are so many talks that government want to sell this Air India or government want to liquidate the Air India. There are talks going on, which means right now you are getting funds from the Government of India and you are paying, that and all is fine. Right now it is okay. But material uncertainty is existing. Agreed? In the next 12 months, when the government will come back and say, I will be withdrawing support, we will liquidate. We don't know whether when the government will come and tell. Right now you are getting money and you are paying everyone on time, so you are successfully running. So this is going concern is appropriate, but a material uncertainty exists. And what we have to do, we will request the management to tell the situation in the notes. If at all governments withdraw the support, the company has to liquidate. The assets and liabilities, whatever you saw in the balance sheet, may not fetch the same values in reality. You tell the fact. So let people be aware of that. There is an uncertainty on the support from the government. This is going concern is appropriate right now, but a material uncertainty exists about the future. Clear? Now if company disclosed it in the financial statements, everything clearly. What we have to do? We have to give unqualified opinion. We have to give what? Unqualified opinion. And this situation you have to highlight, right? For that, what the standard says, they gave a dedicated para. They gave a dedicated para, material uncertainty related to going concern. There is a dedicated para they have given. In that you highlight. You are not modifying your opinion. You just highlight it. This is the question. The second one, for example, Government of India, they gave in the month of March beginning itself. We are withdrawing the support. We will start the liquidation process in the month of May. In the meantime, there are some formalities which company has to do. They gave a list. Government gave a list of formalities the company has to execute in the next 2 months. Now tell me, by the time March 31st comes, by the time company starts preparing financial statements for this year where government already withdrawn the support, where there is no scope for the Air India to run the operations, they have to halt all the commitments honored, already whatever commitments given, whatever flights scheduled, please honor it all that and then we'll stop. So next 1.5 months I'm honoring works are going on. After that, liquidation procedure starts. Now here can the management say going concern is appropriate? Uncertainty. It's not uncertain, it's certain. You are going to liquidate. It's certain, right? It's very much certain now that you are going to liquidate. Now tell me, is going concern appropriate? This is called inappropriate. Going concern is inappropriate. Okay, going concern inappropriate. What management did, they prepared financial statements on liquidation basis, because the time comes, statutory duty. Management, no, they want to prepare financials on a liquidation basis. Realization basis, they prepared. In the notes to accounts also, they clearly mentioned on what basis the accounts are prepared. Financial statements are prepared, they highlighted everything. Now what auditor has to do? Since everything is prepared honestly by not choosing going concern assumption, they didn't choose going concern. Without going concern, they prepared. And what is the basis also they showed. Now I will give which opinion again. If at all I have to give on this financials, unqualified opinion. Now this point I should highlight, right? Where should I highlight? What is the basis of accounting? I should highlight, right? I can highlight it under emphasis of matter paragraph, because I don't have a separate paragraph in the audit report addressing this issue. Agreed? Because I don't have a separate paragraph in the audit report, for material uncertainty, going concern appropriate, but material uncertainty exists. Further, there is a separate paragraph addressing it. But for this situation which I told, going concern is inappropriate. Company prepared as such. Liquidation basis. I want to highlight that. For that, there is no separate paragraph given. Therefore, what should I do? Emphasis of matter paragraph, I'll highlight. That's it. So, you see in 1B, this is the question which is asked. I'll directly read the matter. You see, drafting of opinion paragraph, all that. Basis of opinion, emphasis. We draw attention to note number 10 regarding Delhi branch office management's intention to close the operations of the branch subject to regulatory. Accordingly, the financials have been prepared prepared on the basis that Delhi branch does not continue to be a going concern, and provisions have been made in the books of accounts for the losses arising on account of closure, including losses. Emphasis of matter paragraph, they highlighted. You see, they asked about drafting. 5 marks question in May 24. Yes or no? You see, the opinion paragraph they drafted, basis for opinion paragraph they drafted, emphasis of matter paragraph they drafted. That is a drafting provision which is tested. Through drafting, analysis is being tested. Through drafting, you need to analyze the test, the answer. Like what is the question also, you see, 1B? Draft a suitable opinion paragraph and basis for opinion paragraph along with the disclosure of note number 10 with a suitable place in audit report in terms of relevant auditing standard. So first opinion will come, then basis for opinion, then emphasis of matter paragraph will come. Are you clear? The drafting question they asked. I was telling many a times the drafting questions will be tested. In MCQs they are being tested many times. Direct questions they are testing. In CA Inter also they are testing. Nobody will pay attention to drafting. So drafting, you just observe once. Absorb it. Enough. If it asked, you can write reasonably. Clear? See, never think like this. If going concern inappropriate, we should like this. No, that's not the way. Emphasis when we will use? If a matter is disclosed in financials. If you think that is important, you can highlight here. That's it. Obviously, going concern issue important. I'll highlight it. Simple logic. Are you getting it? Don't think going concern should be highlighted. No, that's not the question. If it is important, we will highlight. Obviously, going concern inappropriate. So the company presented financial statements by not following going concern, but by following some realization method, liquidation method that they discussed in the financial statements. Is that not important for the user? I will highlight. That's it. Clear? Next. Like in the general discussion among students, they think marathon itself is enough. No need to go for regular. They'll be thinking like that generally, because in marathon itself they'll get so much clarity. I absolutely agree. You will get clarity in my marathon beyond many other regular classes that are there, but you will not get command. Command you will get only in the regular class. If at all my marathon and regular is same, how come I'll get business? Yes or no? But definitely I'm telling you, I will give way better clarity. Superb. You will get a clarity on audit like never before. By the time you attend this 24 hours of recording, this session, you will get a clarity enormously on audit like never before, for sure. But the command is different. By the way, I am not here soliciting my regular class. Because at this moment where you are having exam in the November, obviously I don't recommend you to go for it unless you do not get confidence, unless you are not getting confidence. Getting it? That's it. So like I'm just clarifying people perception. Like his marathon, if you watch and study, that's enough. Either do complete self-study, after finishing entirely the self-study, come and watch the marathon, that will be useful. Or if you think we'll watch marathon and study only those points, no, it will not work. The main reason behind fast track classes and marathons why I will not sell, because if I start selling that, only that content which I cover, student will revise. He will not revise the remaining ignored content. That too, this content, whatever extent I explain, only that much he will study. He will not analyze the context fully with examples, with all cases and all, how questions can be asked in institute, all that. So that is the reason which will backfire me more. Since it's a free product, marathon or revision, so they can't blame me. Yes or no? So that's the reason in marathon, I try my level best to give clarity so that at least you can do on your own later on. If at all a student thinks that it is not possible or you don't have like why to take risk, then I will advise them. That's how it is like. So I'm just clarifying, marathon can never be equal with regular. I think you can tell, right? 100%, right? You found the difference? Yes. Like people feel like especially those who attended my regular class, they feel like, arey, whatever is told to us, everything is told in this class also. No, I have told you so much of interpretation part. I have so many examples, so many question and answer, because I need to satisfy them also, right? Hey, like for you, there is a different product. Here it's a different product. I need to explain them. Getting it? So it's completely different, altogether different. But at this moment, you need not even think about this. You can happily, comfortably go ahead. But those of you who are watching in the YouTube, they'll put comments. No difference between regular and marathon. All my friends told. For regular student, it appears everything we are covering and it's neatly going. But for first timers, they understand it is bit fast. Getting the point? Obviously, it's a marathon class. It's a fast track class. Fast track by definition is fast. Yes or no? So obviously it's a fast track class. This much syllabus, 24 hours time we have. How to cover? Understood, right? We have totally 46 standards. 46 standards, CARO reporting, 143 subsection 3 reporting, 143.1 reporting, professional ethics, risk assessment, separate chapter is there, strategy, separate chapter is there, and internal audit and forensic. This is what I told that I will cover in this. How do you think I can cover if I don't go at this level? And by this time, you must all have, like, see, what is a marathon? You must sit and acknowledge what I'm speaking. That is what you are coming here for, not for knowing what is there in the subject. Agreed? This process you must have completed earlier. And I know definitely many students are discovering so many new concepts that were there in the syllabus which they didn't study. This means your original preparation process is inadequate. When it is inadequate, you are not eligible to attempt November. But that's okay. At least consider this. Take this as a basis and identify how many different ways of questions can come, how much syllabus is there. At least these 2 months, if you rectify, revise your preparation plan accordingly, you will do well. If you are still in the same old mindset, not covering entire these points, one question mark I'll study and go right, it will not happen. May 24 attempt, group 1, most of the students failed only because of audit. Only because of audit they failed, not otherwise. They got exemption in SFM, they got exemption in FR, they failed in audit with 30, 28, 22. You're getting it? These are the marks. They wrote correct answers, but not for the question which is asked. Because, that's how I showed, right? Just now going concern itself, I explained you how the question was actually and what students wrote. Every question I'll tell you what is exactly as what they wrote. and what they are supposed to write, what they're writing. I will explain all those slowly. So now we'll begin key audit matter. What is a key audit matter? Only 20 to 25% of the students who are reading key audit matter will understand truly the context of key audit matter. Many don't understand the context of key audit matter, but they read. They think like mugging up the subject will help. It will help if at all I have only 10 standards. I have 46 standards. I have bank audit, NBFC audit. We have internal audit, investigation, forensic, due diligence, ethics, and SDG, digital audit. So many were there. Mugging up will not work unless, see, mugging up requires 20 times reading, more than 10 times reading minimum. Then only the extreme hardcore process. Suppose if you study conceptually, understanding the context, why these points are there under this particular side heading, what is the relevance between these two, and what is its relevance in the overall standard, and revising the standard as a whole with a bird's eye view and in-depth revision. If you do like this, you just have to require 3 to 4 revisions. 3 to 4 revisions. And remember, each revision will not take same time. First time revision alone takes say 50 to 60 hours or 70 hours. Second revision takes 15 hours. Third revision takes only 10 hours. So number of, when I say 3 revisions means 3 into 60 hours. No. Learning curve is there, na? You know learning curve. As you do the same process again and again, your speed increases. Yes or no? That's learning curve, will be there. So 3 revisions to 4 revisions will be sufficiently enough, more than enough. Getting it for audit. Those who don't understand the subject, they always forget. No matter how much they study, they always forget. For example, in 620, I'll show you what kind of confusion you will get. Key audit matter. What is a key audit matter? For example, Air India, I will show you. Air India, I will show you. Some India is 116, they have adopted for the first time. The company has adopted Ind AS 116 for the first time. The company has applied Ind AS 116, standard to its leases of aircrafts and land disclosed under PPE retrospectively with a cumulative effect initially by applying the standard so and so. Accordingly, the company has not restated comparative information. Instead, comparative information is not. See, whenever, comparative information must also be prepared in the same line with the current year financial information. If at all current year financial information, any of the principles were changed, automatically comparative figures also shall be restated. Correct? So that only a proper comparison can be made. If you apply Ind AS current year figures, previous year figures on some other standard where the principles of recognition, measurement are different, how can people can compare and take an adequate decision, proper decision? So restatement they have not done. And you know what? The cumulative effect, they're all probably disclosed everything honestly in the financial statements. Everything is fine. So auditor selected this as a key audit matter. Why? What is a key audit matter? Look at the definition. Look at the breakup of the key audit matter. Important audit matter. In the audit, auditor felt some matter which is important. Definition says the key audit matters are those in the professional judgment of the auditor were of significant in the context of audit of current period. In the context of audit for current period, these matters are selected from those matters communicated with those charged with the governance. That's very common sense. Important points only I will discuss with those charged with governance. For example, SA 260 says significant matters to be communicated to those charged with governance. Significant findings in the audit shall be communicated to those charged with governance. Significant difficulties arise in audit shall be communicated to those charged with governance. SA 260 itself says what are all matters you have to communicate to those charged. Look at those matters and select key audit matters. Enough. You need not even apply judgment. Whatever SA 260 says, you would have followed it in audit. So select those matters. Enough. Now, okay, you're selecting. What are you telling here? You are just telling company what they did. Some Ind AS they adopted. Because of this last year figures, they didn't restate. That issue and all you explain. Okay, what is happened, you explain. What you did. Okay, this is the issue. What you did. What auditors have done. We have obtained an understanding of process relating to so and so asset. We have reviewed the methodology followed by the management while applying Ind AS. We have reviewed the inputs used for determining some borrowing rates and all. So we have performed computation checks and all. We have reviewed the disclosures that are made in the financial statements also. Refer so and so 3 in our qualified opinion section, and emphasis also if at all you want to, because on this matter auditor would have qualified. Because comparatives are not restated, that's against financial reporting framework. So auditor would have given a modified opinion. So already gave a modified opinion. And again highlighting this as a key audit matter. Can he do so? Yes. As a complementary you can do. As a substitute you cannot do. Key audit matter is not a substitute for modified opinion. Suppose comparatives were not restated properly, which resulted in material misstatement as per the framework, right? Comparatives are materially misstated, right? Suppose you cleverly thought, let me not qualify, let me directly discuss it under key audit matter. Let me directly discuss it under key audit. That is not permitted. Suppose you qualified already. Here you see, refer para 3 of basis for opinion para. What is there in the basis for qualified opinion para? Paragraph 3. Non-recognition of right to use and corresponding lease liabilities as required by Ind AS. That is one of the reasons why auditor have given qualified opinion. But still the same is selected as key audit matter. Yes, it is possible because they selected, because they complemented it. They didn't put it as a substitute. They ignored there and commenting it. That is not done. Yes or no? So key audit matter is not a substitute for modified opinion. Understood the meaning? If at all something which is done mistatedly, you must qualify. You must give modified. You did that? Okay, you want to also talk about in key audit matter? Talk about it, no problem. I will not object. But without qualifying, which is a material misstatement, you are commenting under key audit matter? No, that's not correct. Sometimes, let us assume company did everything correctly. Let us assume company restated everything correctly. Still auditor selected it as a key audit matter. Why key? What is key? I felt it is important, that's it. What is important in my audit? In my entire audit, there are some issues which I felt important. Okay, describe them. What are the issues? Don't tell all the important issues. Select some few issues and tell them how you addressed. What are the audit procedures you performed? How you performed the audit. Key audit matter section just simply tells what important issues you faced in audit, how you performed the audit. That's it. Whereas emphasis of matter paragraph, notes to account, some note point is there, read that. Other matter paragraph, branches, I am not responsible. So emphasis of matter paragraph and other matter paragraph talks about responsibilities of auditor, important points in the financial statements that we are highlighting or we are talking about responsibilities. Then what key audit matter talks about? Key audit matter talks about audit process. How we are doing audit. How we are doing audit? Generally in audit responsibility section we told, we do audit as per standards on auditing. Our responsibilities are risk assessment, going concern, appropriate accounting policies. All this, that is how you are doing audit conceptually. I want a real example. Look at key audit matter. I will tell shareholders, look at key audit matter if you want a real example of how I verify. For example, there is an issue called Ind AS 116. If you can understand, read, and what I did also read and go enjoy. Key audit matter is this exactly. Key audit matter is not something anything else. In key audit matter, we just describe what is the matter that we felt important and how we resolved it. How we addressed it in the context of our audit. That's why you see introduction language, how it will be. Key audit matters are those in our professional judgment were of most significant in our audit of financials of the current period. These matters were addressed in the context of audit as a whole and informing opinion thereon. All these matters we addressed in audit. We verified all this. While forming our opinion on financials, we verified all this, addressed all this. Then why are you discussing here? I am just discussing if you want to know one example of how I do audit. You want to know how I do audit. I cannot sit and tell you for what 50 days I did. Some important issues I will pick. What I verified I will give you. Based on that you imagine how I do audit of others also. Just it will provide insights about the audit process. Understood? You see, that's what key audit matter. Purpose of key audit matter is what? The purpose of key audit matter provide additional information to assist them in understand areas of significant matter. People will understand what are all important matters the auditor focused on most in the audit. They will understand. Key audit matters they enhance the value of the audit report by providing greater transparency about the audit. So people are understanding. They means audit means what? They own, definitions, all that. How I exactly do the audit, they don't know. That's why I am picking some audit areas in the audits which I perform and explaining them how I verified them. Simple, right? Like this, you cannot communicate a material misstatement without modifying. Cleverly, see, you are, tomorrow what auditor will say, there is a material misstatement. Instead of qualifying, auditor will communicate under key audit matter how we verified this misstatement without qualifying. Don't be clever like this. If there is a material misstatement, qualify. First to qualify in the opinion paragraph, you should say that it is wrong. Don't say how you verified this. I will accept this if you qualify. Suppose there is no material misstatement, that's okay, no problem. You have evidence, no, that's enough. Are you clear? So any matter, if at all I am covering under key audit matter, already if some reflection is there in the notes to accounts, I need not talk about it. Yes, or I need not once again cover it under emphasis of matter paragraph. Agreed or not? All of you, that's it. So look at the content. Now, so communicating key audit matter is not a substitute for disclosure in financials, not a substitute for modified opinion. Or are we providing any separate opinion on these matters? No, it is not a separate opinion, and even it is not a substitute for 570 reporting where material uncertainty related to going concern exists. Agreed or not? Easy. Now, when this standard is applicable, this standard is applicable for audit of all listed entities, compulsory. For sure, you must give. For other entities, if auditor decided to communicate, he can communicate. Where if there is a requirement in law, then also you communicate. Getting it? However, communicating key audit matter is prohibited if auditor is disclaiming the opinion. Disclaimer of opinion indicates what? You didn't audit. When you didn't audit, where is the question of important audit matter? Simple logic. Correct? Important audit matter means you have you audited. You audited, in that you select what is important. You didn't audit, you gave a disclaimer. Where is the question of important audit matter? That's why key audit matter is prohibited. Clear? Then how do I select key audit matter? Generally, you can select it from the significant matters communicated to management by default. If at all you are still doubtful, if at all you want guidance on how to select key audit matter, very simple. Select the area which is higher risk, significant risk. Select the area where significant judgments involved, significant accounting estimates involved, material high estimation uncertainty is involved. Select the area where high estimation uncertainty. What is high estimation uncertainty? We will discuss in 540 revision. We will discuss that in 540 revision. And you select, you may be selecting key audit matter that belongs to some significant event or transaction. That belongs to some significant event or transaction. For example, suppose for each of it, for areas of higher assessed risk. Let us assume there is a European company. Just a minute. This is alphabet, United States Audit Report, US related. This is also a key audit matter, but just the name is different. What is it? Critical audit matter. What they selected? Key audit matter, loss of contingencies. Some contingencies related they matter. They described the matter, how auditors addressed the matter. Same reporting requirement, right? How in India we follow, the same is followed in the US, the same is followed in Europe, the same is followed in UK. In all the frameworks, the audit is same. Getting it? So here they have selected some loss of the company is regularly subject to claims, all that. So and so claims were there. Probably it might be some significant event. Getting the point? Claims and all are events, right, against the company. So this is the criteria. Reliance, in one of the year, they selected key audit matter of the following. Plant and machinery useful life, they revised it from 30 years to 50 years. 30 to 50. They revised it. Useful life is revised. The value of plant and machinery is some 4 lakh crore. That is selected by auditor as key audit matter. Key audit matters are those which caught significant attention of the auditor. Simple. Key audit matters are those which caught significant attention of the auditor. These matters are called as key audit matters. From where you can select these matters? Maybe in the area where high risk is assessed, significant risk is there. Maybe in the area where significant judgments are there, estimates are there with high estimation uncertainty. What is high estimation uncertainty? We'll discuss in 540. 540. Best example is decommissioning liability, And Ind AS 16. Provision present value of Decommissioning liability. Tell me, is it highly uncertain? Yes or no? It's purely an estimate which is highly uncertain. That can be selected as a key audit matter in the year in which it is capitalized. Getting it? Significant transaction event. Some merger happened, or some acquisition happened, or some major related party has been removed, or subsidiary company has been removed. That can be a key audit matter. Understood? That's it. Key audit matter discussion is over. And there are some points which auditor cannot disclose it as a key audit matter. Some points you should not communicate. Some points you are eligible to use key audit matter section in audit report. When you are prohibited to use that section itself, disclaimer of opinion. You are permitted to use, but the following don't communicate. Matters which are prohibited by law, matters where communicating them brings adverse consequences, don't communicate. Matters which are highly confidential and sensitive, don't communicate. These are all there in the 700 itself. Within the 700, key audit matter cited is there itself is there. Separate discussion on key audit matter is there. Inside that they have not covered. Inside 700 itself they covered this. Are you clear? That's it. Now, in 705, one more additional requirement is there. In 705, there is one requirement. For example, there is a clarification given by the institute. You will not find this like a side heading in the ICA book. You will find it as a paragraph continuation. So you need to figure out clearly. So there is a clarification. If you remember 805 standard. If I don't know how many of you studied 805, all of you? I hope you've gone through 805. By the way, there is an assumption from among the students, especially who are coming from old scheme, who are converted from old scheme to new scheme. They are thinking newly established, newly added standards. What are the newly added standard? 800 series, 2000 series, 3000 series, 4000 series, STG, digital audit. From all these weightages, how much they think? High weightage, 25 marks only. Not more than that. 25 to 30 marks only. Digital audit and this one also you remove. The weightage is 14 marks only. From these standards, in the last attempt only 12 marks only asked. Sir, new standards, no. For you it is new. For the paper setter is not new. It is there in this book. For him every page is same. For him every page is same. For you it is new. For him every page is same generally. In income tax only amendments and all are important. Getting it? In audit and all there is no such thing called new concept, old concept. Syllabus is there on this is the syllabus. From this they have to test. Proposed that very simple. All these 800, 2000, 3000, 4000. From these four put together 10 standards were there. And overall standards are 46. 10 by 46 is equal to how much? Some 20%. 20% or 22%, 21%. Out of 120 marks, 20% is how much? 24 marks. Maximum weightage. Maximum, not even 20, sorry, 15% only. 18 marks. That's the weightage which is reflected, 14 to 18 marks. It is in proportion to the remaining standards only. The syllabus, the points, the questions in the examination will be same proportion to the remaining syllabus. You can see last May exam, it is some 12 to 14 marks only they tested. MTP is also 14 marks only they tested. That's the weightage of these these four chapters: related service, assurance engagement, review engagement, specialized areas. From all these 10 standards, the 14 marks is the only weightage. 14 or worst case 16. Just because they are new, that doesn't mean 40 marks will be coming from them. Whatever remaining 35 standards were there, right? From them 45 to 50 marks came. Clear? Last attempt many missed this. And that marathon also I told very clearly this point. But people will not result until they experience, no? They studied, they ignored many standards on auditing, they focused only those 10 standards, especially converted students from old scheme to new scheme. And result 14 marks in the exam. Only 14 marks question. This fellow would have got 3 marks out of 14. That's a different scenario. Next. So in 805, you have a requirement. You remember in 805, can we give an emphasis of matter paragraph in an audit report that contains adverse opinion? There is a discussion on that. I'll clarify. You are prohibited to use emphasis of matter paragraph. You are prohibited to use emphasis of matter paragraph where you have given adverse opinion on the financial statements. You gave adverse opinion on the financials. In the same audit report, you are prohibited to give emphasis. Why? Emphasis, what are you doing? You are highlighting some 4 or 5 points. At the end of that, what are you saying? My opinion is not modified. In the above, what you said, financials are not true and fair. You said in the adverse opinion section, do not believe the financials, they are not true and fair. Below again you are saying what? I don't have any objection on these points. What does it mean? So it is contradicting your adverse opinion. It is contradicting your adverse opinion. Same way, disclaimer opinion you gave. You gave a disclaimer of opinion. I am unable to give opinion on the financials as a whole. And you want to take some 3 or 4 points. On this, I don't have any objection. So when the auditor gave adverse opinion or disclaimer of opinion in an audit report on a set of financial statements, complete set of financial statements, the auditor shall not give, shall not use emphasis of matter paragraph in the same audit report. In the same audit report, you should not use. Now, actually in the institute book, they will not highlight the sentence and all. They will not give the sentence. They will directly, you see, when the auditor considered it necessary to express, when it is considered, I mean, it's coming, don't worry. Yes. When auditor consider it necessary to express adverse opinion or disclaimer, on the financials, the audit report shall not include unmodified opinion with respect to same framework on a single financial statement or one or more elements in the same. So in the financials, you are giving adverse or disclaimer. The same audit report shall not contain unmodified opinion on a single financial statement or element of the financial statement. Understood? Which means you gave financial statements as a whole adverse. You don't come back and say balance sheet is true and fair. Don't come back and say notes is true and fair. Don't come back and say cash flow is true and fair. Don't say trade receivable is true and fair. How do we give unmodified opinion on a particular element in the audit report? Through emphasis of matter paragraph, correct? In emphasis of matter paragraph, we are highlighting some issues and saying that our opinion is not modified. Indirectly, on those points which we highlighted, are we giving unmodified opinion? That is prohibited. However, in 805, if you see, audit of single financial statement, specific element, item of the financial statement, yes or no? Suppose the complete set, general purpose auditors, they gave adverse opinion. But here I was appointed, exclusively called for trade receivable audit, or I was called for cash flow statement audit. Now on the cash flow, I want to give unqualified opinion, or I want to give unqualified opinion. For example, on the cash flow statement, I want to give unqualified opinion. Can I do so? Since this is a separate engagement, and if the item is not a major portion in the complete set, and the item is not a major portion in the complete set, auditor got sufficient appropriate evidence that this single financial statement or element is true and fair. You got sufficient appropriate evidence that this is a true and fair. This single financial statement is not a major item, or the element which you are doing audit is not a major item. You're getting it? And this report is a separate report from the general purpose report. In this report, you may give unqualified opinion, no problem. Are you getting it? Because here the report is different. Moreover, this is not a major item. This is a minor item. Very simple. The audited financials or complete set of the financial statements, the auditor gave an adverse opinion. Can another auditor, in respect of audit of single financial statement or element, can he give an unqualified opinion is a question. You can do so if at all that is not a major item. In a single audit report, can I give like this? No. That is here. That's the interlink between this and that. Understood? This is called conceptual understanding. Understanding sentence meaning. No, not that. Context based understanding. There, this you need to link. If you don't link these 2 points, in exam this they will ask and you will write that. You clear? Fine. Generally, if complete set of the financial statements were given adverse opinion, even on the single financial statement also, you shall give adverse opinion unless the following conditions present. That's how the 805 standard. Anyhow, when I come to 805, once again I will reconnect to this. That's it. So with this, 701 is also over. Confident? No. Yeah, very good. You reminded me that word at least. Very good. I'll explain. Now you see, so does it mean emphasis of matter paragraph in an audit report can be given only in a case of unqualified opinion and qualified opinion? Yes. If at all you gave financials as a whole adverse, in the same audit report, you cannot give unmodified opinion on a single element of the financials or a specific element of the financials. Because as a whole you said wrong. Why are you saying that this element is right again? It's contradicting your own opinion. Or when you are not giving opinion as a whole, which you are supposed to give, that time also don't select some specific points and give unqualified opinion. Understood? So that is what. Suppose I gave qualified opinion. Qualified opinions on some issue. I want to highlight emphasis some other issue. I can do so. Because as a whole I didn't qualify. No, I only qualified 2 or 3 points. This I didn't qualify. I gave unqualified opinion. You can highlight important points, no problem. You're clear? In a case of adverse opinion and disclaimer only, never use emphasis. Very fundamental logic. I said every balance sheet is wrong. Again I'm saying, go and see that important point. That I'm saying don't believe it. Adverse opinion means what? Don't trust it. When I said don't trust it, again I'm asking you, come back. This point you come and see. What? Is it contradicting your own opinion or not? Simple logic. Disclaimer, I will not give opinion because I did not get significant amount of data. How can you figure out important point in such a case? Then also you can't highlight the logic. But if at all you are doing separately a single financial statement audit, separate audit for specific element audit, getting it? So that's a different scenario. So that's why 805 addresses that issue. Now unmodified report means what? Modified report means what? You will get this discussion in 805 again. 805, at some places they use the word modified report, unmodified report. They use that word. You know, generally unmodified report means what? You know, under SA 700 there is a format. Actually here I am showing you the format of audit report, right? The contents of audit report. These are the contents of audit report, etc. Title, address, all this. If you look at original 700 format, you will not find these elements. You will not find these elements. 700 format is what? Unmodified report which contains unmodified opinion. You are simply giving opinion, basis for opinion. You are talking about responsibilities of management, audit responsibilities. Happily you are proceeding, no issue, nothing. That's unmodified report. Suppose I want to talk about important issues in the financials. I want to highlight, which means 700 report format you are not following. You are including 706 matters in audit report, which means 700 report format you are modifying, right? 700 report format you are modifying, right? That's a modified report. Sir, I gave unmodified opinion only. Your opinion is unmodified, boss. The report is modified. Why we call it as report is modified? Because you are not following 700 format. 700 format is unmodified report. If at all you modify that report, either because of emphasis of matter, other matter para, key audit matter, or because of modification to the opinion, whatever reason you modify the report, 570, other information, whatever reason you modify, that's a modified report. Clear? So which means a modified report also can contain unqualified opinion. That's it. This discussion is very relevant in 805. 805, this is very relevant. Even in summary financial statements also the discussion comes. I will link it there. That's it. Now with this 701 is also completed. Now let's continue with 720. Let's continue with 720, which is other information. Which is other information. Yes, just a minute. Yes, let's continue discussing SA 720. SA 720 we will discuss. So what is 720? Ayyo, very simple, I told already. Like one doubt is, what is the difference between emphasis and key audit matter? Very simple. Financial statement, some point is there, I want you to read that. What should I do? Highlight it. I did audit so many issues I have in audit. Some important issues is there. I just want to explain you what I did in that. Clear? That's it. I want to talk about division of responsibility. Other matter paragraph. So what is other information? SA 720. SA 720, what it says, auditor responsibilities relating to other information. Auditor's responsibilities relating to other information. Other information means financial, other information means information presented in annual report other than financial statements and audit report. Information contained in annual report other than financial statements and audit report. The standard is so simple. What are they asking is, company is giving annual report. The company is giving annual report. For example, I will show you Tata Motors itself, or else Reliance is there? No. Yeah, Tata Motors is there. I'll just show you this. You see, this is the Tata Motors annual report. You see, this is the Tata Motors annual report. And you see, what are the contents of this annual report? So many is there. Some board of directors, word from intro from board of directors, business segments they explained. They explained about growth responsibility. They explained about building some growing responsibilities, people and culture. They're explaining about their subsidiaries. They're explaining about statutory reports like management discussion, corporate governance, so many. And finally, they are coming to financial statements. And financial statements contains audit report also. Financial statements, along with that only immediately audit report also will be given. Now, which means the Tata Motors annual report contains financial statements and audit report in a document that contains other information. In a document that contains other information. Now, you see here in Tata Motors, they are giving how much sales they are saying. You see, profit consolidated. What are they? Consolidated. They sold 13,80,000 cars. Some 13,80,000 cars. Group revenue, oh my god, 4,37,000 crore they said in the financial highlight. Profit before tax 31,800 crore. R&D spent so much, like some financial information and all they gave, right? Okay, let me do one thing. They are saying 31,807, right? PBT, consolidated PBT. Let us see in the financial statement also the same is included, consolidated P&L. Okay, I'll go and see consolidated P&L. Just a minute. So this is consolidated balance sheet, consolidated P&L. Correct only. Profit for the year, how much they mentioned? 31,806.75. They said 807. That's okay, not an issue. Okay, fine. Which means other information is consistent with financial statements I audited. Correct? What if in the PBT there, for example, PBT in the highlights, no, they mentioned 40,000 crore. Immediately a reader who reads this annual report fully, he will get it out. They are saying 40, here auditor said 31 is correct, which is right. What auditor did not verify that, or management is correct, they'll get a doubt, right? To address this only 720 standard is brought. To address this only 720 standard is brought. What is the auditor's responsibility for other information? You are not responsible to give opinion on other information. What is your responsibility? What the standard says? The standard says your responsibility is to read the other information. Is to read the other information. You see, what is the responsibility of auditor? Audit procedure. Auditor first obtain what are all the documents comprises annual report. Obtain. When you should obtain? By the way, after date of audit report. Prior to the date of audit report. Final version you obtain. If at all full annual report, that and all documents are not ready by the time you are giving audit report, get a written representation that before you publish the document, give it to me. Representation. So they need to give a promise that, sir, don't worry, right now other information is still going on. First you give it, sir, we have to submit to holding company for consultation. First you give me. So company, I gave audit report with a written representation that management will give me other information once it is available before publishing to third parties. Fine. What auditor shall do? You shall read other information. Okay, reading it. What you need to check? Whether there is a inconsistency between other information and financial statements. I read entire the 300 pages document to figure out where and all financial figures and all they spoke, where and all business issues and all they spoke. Are they contradicting with the matter that is shown in the financials? Are they inconsistent or not? I will figure out. And not only that, my objective is to consider, is there any inconsistency between other information and auditor's knowledge? Maybe when I'm reading the annual report only, I got to know company future plans and all. My knowledge will get updated, right? Sometimes I may get to know about company subsequent events by reading other information. By reading other information, I will get to know subsequent event. So I may have to modify the audit procedure. So by reading other information, identify whether other information and financials are the inconsistent. Identify whether other information and your knowledge about the company, is it inconsistent? Further, be alert. Be alert that other information not related to financials are materially misstated. See whether other information is materially misstated. That is the objective of the standard also. You see, objective of the standard. The auditor has to consider whether material inconsistency between other information and financials. Is there any inconsistency between other information and your knowledge? To respond, okay, you found some inconsistency. Some inconsistency is there. Inconsistency means what? Other information, financials are not matching. Now you need to determine which is right. Is other information right or financials are right? Which is misstated, you should. So to respond appropriately when auditor identify inconsistency, is that inconsistency resulting into material misstatement in financials, or is it other information which is wrong? Report accordingly. Then report accordingly. That's the objective of the standard. So what auditor has to do? By the way, is other information reading? No. What is the responsibility for other information? Is it a separate assurance engagement? Am I providing any assurance on other information? No. In the context of my audit of financials, while giving opinion on the financial statements, I'm just reading other information to know whether any inconsistency between there or inconsistency between my knowledge and the other information. Only for that reason, only for that limited purpose. I am not reading other information to provide assurance on that. No. I am not giving any assurance on other information. By the way, is there any obligation on the auditor to verify accuracy of the other information? No, we are not. Only inconsistency there or not, I will check. If inconsistency is there, if I feel other information is apparently misstated, I will tell the management to rectify. If they don't rectify other information which is containing material misstatement, what I will do? Modified opinion, huh? Modified opinion I will give. The financial statements are materially misstated. Here financials are true and fair. Other information wrongly they are presenting. I should highlight that in other information section of the audit report. I should highlight that in the other information section of the auditor's report. For example, you see Tata Motors. This is you see other information they presented. What they presented? The side heading can be either other information or side heading can be any suitable matter. They gave definition itself. Information other than financial statements and auditor's report. This is the definition of other information. Side heading they use definition itself. Now tell me who is responsible for other information? Board of Directors is responsible. What other information will contain? Corporate governance report. Other information includes annual reports, annexures to annual report, but does not include financials. What you have to do? Our opinion is only on standalone financials. That does not cover other information. In connection with our audit, our responsibility is what? Read other information, identified above whatever other information. If at all they are inconsistent, we need to respond appropriately as per the standard. Based on the work we performed, the other information we obtained, we concluded that there is a material misstatement of other information. We are required to, okay, like responsible we are saying. If at all, based on our reading, based on procedures as per 720, if at all we identify any material misstatement in other information, we are required to report the fact. This is our responsibility. What auditors are saying ultimately, we have nothing to report in this matter. So indirectly what SBI auditors are saying, other information, everything is true and fail. This is the reporting requirement in case of other information. This is there for you as a question. You see, the auditor has to give audit reporting requirement. What is the audit reporting? A statement that management is responsible, identification of other information, and statement that prior to the date of audit report you should get it. A statement that opinion does not cover other information, description of responsibilities, and a statement that auditor has nothing to report. Understood? Suppose if material misstatement is there in other information, what auditor has to do? If material misstatement is there in other information, suppose if material misstatement exists in other information, request management to correct it. If management does not correct it, and concluded that there is an uncorrected misstatement in other information, a statement that describes the misstatement in other information section describe clearly what is the mistake happened. Suppose what if after reading other information you concluded that a material misstatement exists in the financials. After reading other information you got to know that financials are materially misstated. You investigated, you found it's a mistake in financials, not in other information. Then you will modify the opinion. 705 procedure will apply. That's it, the standard. Clear? But in the standard, no, suppose no, if misstatement is identified before date of audit report, because no entire other information is given to you. So you identified material misstatement in other information before audit report date. Ask management to rectify. If they don't rectify, you modify your audit report in other information section what mistake it is. Suppose you gave audit report where other information para you said nothing to report. You gave report. Now management gave corporate governance report to you. Sir, this is the final report, sir. As per your declaration, we gave you. Now other information contains material misstatement I found. Audit report I already gave. No, I'll take back. I'll take back the audit report. I'll modify the other information. That section. Suppose if audit report is already issued to the shareholders, everyone, without my consent. Without my consent, I will take appropriate action as per 560. As per 560, whatever I have to take, that action I will take. We will discuss at 560 that point. At 720 is over. Understood the concept? All of you? Sorry? I'm not getting it. Louder. Not getting. Bit louder. Okay. You didn't get evidence, so you are giving disclaimer of opinion. Later on. Sorry. Evidence there in other information. You gave a disclaimer of opinion on the financial statements. For what? Can you please narrate it? Okay. How come it will be? How come it will be, first of all? Hypothetical situations don't create. Unnecessarily you will confuse. Getting it? Yes. No, it's okay. Sometimes curiosity will make us to think over. So that's okay, not required. If evidence is not there and you give a disclaimer of opinion, and later that evidence is available in other information, what to do? I'll take back audit report. Evidence is there. If at all there evidence like this, I will see is it sufficient for my audit or not. And again, I will modify the audit report, give unqualified opinion. This is. But do you think this will happen? No, obviously not, right? Yes. Okay. That's it. First of all, question itself is wrong. Why, you know? How come I give opinion before reading other information? You're getting it? So how come I give audit report before reading other information? So technically it is not. If at all we have to give audit report before we read other information, before we give other information is available, we will ask a representation from the management that other information is made available to me. But in a case of disclaimer, do you think auditor will have a cordial relation with the client? Obviously not. Auditor will give disclaimer of opinion only when the relationship between the auditor and client is not cordial, it is not completely disrupted. So this discussion, this situation itself will not arise. So 720 is also over. Next. So now let's again go back to the auditor report. So other information section is also over. Other information section is also over. Then what else we have in various sections of audit report? Then you should tell about responsibilities for financial statements. You should tell people that who are responsible for financials. What is their responsibility? They are responsible for preparing financials as per applicable framework. Their responsibility is to maintain internal control so that frauds and errors are prevented. They are responsible to give me complete access to books and records, provide me additional information, provide me access to people. You need to tell, right? People, what is the responsibility of management? You should tell. Then you tell about your responsibilities. auditor responsibilities are broadly categorized into three parts. Primary responsibilities, responsibilities under various standards on auditing, communication related responsibilities, and that's the audit responsibility section. Then report on legal and regulatory requirements. By the way, I already covered how auditor responsibility section gets affected when auditor gave disclaimer of opinion. I already explained it in 705 discussion. Then report on legal and regulatory requirements, that I will get back later. Signature of the auditor. Then finally auditor has to sign the report and he should place the signature. Yes or no? Ordinary necessity. When you are signing, you should sign in the personal name of the member. If at all you are a partner in a partnership firm, you have to sign in personal name and represent as a partner of so and so partnership firm. Mention FRN and MRN, all that. Yes or no? Then date of the auditor report. The date of auditor report cannot be earlier than the date on which you completed the audit. It cannot be earlier than the date on which you completed audit procedures. It cannot be earlier than the date on which you obtained sufficient appropriate evidence about the financial statements. Yes or no? It cannot be earlier than the date of approval by the board of directors. Approval means what? They are signing balance sheet and P&L saying this is what I am going to issue to the public. On that only you should give audit report, right? So which means you cannot sign audit report before they approve it. So date of audit report shall be on or after date of approval, on or after date of obtaining sufficient appropriate evidence. Then UDIN. I hope every one of you know the significance of UDIN. I'm not covering. For all attestation, certificates, reports, whatever you do with effect from 1st July 2019, UDIN is mandatory. For all certificates, attestations, reports, whatever you issue, today UDIN is mandatory. That's it. Now, report on legal and regulatory requirements. What is it? Report on legal and regulatory requirements. Just a minute. Now let's begin the last section in the auditor's report, that is report on legal and regulatory requirements. You know, we have report on legal and regulatory requirements. We have totally 3 reporting requirements. We have one more requirement, 143 subsection 12, 143 subsection 11, 143 subsection 3, 143 subsection 1. The auditor has to inquire 6 matters here. The auditor has to inquire 6 matters here. 143.3, auditor has to inquire here, auditor has to verify 16 matters here. 143.11, which talks about CARO 2020, where auditor has to comment on 21 matters. 143.12, where auditor has to report to central government. What is it? Report to central government. Technically, it is not a reporting requirement in audit report. It's actually reporting to central government. But since 143 continuousness that I am covering here, that is not a reporting requirement technically speaking. Getting it? Now, so auditor has to report on close to 47 matters. 16 plus 6, 22 plus 21, 43 matters. How many? Correct only, na? 22 plus 21, 43 matters. So close to 43 varieties of issues, auditor has to give his opinion. Auditor has to comment his view in the auditor's report. 43 variety of matters. Where he will has to comment on all this? Report on legal and regulatory requirements section inside the audit report. This is also called as other reporting responsibilities. This is also called as what? Other reporting responsibilities. Reporting responsibilities under standards, reporting responsibilities under law and regulation. 2 parts were there. I am talking about reporting on other legal and regulatory requirements, which is enough. Clear? Now, what is report on legal and other, what is the responsible, what is the reporting on other legal and regulatory requirement? These are all the matters. Now, let's discuss 143 subsection 11, which is nothing but where the central government was given the power by the Companies Act to notify matters on which auditor has to give opinion. But before that, one point, you know, under 143.11, 143.3, 143.3 do, this is actually called as checklist item. This is also called as what? checklist items. We also call them as what? Affirmations by auditor under Companies Act. Affirmations by auditor under Companies Act. You know, on all these two, whether your matter, whether your reply is going to be positive or negative, both you must. Whereas on 6 matters, generally if your reply is going to be negative, only then it has to be reported. If at all your reply is positive, no need to report. Clear? Understood? So 143 subsection 11, CARO. So in CARO we have totally 21 clauses. Each clause is dealing with various aspects of the financial statements or non-financial statements, non-financial information. Now what auditor has to specifically talk about in CARO? By the way, CARO is applicable for all the companies, including foreign company, excluding what? Banking company, insurance company, section 8 company, small company, one person company, and a private limited company which satisfies 4 conditions, which is not a subsidiary or holding of a public company, whose paid up capital and reserves and surplus does not exceed 1 crore as on balance sheet date, whose borrowings from banks and FIs shall not exceed 1 crore at any point of time, and whose turnover does not exceed 10 crore. Right now this 4 conditions is useless, because most of the private companies are coming under small company. Straight away CARO is exempt. You need not even check this. Small company definition, less than 4 crore capital, less than 40 crore turnover. Most of the private companies come under these two. Yes or no? If at all a company turnover is less than 4 crore, paid up capital is less than 4 crore, and the turnover is also less than 40 crore, it's a small company. Straight away CARO does not apply. Why you have to come and check again 1 crore all these points? Then you might get a doubt. Then why this is included? Once upon a time, before CARO was introduced, before CARO 2020, which is applicable from 21-22 financial year, which is applicable from 21-22 financial year, Companies Amendment Act 2021. Before that, small company limits are 25 lakhs and 2 crore. 5 crore or something is there. Small company limits were. Thereafter, it was revised to some 2 crore and 10 crore. Thereafter, it was revised to 4 crore and 40 crore. That's how the revision happened. So earlier, small company is lesser than private company. That's why for private companies, separate limits were given in the CARO. You know, CARO was originally brought in 2004. Before that, in 1999, there is a CARO called MAO-CARO. MAO-CARO, Modified Auditor's Report Order, something like that. There is a name. 1999. 2004, it was CARO 2004. It was amended in 2011. It was amended in 2016. Then finally amended in 2020. This is the history behind this entire small company, private company conflict. You're getting the point. So right now, all the private companies comes within the definition of most of the private companies, small. If a private company satisfies definition of small company, no need to check private company limits. Limits checking is useless now. Are you getting it? But in exam, write an alternative answer. In exam, write, if a senior citizen tests the paper on private company point, yes or no, who does not update his knowledge about small company? Yes or no? So you will be losing marks. So that's why if at all a private company limits and all is given, you clearly write the main provision. The above private company is treated as a small company. Accordingly, CARO does not apply. Alternative view, if at all the above company is not classified as a small company, then private company conditions will apply, and this is the answer. You write an alternative view. 99% first view was only will be there in the suggested answer. 99%, I'm sure. Getting it? But I'm telling no suggested answer. If the person who designed question paper, he should only give suggested answer also. Give a valuation. And that guy is a super senior citizen who cannot update his knowledge. And if that fellow test, he will test only these 4 conditions. Next. Now, what are the points to be reported in CARO? Fixed assets. What auditor has to report on fixed assets? There are 5 aspects on which auditor has to report on fixed assets. About 1. Fixed asset register. See, in financial statements, in the opinion audit report, I am knowing whether balance sheet P&L is true and fair or not. But I don't know, is the company taking care of the assets? Is the company maintaining asset register? Is the company, like, what are all some issues are there? I want to know about those issues also. That's why CARO report is given. Is the company maintaining asset register, which contains a quantity and situation details? Is the company maintaining asset register? They're asking. The law, if the company is maintaining register, you say that they are maintaining. Second, is the company verifying the physical verification of fixed assets at reasonable interval? You check, you ask management, they are verifying once in 3 years. considering the size of the company, if you think once in 3 years is adequate, say that the company is reasonably verifying physically the fixed assets. If at all any differences were noticed on the verification, whether the same were dealt in the books of accounts. If at all when physical verification is conducted, no, by management, if they identify excess or shortage, they will record it in books. They will rectify that in the books of accounts. You check whether they rectified or not. Who did this verification, by the way? Auditor, management. Whether are they doing it or not, you have to check. Tata Motors is doing physical verification over a period of 3 years. Entire assets are verified over a period of 3 years. Tata Motors auditor said, looking at the size of the company and nature of operations and control systems implemented, once in 3 years is adequate. Getting it? Then immovable property. What is the reporting requirement here? Dear auditor, you saw immovable property in the balance sheet. I know that true and fair. I'm not asking that. What about the title documents? Whether are they in the name of the company or somebody else's name? If so, if at all they're on somebody else, what property, which building or which land is in the name of somebody? What is the carrying value? In whose name it is held? Why it is held? Why it is not in the name of the company? You need to ask, you need to report. Revaluation, another point which in fixed assets auditor has to verify is whether the company went for revaluation. Okay, that is part and parcel of the business. Revaluation will be done. If so, who did this valuation? Is it by a registered valuer? Is it by a registered valuer? In the May 24 RTP or MTP, somewhere I have seen this question. Auditor has been, the auditor CA has been appointed for revaluing plant and machinery. That's wrong. We are only permitted to value financial assets. We are only permitted to value financial assets. We don't have right to revalue plant and machinery property. We are not experts in plant and machinery, right? To do valuation of plant and machinery, to do valuation of property, we are prohibited to provide valuation services related to machineries, related to buildings. For that, separate some segment is there. Some other people are there for them. You are only permitted to do valuation of financial assets like shares and securities. Registered valuer is there, na? Who is the registered valuer? CA, who is the registered valuer? Who, like what he can do valuation? Only financial assets valuation he can do, not others. Clear? And now company did some PPE revaluation. What they are asking, auditor, you check who did that valuation. Is it a registered valuer? Check out and specify the change. If the change is 10% or more in aggregate of net carrying value of PPE. If at all there is a change because of revaluation. If the change is more than 10%. 10% of what? There are so many classes of PPE, right? Furniture, equipment, plant and machinery, buildings, vehicles, like these classes are there, right? In each class, there is gross carrying value, net carrying value there, right? In the net carrying value, more than 10% if there is a change, upward or downward, it doesn't matter. 10%, more than 10%, there is a change. Report it. Are you clear? Remember, there is a parallel reporting requirement in Schedule 3 as an additional regulatory information. This is a Schedule 3 requirement also. Company should also disclose this as a regulatory information in the Schedule 3. This is an additional. Even this also, it's a regulatory information. It's a regulatory requirement for the company to disclose it in Schedule 3. So regarding this, you should report in CARO. You should also check whether Schedule 3 contains these disclosures or not. Next is the disclosure of Binami. They're asking you whether any Binami proceedings were initiated against the company, pending against the company. They are not asking you to comment about status of the case and all. They are asking you whether the company disclosed it in financials or not. Why the company has to disclose this? Because there is a requirement in Schedule 3 under additional regulatory information. Under Schedule 3, there is a section called within the Schedule 3 in the notes, additional regulatory information. Under that, so many points company has to disclose. Working capital related issues, this title of immovable property issues, revaluation issues, Binami property issues, loans and advances related issues, willful defaulter related details. So many they have to disclose. That and all, anyhow you verify. Not only verifying that, you should also comment about them in CARO wherever there is a requirement like this. Clear? Fixed assets is over. And Tata Motors auditor, if you see, they have given everywhere positive opinion, unqualified. Everywhere they give a positive opinion. Clear? Inventory. With inventory, there are only two conditions. With inventory, there are only two conditions auditor has to verify. One, whether inventory is being physically verified by the management at reasonable interval. If at all any discrepancies of 10% or more in each aggregate of each class of inventory, we are only having 3 classes: raw material, work in progress, finished good. So within each inventory, upon physical verification, if they found a discrepancy 10% or more, how it is dealt in the books? How it is dealt in the books? You will have physical verification records will be there. You verify the records, you will find whether discrepancy was noted by the management or not, whether they were dealt in the books properly or not, you will find, and come back and report you. And physical verification reasonable interval means minimum once in a year. It must be once in a year. Why? Even under 501 you see, we should obtain sufficient appropriate evidence regarding existence and condition of inventory. Once in a year we must do. We must get evidence of every company which is dealing with inventory. We must get evidence. Existence and condition, how can we verify? By physically verifying. Indirectly, once in a year company must do physical verification of inventory. Yes or no? Fixed assets, okay, because there won't be movement. Inventory must be verified because there is a regular movement in the inventory. Clear? What happened, all of you? You're all clear, right? Then working capital loan. Just 1 minute. If you do this kind of intense revision, you remember very well. Revising whatever is there, plainly reading without processing, sleepy mind, that is not revision. This is intense revision. Every blood cell in your body should be alert when you are revising. That is when that revision is counted. You're getting it? From this chapter, you will have a weightage of, as per our material, I'm telling you. Because we have totally 12 standards and CARO all this. You'll have a weightage of 20 marks. Even in the May also it is tested like that. MCQs plus this put together based on my knowledge of MCQs which students told me, and this it is close to 20 marks which is tested. We are about to finish that. Okay, get back. So inventory, first point, what auditor has to verify? Whether physical verification is being reasonably done by the management, whether physical verification is done at reasonable interval. If any discrepancy was noticed 10% or more in each class of inventory, how they were dealt in books? In fixed assets, no, they didn't tell discrepancy point with the percentage. They told material discrepancy. Here they specifically told 10% or more discrepancy. They just quantified it. That's it, not a big deal. Working capital. What auditor has to verify regarding working capital? Whether during the year at any point of time is the company sanctioned with working capital? Is the company sanctioned with working capital limit in excess of 5 crore? Whether company withdrawn the down amount or not is not mattered. That is not that does not matter. How much is drawing power also does not matter. How much loan was sanctioned to you? That is what important. If the sanctioned limit is in excess of 5 crore, this subclause will apply. What? Okay, sanction limit is more than 5 crore. What should I do here? What auditor has to verify? Okay, since working capital loan or like cash credit overdraft funded exposure, we call it as what? Funded exposure is more than 5 crore. For banks, there is a guidelines. Stock audit has to be conducted. Quarterly reports and all has to be obtained from the borrower. For banks, there are guidelines when the funded exposure is more than 5 crore. Now here company is giving quarterly statements to the bank. Whether the quarterly statements submitted by the company to the bank are the matching with books of accounts. I know books of accounts you verified, financials are verified, that and all true and fair, but the reports are given to third parties. They are inflating and giving to third parties for getting a higher working capital loans. That should not be right. That is not a right practice. Please check auditor. Are they doing like this? The company that you are doing audit doing like this? Check out. In 2021 Tata Motors audit report, auditors have qualified with every bank, with every report which they filed quarterly, they inflated and filed. Later on from 21-22 onwards, because of this reporting requirement is there, companies are properly filing with bankers the statements. This is one of the reason why banks or companies are defaulting, because they are obtaining loan more than their capacity as per the bank, and they are unable to honor the commitments and they are defaulting. Understood? That's it. So they're asking whether quarterly returns are in agreement with books of accounts. That's it. Next, third clause, loans and advances given. It's about loans and advances given by the company. Ninth clause is talking about loans and borrowings taken by the company. 10th clause is talking about funds raised by the company through IPO, FPO, all that. So funds raised by the company through loans, 9th clause, through IPO, FPO, 10th clause. Clear? Now, this is loans given by the company. Okay, company gave loans, advance, guarantee, security, whatever, to whom it is given. How much aggregate amount is given? To subsidiary, joint venture, associate. How much of the loan you gave to subsidiary, associate, joint venture? What is the balance outstanding at balance sheet date? And how much amount you gave to other than subsidiaries, joint ventures, associate? What is the balance outstanding? Are you getting it? So here they're using the word whether the company has given any loans or advances in the nature of loans. Coffee day, this fraud is also there. They have given so many advances, but they're not advances. They're in the nature of loan. They're in the nature of loan. In the last MTP, May 24, MTP or RTP contains this question. See, I'm not sure it is there in CA inter or CA final, but I'm assuming it is CA final only. But both are related to the same CARO clause. Like where this company has entered into an agreement with film production company. Every year the film production company, the general transaction size the company generally makes is 5 crore. For example, some dummy number I'm telling, there the number is different. But company paid 25 crore advance. Advance means what? An amount given which is settled against a future transaction. Future transaction means what? Within next 1 year it should be settled. But I gave 25 crore loan, but 5 crore only settled. Advance I gave. I wrote it as advance to supplier, advance to customer. And advance to supplier, advance to customer. Getting the point? And 5 crore I will adjust it against at a future date. That is what I told. Getting it? Now only 5 crore is adjusted. I gave 25 crore. It clearly indicates it's a loan. It's not an advance. But companies classifying it as an advance. This is an advance in the nature of loan. Is there any such loan? That also you have to verify. Are you getting the point? So loan means very simple. See, generally when we give loan, no, immediately terms and conditions, company articles of association, all that comes into picture, formalities. If I say advance, no formalities. Transaction purpose I gave, I can say, I can escape from routine checking. That's why companies manipulate in the name of advance they'll be giving. So is there any advance that is in the nature of loan? Check out. If so, how much is given to subsidiary, associate, joint venture? How much is given to other? What is outstanding with category 1? What is outstanding with category 2? What are the terms and conditions? Are they prejudicial to the company? Terms and conditions on which loans and advances are given, are they as per articles? If so, okay. If they're not as per articles, comment, they're prejudicial. Are they paying regularly? Check out. Third point, your company gave loans, terms are okay. Are they paying regularly? Check out whether they are paying interest, repayment, everything regularly. Suppose if there is a default, what is the default for more than 190 days? More than 90 days. What company is doing? What action company is taking to recover this? And suppose if the company gave any loans which are rescheduled, if the company rescheduled any loan, if the company gave any fresh loan to repay existing loan, or company gave extension of credit period. Getting it? If at all any of those incidents happened, what is the total amount of the loans and advances given which were renewed, which were extended, which were settled by fresh loans? That breakup also you should give. What is its percentage to the total loans and advance? What is its percentage to the total loans and advances granted during the year? Company saying this year we gave 100 crore loans, but out of it 30 crore worth of loan is already given long back. That is extended now, that is renewed now, where you gave a fresh loan and got back the old loan. Now this is not something which is a beneficial for the company, this kind of activity. So that percentage has to be given. It's last requirement. Did the company give any demand loans to anybody? Demand loans means what? Where we don't specify any terms, which are repayable on demand. In banks, it is called as money at call and short notice. In banks, it is called as what? Money at call and short notice. When I call, they will have to pay me, or they will have to pay me with a short notice. This is called demand liabilities. We call it as. Are you getting it? So, is the company, your company, did they give any loans like this, demand loans? If so, how much total like demand loans were there? Tata Motors disclosure requirement is that Tata Motors have given so much of demand loans. Getting it? So how much demand loans you give? Out of total loans given, this loan is how much percentage? That you need to disclose. Understood or not? They will give you the entire this third clause. You need to write all these 6 disclosures. 5 marks question they'll give. Next. Only important points I'm covering. Deposits. Suppose if the company has raised any money by public deposits, if the company has raised any money by public deposits, whether are they complying with Companies Act, whether are they complying with RBI guidelines, whether are they complying with Company Law Board guidelines, if any, if there is a non-compliance, what exactly they contravened, what is the consequence of that? That you need to. Nature of contravention means what? Indirectly they are asking you what punishment is applicable. That's it. 7th one, statutory due. Statutory dues means what? Any taxes and duties that are payable by the company. Any taxes and duties that are payable by the company because of there is a levy under the law. Because there is a levy under the law, if any liability that the company has to pay, we call them as what? Statutory. These dues have to be reported under CARO under 2 parts. Undisputed due how much? Disputed due how much? Disputed due, you just have to give information. What information? Under which laws and regulations you have disputes, how much amount is involved, where the dispute is pending, High Court, Supreme Court, CESTAT, GST Tribunal, Customs Tribunal, where it is pending, Excise Tribunal, Income Tax Appellate Tribunal, where it is pending, you should give disclosure alone. Are you clear? And remember here they said a point, a mere representation is not a dispute. What does it mean? Suppose department called for scrutiny of books of accounts, you are just going and representing on behalf of the client, books explained to the department. That is not a dispute. When the dispute will start, department passed a demand order, company filed a case against the department, why should I pay? Then the amount is under dispute. Clear? Now another, undisputed due. What is the reporting requirement for undisputed? Undisputed dues are nothing but every month the company has to pay GST, TDS, all the trade provident fund. These are all every month voluntarily they have to pay, right? Are they paying regularly? The CARO is asking, are they regularly depositing these undisputed dues and all? Are they regularly depositing? They're asking. Suppose if not, regular means what? Within due date. Regular means what? Within due date. Is the company paying TDS, GST, Provident Fund, ESI, profession tax, municipal taxes within the due date? They're asking. If not, what is the delay? What is the arrears of outstanding which are outstanding as on the last day? 31st March also is outstanding only. 31st March also is outstanding. From when it is outstanding, check out. It was outstanding for more than 6 months. Report that amount. Report that amount. Are you clear? You have to report the amount outstanding as on balance sheet date, which was outstanding for more than 6 months. That long outstanding overdue liability, report it. Normally, if it is outstanding for more than 3 months only, as on balance sheet date, no need to report. Are you clear? No need. It is not that you should not report. If you want to report, you can report that also. Not an issue. But more than 6 months, it is compulsory for you to report. Clear, all of you? 8th one, discovery of undisclosed income. Recently it was tested, I think. I'm not sure exactly. Maybe MTP it was tested. For me, MTP, MTP1, RTP, sorry, MTP and question paper both are same. Getting it? MTP and question paper are both are same. If at all it is there in MTP, assume that it is there in question paper only. Because the process of developing MTP and question paper is same. Now, discovery of undisclosed income. What are they saying here? Is the company declared any income that was not disclosed by them in the earlier years? When the company declared in an assessment proceeding or scrutiny proceeding or survey proceeding which is conducted by department. So in that time the company agreed, yes, these are all undisclosed income. Okay, they filed tax, they paid tax, everything is fine. Now when the previous year income is discovered, now it should be recorded in the books of account as a prior period item, right? Whether they recorded or not, you have to check. Whether it is recorded or not, you have to check. The auditor has to check. If so, whether previously unrecorded income is properly recorded or not, you have to check. You are able to understand the reporting requirement exactly? All of you? Remembering class number will not save you. Matter reporting requirement is what carries marks. Class number will have half mark only. We only remember that class number. Inside matter, we don't remember. Next, default in repayment of dues. This itself can be asked as a 4 marks question. Write about reporting requirement under CARO with respect to loans and borrowings, they will say. They will not give you clue that default in repayment of loan. Loans and borrowings, this only. Now, what company has to report? Whether company has defaulted in repayment of loans and borrowings. If so, period and amount of default to be reported lender-wise. Especially if the lender is bank or financial institution, you have to give default lender-wise. Debenture holders lender-wise breakup not required. 10 lakh lenders will be there. You need not. So, what you need to break up? What is the nature of the borrowing? Overdraft. What is the name of the lender? ICICI Bank. Amount not paid 50 lakh. Whether principal, interest portion, delay in days 55 days. Even if the company repaid, still you have to report. You have to report defaults. That's it. You should not. It is not about whether it is still outstanding or that and all. You need not worry. Or have they defaulted? Yes. If so, report it. Because this information may be useful under section 43B. This information may be useful under section 43B. Certain bank loan interest and all will be allowed as deduction only if it is paid within the due date for filing IT return. Yes or no? This information will be relevant there. Next. Second, is the company declared as a willful defaulter? Is the company declared as a willful defaulter by any lender? Check it out. If so, report that. You will find this information in civil reports and all. Now, whether the company borrowed any loan by stating so and so purpose, whether for the same purpose they utilized or not, check it out. Whether company borrowed any loan for so and so purpose, whether the same is utilized for the same purpose. If at all the loan is diverted, getting it, for what purpose ultimately it is used also should be reported. First of all, you shouldn't divert. If at all you divert, auditor has to tell that amount, that thing also. Is there any short-term loan raised by the company which is used for long-term purpose? That also has to be reported. Did the company take any loan to meet subsidiary company obligation, not your own obligation? You took loan, holding company took a loan for subsidiary company purposes. If so, details thereof and the amount of loan you taken and gave to subsidiaries, that information you have to give. Now, another last reporting. Suppose company has taken a loan. Company has to give a security, right? For loan taking to a bank. Banker will not give a loan without security. What company gave security? Shares and securities held in subsidiary, associate, joint venture. The company has shares in associate, subsidiaries and joint venture. That company gave it as a security and got a loan. Is it there? Is that scenario there? If so, is the company defaulted? Is the company defaulted? What happens in case of these kinds of defaults? You will lose subsidiary company ownership. Banker will get that subsidiary company ownership. Correct? That's it. Next. End use of funds raised. Here, IPO, FPO, private placement. They are all covered. Whether company has raised any money through IPO, FPO or private placement. If so, for what purpose they raised? For what purpose they utilized? So, if at all company has not utilized for the purpose for which they have raised for, the auditor has to report the default because they didn't utilize for the same purpose, or they have not utilized it within the time limit they gave. Delay has to be reported. Suppose company utilized it temporarily for some other purpose and they rectified it. Still you have to report. Subsequent rectification also should be reported. Next. Is the company made any preferential allotment, private placement like that during the year and funds raised? Yes. If so, see provisions of Companies Act section 42 complied, and further for what purpose it is used. Are they for the same purpose in which it is raised for? Check it out. Reporting of frauds. Whether any fraud by the company or on the company, this point I specifically said, by its officers or employees, please strike off. Whether any fraud by the company or on the company, that's it. Whether any fraud by the company or on the company has been noticed or reported. has been noticed or reported? If so, nature and amount involved shall be indicated. Regarding this, you have an additional question in your ICI book, where in our book additional questions, we have additional information at the end. How to report these kinds of frauds, we have a detailed question on that. Representation should be obtained, auditor inquiry has to do like that. That also you should read, because in exam that will be tested more. If at all they have to test on this clause. Clear? Did auditor filed any form under 143 subsection 12? They are asking next what? Did auditor filed any form under 143 subsection 12? What is 143 subsection 12 form? If auditor has identified any fraud for an amount involving 1 crore or more than 1 crore, the auditor shall report the matter to central government within 60 days. Initially will report to board of directors, 45 days time, get information, compile that and file a form to the central government, ADT 4. If at all any such incident is there, report that in the CARO also. Finally, every company, especially listed entities, they have to maintain whistleblower, where they have to design and implement whistleblower mechanism. What is it? Internal complaints mechanism. So internal employees of the company, top management, if at all they find any issues that are affecting badly the company, they have to complain through whistleblower policy. Now, this whistleblower complaints and all auditor should consider, right, to do his risk assessment effectively. Yes or no? Whistleblowers and all is a fraud risk factor. So, auditor has to consider whistleblower complaints. CARO is asking, dear Mr. Auditor, have you considered that? Whether auditor has considered whistleblower complaints received during the year. That's it. Next, Nidhi company. Suppose, is the company that you are doing auditing is a Nidhi? First of all, identify. Nidhi is an NBFC, but it is exempted NBFC because Nidhi is directly governed by Ministry of Corporate Affairs, not RBI. The NBFC audit chapter that we are going to read about those NBFCs where RBI is directly monitoring. We are reading NBFC audit chapter where those NBFCs which are directly monitored by RBI. But Nidhi company is a company which is governed by Nidhi rules, company Nidhi rules. Suppose you are doing audit of a Nidhi company. They have to maintain certain liquidity criteria. 1:20, the liability shall not exceed. The Nidhi company minimum, net owned funds shall not exceed 5. The Nidhi, whether Nidhi has complied with net owned funds to deposit ratio. Like Nidhi companies, what they do is they take loans from their members and they give loans to the members. This is what they do. Now, 20, like for every, Nidhi company has to maintain minimum 5% liquidity. 5% liquidity is nothing but 1/20. Yeah, correct only. 1/20 is nothing but what? 5%. 100 by 5. 100 by 20 is equal to what? 5. 1/20 means what? 5%. So Nidhi company has to always maintain 5% own funds. So and further, Nidhi company, they raise money from members, right? They raise money from members, right? That money entirely should not be given as a loan. 10% they should maintain it as an unencumbered deposit. Are you getting the point? Whatever money they borrowed, that should not be given as a loan to member. 10% they should maintain. This is something like CRR, SLR requirement in bank. This is a liquidity requirement for the Nidhi company. Understood or not? If any default is there, whether the Nidhi company has defaulted in payment of interest or deposits, if default is there, that should also be reported. Then related parties. Here in related party, the auditor has to check all the related party transactions. Are they as per Companies Act provisions 177, 188? Check out. Second, you have to check whether disclosures as per accounting standard is made or not. 2 points were there. Next, non-cash transaction. Now, internal audit also. Internal audit, what auditor has to check? This point, internal audit. Anyhow, we have a separate chapter internal audit. Preferably, I am discussing that. So there I will cover. Non-cash transaction, whether the company has entered into any non-cash transactions with the directors. If so, section 192 provision satisfied. Companies Act provision only they are asking. 16th one, NBFC. This point is applicable generally for all the companies. See, in NBFC audit, you might have seen this criteria called principal business criteria. What it says, if a particular entity, if at all their total assets consist of more than 50% of financial assets, if total assets consist of more than 50% by financial assets, if total assets consist of 50% or more by financial assets, What are financial assets? Loans and advances, shares and securities, investments. Yes or no? These are all what called as financial assets. If financial assets percentage of total assets is more than 50, if income from financial assets is more than 50% of the total income, if both the conditions are satisfied, that must be registered as an NBFC under RBI guidelines. As per RBI Act 45 1 year. They are asking, is the company you're doing audit, does it require to register as an NBFC? Check out. No, like we would have done, we would have verified this principal business criteria. Tata Motors said, no, the company is not liable for NBFC registration. Is the company conducted any NBFC activity or housing finance activity without a registration? Suppose if it is more than 50%. Without registration, they are doing it. You need to qualify here. Third clause. Is the company is a core investment company? Whether the company you are doing audit, is it a core investment company? Suppose I am doing audit of Tata Sons Private Limited. Yes, Tata Sons is a core investment company because more than 90% of the assets of the Tata Sons are represented by investments. Therefore, it is a core investment company. So, is the company that you are doing audit is a core investment company? If so, whether it continue to fulfill the core investment company criteria, if suppose if it is exempted core investment company, is it fulfilling exemption criteria? If it is unregistered core investment company, is it fulfilling that unregistration criteria? Core investment company with asset size more than 100 crore is called a systematically important core investment company. An NBFC, which is a core investment company with an asset size more than 100 crore, is called as a systematically important core investment company, which must register with the RBI. Whether the group has more than one core investment company, whether the company belongs to one group, is it having more than one core investment company? If so, indicate the number of CICs. Tata Group is having some 5 or 6 core investment companies. The auditors reported the same in the Tata Motor audit report. Clear? All of you? Next, is the company suffering cash losses? What is a cash loss? Suppose profit after tax is negative. Actually, profit after tax is what? Negative. For that, add back depreciation, add back provision. Nothing but you are adding back non-cash expenditures. Is it still loss? Is it still negative? If so, then we call it as what? Cash loss. If so, we call it as what? Cash loss. Suppose after adding back non-cash items, you are getting profit, which means the company does not have any cash loss. Are you getting it? Suppose if the company is having cash loss in the current year or immediately preceding previous year, financial year. If so, report it. You're clear, all of you? Resignation of auditor. Because P&L account shows the net effect only. When people are concerned, if there is a cash loss, people are concerned. Resignation. During the year, before you were giving audit report, there is some other auditor, right? He resigned. Have you considered reasons of the resignation, issues, objections? Of course, we have to. This is a requirement in clause number 8, part number 1, schedule number 1. Yes or no? Communication with previous auditor. It's a requirement. I'm supposed to consider. If I don't consider, I'm treated as guilty of professional misconduct. So, CARO is asking, have you considered that or not? Next, material uncertainty. This point I already covered, but once again I'll repeat. See, this point is so lengthy, you can simply see whether liabilities existing as at balance sheet date, as and when they fall due within a period of 1 year, nothing but they're talking about current liabilities. Whether current liabilities that are there in the balance sheet that fall due within 12 months from the balance sheet date, do you think company can honor it? Whether the auditor is of the opinion that no uncertainty exists on the date of audit report. You are giving audit report in July, no. Company said it is a current liability on 31st March. They have so many liabilities which are becoming due in the next 12 months. On audit report date, some subsequent information, all that you got to know. You are very much latest. You know latest information. Do you still think on the date of audit report which you are giving in July? Do you still think company can honor within next 12 months those liabilities that are there in balance sheet date from the date of balance sheet 12 months? If so, say that you can. So Tata Motors auditor said there is no material uncertainty on the date of audit report that liabilities that fall due within 12 months from the date of balance sheet, the liabilities existing on the date of balance sheet. That's how they report. So how do you analyze this? How do you analyze this? You analyze on the basis of ratios, aging, expected dates of financial assets and payments and liabilities realizations, other information, management discussion. By looking at all this information, you will analyze on the date of audit report whether company can honor all the liabilities that are existing on balance sheet date that fall due within 12 months. That's it. CSR. CSR related reporting is very simple. 1 minute. After this CARO completion, we have 143.3. In that, funding party, intermediary, ultimate beneficiary, audit trail. Remember? That I will cover. Then I will be covering 610 and 620. With that, this chapter will be over. Okay. Yeah. CSR. By the way, 21st clause in CARO is only applicable for consolidated financials. Technically, CARO report does not apply to consolidated financials except clause number 21. And 21st clause is not applicable for standalone financial statements related audit report. Getting it? Only for consolidated financials audit report it applies. So CSR fund, what is this? Every company has to spend a percentage of its profit on CSR activities. These profits can be spent, these profits has to be spent within the year end. If any unspent portion is there by 31st March, it must be transferred to the specified funds within 6 months. That's the rule. Here they are asking whether our company has transferred to specified funds or not. Suppose if the company has selected any project to spend the CSR funds, the project duration is more than 1 year. In that case, the company has to transfer these funds to a special bank account. Because by 31st March on a project full amount cannot be spent. It's a project oriented spending CSR activity, so where the gestation period is more than 1 year, so the company transfer the amount to some specified bank account. Auditor has to report whether the company did that or not. Are you getting it? So one is other than ongoing project, within 6 months the company has to transfer to special funds given under schedule 7. If it is ongoing project, amount of any unspent pursuant to ongoing, whether the amount transfer to special account or not, they are asking. That's it. Clear? For this CSR provision knowledge must be there, but I still gave you a brief provision about CSR. Next. Now the auditor who is giving audit report on consolidated financial statements, in that audit report 21st clause of the CARO alone he should describe. What in that clause he should describe? In the consolidated financials, many subsidiary companies, Reliance you see 240 subsidiary companies are consolidated, 120, 30 associates are consolidated, joint ventures some 25, 30 were there. These 400 companies are consolidated in consolidated financials. Now all these companies are having their own auditors. All these companies also CARO reports were there. What is the qualification in all these companies CARO report? People want to know. Summary of all the qualifications in these 400 companies in the CARO report. Put that summary in the audit report on the consolidated financial statements. That's it. That is 21st clause. Clear? Whether there have been any qualification adverse remark by auditors in CAROs of consolidated financials. If yes, indicate details of paragraph. Not only CARO, I'm telling you, in future reporting requirement will be, these are 21st clauses, right? In future 10 more clauses will add very soon. Getting it? There may be reporting requirement that subsidiary companies auditors what opinion they give. That list also you give here, because we can't go and set all the 400 company reports. Overall auditor considered that it is immaterial, but I want to know specifically in which subsidiary company what they qualified. I want to see the paras also. So audit report will keep on increase. You are getting it? Once upon a time there were only 11 clauses. Later it was increased to 16. Now it is increased to 21. Later it will be going to 30. Clear? So that's it. 143 subsection 11 CARO key points and all we have completed, except some 3 or 4 majorly we have completed. Next, 143 subsection 3 duty to report on certain matters. It has totally 10 points, whereas the 10th point have totally approximately 6 sub clauses. So in this, the auditor has to check whether dividend declared or paid by the company during the year, have they complied with the dividend provisions under Companies Act. Next, auditor has to check whether company is maintaining a software, accounting software that has a feature of audit trail, and whether the audit trail is retained by the company for the statutory retention period, whether audit trail is tampered. Auditor has to check all this. What is audit trail? All that I will discuss in internal audit chapter. We have a separate concept on audit trail there. Next, now fourth, this is one point where many don't understand again. What is this fourth point says? Here auditor should get a representation. Here auditor should get a representation. Third one, auditor should check whether representation. Auditor should check whether representations given under the above two are materially misstated. First point, 4 subclause 1 says auditor should get a representation for something. Okay, what is that? We'll discuss. Second point also says auditor should get representation for something. What? We will see later. Third point, they're asking you, based on your procedures, you might also perform audit, right? Okay, you got representation, that's fine, but you might have verified, right? So many. Based on the verification, do you think the representation is wrong? Are you getting it? Coffee day auditors, they just got the representations without verifying. Are you getting it? That's why NFRA levied penalty in this clause also. On this clause non-compliance. Fine. So what is this clause says? Very simple. Generally the companies, suppose there is my company. There is a company for which I am acting as an auditor. This company has transferred some funds to an entity. What this company told to that entity is, please transfer that funds to another entity. Now the entity which my original client is a funding party, and there is a middleman, another entity which is called as intermediary. It may be a foreign entity also. And what the original company told the intermediary, you transfer this fund to another party identified by the funding party. We call them as ultimate beneficiary. Okay, there is a kind of transactions like this. It can be there, nothing wrong. Companies, they want to acquire subsidiary companies strategically. They want to acquire some companies strategically. They can do like this, which is not prohibited. So through multiple subsidiaries, we can acquire another company. Vodafone acquired Hutch company through 67 intermediaries, which is permitted in law. No, not prohibited. Some strategic purpose is there. All these transactions shall be disclosed in the financial statements. Company disclosed. Get a representation that other than disclosure in financials, there are no other such kind of transaction. That is what the point says. Whether the management has represented to the best of its knowledge and belief, other than disclosure in financials, no funds have been transferred to intermediary with an intention that they have to transfer to another entity identified by the funding party. How this entire sentence is drafted. Now you see, based on the example, whether the company has transferred. Transferred means what? How they transfer? In the form of loan, advance, investment to an intermediary, including a foreign entity, with an understanding, whether in writing or otherwise, that the intermediary shall transfer to another party or give guarantee on behalf of another party to a third party. All this must be disclosed. other than disclosed in financials. Is there any such a transaction? Board of directors said, no sir, everything is disclosed. Give me a declaration that everything is disclosed. Here you are the auditor of whom? Funding party. Second scenario. Here you are acting as an auditor of one company, right? Did the company acted as intermediary? Ask them. Yes, company has acted as intermediary. You know, all these transactions require disclosures in financial statements. Suppose I'm the auditor of funding party. What funding party shall disclose? You know, who are the intermediaries, how much amount transferred, who are the beneficiaries, how much amount intermediary has to transfer. They need to disclose. What is the purpose they need to disclose? You're getting it. Same way, suppose I'm acting as an auditor for a company which acted as an intermediary for some transactions. If so, whether the company has received any funds from another entity with an understanding in writing or otherwise that this entity shall transfer these funds in the form of loan advance to another entity identified by funding party. If so, whether the company disclosed or not, they disclosed. Is there anything omitted? They said no. Give me representation that no. And you might have already verified bank statements of the company, ledgers of the company, all that, right? You will know whether is there any other transactions apart from disclosed in notes. You know very well, right? You might have done some audit procedures, right? Do you think the representation given by them is wrong? Because director said nothing is missing. Do you found anything wrong? Indirectly, what are they asking? Have you found any undisclosed transactions? Are you clear? That's it. This is what the fourth point. Clear? All of you? So with this 143 subsection 3 major point is completed. One more reporting requirement is 143 subsection 3 clause I. Auditor has to comment whether the company's internal financial controls related to financial statements are operating effectively. Whether the company's internal financial controls related to financial statements, are they operating effectively, they are asking. So you just have to test the internal financial controls, are they operating effectively or not, and then report accordingly. This reporting requirement does not apply if at all you are doing audit of 1% company, small company, or a private limited company, turnover not exceeding 50 crore and borrowings not exceeding 25 crore. If a private company satisfies both the conditions, turnover is less than or equal to 50, borrowings are less than 25, this reporting requirement for that auditor will not apply, which means he need not verify operating effectiveness of internal financial controls. That's it. Easy or not? Next, there is one more reporting requirement which is there in the 197 section. The company has to make a statement whether remuneration paid by the company to its directors, is it in excess of limits given under the law. Especially this is applicable for whom? Public companies. Director remuneration limits are applicable only for public companies, not for private companies. So whether the company is paying remuneration to the directors within the limits prescribed under Companies Act. Maximum limit is 11% of the profit. You're clear? That's it. 143 subsection 3 is also completed. We are still having 3 more standards, 610, 620 and 710. I will cover 710 right now. Okay. 710. What is 710 standard is dealing with? This is one standard where many again have this confusion. 710 standard. 710 is dealing with what? Comparative information. 710 is dealing with what? Comparative information. This comparative information can be in 2 approaches. The comparative information can be in 2 approaches. Corresponding figures approach, comparative financial statements approach. In India, for preparing general purpose financial statements, we follow which approach? Corresponding figures approach we follow. We don't have comparative financial statements approach, not just in India, anywhere else in the world is also, it is not there. Comparative financial statements approach, generally this approach might come in special purpose financial statements audit. It might come in special purpose financial statements audit. For example, a company is preparing a balance sheet and P&L which contains figures of last 3 years using some framework. And they appointed you to give opinion specifically on all the 3 years. Generally, in audit report, we give opinion, right? It is only dealing with current year figures. Our opinion generally does not deal with corresponding figures. That approach is called as corresponding figures. Comparative financials means what? You should give opinion on comparative financials also. All the entire comparative information you should cover in your opinion. If that is the requirement under the framework, then that approach is called as what? Comparative financial statements. That approach is not there in India. What approach is there in India? Corresponding figures approach. Even in many other countries also, what approach is there for general purpose financial statements? Corresponding figures approach. This fact you should understand in order to read the standard. Without understanding that, if you read the standard, you will confuse what is this, confusing both same points. No, you will have this confusion. Now, comparative information means what? It's nothing but amounts and disclosures that are there in the prior periods, that are belonging to prior periods, but are presented as an integral part to current year financial statements, which are to be read in relation to current period financials. Correct? Prior period amounts and disclosures are presented as part of current period financials. That's it. In accordance with applicable framework. What is corresponding figures? They are also nothing but prior period financials which are presented as part of integral to current period. Getting it? So what is the what is the level of detailed? The corresponding figures we will present. Same detailed presentation for current year. If current year giving breakup for 6 months, for example, breakup and all you are giving, same breakup you should give for prior period data also. So the level of detailedness of corresponding figures is primarily dictated by the level of detailed for current year figures. Now, what is the objective of the auditor? We simply has to obtain sufficient appropriate evidence, whether comparative information, it may be corresponding figures or it may be comparative financial statements, whatever it is. Comparative information, is it presented in accordance with the applicable framework or not, and report in accordance with the standard. Correct? And in case of corresponding, we give only opinion on current year. In case of comparative financials, we give opinion to each period that is referred in financial statements. Understood? Audit procedure. How we should do audit procedures for comparative information? Ensure that comparative information is tallying with last year financial statements. Comparative. If the accounting policies are applied consistently or not, you need to check. Whether changes have been adequately disclosed or not, you should check. This is the same requirement in 510 also. When you are doing audit of opening balances in case of initial audit engagement, you should check whether opening balances were correctly brought forwarded from previous year. For that, you need to verify whether the opening balance are matching with the previous year audited financial statements or not. 2. Whether accounting policies reflected in opening balances are they consistently applied and followed or not. 3. You need to see whether any changes to the accounting policies, if at all make, are they reflected or not. Same, no? In comparative information also you check the same, no, nothing else. The responsibility for corresponding figures, comparative information and opening balance is one and same. You are getting it? If at all auditor identifies any misstatement in comparative, nothing but any misstatement in opening balances, what is its impact? You should get evidence. And if at all you only have audited prior period financials, check whether 560 procedure can be performed, because you identified a material misstatement after the date of audit report. See, 560 can be applied. If 560 cannot be applied, come back and see 720 approach, 710 approach and 510 approach. Are you clear? And get a written representation that any prior period item, if at all the company has if any prior period item company has identified, that they're all properly accounted and disclosed. Get a representation. Enough. What is the reporting ultimately? Very simple. With respect to corresponding figures, no, you will not refer to previous year figures. You will not talk about previous year figures itself in audit report. However, there are some circumstances where you will talk about prior period, where you will talk about comparative information in the current audit report. When if audit report of the prior period contains other than unqualified opinion, you remember SA 510, it says if the predecessor audit report, if the previous year audit was performed by another auditor and he has given a modified opinion, for what reason he gave a modified opinion, if that reason is relevant in the current year, material in current year, current auditor shall also give a modified opinion. To explain this, you should also talk about previous audit report, right? 510 requirement. So comparative information, generally we will not talk about corresponding figures in the audit report. However, if previous auditor gave a modified opinion, and if in the auditor opinion he has an evidence that a material misstatement exists belonging to prior period that was not addressed earlier, or if the prior period were not at all audited and you should obtain an evidence that opening balance are free from MMS. In all these 3 cases, you will refer about prior period comparative information in the audit report. You see common reporting also. You should report in other matter paragraph clearly in the audit report of current period. If prior period financials were audited by another auditor, who audited that, what opinion they gave, what is the date of report. If at all prior period financials were not audited, say that prior period financials are not audited. Does it mean you are exempted from getting evidence on opening balances? No. This disclosure does not relieve the auditor from responsibility to obtain sufficient appropriate evidence regarding opening balances. This is entire reporting requirement and discussion for corresponding figures. Comparative financial statements, ignore, not required from exam point of view. Because comparative financial statements contain some discussion. Suppose already previous year financials were audited by some other auditor. This year company again prepared financials using 2 amount columns, where on the 2 I have to give opinion. In the second column, nothing but previous year figures, I found a misstatement. Earlier previous auditor said everything is true and fair, whereas I found a misstatement in the previous year column now, and I have to give opinion on the previous year column. What should I do? First I should resolve the conflict. That conflict first present in other matter paragraph, preferably if possible resolve it with previous auditor. If at all resolving is not possible, explain that conflict in other matter. Previous auditor gave unqualified opinion, he did not find, I found this material misstatement. Are you clear? So this is one additional requirement for comparative financial statements. That's it. 710 is over. Understood 710 now? With this understanding, read the standard, you will get complete clarity. You're clear? So almost we have completed entire audit report except 610 and 620. 610 and 620 will continue in the next session. Maybe it will take some half an hour to 40 minutes. Approximately it will take half an hour to 40 minutes. You know what? Audit report chapter we discuss in real class for 25 hours. 24 hours we discuss this chapter. And I tried to cover it for you less than 4 hours. Are you getting it? So the level of detailedness in that is different. But I hope this gives you a lot of clarity on the subject now. You're getting clarity? Yeah, thank you. In the next session, we'll continue discussing those two, and then I will start ethics chapter. After completing ethics, I will go to standards. Or maybe let us do one thing, I'll go with standards only. Let us go touch all the standards and finish, and finally ethics. Ethics is Zuzubi, easy chapter. What is there in ethics? Own preparation chapter. Yes or no? It's a very easy chapter. Standards is what challenging. Correct? Yes, we'll meet in the next session with more energy. I think you're tired more than me. Yeah, bye. So let's continue the discussion on the pending 2 more standards, that is SA 610 and 620. 610, which deals with using the work of internal auditor. Using the work of internal auditor. So, like, who can use the work of internal auditor? It talks from the point of view of external auditor using the work of internal auditor. Like, what is exactly the context of the standard is talking about? For example, we are doing an audit of a very big multinational company, and which has, for example, GST registrations across India. 29 states were there. Even TAN numbers also state-wise. Correct, right? TDS collection and account number is also state-wise. Is it so? It's not entity-wise. I think they take separate strategic business units. Like, it depends. If they want to take for every branch, they can take a separate TAN number for every branch. In such a case, they are supposed to file separate ETDS returns and all. Same way in case of GST, for each state, registration is compulsory separately to be done. Deemed distinct entities. So they have taken registrations across 12 states. Even the inventory, the company is having inventory which is being performed at, where the company is having inventory locations, for example, at all the 29 states. So they're having at all the states and union territories go downs. So we want to see whether the company physical verification process is proper or not. Whether, like, we want to conduct, suppose under 501 you see, we have to do physical verification of inventory. Let's take inventory example. Let's continue with inventory example. We are supposed to get evidence about existence and condition of inventory as per 501. Now what already companies having, the internal auditors, all of them are already going and verifying all the 29 branches, whatever in the 29 states, all the go downs. The internal audit department is going and conducting physical verification. Can I use their workings? whatever the work performed by them, can I use their workings in the process of audit in my external audit or not is the question. The standard says, yes, you are permitted to use, but standard also says you cannot transfer the responsibility of yours to them. Your responsibility remains the same. Even if you are using the work of internal auditor, your responsibility remains the same. It will not be reduced. Internal auditor will not be responsible for the opinion that you are expressing, where your opinion is based upon his work. Even though you formed your opinion based upon his work, ultimate responsibility for the opinion that you are expressing is only with you. You cannot blame internal auditor later. Now, the standard is permitting to use, but they are not shifting the responsibility. In such a case, in order to whether to use internal auditor or not, whether to use the work of internal auditor or not, we need to assess certain parameters. We need to assess certain parameters. For example, how far the internal audit department is independent. How far the internal audit department is independent from the entity, objective from the entity. How are they competent? What are the work methodologies that they are following? So like this, we need to have an evaluation of internal audit department. The internal audit function, we should evaluate. Just a minute. Yeah, let's continue. Sorry for the interruption. So the external auditor has to use, the external auditor decided to use the work of internal audit function. The external auditor decided to use the work of internal audit function. Now can he use it? Yes, he can use it provided he checks certain parameters like what objectivity of the internal auditor, competence of the internal auditor, whether internal auditor is following any systematic approach or not. Like that, there are some evaluations to be made which the standard says. Now this is one type of work of internal auditor. This is one way where internal audit function of the entity can be used by external auditor. This is one way internal audit function can be used by external auditor. Type 2. Can the internal auditors use, another way how internal auditor can be used is direct assistance. There are multiple reasons why we take direct assistance. Direct assistance means taking internal audit department staff, like internal audit function will have some people, right? Taking their people into our team so that we can complete the audit much more faster, so that we will have more access to manpower. The multiple reasons why external auditor will take the help of staff, the internal audit department people. There are multiple reasons. Whatever the reason it could be. Can I take their direct assistance, just like how I have article assistants, paid assistants, manager who are there in my team who are doing this audit? Can I take internal audit department people also into my team and then finish the work faster? Yes, the standard allows that. But whether you are using type 1, like using the work performed by them, or type 2, getting direct assistance from them, in both the cases, you need to evaluate certain parameters. You need to evaluate certain parameters. So that is what the standard guiding. Look, when you're using their work, how to evaluate, what parameters you have to evaluate, what factors you should evaluate, and when you're verifying their work, what points you should consider. So the standard provides some guidance on using the work of internal auditors, whether it is type 1, work performed by them, you are using it, or type 2, using them directly under your team. So these are the two things which the standard says. So naturally in this, reporting element will not come. In the standard, reporting element will not be there. Reporting on the audit report, modified opinion, no, it won't be there. Because no, I'm taking their work help. Ultimately, I need to form conclusion. Whereas you see SA 620, you will have something called reporting element. In SA 620, you have something called reporting element also will be discussed in the standard. Because in SA 620, using the work of expert, there we are using him for the purpose of getting sufficient appropriate evidence. Where the expert opinion, expert report, whatever is there, that will act as an opinion for you to decide about it. You will conclude based on that. So that will have an impact on the reporting. Fine, when I begin that standard, you will understand that. So The standard is very clear. The standard talks about whether, like, the standard gives guidance. The standard gives guidance on determine whether work of internal audit function or direct assistance from internal audit can be used. Whether the work of internal audit function or direct assistance from internal auditors can be used. If using the work of internal audit function, suppose if you are using the work performed by them, the standard gives you guidance on whether that work is adequate for the purpose of audit. So one of the question, first what they're explaining, can we use type 1 or type 2 work? Can we use type 1 or type 2 work? 2, if at all you're using type 1 work, how to determine whether that work is adequate? Because see, when we are going and verifying physical verification for our audit objective, when we are attending physical verification process for our audit objective under 501, our objectives may be different. When internal auditors are attending physical verification, their objective might be different. Their objective is much more comprehensive than our objective. Our objective is very small, very narrow, limited to whether financial statements are showing true and fair or not. Whereas internal auditors' objective and scope of work is very wider. Their observations are very wider. They do so many quality observations also. We are not bothered about that many quality observations. We are only bothered about what? Existence and condition. Is the condition good? Existence is there? Controls are basic, normal or not, at least decent or not. That's it. They do an in-depth process evaluation. Internal auditors do an in-depth process evaluation. So when they are attending physical verification process, that process is comprehensive. In that, some elements that we want to look into, they may not cover. So when you are using their work, it's not blindly document it and conclude it. Whatever work they have given you, workings they will give you, right? Those workings, are they adequate or not, you have to check. Those workings, are they adequate or not, you have to check. And another thing the standard is addressing, what? If at all you are using internal auditor to provide direct assistance, whether how to direct them, how to supervise them, how to review their work. So that element also standard is talking about. So the standard is helping you. Can I use type 1 and type 2 work? That they are addressing. If at all you are using type 1, how do you check that work? If at all you are using type 2, how to direct these people? That is what the standard is exactly talking about. Clear? You know what the standard says? Using the work of internal auditor, type 1, for example, you see, you need to evaluate few things. You need to evaluate 3 aspects. When you are using type 1 work, you need to evaluate 3 aspects. Objectivity of the internal auditor, how far internal auditors are objectively behaving, level of competence, and are they following a systematic and disciplined approach, including quality control. Do internal audit department have a systematic approach? We external auditors have quality control policies and procedures. Under SQC, we have to establish quality control policies. The same way, internal auditors also should have some policies and procedures. See whether they have a systematic approach or not. Systematic approach. What is systematic disciplined approach? What is quality control? I will discuss in SQC. Now, when you are prohibited, the standard says, if at all they are not having objectivity, or if they are lacking competence, or if they do not apply systematic approach, disciplined approach, then you do not use their work. Do not use the work of internal auditor. Now, suppose you decided, okay, internal auditors are objective, competent, and in all the parameters, systematic approach, everything is good. You decided to use the work. Where and all you can use? Examples of areas. What are the examples of areas where internal auditors workings can be taken by us? Where and all, in what areas? For example, you can take their help in testing of internal controls. You can take their help in testing, performing substantive involving limited judgments. Suppose if the judgments are high, where high estimation uncertainty is there do not take the help of internal auditor. Observing inventory counts, these are all using clerical tasks. Yes or no? Compliance with regulatory requirement, whether law and regulation is complied or not, for that purpose you can take their help, not an issue. When I am discussing 250 standard, I will tell you what do you mean by compliance with law and regulation. Then for review of components to the group, and when we are verifying, suppose we are doing audit of consolidated also, in that group, in that group, so many components are included, right? Immaterial components will be there, right? Non-significant components will be there, right? Subsidiaries, associates, all that. To verify the financial information of them, you can take the help of internal auditor. Indirectly, where and all you should not take internal auditor's help, where substantive process involving higher judgments, or material subsidiaries related one. In all these cases, you should directly verify. Your team only should directly verify that. Don't take their workings. Same way, the external auditor shall make all significant judgments in the audit. In the audit, where and all significant judgments, significant assumptions, significant estimates that you have to verify, the external auditor only shall take up that. And he shall plan to use less of the work and perform more of the work directly. The functions work depend on that very less. You perform directly the more. I know internal auditors have performed all the areas of audit. Technically speaking, purchases, sales, expenses, incomes, assets and liabilities, every aspect of the financial statements they addressed. They have workings for that. Does it mean you can take all their workings and sit idle and give audit report? No. The standard says use their work as limited as possible. You perform most of the work. Just because standard allows you, don't depend too much on them, because ultimately it is risky only for you. Remember, at the end of that, they are internal auditors. They are internal to the company. So whatever their workings, everything will be favoring to the company only, if at all they want to do frauds. Next. So the external auditor shall continuously evaluate whether he is sufficiently involved in the audit. It should not appear to the management and those charged with the governance that what external auditor is doing every time is only depending on internal auditor. Then why are we paying fees to him? It should not appear like that. Getting it? And the external auditor, where he should communicate. Once all these elements you considered, where and all you want to use internal auditor's work, because you study the entire function, their scope, their objective, areas which they covered, where and all you can use their work, where and all you cannot use their work, you will get an idea. Once you got this idea, you communicate with top management. You communicate with top management how external auditor has planned to use the work of internal audit function. Why you have to communicate the planned use of internal auditor work to the top management is one of the reason is, if you communicate them, these are the areas I'm going to use on so and so timelines, they will complete those works and get back. Otherwise, if they do separately their work and I do separately my work, at the right time when I want to check the data, it may not be available. So using the work, you must discuss and coordinate with internal audit function. You must discuss and coordinate with internal audit function about planned use of its work and coordinating their activities. So you must discuss with them how his work is going to be used by me, where and all I'm going to use, and when I'm going to use also I should tell him. And how I will use their work, very simple. I will read their reports, I will read their workings relating to the work which they perform, yes or no. Then I will perform some procedures to determine adequacy, like inventory counting, inventory valuation, all they did. I will check their workings, what assumptions they used, what data they have used. I will verify their workings. Just like how my article has performed the work, how I have to verify his work, the same way I verify their work. Just that this work is performed by internal audit department. That's the only reason. That's the only difference. Correct? So I will verify their workings, whether work of the function is properly planned, whether internal audit function properly planned, performed and documented the entire work. Sufficient evidence did they obtained or not, whether conclusions reached based on this evidence is appropriate or not, whether conclusions reached are appropriate or not. So all these elements we will be checking. Then finally, the audit procedure shall be responsive to the nature and extent of audit procedures. Relevant to this is depend upon the amount of judgment, assessed risk, whether it is supporting objective and competence. What is this? Nothing but, now we are saying we are using their work, like their work right here. We are using their work, like what are we using? We are determining how they performed it. We are checking how their planning process, how their performing process. And we are also seeing whether sufficient appropriate evidence is obtained by them or not, whether the decisions taken by them are right or not. All that we are checking, right? To what extent you will check? To what extent you will check? Will you check it on a sample basis or will you check on a 100% basis? It depends upon my perception about his objectivity. It depends upon my view or perception or my decision about his objectivity, and it depends upon his competence, it depends upon risk involved, it depends upon judgment involved. If at all the work which internal auditor performed, no, it does not involve any judgment itself, everything is factual data, I may not verify that in depth, because in factual data there is a possibility of reporting mistakes is low. Suppose if the work involves limited judgment, I will briefly verify the work. If at all the work involves little higher judgment, getting it, and that also I decided to use this work, then I will verify little more in depth. If the work is having too much of high judgment, I will not use their work, I will only perform that work. You are getting the point. Next, the external auditor shall evaluate whether external auditor's conclusion regarding internal audit function for the purpose of audit, is it remaining appropriate. Finally, you once again check whether the function is still appropriate. Can you still rely upon the reports or not? That's it. Now, you see, like, you read the standard like this, right? If you read like this and go to the next part, you will never remember, you will never analyze, you will never understand. You should summarize what we read. You should summarize what you read, and that's how confusion can be avoided. Like some are asking this question, for which question what answer to write? We are unable to understand. For example, in exam they may ask you, write about nature and extent of work of the internal audit function that can be used. There is a high possibility that students will raise this answer. Getting it? Because then they never differentiated between this and that. Like suppose in exam they may ask you, write about evaluation. What are the points external auditor has to evaluate? Suppose this itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. This A point itself, I'm telling you, by the way, this A point itself can be asked as a 5 marks question, or this entire third point can be asked as a 5 marks question, where you are supposed to write A, need not write sub points, B, C, D you have to write. So main points you have to write, that can be asked as a 4 marks question, or they may ask you a specific question on controls, or they may ask you this question, write about discussion and coordination with internal auditor while using the work of internal auditor. That they may ask you. In such a case, you need to write these points. Now this one, then internal audit, the external auditor nature and extent of audit procedures shall be responsive to external audit evaluation of internal audit function. What he will evaluate, this D point itself can be asked as a 3 marks question. Anyway it can be tested. Now let's summarize and see what they're exactly talking. This one I'll give you example, 620 also I'll give example, at 2-3 more standards also I'll give example, how you need to differentiate. Very simple, understand the context of what they're talking. First they're asking us what, like first of all, what is the standard is saying? The standard is saying whether internal auditor's function can be, whether work of the internal auditor can be used or not. In that one way how you can use, they have already performed the work and you just have to use that work. This is one way. Another way is what? Type 2. Directly taking them. Right now we only completed type 1. Type 2 we have not yet discussed. Okay, type 1 you're using. Tell me common sense, if at all you are there as an external auditor, will you blindly use their work? First of all, who are the people comprising of internal audit function? What is their skill set? How are the methodology that they are following audit? Because I am a big 4 entity, I am a big top 10 big entities. Getting it? I have certain quality control practices. I have certain systems and methodologies in which I do audit. I can't take their workings just like that. So I need to evaluate their, systematic approach. I need to verify their skill set, competence, and not just that. How are they performing the audit? Are they independent of the management, or are they completely biased towards management? That also I should see, right? Only then their work can be reliable. Okay, I need to evaluate all this. For that now you will see what is their organizational status, what is their policies and procedures, how the company is treating them, how the company is responding to their issues. We will understand the behavior. Then when the standard says prohibited, if at all the objectivity is missing, competence is missing, discipline is missing, systematic and disciplined approach is missing, don't use their work. Suppose you decided to use the work. Nature of work that you can use. What nature of work you can use, to what extent you can use. This first point is talking about nature of the work. Nature of work of internal audit function that external auditor can use. The nature of works. What nature of works you can use? You can use the works which involve limited judgment. You can use their works in inventory count. You can use their workings in terms of verifying compliance with law and regulation. You can use them to review components and subsidiaries which are not significant, that are relevant for group audit. You can review them in testing of operating effectiveness of controls. Clear? This is a nature of work that can be used. The external shall consider nature and scope of work performed by function so that he can plan the following. Now, what extent you can use? How extent, to what extent internal auditor's work can be used? To what extent internal auditor's work can be used? The external shall make all significant judgments. This you should not give it to internal auditor. External auditor shall perform most of the work directly. He must plan to use less extent the work of internal auditor. Correct? And it should result in the planned procedures. The external shall evaluate whether using the work of internal auditor, is it still resulting in the external auditor sufficiently involved in audit? And the external auditor shall finally communicate with those charged with governance what is the planned timing and scope of work that the external auditor is planning to use the work of internal auditor. So nature of the work you are using, internal controls, limited procedures, counting, that and all. Extent, you should perform more, use that work less. It should appear that you are only performing the overall audit. Very simple. Finally, communicate with management what works you are going to use. Now, okay, you decided. Nature and extent you decided. Now you need to ask their workings. Nah? Yes or no? You should now sit and coordinate with the internal auditor. You told top management everything. You told top management which works I'm ready to use, which works I'm not going to use. So you gave a presentation to the top management that these works I'm going to use, all that. You still don't worry. I am still sufficiently involving in the audit, all that you informed. Now you need to tell them what. Now finally top management and all, everything is over. Communication, formalities, everything goes over. Now sit with internal auditor. Discuss with internal auditor, coordinate with internal auditor, how I am going to use his work, how his work is going to help me. I should tell him the activities, when he should do all that. So that parallelly, as and when my requirement comes, he will be ready with the workings. So that I need not wait for his workings. Further, he will read the reports. He will read the reports of internal auditor. The external auditor plan to use an obtaining of understanding of audit work performed and related findings. I will read the report. In that report, what internal auditor will give, what procedures they performed, what are their findings. That and all I will observe. Then the external auditor shall perform procedures to determine adequacy of the work. Whatever the work performed by internal auditor, I will see whether it is adequate for my audit. What I will see whether it is adequate for me, simply what evidences they have obtained, is it sufficient for my purpose of audit, what conclusions they reached, is it proper from my audit point of view, what work exactly they planned, performed, supervised and decisions taken, all that I will check. Typically our engagement team also will do the same, right? We plan the work, we plan and perform, supervise and review the work and document the work, right? That is what we also do, right? We obtain sufficient appropriate evidence, right? We take decisions based on that, right? Now this activity is performed by internal auditors. That alone you verify, simple logic. Now, to what extent you review their works, to what extent you monitor that, to what extent you in-depth checking will be done, that and all dependent upon how much judgment involved, how much risk involved, how far he is independent, how far he is competent. Once you decided that the work is adequate, everything is fine, once again as a whole based on your understanding, still once again just check. Do you still think internal audit function is relevant for your audit? The whatever work you're taking, right? Is it relevant for your audit? Have you understood? All of you. That's how you should summarize. Getting it? Now once you summarize like this, then go to the other part of the standard. Once you read the other part of the standard also, then do an overall summary like this again. That is how you will avoid confusion. You will have a concrete clarity on every topic. Okay. Now, using the internal audit function to provide direct assistance. Okay, direct assistance I want to use. What I will say directly, only two elements. Objectivity and competence. Only two elements I will see. Objectivity and competence. Whether they follow systematic approach is irrelevant to me. Why? I am not using their work. I am using directly as part of my team. I will tell them how to do the work. Here I am just taking manpower help. I am not taking their works. If at all I am using their workings, their working notes and all, then I will see on what methods they followed in the working, what systems they applied, all that. Correct? So, prohibition. When it is prohibited? When there is a threat to objectivity, when they are lacking skills. Like this itself can be asked as a 3 marks question. Like internal auditors know, while using direct assistance, you need to check whether they are possessing objectivity or not. What points you will check for checking objectivity? This answer you have to read. What relationships they have, what associations they have, all that. Then, suppose You know when you cannot use direct assistance, when you can use direct assistance, we understood now. Now, you know, you decided direct assistance, right? Some areas you cannot give them. Like in type 1 also, some areas we cannot take their workings. What are the areas? Areas of higher risk, areas of significant judgment. Same points will be there. Areas of significant judgments, areas of higher risk. The work, no, the area where I want to use, no, it relates to the area where already they involved. The same work again, don't give it to them. You're getting it. So, or related to decisions external auditor makes in accordance with this standard. Under this standard, we are supposed to take some decisions, right? What decisions? Can I use work of internal auditor or not? If so, type 1 work, which works I can use, which works I cannot use. This activity, can I delegate to internal auditor itself? That's it. That you should not delegate. Finally, once you decided to go for direct assistance, you need to do some formality. Enter into a written agreement with the company that they are okay with providing internal auditor as part of external auditor team for direction, supervision and review of external auditor. 2, from internal auditor also get a written confirmation that they maintain confidentiality. Any threat to independence, they will intimate me immediately. Here you have to be honest with me. Like that, I need to enter into an agreement with them. That's it. Over. Finally, documentation. The standard is over. 610. Understood? Easy or not? Next we have 620. Using the work of an auditor's expert. Using the work of an auditor's expert. That's how, like when you are reading each and every compartment context, always remember why we are seeing this audit, why we are reading the standard, how far the standard is relevant in the overall our audit objective. Then each and every point when you are reading, how far that point is relevant to the standard objective, and then sync it with the overall objective. That's how you have to read. That's how you can minimize number of revisions. Getting it? Without understanding, mugging up, it will never work. 10 standards you will remember. 46 standards you will not remember. 10 standards mugging up will work. 620. Using the work of an auditor's expert. Who is an expert? If at all somebody is expert in accounts and audit, we don't agree. So we are only experts in accounts and audit. Correct? Whether we know it or not. No. But the standard says what? You know, a person is an expert. I mean, any person having specialized skill or talent or any knowledge in any field other than expert, other than audit and accounts, if a person is expert, now we call we will treat him as expert. Now these experts are 2 types: management expert, auditor's expert. Management expert is a person who will help the management in preparation and presentation of financial statements. Auditor expert is a person who will help the auditor to obtain evidence. What is it? To obtain sufficient appropriate. Ultimately, whatever activity we do in audit, why are we doing it? To get evidence. Our objective is to verify the things and see whether it is right or not. For that, we need some evidence, we need some information, we need background data. So, auditors, like auditor expert definition, you see, an individual or expert may be an organization possessing expertise in a field other than accounting auditing, whose work in that field is used by auditor for obtaining sufficient appropriate evidence. Who is a management expert? If it is used by the entity for preparing financial statements. For preparing financial statements, it is used by management. So that's management expert. So an auditor expert may be internal expert or external expert. Again, auditor experts can be 2 types, internal or external. Internal expert means within my firm I have another partner who is an expert in law. For example, suppose a company is having a very big pending litigation, and I want to know whether the company should create a provision or whether the company can disclose it as a mere contingent liability. And this is a query. For that, I have to consult a lawyer or a person who is having a legal knowledge of this entire case, who can understand this entire case. I am not competent to understand the law. I am only competent to understand 5 or 6 laws, not many laws. So I have I have a partner who has completed even law. Getting it? Can I contact him? Yes. He is an internal expert. Or network firms are there. Our firm belongs to one network like KPMG, Deloitte, EY, GT, like that. We belong to one network. In this network, there are some other firms were there. In that firm, some experts were there like this, lawyers. Can we contact them? Yes. They are also internal experts. They are also internal. External means what? Suppose in my network or in my firm, I don't have an alternative source. In that case, I will go to a third party. We call him as what? external expert. Whoever it is, you can go with whomever it is. But before you take the help of an expert, you should evaluate his competence, you should evaluate his skill set. What is his relationship with this entity? Yes or no? Especially when you're doing audit, whenever you're using external expert, you should check what relationships he has with the entity. Internal expert we need not. Anyhow, we will check it as part of acceptance of the audit. At the time of accepting the audit itself, whether our firm, partners, any other personnel in our firm or network firms, what relationships we have with the company, we anyhow check it as a part of accepting the audit. So when I am bothered about relationship between the expert and the client, when the expert is external party, when the expert is external to the auditor, auditor's external expert, that time I should check specifically whether do they have any relationship with the client or not. What services already this expert is providing to the client, all that I should keep in mind. So we will take the help of experts in various areas. For example, you take insurance company, they do take help of take the help of actuaries for actuarial liability valuations. So there are many liabilities under insurance law that were to be valued only with the help of an actuary. So companies, they will take the help of actuaries and measure those provisions and all for financial statements purpose. Getting it? Now the auditor is, suppose I am appointed as an auditor for the insurance company. I am appointed as an auditor for insurance company. So what points I should check? When I'm using the work of an expert, what points I should check? First to know, management has already appointed expert, right? I will try my level best to use that work only. I will not go for auditor's expert directly. I will try to take the help of management expert, like whatever their workings is there, that only I will have to verify. If at all I feel management expert is lacking competence, if at all I feel management expert is lacking objectivity, then only I will go for my external expert. Now, like, okay, you are using expert work, he gave some workings and all, you concluded, you took some decisions based on these workings and all, like what is your responsibility regarding this? The standard says you are only ultimately responsible. You are only ultimately responsible. You are the one who is responsible to get a sufficient appropriate evidence. One of the method through which you can get evidence is by using expert. That doesn't mean expert is responsible for the opinion you are giving. You are the one who is signing the audit report. Your opinion is what people are reading. So you are only responsible or answerable tomorrow for everything. Tomorrow, see, wherever the standard says there is no responsibility shifted. What does it mean? You are liable to explain. It is not that, see, you are only the external auditor is responsible. What does it mean? Punishable is different, responsible is different. You're getting the point? Many interpret responsible as punishable. No. Both are different. When a situation comes, suppose I dependent upon one expert and I concluded his workings is right. Later on it is discovered that that entire working is fraud. I am responsible to give an explanation to the people, to the NFRA or to the regulatory bodies that I complied procedures given under the standard. I followed everything honestly. Look at my documentation. Look at the mail. Look at the correspondence I did. Look at the activities I performed. So I did my duty justified. He did fraud. What can I do? Beyond mine is reasonable assurance. But you are responsible to give this explanation, right? That is what the standard says. Responsibility means what? You are responsible to prove that you are complied with the procedures given under the standard. Your responsible means not that if tomorrow expert did fraud, you are punishable. No, not that. Even in internal auditor, when we say external auditor only fully responsible, even here when we say external auditor only fully responsible, even in 220 we say the engagement partner is fully responsible. Wherever we say the firm or partner is fully responsible, they are supposed to give explanation. That's what that means. If at all you are unable to give proper explanation, if at all you are unable to prove that you complied with the standards on auditing, whatever standard it might be, then only you are punishable. Are you getting the point? So, the standard says the external auditor has sole responsibility even though the external auditor using the work of an expert. What do you mean by responsibility? Just now I told. Now, first okay, like in the standard, they gave you guidance on, first of all, do you require an expert? The standard gives you a guidance on when do you require an expert. Okay, if expert is required, can you go with management expert or do you require a separate auditor's expert? Both the standard is addressing. The standard is addressing two different aspects. One, the standard is not, you don't have to worry about whether expert is needed or not. You can read the standard and you will understand whether expert is needed or not in the circumstance of the case. So the standard gives guidance on when do you need expert, when do you need auditor's expert. Both are different. The standard gives guidance on one, when do you need an expert, when do you need an auditor's expert. When will I need an expert? An auditor's expert may be needed in the following areas. An auditor's expert may be needed in following areas. First of all, in which areas auditor can use? Tell me entire audit process. First, what we do, we understand the entity and its environment. We test internal controls. We perform substantive procedures. Yes or no? We do reach conclusions. Broadly, I can say like this. They are only listed here. They are only listed here for obtaining understanding of the entity, for identifying and assessing risk of MMS, for designing further audit procedures. Overall response means what? Further audit procedure, which may be compliance procedure or substantive procedure. I mean, that is what? Determining and implementing overall response. Determining and implementing overall response means planning. And designing and performing further audit procedure comprising test of controls and substantive. Now, by performing this, what you will get? Evidences you will get. Whether the evidence is sufficient or not also, you may need expert help. Because you don't know whether this evidence is sufficient or not. An insurance company creating provision for some, calamity related purpose. Some calamity happened, for that they are creating some provision. For that they have given certain workings. The company gave certain workings. Is this workings adequate? Correct? For that reason, you need to take the help of expert for determining sufficiency and appropriateness of evidence obtained for forming the opinion. Indirectly, the standard is saying in any phase of an audit, you may take the help of an expert. You may be taking help of an expert in understanding phase. You may take the help of an expert in risk assessment phase. You may be taking the help of an expert in designing and implementing response to the assessed risk. You may take the help of an expert in performing further audit procedure. You may take expert help in sufficiency and appropriateness of audit evidence evaluation. Easy? Further, like you see, factors for determining need of an expert. What factors? First of all, that they are answering where you will require generally an expert. Where you will require throughout any phase of an audit, you may require. Second, what are they saying? Auditor may obtain understanding of other field. How far auditor has knowledge of that field? Suppose, I am doing for the first time insurance company audit. Everything appears new to me. I don't have any friend, any partner or any senior who nobody is there to explain me who has experience with this. So in that case, I may need an expert, right, for sure. What if like suppose, can I get an understanding of that field generally? Like, is it possible for us to get an understanding? Yes, it is possible by auditing those entities. Yes or no? Or through some formal courses, discussion with people who have expertise, discussion with other auditors who performed similar engagements. Generally, auditor is not an expert in a field other than accounting and auditing. However, regarding other fields, auditor can get expertise by what? By doing auditing those entities, or by doing a formal courses, like by development, professional development, education and development, or discussion with individuals who have that knowledge, discussing with other auditors who perform the similar engagements. If in all these cases I don't have any option, in that case what I will do? I will directly go for expert. In that case, I will do consider auditor's expert. In that case, I will do consider auditor. So how are they answering? What are the factors that you require whether you need an expert or not? One, you require an expert in these areas. Two, you require an expert if you don't have experience in these audit entities, if you are not able to go for any formal course, you don't have any people to discuss with, you don't have any other auditor who have performed the similar engagement. These factors will help you to decide whether you need an expert or not. Correct? When do you need an auditor's expert? When I will need an auditor's expert? Expert is required, understood. Already management used management expert. You require expert, right? Management said, sir, that's what, sir. We also did expert only. We didn't take decision on our own. We took this with this fellow decision. He is a member of so and so body. He's liable for so and so, all that. You can take the, we relied upon him. So these are the workings. You please take this. Why unnecessarily again taking another auditor, another expert, again paying him the fee? We have to bear. Client has to bear ultimately. Correct? So the company said, in that case, what auditor will evaluate? When management used a management expert, the auditor will evaluate what is the nature of the work he performed, what is the objectives of the work, whether he is employed by the entity or is it a third party of the entity, and whether management is influencing him, whether what are his competence and capabilities, whether the expert is liable for technical performance standard. I see my work people are believing because I am liable for standards and auditing. Same way, other guy is also some expert, right? When I can believe his work, if at all he is governed by some standards like how I govern, how I was governed, yes or no, I will evaluate management experts' objectivity, competence and ethics, independence. Then what is the significance of the matter and complexity involved? What is the risk involved? What expected procedures that are required? What about alternative sources of evidences? By checking all this, I will decide whether should I go for an auditor's expert or can I settle with management expert workings. You're getting it? If at all alternative sources of evidences are available, why to go for expert? Take alternative evidences. So these are all factors I will evaluate to determine whether auditor's expertise is required or not. Understood? In exam they may ask you, what are the factors an external auditor shall determine for need of an expert? You should write these 2 points only as an answer. What are the considerations when deciding to use an auditor's expert? Only these points you should write. Sometimes I'll ask you only this point. The auditor want to consider whether to use an auditor's expert or not. In the process of this consideration, he identified that management has used an expert for preparing the financial statements. What points the external auditor shall evaluate with respect to management expert? That itself can be asked. This first point itself can be asked as a 3 marks or 4 marks question. You are getting it? Then, suppose you decided to use the work of an auditor's expert. You decided to use the work of an auditor's expert. After evaluating all this, you decided, okay, no, I don't want to risk all that. I want to go for my own expert. Now remember, the moment you decided that you want to use your expert, your nature, timing, extent of procedures will be affected, right? Because you are using expert, sometimes your works will be in such a way that only if expert report comes, your work can be proceeded further. Sometimes the external auditor's nature, timing, extent of audit procedures are influenced by use of auditor's expert. How it is influenced, in some cases, more extensive procedures is required. In some cases, more extensive procedure is required. When the work of expert is relating to significant matter, or when the auditor has not previously worked with this expert, first time I am working with him, or when the expert is performing procedures that are integral to audit, only when he completes that one I can go further. Only if at all he give me confirmation about opening balances, I can go further. Opening balances involve so many items which are judgmental. I am unable to verify. Expert is an auditor external expert and not subject to firm's quality control policies. Means the expert is outsider. He don't know exactly what is my requirement. He is not subject to my firm quality control policies. My policies and procedures are documentation, work methodologies, everything is different. His methodologies and all is different. Are you getting it? Now, so indirectly, these are the points, right? In these points, we generally have to perform more extensive procedures. Which means what factors we are checking here? We are checking nature of the matter, risk involved, significance of the expert's work, my knowledge and experience with the work of that expert. What factors I am checking in see, definitely nature, timing, extent of my audit procedures are influenced by auditor's expert. No doubt. How far they get influenced? It depends upon the nature of matter, significance of the matter, risk involved, and knowledge and experience this auditor has with that expert. In some cases, the nature, timing, extent of my audit procedures extensively be affected because of the expert work. When the matter is related to a significant matter, when auditor has not previously worked with him, and auditor has no knowledge about his competence, and expert is performing procedures that are integral to audit, and external auditor is an expert, the expert is an external guy and not subject to firm quality control. policies. They'll give you this only question. They will give you a question like this. You know, the nature, timing, extent of audit procedures influenced by auditor's expert. There are some circumstances where external auditor has carried out extensive audit procedures in a scenario where he is using the work of auditor's expert. Give few examples. What will you write? This answer you have to write. 4 marks question they'll give you. Understood? Now, okay, you understood how expert work is influencing your audit. First we understood, do I need an expert? Then we understood, do I need an auditor expert? Then I understood how my audit procedures, timing, everything will affect because of him. Now, after deciding all this, now you decided to use his work. He worked also. He completed the work also. He gave you the report, workings, all that. Should you verify the documentation, everything? Yes or no? Before that, no, that is actually using the work. Sorry, evaluating the adequacy of the work. That is what? Evaluating the work of the expert. Once the expert is completed the work, that I will evaluate. Now, suppose no, you decided. Suppose right now we decided, okay, my audit plus everything will affect. I understand. Now you need to recruit an expert, right? Now, when you are recruiting, what you are liable to verify, you need to verify whether an expert is competent. Do they have? I mean, are they having capabilities, and are they objective? Objective means what? Is this expert has any relationship with this company? That also I should check. Getting it? Suppose like external expert objectivity. This itself can be asked as a 5 marks question. How an external auditor can verify external experts objectivity. Getting it? How do I verify? I will ask, I will inquire. First, no, I will inquire regarding interest and relationship that create a threat to experts objectivity. I will ask external expert first. I will ask that guy, do you have any company? I'm auditing Reliance company. I'm the auditor of Reliance. Do you have any relationship with the Reliance company, directors, any key managerial persons, shares in that, loans in that? Tell me what are the relationships you're having. And I will ask entity also. I will ask company also. I will do a cross examination. I will ask company also. Sir, I'm going to recruit this guy as an expert for my audit. So tell me what relationships you have according to you. And I will see whether, suppose, no, if at all some relationship exists, I cannot straight away say this expert is not used. See whether it is creating threat to independence of the expert. If it is creating threats, can we put some safeguard? Can we put some safeguard? If safeguard is possible to reduce the threat, you can happily recruit him. Are you getting it? Then I need to get a representation. I need to get a representation from the expert that he does not have any relationship with the management. He does not have any relationship with those charged with governance. Remember, these are all requirements of the standard that you must follow whenever you are using the work of an auditor's expert. And whether expert work is subject to technical performance standard, like my audit is subject to NFRA review, Qual Review Board review. So I will do audit work carefully because there are so many bodies who are reviewing. Same way, is expert liable for any review like me? I will check it out so that I will understand the seriousness with which expert will perform the work. And relevance of auditor's expert competence to which his work may be used. Like here it is, no, relevance of auditor's expert competence to the matter for which that expert will be used, including the areas of speciality, all that. You know, actuaries are there. Actuaries are very good in various purposes. But some actuaries will only help insurance companies, will only work for insurance companies. Some actuaries, they don't deal with insurance itself. We CS also specialize, you know. Some of us will only focus on direct access practice, some of us focus on GST practice, some of us focus on internal audit practice, some of us focus on external audit practice. So suppose I decided to use the work of a lawyer, for example, which particular laws is dealing with. Some lawyers are good at IPRs, some lawyers are good at civil cases, some lawyers are good at social cases, some lawyers are good at some tax related cases. So which lawyer? Just because you take a lawyer, that doesn't mean, you know, proper expert you selected. You should select the domain of expertise. Are you getting it? That also auditors should check. And evaluation of expert is a continuous. They'll give you the sentence in exam. Evaluation of experts' competence is a continuous process, keeping in mind unexpected events and changes in conditions. Give you examples in light of SA 620. They'll give you this answer, this question. They give some case study. Finally, they'll give one line. Evaluating expert competence is a continuous process. Comment, 4 marks question. What will you write? The above points, all that you have to write. Yes or no? The above points. Whether expert is subjected to technical standard, whether expert is competent in the matter where I am looking for, like area of specialty, whether expert is having any relationship with the entity, ask the entity and get a confirmation that whatever relationship he has to disclose you. These are all points I should evaluate to determine his competence, because his competence is affected by relationships also. Objectivity and competence are so closely related. Compromise in one will affect the other. Clear? If the expert is not competent, he will generally be not objective. Because if at all he is not competent, he will have a high threat of replacement. Therefore, he will always try to convince people. You're getting it? Next. Once you decided, okay, I will go with expert. Like you see how cleverly the standard is drafted. Do I need an expert? Do I need an auditor's expert? How far your audit procedures are affected by using the work on, like standard is giving you everywhere hint. Go to expert only when it is required really. So look at whether you need an expert. See whether you need an auditor expert. Look at how it is impacting your audit procedures. Getting it? And evaluate. What is this? Evaluate his competence, capability, all that, and independence, objectivity. And finally, don't directly start working. Enter into agreement, formality. Yes or no? Enter into an agreement. Design, like, both of you discuss and design scope and objective. What are your responsibilities, auditor? What are expert responsibilities? Who should compensate him the remuneration? How much? Everything you should decide, right? So, nature and scope of objectives of the expert, roles and responsibilities of auditor and expert, timing of the communication and form of report the expert has to give. And you should tell him confidentiality has to be observed. You should tell the expert that confidentiality has to be observed. Finally, recruitment process of expert is over. We recruited. Now management is giving him the data. He worked on it and he gave the output. Now what you need to check here? Blindly will you take it? The expert said, sir, that is materially misstated. Will you blindly take it and directly give a modified opinion on the company? No. You should check adequacy of the work performed, what methods he followed, what assumptions he followed, whether he followed any standards and all. Do I check all this or not? So, inquire the expert, review his working papers, observe the expert how he is performing, confirm with the third parties if at all required. Whatever he said, no, don't believe. Confirm once with third party also. Does it appear reasonable or not? Reperform the calculations. Discuss with another expert if the matter is so significant. Discuss with the management. If expert works involve significant assumptions, auditor must check reasonableness of those assumptions and what data he is using. Expert is using what data, what is the relevance, how the data, is the data completed, is the data accurate? Here we are evaluating work of the expert. Here we are evaluating what? Work of the expert. Suppose if the work of the expert is not adequate, after verifying his workings, you somewhere felt, no, I'm not getting convinced, I'm not convinced, you're not getting convinced. What you will do? You will ask him to do more work. You will also ask management, please provide complete proper data. We are not getting proper conclusion. Agree with the expert nature of further work to be performed. Correct? Further work. Discuss with him and tell him, perform further work. If possible, you also perform further audit procedures. If at all, you can resolve it. A work of expert may not exactly be directly useful. You may have to definitely work on it something else additionally. You're clear. Suppose if at all ultimately you are not able to get evidence through the expert, you understood that there is a limitation on the scope of the expert. The evidence that expert is getting, no information is getting from the management, there is a limitation you felt. You give modified opinion because there is a limitation on the scope of information. There is a limitation on the evidence. Therefore, even though expert decided to work extra, it will not result into a proper, adequate for the purpose of audit. Now, when you are so you modify the opinion. Now, finally, should I refer about expert name in my audit report is the question. Suppose you use it as expert, you use the expert, auditor's expert work, all that. Based on this, you concluded the financial statements are true and fair. Like the element for which I asked him, valuation of inventory is what we asked him. He valued inventory, I saw his workings, everything was fantastic, everything was proper. Whatever company did, expert report also says more or less 5% same. Getting it? I felt on that aspect unmodified opinion can be given. How I concluded? Based on my audit procedures, based on experts audit procedures. I concluded based on these two. Now I decided unmodified. When you are giving unmodified, should I refer about expert? in the audit report. Why to refer and confuse people? You got the evidence and document it. Are you getting it? Suppose you decided to give modified opinion. Suppose expert report gives us complete different figure than management calculation, and when I further evaluated, expert's work is what proper. And I told management, please modify the financials. Management said, we will not modify. Our report is only correct. Your expert is only wrong. There is a conflict between auditor and the management. Our firm quality control policy says you go with expert opinion only. Getting it? In such a case, I conclude the management that item assertion as materially misstated. Then I have to give a modified opinion, right? Yesterday, previously we discussed in a basis for qualified opinion or basis for adverse opinion, I should clearly tell them the reason why I am modifying. Here I am modifying because valuation is correct. Why? How can you say valuation is correct? We have taken so and so expert help who is liable for so and so standards, well known in the market. This fellow gave a report like this. Now here, why am I referring his name? So that people will understand better why I am giving exactly modified opinion. Now tell me, just because you are referring his name, the responsibility under this standard, will it go to him? No, that's it. Over. The standard is over. Easy or not? Entire standard. So what are the elements that are there in the standard? Do I need an expert? Do I need an auditor's expert? How this will affect the nature, timing, and extent of procedure? Evaluate the competence. Enter into agreement. See the work is adequate or not. If the work is not adequate, what to do? Finally reporting. Over. Correct? Huh? So, see, having a chart book where this entire points is given, reading from that will not give you understanding. You see, I am using without a chart, I am giving you over bird eye view. That only comes by mind summarization. Just because chart book is there, you will not get summary. Summary book doesn't mean you are summarizing it. Your mind should summarize the data, not the summary book. Book can never give you the explanation. You should decide that. Understood the standard, everyone? Now will you confuse on this standard? Any question asked? The standard we discussed 2.5 hours in class. Because we discuss so extensive. We discuss top to bottom, bottom to top, middle to bottom, middle to top, all in the ways. We will run continuously. And definitely I'm telling you, in this class, definitely little more points I would have told extra. Though it is half an hour I spent, I would have definitely told some 2 or 3 extra points. Correct? Huh? Yes, clear. So just 2 minutes, we'll take a gap and then continue. Yeah. Let's begin the chapter standards on auditing. If you look at ICI book, we have totally 1 to 7 chapters, actually 1 to 11 chapters. Chapter number 1 to chapter number 11, they are all dealing with engagement and quality control standards. 8th chapter onwards to 11th chapter of ICI book. If you look at 8th chapter to 11th chapter, they are dealing with 800 series, 2000 series, 3000 series, 4000 series. 8th chapter to 11th chapter, 8, 9, 10, 11. 4 chapters, 4 different series. Remaining 7 chapters, they are dealing with. Remaining 7 chapters, they are dealing with these 36 standards, which are standards on auditing and quality control. Remaining 7 chapters. Out of which 1 chapter which deals with 12 standards, as per our book, we completed. And there are 2 more chapters, risk assessment and audit strategy, which we gave it as a separate chapter. So out of 7, these 3 you eliminate. There are still 4 more chapters in the ICI book. Out of 1 to 7, audit report you eliminate. Risk assessment strategy you eliminate, because these 3 are 3 separate topics which are given as standards again. Out of remaining 4, some of this is covered. For example, right now what are all we have completed? 600, 610, 620, 700, 701, 705, 706, 710, 720, correct? And even 570 we have completed. 299 also we have completed. These are the standards which we completed. Now, and there are some standards which institute itself does not give. Like what are the standards they didn't give? 200, 210, 230 and 320 also is not there in the ICI book. 320 also not there in the ICI book. 330 also not there in the ICI book, and 450 is also not given. In the ICI book they have not given. Like these are all given in depth. Whatever I have highlighted in red color, no, they are all given in depth in CA Inter. If you want to read these standards, they are asking you straight away read CA into book. You're getting it. They have not given any idea about this in the book itself. In the CA final book, you will not find any traces for this. You will find like whereas 300 we have a separate chapter called audit strategy. 315 we have a separate chapter called risk assessment. In that itself 265 is also discussed. In that itself 265 like communicating weaknesses in communicating significant deficiencies in internal control to those charged with governance, that is discussed. 260 like what are the standards that are exclusively discussed in CA final? I'll highlight. 240 is in-depth discussed in CA final in the standards topic. 250 is in-depth discussion is there. 260 in-depth discussion is there. 220 in-depth discussion is there. 402, 540. That's it. These are only the standards which are in-depthly discussed. Like 1, 2, 3, 4, 5, 6. That's it. Only 6 standards were given in the CA final, those 4 chapters which I told in-depth. Also, they have given briefly as a diagram, a single diagram, simple diagram, 500, 501, 505, 510, 520, 530, 550, 560, 580. All these standards which I highlighted in pink color, they were also there in those 4 chapters, but simply as a diagram. But in exam, they will ask you in-depth questions. It is not like they will ask you from the diagram, and we have solved recently the question bank in our regular class also, where we have shown clearly how in-depth questions can come from these standards, even though it is not covered in-depth. Even one more for your information, even 570 also given as a diagram only. But still we discuss little bit better than the diagram. But not as detailed as given in the CA Inter. As detailed as given, even 570 institute is asking you to refer CA Inter book only, because this 570 is covered in this chapter called completion and review. We discussed it as a part of audit report chapter. So we didn't discuss it as a part of completion and review. Are you getting it? So audit report, risk assessment, strategy, only these 3, and we have 220, 240, 250, 260, 540, 402. Only these standards were in-depth. And audit report, whatever standards we discussed, that is in-depthly discussed. Rest all other standards, they were only given as a brief diagrams. Getting it? But still, we will be discussing, except the one which I highlighted in red color, with red round, red circle, that I will not at all touch. But everything else I will briefly discuss. Getting it? Whatever I have given in blue, right, that I will discuss little moderately. But remaining whatever highlighted in pink color, I will discuss it briefly, because these are all CA Inter standards. And even in 580, recently in the CA final also they have asked a question which actually was there in the CA Inter. But of course in CA final also these were asked as a part of RTPs and MTPs in the previous years. But never you should never learn the subject from the question bank. What we generally do is we read so many questions so that we can practice so many questions, so many concepts. Never. That's never a right approach. You should always fix the destiny and then design the route. Not going every route and then going to the destiny. Getting the point? So fix the destiny. What exactly you have to learn from the standard and what exactly you have to study, so that any question on the standard comes, you can answer. Not by practicing, uncountable questions. By practicing so many questions, you will never gain conceptual clarity. You will never gain that understanding. If the slight twisting is done in that question, you will do mistake. Clear? Fine. So let's try to begin. Let's begin this standard. Okay, fine. Let me save this file as a separate thing. This is introduction. This is introduction to standards. And of course, by the way, one more thing I forgot. Blue, even SQC, this is also discussed in depth. Total 7 standard, including quality control, we have in-depth discussion which yet to be done. And we have remaining standards which are briefly discussed by the institute. So we'll directly start with 250. We'll directly start with 250. Yes, let's begin 250. So 250 talks about what? Auditors' responsibilities relating to laws and regulations. Auditors' responsibilities relating to laws and regulations. There is another heading that is also widely circulated. Consideration of laws and regulations in an audit of financial statements. Any heading can be used. But if you ask me the right heading, the first one, auditor responsibilities relating to laws and regulations, or considering laws and regulations in an audit of financial statements. I'll just show you one document, one practical document. Yes, yes, we'll see that. So this is one of the compliance audit. This is one compliance audit, like where the auditor is specifically appointed to check laws and regulations, where he is specifically appointed. This is like an agreed upon procedure. This is an agreed upon procedure where a practitioner is exclusively appointed to check list of laws and regulations applicable to the entity and what are the compliances under those laws and regulations. So these are the list of laws and regulations that are applicable to one entity, where they have close to like almost 4,935 compliances. There are totally 4,935 compliances. Approximately some 30 to 40 laws were there. And this is the compliance audit workings. These are the compliance audit workings. So like these are the documentation of what are all the observations they made. So 4,935 observations, you can see 4,935 compliance checklists they prepared and they're doing it. If at all we are called for doing this kind of engagement, then 250 will not apply. That is what the non-applicability of point 250 says. 250 standard is not applicable when? Just a minute. You see, first point itself it says, it does not apply to assurance engagement in which he specifically to test and report separately on the compliance with laws and regulations. What does it mean? The report which I showed. Getting it? So 250 specifically do not apply for these kinds of engagements. 250 is applicable for what? For all laws and regulations. 250 is applicable for audit of financials. More clearly, audit of financials. In the audit of financial statements, how far these laws and regulations I should consider? What is the significance of these laws and regulations in the audit? That is what 250 mainly deals with. And you know, an entity is subjected to so many regulations which auditor is not aware of. We don't generally aware of. Imagine a very big entities. Don't imagine small private entities, small private entities. No. Imagine a very big entity which is doing some 10,000, 15,000 crore turnover, has spread across India. Getting it? Has some factories established, and they are subjected to so many laws and regulations like environmental laws, so many. Now, are we supposed to verify compliances with all these laws? First of all, how the law and regulation have a relationship with the financial statement? What is the nexus between these two? First of all, very simple. Suppose if the company does not calculate GST at the right rate, By applying the right rate of GST applicable to the product, they don't calculate. They collect from customers at a lesser rate and they remit at a lesser rate. Tomorrow when department give a notice, the company has to pay out of his pocket the higher rate. And it results in under recognition of liability. Are you getting it? So if the company failed to interpret properly the GST law, it results in omission of liability or overstatement of liability. That is, these laws are called as something like tax laws, labor laws. These are the laws where you can find a direct impact on the financials. But there will be some other laws where you will not find a direct impact. Where you will not find a direct impact, but they will hit the financial statements at a point in time. Suddenly they'll hit. They affect the financial statements materially at a point. Suddenly. For example, Paytm Payments Bank is there. Paytm Payments Bank is there. They are continuously violating KYC norms of the RBI. They are continuously violating. In spite of repeated reminders from the RBI, Paytm Payments Bank did not rectify their wrong practices which RBI continuously recommending them. Now suddenly what happened overnight? RBI cancelled the license. Going concern is affected. So compliances with laws and regulations is so severe that affects going concern. Does it mean it has an impact on financials or not? Obviously, yes. So it has an impact on financial statements. This all these laws and regulations will have a direct or indirect effect on financial statements. Now you may say, sir, how are we, like again, another one, environmental laws. Another one is what? Environmental laws. Suppose a company failed to comply with the forest law. Continuously they are violating some laws related to environment protection safety. Some social activist filed a complaint against the company in the environmental committee. And that social activist is also very powerful background. For example, what happens? Obviously the company license will be cancelled. Business will be interrupted. Business will be like completely like what? Entire interruption will happen. Correct? Now, auditor has to check whether the company is conducting its business in compliance with the law that is applicable to the entity. Which laws? If you ask tax laws and labor laws, which I can understand, I can interpret and check. What about remaining laws? They will not have a direct effect on financials. I don't know anything about these laws. What about them? You need not worry about detailed checking of those laws, but you should do a limited procedure. You should do a limited procedure to identify non-compliances. See, whether a law is complied or not, it is difficult to verify. Whether is there a non-compliance or not, easy to verify. Detecting mistakes is easy than figuring out whether the process is right. Is it so? Correct? Huh? So the standard divides laws into two types. Those laws and regulations that have a direct effect on determination of material amounts and disclosures in the financial statements. Type 2, other laws and regulations that do not have a direct effect on determination of material amounts and disclosures in financials, but failure to comply with them will result in material fines and penalties, and even going concern might be affected. Agreed? These are type 2 laws. Means other laws that do not have a direct effect on financial statements, amounts and disclosures, but failure to comply with them will have a material impact on the financials, because they results in fines, they results in penalties, all that. What the standard is asking you? The standard is asking you first to look at, did the company establish any framework? Did the company establish any framework, policies and procedures to ensure that these laws and regulations are complied timely? Whether company is established procedures to ensure these laws and regulations are complied timely. Now you see, the following are the examples of types and policies the entity may implement. The entity may implement to ensure prevention of non-compliance. If at all any non-compliance is there, it is detected on a timely basis. Obviously, whose responsibility primarily to comply with laws? Management. Who should design internal control system for laws and regulations? Management. You might have studied one of the objective of internal control is what? Prevention and detection of non-compliance with laws and regulations. Prevention and detection of non-compliances with laws. What controls company will implement? These controls. What controls? They will design and implement a monitoring department. Getting it? For legal requirements. They will design and implement systems. They will design a code of conduct for complying with laws. They will train the employees, make sure the employees understand the compliance process, and they engage legal advisors, and they maintain a register of laws and regulation. They maintain a register of laws and regulations, and monitoring the compliance and disciplinary mechanism against the employee who failed to comply with the code. For all this, company shall establish processes. The company shall establish processes for monitoring legal requirement, designing and implementing appropriate system, designing a code of conduct, training the employees, taking action against those who do not comply with the code of conduct, engaging the lawyers, maintaining the list of laws and regulations. If a company has such a kind of system, whether we can have an assurance that yes, company is complying with laws and regulations. Some companies which are dealing at a bigger level, where multiple products they're dealing with or big consumer share they're having, they generally go for the compliance audit, which I told. They generally will have a compliance audit team where they will list out all the laws and regulations, all the compliances under that law, whether the company complied or not. Each and every compliance. You are getting it? Suppose pollution control pipe is there, for example. What density of the pipe material to be used? That's the rule. What should be the density, gauge number of the pollution control equipment, emission tool, emission particle, whatever the pole, getting it? What should be the density? Further, there is a regulatory norm, whether the company used or not. Some expert will come and give a report on that. And whether it is complied or not, compliance audit team will verify. So that's a compliance audit. Are you getting the point? So if a company has such a kind of system, I will get a reasonable assurance, yes, company is complying with laws and regulations or not. Now we understood there are two types of laws. What controls company? By the way, this itself can be asked as a 4 marks question. What are the examples of policies and procedures company will implement to prevent and detect non-compliances? And one more thing, in large entities, these policies are supplemented by assigning responsibilities to internal audit. In many entities, internal audit functionally takes care of all this. Then what are the responsibilities of auditor in relation to? Okay, we understood type 1 law, we understood type 2, two types of laws is there, and how a company can ensure compliance with these laws and regulations we understood briefly. Internal control they will establish. What will be there in the internal control examples we understood. What is auditor responsibility for type 1 laws, where they have a direct effect on financial statements, amounts and disclosures? Auditor should obtain reasonable assurance whether they are all complied or not, which means type 1 laws and regulations you have to list out. You have to list out the requirements of type 1 laws. You have to check each and every requirement complied or not. In this case, you may take help of internal auditor. That's a different story. When I'm checking GST complaints, I may take help of internal auditor. When I'm checking TDS working, I may take help of internal auditor. At the time, that stand also applicable. Type 1 laws, you must obtain reasonable assurance whether they are complied or not. Type 2 law, you have to obtain limited assurance. Type 2 law, you have to obtain limited assurance. You should get an assurance that nothing has come to your attention to say that type 2 laws are not complied. In type 2, you just have to perform specified audit procedures. The standard uses the word specified audit procedure. The standard says specified. You see, the auditor shall obtain sufficient appropriate evidence regarding type 1 loss. Whereas type 2, the auditor responsibility is limited to undertaking specified procedures to identify non-compliances that has a material effect on the financials. For type 2, your responsibility is very limited. Whereas in type 1, you should get sufficient appropriate evidence whether all the type 1 laws and regulations are complied. Remember, just like we have inherent limitations, we have so many limitations with respect to laws. With respect to laws and regulations, non-compliance identification, we have so many limitations. This was asked recently for 4 marks in May attempt, I think so. Either RTP or MTP or May final exam. Getting it? So, because of inherent limitations, there are so many limitations with respect to auditor's ability to identify laws and regulations non-compliance. Especially laws and regulations are inherent and the limitation is greater. Why it is greater? Because there are so many laws that are not affecting financials, which are not captured by entity information system. Company may not have a practice of identifying all the laws because they are not affecting financials. Or non-compliance, no, the company conducted a non-compliance with collusion, forgery, deliberate failure, Deliberately they record, they did not identify this non-compliance. Or sometimes, whether a particular act in a particular law, whether that amounts to non-compliance or not is a matter of legal determination. Sometimes non-compliance is performed, but it is removed from the books of accounts. Auditor is less likely to become aware of it. These are the limitations. There are so many laws which does not affect financials, which were not recognized by company in the books of accounts and financial statements. There are so many laws. Management with collusion, forgery and all hidden the non-compliances, or management removed non-compliances. Sometimes whether it is a non-compliance or not, we can't identify. These are all limitations in the laws and regulations. Clear? That's it. Whatever it is, auditor has to be alert, skeptical, continuously alert to identify, is there any incidents or is there any circumstances that results in non-compliances. Clear? Then what auditor has to do? Understand, the auditor, what are the auditor's considerations about compliance with laws? This is like they are telling what is the procedure you have to perform. Specified audit procedure. What specified audit procedure you will perform for type 2 law? You will inquire management. You will inquire those charged with governance. You will inquire correspondence with regulatory authorities. You will inquire lawyers. You will verify fines and penalties ledger account. You will verify legal fees paid to lawyers. All these points I will verify and try to figure out for what purpose fine is paid, for what purpose penalty is paid, for what purpose lawyer fee is paid. I will ask management, did you know are you aware of any non-compliances? I will ask. I will see correspondence, mail that the company is receiving from legal authorities. Most of the big entities, they will have a separate mail ID which is given for various regulators. So all the regulators will communicate in the same mail ID. So when they're registering with GST, when they're registering with income tax law, when they're registering with environmental law, in all these cases, they will have a common mail ID. That will not be company's general mail ID. You're getting it? So check the interaction. Check any reminders from the lawmakers came, any reminders from regulatory came. Look at that correspondence. By looking at all this, you will identify, are there any non-compliances? It is not possible to list out 5,000 compliance list and verify. It's not possible. Technically, it is outside your competence. It is outside your competence to verify that, yes or no. So it is not possible for you, and you are not here. By the way, we are verifying laws and regulations right here as a part of audit under 250. Is that objective is to give opinion on that? No. Our objective is same. Our objective is to give opinion on financials. In this process, we want to see whether any non-compliance impacting the financials or not. Clear? And you must finally get a written representation that all the now non-compliances or suspected non-compliances have been disclosed to the auditor. You must do this entire audit procedure and get a representation finally that management has disclosed to the auditor all now non-compliances, suspected, possible non-compliances. Everything is to be disclosed to the auditor. Suppose no. So after doing this audit procedure, after gathering evidences, you may come across, you may identify some non-compliance, right? You may identify that when you're doing this entire procedure, you may identify non-compliance which company did not disclose you, which company internal control system failed to identify. What will you do? First, I will understand what is a non-compliance exactly, what exact mistake happened. And I will look at the further information to evaluate what is its impact on the financials. So some non-compliance is there with environmental law. I will ask this, so-and-so department, what it results in. He said some penalty will be levied, sir, because of this. Right now, this is not yet detected. You only detected it. So this is a penalty will be levied. When they will levy, whenever they come for the next time inspection. When they will come for next time inspection, 15 days after it is there. So they will levy penalty. Condition for this is already existing on balance sheet date. Now it will levy, penalty will be levied later on. So it's a subsequent event. I'll ask them to adjust the financial statements. Understood? Next. So if auditor is suspecting there may be non-compliance, first discuss the matter with management. Discuss with top management. If they do not provide evidence, go and interact, go and get a legal evidence. Getting it? If at all sufficient information about sufficient information about suspected non-compliance you are not getting, there is a possibility that there is a limitation on the scope. You need to interpret whether it is impacting the overall audit opinion. If sufficient information about is cannot be obtained, the auditor shall evaluate what is its effect on the auditor's opinion. If at all sufficient information about suspiciousness of a non-compliance, you are unable to see non-compliance, suspected non-compliance with possibility. Non-compliance means you found exactly what they did wrong. Then reporting non-compliance. Obviously, once you identify a non-compliance or you identified suspected non-compliance, you have to report to top management. Dear management, here I found some symptoms. Some fine is paid, but in that particular ledger journal entry, there is no explanation about why the fine is paid, and the fine amount is so big. So I am suspecting some severe non-compliance is there, which I am not getting from books of accounts. So you please investigate further and get back to me. I will report it to top management. Getting it? So suppose if management or top management, they are only involved in non-compliance, I will report matter to next higher level authority. If at all chairman is at them, or if at all holding company is there which is monitoring this, I will report them if at all required. If at all there is no higher authority exist, get a legal opinion and decide accordingly. What about reporting the non-compliance in the financial statements? What about the reporting non-compliance in financial statements? Suppose you identified non-compliance or suspected non-compliances, and management also investigated and agreed that there is a possibility, and you asked them, please disclose the same in the financials, because your financial statements are saying we conduct our business in compliance with laws and regulations like that. So you disclose the entire non-compliance in financial statements. I asked company honestly disclose everything. Tell me which opinion I'll give. Unqualified. And can I highlight this non-compliance in emphasis of matter paragraph if required? Yes. In auditor's judgment, if you think it is usable for the user, you can highlight. Suppose management is not giving you information itself. They are not letting you to verify non-compliances. First of all, when I want to verify type 2 loss, such a big company, they didn't have a process itself. First question I showed, policies and process management supposed to implement internal control system. That itself is not there. There it is extremely difficult for me to verify type 2 compliances. Then it's a limitation on the scope of audit, limitation on the evidence obtaining process. And then I will give modified opinion, qualified or disclaimer, depending upon the severity involved. That's it. Entire answer is over. You're getting it. Sometimes information is given, but you are unable to determine whether it is a non-compliance or not. You are unable to determine, which means why you are unable to determine, somewhere management is hiding something from you. If you are unable to determine non-compliance, it is generally treated as limitation on the auditor's evidence. Then also we will give which opinion? Modified opinion. And not just that. We have a requirement under Code of Ethics ICA NOCLAR. Yes or no? We have a Code of Ethics requirement NOCLAR. What the NOCLAR provision says, SCA 250 and NOCLAR are interrelated. I will not explain NOCLAR separately there. Okay. So what is NOCLAR? It says senior professional accountant employed in a listed entity, senior professional accountant employed in a listed entity, and an auditor of listed entities. A CA who is employee. Which CA? Senior CA, senior professional accountant. Senior professional accountant means what? Those who are working in the company as an employee, who are in key managerial roles or directors roles. That too for which company you are an employee? Listed entity. For you, NOCLAR concept is applicable. Another category of CS for whom NOCLAR is applicable, you are an auditor of a listed entity. For you also NOCLAR is applicable. What NOCLAR says, it does not say anything specifically like you do this, you do that. No. Check whether you identified any non-compliances with laws and regulations when you are doing audit or when you are in employment. Check, do you have any requirement under any law? Do you have any requirement under any law, specifically responsibility cast on you, that you have to report that non-compliance to respective legal regulatory authority? If there is a response, or if there is a responsibility specifically casted upon your designation, that you have to report non-compliance to some law and authority, if that responsibility is there, ICA Code of Ethics says you report it. If you do not report it, I will consider it as professional misconduct and punish you. That is what NOCLAR objective. NOCLAR objective is what? If you fail to report a non-compliance, lawmaker and they will punish. That's a different case. But you are violating ICI professional conduct of the profession. Yes or no? A proper conduct of the profession you are violating. So I will punish you if you fail to report non-compliance to lawmaker where you have a duty to report. Suppose no, I am working as an auditor listed entity. Some environmental company violated. But in the environmental, there is no duty upon me. There is no duty for me to disclose it. I didn't report. Can I say punish me? No. Hey, you are getting it. NOCLAR means that only. The objective of NOCLAR is this only. The objective of NOCLAR is saying, identify is there any non-compliance. Identify whether that non-compliance shall be reported by you to the respective authority. See, is there reporting requirement like this? Reporting means what? You have to report them. If such a reporting requirement is there, you have to report. If you fail to report, you are liable for punishment because you are violating code of ethics. Because you are violating council guidelines. You are violating requirement of the CA Act, NOCLAR. The standard also says here a corresponding point. If the auditor identified a non-compliance, the auditor shall determine whether the auditor has a responsibility to report. See, not every non-compliance you have a responsibility to report to lawmaker. For example, you are doing an audit of a bank. Some non-compliance is there which is because of a fraud. Because of a fraud, some non-compliance is there in a bank audit you found. RBI has given a specific circular on this where statutory auditors, internal auditors, both of them has to report. In that case, if at all I am an employee of the bank acting as an internal auditor, found fraud or non-compliance like this, I must report to RBI because there is a requirement for me to report, which means NOCLAR is applicable for me there. If I fail, IC also can punish me because I didn't report. Same way, I am a practicing CA. RBI says stat auditor should report fraud, non-compliances to RBI. If you find anything, you should report. RBI report says that. RBI circular says that. If you fail to report, it's a non-compliance. Suppose there is no such a duty. There is no such a duty and I didn't report. I know it, but I didn't report. No problem at all. No problem to the auditor. Why? His duty is to identify non-compliance. What is its impact on financials? Did he consider or not? He checked. That's enough. He don't have any duty to report to regulatory authority. That is not required. Understood? All of you. And finally, documentation. Finally, documentation. With this entire understanding, you read each and every element of the standard, you will get an idea. Otherwise, this standard is little tough because the same matter will be repeated again and again. Look at the objective of the standard. Two types of laws. Type 1, reasonable assurance, sufficient appropriate evidence, whether they are all compliant. Type 2, perform limited audit procedures. Is there any non-compliance? Getting it? That's it. Clear all of you? 250? Yes. So we'll take a break and continue in the next session. See, with respect to 250, what exactly and how exactly 250 is different from NOCLAR? NOCLAR is only talking about reporting to legal and regulatory authorities. First point. It is not concerned with financial statements. It is not concerned with financial statements. You are an auditor of a listed entity. You found a non-compliance. Check whether do you have a requirement under law to report. Check whether do you have a requirement under any law to report it to the lawmaker or regulatory authority about the non-compliance. If so, then report it. Failure to report to the legal and regulatory authorities, even if there is a requirement for you under the law, amounts to misconduct. Correct? 2. What auditing standard is talking about? This is talking about mainly reporting in audit report. What if you found a non-compliance with law? What if you found a non-compliance with law? And how to report the same in the auditor's report? That is what 250 standard is addressing. NOCLAR provision is addressing about reporting to regulatory authorities. 250 standard is addressing about reporting in the audit report mainly. In the 250 itself, they also give one line. You see, they only gave one paragraph. They just gave one paragraph. If at all there is a requirement for the auditor to report to legal and regulatory authorities, then he must report to them also. Since this paragraph is only at a minimal level covered in 250, institute felt the need. No, non-compliance with laws and regulations is a severe aspect. There will be definitely some laws and regulations where auditor might have a duty to report. So NOCLAR has been developed. NOCLAR is developed exclusively for reporting to legal and regulatory authorities about the non-compliances or suspected non-compliances identified by the auditors of a listed entity, identified by the senior managerial personnel, senior professional accountants in the listed entity. Whereas 250 is purely dealing with financial statements audit, reporting in the audit report about the non-compliance. Just as a formality, it also contains a provision for reporting to legal and regulatory authorities. Ultimately, should I report a non-compliance to legal and regulatory authority? This is the question. Check that law. Is there any condition for you to report? If so, report. No such indication. Explicitly, there is no such indication. No need to report. That is what SA 250 says regarding this aspect. NOCLAR also says regarding that aspect. Understood? One more question which is asked is, what about disclosure of non-compliances in the financial statements and its effect on the auditor's report? Understood the question? Disclosure of non-compliances of or suspected non-compliances in the financial statements by the management, and what is its impact in the auditor's report? Disclosure of non-compliances. Whether a non-compliance, whether it is type 1 law, type 2 law, whatever it is, should it be disclosed in financial statements is the question. Should it be disclosed in the financial statements? This is the question. It depends upon the requirement of the applicable financial reporting framework. If there is a framework, if there is a standard, if there is a requirement under Ind AS or Schedule 3 or somewhere, that list of all the non-compliances a company has to present, then it has to be presented. For example, if you look at Schedule 3, in the 2021, it was amended drastically. The Schedule 3 was amended drastically, where Schedule 3 contains additional regulatory information. Where Schedule 3 contains additional regulatory information. Inside that, they have specifically made, is the company facing any binami proceedings? If so, disclose the details. Is the company filing statements with bankers and all for working capital limits? Whether the statements are matching with books of accounts? If so, report it. If not, report it. These are the responsibilities there on the management itself. Not forget about auditor. We have a responsibility under CARO of the same aspects. That's a different story. But management itself was given this responsibility. Like that, identify is there any regulatory requirement or regulatory information to be given regarding non-compliances in the financial statements. But tell me, type 1 non-compliances will affect the financials, right? So I have to for sure disclose it. The question generally comes for disclosure of non-compliances identified relating to type 2. Suppose some pollution environmental law company has violated. Should it be disclosed in the financial statements? If at all it is bringing a litigation against the company, if a litigation is there on the company, if the environmental has filed a litigation against the company, that litigation must be disclosed anyhow, because contingencies and commitments, that litigation. What about a non-compliance identified, but lawmaker also have not recognized it, regulatory has not recognized it, but we know that there is a non-compliance. Tomorrow they may initiate some investigation, all that. Right now should be disclosed. If there is a requirement in the framework, that has to be disclosed. If there is no requirement in the framework, need not be disclosed. Are you clear? But what is fair presentation? What is a fair presentation? If at all it is relevant for users, they must know about this non-compliance, because company for sure going to face consequences, if not in the next 1 year, but next 2 years. For sure they'll face consequence. And if you feel, dear management, please show that there is a non-compliance like this. If auditor insists on the management to show non-compliance for achieving fair presentation, then management will show, should show. If they are not showing it, then we can modify our opinion on the financial statements, saying financial statements are not disclosing the material non-compliances that they made with the various laws, which will have a material effect on the financial statements at a future date. Clear now? Clear? That's it. Understood? I think now I gave a solid conclusion with NOCLAR versus 250. That confusion is avoided, I hope. So NOCLAR is only dealing with reporting of non-compliance to regulatory authorities. What auditor has to do, when auditor has to report. SA 250 talks about whether a non-compliance, does it has an impact on the audit report? It will have an impact on audit report if it has an impact on financials, generally. Correct? There will be some laws and regulations which may not impact the financials immediately, but in long run they may impact. Then that may also be auditor has to report. That also maybe auditor has to report, because financial statements have to present a fair picture and position and performance of the company. That's it. So that's about the clarification on 250. And 250, one more point is that auditor has to do risk assessment of laws and regulations. When you're doing risk assessment of identification of laws and regulations, you will generally find some indicators. What are the indicators? Investigations are going on. Payment of fines and penalties. Payment of fines and penalties. Unusual payment towards legal and professional fees. Retainership fee, lawyer fees and all, too much is paid. That indicates some non-compliance is there. Payments of unspecified services or loans. Payments in cash or payments in the form of checks, bearer checks, nothing but unauthorized transactions. Purchasing at prices at or above market prices. This may be have a non-compliance impact on income tax law. This may be relevant to non-compliance in income tax. And payments for unspecified services. Payment for unspecified, like suppose in companies, they will have this point, payment for others. Others means what? You should give clear breakup. Payment to others, some miscellaneous expenses. What is this unauthorized miscellaneous expenses and all? Some penalty was levied against Walmart in the US because they were acquiring license in India. There is an entity called Best Price, which is associated with Flipkart in India. So there is a store chain called Best Price. Okay, very less branches only they have in India. Now Walmart was levied a fine by US Anti-Corruption Bureau. A huge penalty was levied on them because they have recorded so many unspecified expenses. Upon investigated, it was bribes paid to Indian officials for acquiring licenses for Best Price store establishment. Why Walmart paid in US? Consolidated financials they prepared in the US. In the consolidated financials, when the quality review was conducted, this was detected and they levied a fine. And whether Indian authority will levy a fine on that is again handled by Indian laws. That external lawmaker, whoever is the regulatory, they will forward the case details to Indian law government and they will take the subsequent action. What action they'll take? They only took. Yes or no? That's it. So that's 250. Clear? So 260, communication with those charged with governance. Communication with those charged with governance. So communication with those charged with governance. What you have to communicate with those charged with governance? There are 6 elements. There are 6 elements which compulsorily the auditor has to communicate with those charged with governance. What are they? You need to communicate auditor responsibilities in relation to financial statements. How do we communicate? What are all our responsibilities in financial statements audit? We communicate it at the beginning of the audit by engagement letter itself. We should communicate them. Planned scope and timing of the audit. Planned scope and timing of the audit we must communicate. Because if we do not communicate what is the planned timing and scope of the audit, management cannot make arrangements. Why scope of audit we should communicate? Like companies having so many branches, so many like warehouses, all that. You should communicate them. What are all warehouses you are planning to visit? Briefly at least. If not, you don't want to give a brief detailed communication. Give a brief communication that you are wanting to do like this. From these dates to these dates, quarterly for 10 days we will come and do audit. Half year we will be staying some 15 days extra. You communicate timing of the audit so that they will tell you what are their reporting timelines, what are their reporting timeline to holding companies, all that. So you will have a proper timing so that you will work, you will discharge your works as per the right times. Then you should communicate significant findings in the audit. See, All these matters you have to communicate to whom? Those charged with governance, top management. You will be communicating so many issues, interacting with so many issues with day-to-day management, production people, sales personnel, marketing personnel, accounts department. Anyhow, you're interacting with them every day. What are the cases where you must communicate certain instances to those charged with governance? Best example, audit committee. Suppose in a listed company, audit committee constitutes a TCWG, not board of directors. Audit committee will be the supervisory body for entire financial statements, affairs, everything. So what are the points that you have to communicate to them? Whatever you feel that merit their attention. Whatever points that you feel that is important for top management, those charged with the governance for effective financial reporting process. For effective financial reporting process, all those matters you must communicate to those charged with governance. So one more thing that you have to communicate is significant findings in the audit. Have you found anything that is significant that requires top management look on it? Communicate. And communicate independence in case of listed entities. Most important thing this is. Communicating independence in case of listed entities. Auditor has to communicate independence, compliance to the listed entity, those charged with governance. In fact, section 177, role of audit committee, it has a requirement that in case of the audit committee, one of their responsibilities to monitor independence compliance by statutory auditors. One of the fundamental responsibility of audit committee is what? They need to obtain a confirmation about compliance by independent auditors. Since they have a regulatory requirement, that's a requirement under SEBI. Now auditors should communicate them that they complied with the independence. You should communicate some matters related to independence. And finally, you should establish terms of engagement taking into account all this. You must establish terms of engagement taking into account all this. Terms of engagement means again nothing but engagement letter. And finally, you should also communicate reporting requirements as per 700. What are the circumstances in which auditor has to include additional information in the auditor's report? Means under what circumstances auditor is giving modified report. Under what circumstances auditor is giving modified report? I told you modified report means not modified opinion. If at all the auditor is including emphasis, if the auditor is modifying the opinion, that you must communicate top management before giving it. The auditor want to include material uncertainty related to going concern, you must communicate. The audit matters, 706 matters, 720 matter. In all these cases, wherever you are modifying the audit report, you must communicate that incident to those charged with governance. Clear? And finally, any other matter which auditor feels useful, that it requires top management attention, those matters you can communicate. Technically only these 6 points. What are they? Responsibilities of auditor, planned scope and timing of the audit, significant findings in the audit, independence in case of listed entities, establishing terms of engagement, and circumstances which necessitates the auditor to include additional information in the auditor's report. Correct. Now let's look at what auditor has to communicate in case of listed entities. This is very important question. Auditor has to communicate a statement that engagement team and others have complied with ethical requirements. The auditor has to give a communication that our team and members all are complied. Auditor shall also communicate relationships and other matters that may reasonably bear on independence, that you should communicate. What relationships this auditor is already having with the management? What relationships this auditor is already having with management? That means with that entity. Suppose before I became an auditor, I am already providing some other services. I am providing some assurance services. I am providing some non-assurance services, related services I am providing. What are all relationships that you are having with this company? You, your partner, your network firms, your relatives, entire that relationships you should communicate. Total fee that you are charging for these non-audit services, audit services, total fees charged by you and your network firms should be communicated. Why? Even in Code of Ethics Council guidelines, we have a requirement that the fees charged by the audit firm shall not exceed. So the other services fees shall not exceed audit fee. Network firms, if at all they are providing other services to these entities, the fees charged by them for other services shall not exceed 3 times of the fees charged by us with the entity. Remember this ethical requirement, council guidelines. When I come there, I'll repeat that. So there are so many ethical requirements we have while providing non-audit services to the same entity. So what are all the non-audit services you are providing to that entity? How much fees you are getting for that? How much fees you are getting for audit from the same entity? That information you communicate to top management so that top management can understand whether you are independently acting or not. The fees should be allocated to categories, audit how much, non-audit how much, so the top management will understand what is its effect on independence and what safeguards auditor has applied. I know definitely in every case some threat will be there for independence. How auditor implemented safeguard? So that also has to be reported. That also has to be intimated. So intimation means what? Auditor has to give a statement, a declaration that he and his team members have complied with relevant ethical requirements. Should give a statement of relationships and services which the auditor and network firm is providing to the entity. In that statement, you should include how much fees you are charging. Give a statement in such a way that the fees must be allocated to separate categories so the top management can interpret your independence. Yes or no? And what safeguards you applied, what threats you have, all that you have to communicate to those charged with governance. This communication is mandatory for listed entities. Are you clear? Next, this is important question. One more thing that you have to communicate is what? Significant findings from the audit. Significant findings. What do you mean by significant findings? You, as an auditor, you have evaluated entire accounting system, entire accounting practice followed by the entity. You have evaluated. How do you feel the qualitative aspect of the entity's accounting practices? Is the entity accounting practices are biased towards something, or are they unbiased? Are they lacking neutrality? So that situation you have to report. 2, auditors shall report significant difficulty if any faced. As a management, they are supposed to prepare list of laws and regulations list. They are supposed to prepare a list of what are all laws and regulations applicable, what are all they have complied, what are all non-compliances were there. They are supposed to prepare a list like that. But they didn't prepare, because of which I am facing significant difficulty in the audit to prepare that list. This I will communicate to top management. See, this is your duty primarily to prepare so that my verification becomes easier, but your management did not do that, because of which I am facing significant difficulty. If at all it is so difficult that I cannot do the work, I am here to verify, not to design this works and all, doing these works and all. I will give modified opinion. Significant difficulties means what? Unexpected effort is required. Unexpected effort. I didn't expect this effort. You must have done this workings entirely and I would have verified it easily. Unreasonably brief time means companies pressuring you to complete the audit as fast as possible. Delay in providing information. Restrictions imposed. Information is not available. Going concern. Management is not making assessment of going concern. Difficulties in some circumstances, these difficulties, no, they will constitute limitation on the scope that results in modification of opinion. All these difficulties you must communicate. What are significant difficulties? They will ask you a 3 marks or 4 marks question. 3 marks or 4 marks question they'll ask you. So one of the important matter the auditor has to communicate is significant findings, which include significant difficulties. Give you examples of significant difficulties. 5 marks question they'll ask you. Not only that, any significant matters arising in the audit. Have you found any significant matter in the audit that requires top management attention? For example, significant transactions and events, business conditions affecting the entity that affect risk of MMS, concerns about management, consultations with others and others on accounting auditing matters, like how far management is consulting with experts and all for accounting and auditing issues, discussions and correspondence with auditors regarding their appointment and reappointment, like are they discussing with the previous auditor even after discontinuance? What are they discussing? If something is so sensitive that I have to communicate to top management. Significant matters on which there was a disagreement with management. Here they said except for the differences which were resolved later. If all differences resolved later with the management, that's a different thing. If the difference is not resolved, some differences we have between me and management. Management said the accounting entry is correct. I am saying that accounting entry is wrong. That is not how it should be accounted transaction. They are not agreeing. I'll communicate to top management to resolve it. Significant matters means what? They'll ask you this question. What are significant matters to be communicated? 4 marks question. Some students write significant difficulties answer for this question which is asked. So be careful. Significant matters means it's not about difficulty you are reporting. You found something sensitive. You found significant transaction. You found significant event. You found some business condition that is affecting the entity. You found some correspondence with other auditors and all. That is something relevant for the top management attention. You found some matters where you disagreed with the management. So you want to get a clarification on the same from top management. These are all you must communicate with those charged with the governance. If you look at further, what you should communicate to top management, where and all you require written representation. What are the circumstances that affect the form and content of audit report? That is what we have given. We have discussed in detail here. Circumstances when audit report will affect, when auditor has to modify the opinion, when auditor has to include emphasis of para, when auditor has to include key audit matter, when auditor has to include material uncertainty, when auditor has to include other information. In all these circumstances, the auditor is modifying the report. These circumstances must be communicated to management. Indirectly, they are saying, please give a draft audit report before finalizing. You're getting it. Please give a draft audit report before finalizing. That is what even 701, 705, 706, 710, 720, everywhere it says. Yes or no? Next, you have to establish terms of engagement. These are all the matters that auditor has to communicate. What significant findings means what? Qualitative auditor's view about qualitative aspects of entities accounting practices that contains bias, that contains lack of neutrality shall be communicated. 2. Significant difficulty shall be communicated. 3. Significant matters shall be communicated. 4. Where and all you want written representations, communicate. Circumstances that results in modification of opinion, communicate. Any other significant matter which is not listed above but which auditor feels top management attention is required for effective discharge of the financial reporting process, that you communicate. Over. The standard 260 mainly deals with this. Clear? Next. What should be the communication process? What should be the communication process? Auditor shall discuss with management the mode of communication. Should we communicate through mail? Should we communicate through WhatsApp? What? If it is mail, to which mail ID I should communicate? All that. Process of communication, the form of communication, timing of communication, any expected content of the communication. Getting it? Like I should ask management, dear top management, should I give report every 3 days or every day? How do you want? So I should discuss with them. How should I communicate? Should I communicate through the company official mail ID or should I communicate through WhatsApp with you directly? How should I communicate? What is most appropriate method? That and all. So auditor has to decide. Further, auditor has to ensure that the communication process, the interaction between the auditor and those charged with the governance is adequate. He must not do audit in such a way in an isolated manner where top management tomorrow investigation comes where sir auditor will never interact with us. He will do audit on his own. He will verify something. He will ask once in a while something. He don't communicate anything to us. He should not complain on the auditor. So it is your responsibility to ensure that you and top management have communicated adequately. Otherwise tomorrow when investigation comes, they simply blame it on you. Getting it? He never interacted with us. They will blame it on you. That's why you have to document entire communication. So, especially what? If at all any communication is orally made, the auditor shall include when that communication is made, to whom the communication is made, what response they gave orally, document it, get a signature. Are you getting it? Get a signature of that particular management or top management person. That's how communication. That is what communication with those charged with governance. The first question is there, which explains about who is those charged with governance. It depends upon the governance structure. It depends upon the ownership structure. It depends upon the organization structure. Getting it? So generally, in some entities, there will be a supervisory board. There will be a board of directors. Getting it? Above board of directors, something called committees and all will be there. In that case, committees will be those charged with governance. In some entities, no, there won't be separate those charged with governance and management. Private entities, he himself do the business, he himself take the decision. He himself participate in financial reporting process. So in some entities, they both are one and same. If you want to know who is those charged with governance in a particular entity, directly talk to the appointing authority. They will tell you who is those charged with governance. Get a declaration that these are the people constitute those charged with governance from them. Enough. That is first question. You're clear? Over. 260 standard is over. Understood what is there in this? Yes. It is a small standard only. Let's begin 402. Actually, in the ICA book, I think second or third chapter dealing with 4 standards exclusively. SA 240, 250, 260, 402. These 4 put together one chapter. 250, 260, 402 I'm reading now. I'm explaining now. 3402 also I'll explain now. So one of the main topic will be completed. If I complete this 402 and 240, that also if I complete, the main topic will be over. So 402, auditors consideration relating to services provided by service organization. This is one standard which many don't understand, because they don't understand the context of discussion. 3402 talks about assurance report on controls at service organization. Assurance report on controls at service organization. Like, what is this 402, 3402 exactly deals with? Suppose there are many companies which outsource their payroll function. Best example is where they outsource their payroll function. Yeah, they outsource the payroll function. Or another example, you can take this Flipkart, Amazon warehouses, central warehouses, where a company which is dealing with some consumer electronics, FMCG products, these companies know what they maintain is they register as a seller on the aggregator platform like Amazon and Flipkart. They register as a seller. But Amazon, for the purpose of improving effectiveness and efficiency of faster delivery, all that, they have constructed big warehouses, central hubs at various cities, where nearby sellers who are registered on Amazon, they can keep their inventory in the warehouse. Amazon will take care of processing, labeling, packing, delivery, everything. Settlement will be done accordingly, the amount which is collected. Now, the inventory is lying with whom? The company's inventory with Amazon warehouse, Amazon. Let us assume, let's simply call it as Amazon. We are the auditor of the company. Let us assume Hindustan Unilever. We are the auditor of the company called Hindustan Unilever, where Hindustan Unilever is storing their inventory with a third party called Amazon, where Amazon is providing many services relating to maintaining the inventory records, that particular inventory, packing it, delivering it, everything. Where this entire process that is followed by Amazon is affecting the accounting records of the Hindustan Unilever. Now, these are the services performed by service organization. These are the services performed by service organization called Amazon. Another example also take. Actually, payroll example, we can even more connect with this standard, because payroll is one of the function which is very popular function that is outsourced by companies. Another function which many companies outsource is accounting function itself. Complete accounting is outsourced. They're not maintaining accounts. They're completely outsourcing accounts to various other entities, especially many foreign entities. They're outsourcing accounting services to Indian entities. Fine. Payroll function we are outsourcing. Payroll function means what? Tell me. Payroll is generally a significant cost for any company. Yes or no? The employee cost is one of the significant cost for any company. What will be there in the payroll activities? If you understand this example, the standard becomes easy. What will be there in the payroll activities? First of all, payroll means, first of all, HR and payroll both put together will look into. First, a company will have an employee master, where all the list of employees recruited, that list who are active employees will be there. And any employees who are resigning or retiring very soon, that list also will be there in the employee master. And company will maintain an attendance record to recognize loss of pay, nothing but absentees, the leaves, and deductions for that, all that. Now, the company is maintaining only these two records. Attendance record is maintained, the entire employee master is maintained. Now, this particular data, periodically on a monthly basis, they need to transfer this data to a company called ADP Incorporation. Best example, ADP. This is a very popular payroll company across the world. More than 70% of the payroll processes in the world are handled by this company for various companies. So this company has transferred this particular the payroll functions, this data, attendance data, employee sheet data, employee master data, just to this particular ADP Incorporation, which is a payroll processing company. What this ADP incorporation has to do is, they will have a set of legal experts, they will have a set of employees who are working on what should be the taxable amount within the salary composition. They will see what is the taxable amount in that, and how much is the TDS to be deducted, how much is the provident fund to be deducted, how much is the ESI to be deducted. Entire that employees related tax planning work will be done by this particular payroll processing company. And not only that, they will finalize the amount that to be paid as a salary to these 1 lakh employees. This company is, let us assume, having 1 lakh employees. To all these 1 lakh employees, how much salary to be paid? Each of them, that final amount they will compute. Further, how much amount has to be paid to, how much amount has to be remitted to PF authority, how much to be remitted to ESI authority, how much to be remitted to income tax department. All that challans also they will prepare. Finally, one consolidated check they will send. This HUL has to authorize the check so that funds will be debited in HUF. It will be transferred to various beneficiaries, tax beneficiaries, provident fund authorities, employees, all that. Now tell me, if at all this payroll processing company does not implement proper controls, the computations will affect, the payments to tax authorities and all will affect, which results in non-compliance with laws and regulations. Agreed or not? Now tell me, as an auditor, should I look into this payroll function, whatever payroll processing company is doing, the workings and all? Generally, if the company itself is maintaining payroll, I will simply look into the entire payroll activity, whether they are deducting properly, whether payroll controls are proper, whether provident fund is collected properly, what controls they established, I can look into very well. But the company is not processing this. Payroll company is processing this. How can I look into? I ask the payroll company, I want to come there and I want to visit there and look into whether the controls you established for processing our employees payroll master, is it proper or not? I want to come and verify. Then ADP company replied, sir, you are not the only client we are processing. We have thousands of clients for whom we are doing payroll activity. And like you, if remaining 999 company auditors are also asking us, we should sit and explain auditors' queries only. How can I do this? You cannot come and do this. This is what the payroll company replied. Then I replied, then how can I get an assurance that you are processing the payroll and all correctly as per the law and regulation? How can I ensure? Because that's a material cost to this company, substantial cost to this company. If at all your worry is about this processing, don't worry. We will appoint a separate auditor. The payroll company replied, we will appoint a separate auditor who will verify the controls that we implemented in this payroll process. In the payroll processes, what are all controls we implemented? How are they implemented? Are they working effectively or not? All that we will appoint an auditor. He will give an audit report, and that report we will forward it to you. Are you okay with it? We asked that company auditor, the client auditor. The client auditor said, okay, no problem, I will use it. This is called type 1 and type 2 reports. These are called as what? Type 1 and type 2 report. Now, the company for whom Hindustan Unilever, we are auditor, right? The Hindustan Unilever in this example is called as user entity. We are auditors of Hindustan Unilever, right? We are called as user auditor. There is a payroll organization, ADP incorporation, right? That is service organization. The payroll function that they are providing, right? That is a service provided by the service organization. Now, we are asking a report of auditor of this particular process, right? He is called a service auditor. Are you getting it? Now, under 402, my responsibility is to give opinion on the financial statements. My responsibility will not change. My objective is to give opinion on financials, whether they're true and fair. Inside that, I should ensure whether payroll cost is true and fair. To ensure whether payroll cost is true and fair, I need to see whether payroll activities are proper or not. Whether to see payroll activities are proper or not, it is not done by the company. It is outsourced to somebody. So their auditor said whether payroll is proper or not. Their auditors have given a report. What report he gave? Some report, SOC report we call it as. What is the report actually called as? SOC report, service organizations, systems and organizations control. What is it? Systems and organizations control report, SOC report we call. This SOC report is two types. Now, 1 minute. See, how we will get this data, First, tell me, as an auditor of my Hindustan Unilever, I want to know what controls they designed and implemented, correct? I want to know what controls they designed and implemented. Why I want to know what controls they implemented, designed, all that? To know whether objectives of the payroll are achieved or not. To know Whether objectives of payroll process. What is the objective of payroll process? Timely remittance of law, timely remittances of taxes to authorities, timely remittance of PF and ESI to respective authorities, timely remittances of salaries to employees. These are all objectives. These are all objectives. If at all timely remittance does not happen, interest, penalty and all will apply. These are the control objectives. What is it called as? Control objectives. So these are the control objectives. Now for these objectives, what controls are implemented? I want to know that information. Now these are the objectives. They implemented so and so controls, they set. Whether these both are suitable or not, we need to check whether a process implemented is suitable to achieve this objective or not. Whether a process implemented is suitable to achieve this objective or not, we want to check yes or no. That also we have to check. Sometimes we also want to check whether these controls are operating effectively or not. Sometimes we also want to check whether these controls are operating effectively or not. That also we want to check. Which means I want to know as an auditor, user auditor of user entity, I told my Hindustan Unilever, I want to know what controls they implemented, what system they implemented, what objectives they listed out, whether the system they implemented is meeting the objective and whether they are operating effectively. Sometimes I may not be concerned about operating effectiveness of control because my risk assessment will not contain that requirement. For example, I am doing an audit of a private limited company whose turnover is less than 50 crore, whose borrowings are less than 25 crore, which means I am exempted from verifying operating effectiveness of internal financial control. I am exempted from verifying operating effectiveness of internal financial control. In that case, whatever payroll function you outsourced, right? There, whether the controls whatever they implemented, whether the controls whatever suitably implemented, are they working, operating, are they effectively working, are they operating effectively, I don't require. For me, controls implemented or not, whether the controls are suitable or not, that report alone I want, and that report is called as type 1 report. Suppose I am doing audit of a listed entity. For a listed entity, one of the requirement under 143 subsection 3 is I must ensure whether these internal financial controls are operating effectively or not. Some of the internal financial functions were outsourced. Controls are also made by, controls are also implemented by service organization. In such case, those financial controls, are they operating effectively or not? Also, I want to know, right? There I will ask a type 2 report. There I will ask what? Type 2 report. If at all I have a requirement under law to verify operating effectiveness of internal control, I will also ask type 2. I will ask a type 2 report. Suppose law there is no requirement. I myself want to know operating effectiveness of these controls because significant portion of the transactions are processed. Because significant portion of transactions are processed, I want to know whether they are operating effectively or not. In that case, tell me if they are operating effectively. If I want to know, then also I want which report? Type 2 report. Now, these are the sentences that you must remember in order to understand the this particular standards. Now, like you know how this entire will be achieved. You know, service organization, Amazon is there, right? Amazon management, they will prepare a chart. They will prepare a document which contains description of its system, which contains description of its system, what system they designed, what system they implemented, related description. So the document name is called as, you know, what is the document name is? Description of system. That's the document name. Service organization's description of system. That's the document name. Service organization is Amazon. Amazon's description of system. What the document contains? The document contains controls implemented, control objectives, suitability of these controls. They will give you a list what controls were implemented, what are the objectives for this control, and how far that objective is met with this. Suppose one of the control objective is employee, whatever absentees days are there, the amount has to be deducted from salary because it's a loss of pay. Yes or no? And only that amount has to be paid. That's the one of the important payroll function. For that, what control the payroll organization is asking, what control it is doing? The payroll organization is asking us the date of list of absentees, list of leaves every month. We are giving that. We are giving that. Means control objective is deduction of loss of pay. That's the objective of control. For that, what control they implemented? When they are calculating the payroll cost, they are taking into account leaves and all, which means the control which they implemented, the process which they are following, is it achieving control objective or not? That is called suitability of the control. What is it called as? Suitability of the control. So, service organization description of system. This is the document. Inside that, what controls they followed. Control is nothing but process. Some process. Getting it? What are all the processes they're following? What controls they're following? What is the objective of this? Look at that. Whether the objective is meeting this, suitable or not, you need to verify. Getting it? So, service organization system of description contains controls implemented, control objectives, whether these controls are suitable to achieve these objectives. Management of service organization will give all these assertions. Management of service organization will give all these assertions in which document? Service organization's description of system. In the document, they described all this. The document is sent to you. The document is sent to you. Dear Hindustan Unilever auditor, don't worry. These are the controls we designed. These are the controls we implemented. This is suitable. Who gave this document? Management gave. Then I asked you, since you are the management person of organization, you will say all this. But I want assurance report that whether whatever you said this in this is correct or not. I want an assurance report on description of system by service organization, description of related controls, description of control objectives, description about suitability. You describe everything, I understand, but I want an assurance report that whatever you described, no, it is really existing or not. It is existing in reality or not. I want an assurance report. For that, what Amazon is doing, they appointed service auditor. What they did? They appointed a service auditor. What service auditor is doing? He verified that entire system document. He saw the document because the document is going to be used by me. So the document is going, that's like a financial statement, which is going to be used by various others. Whatever the document contains, description, is it really implemented or not, the service auditor will verify. Whatever control objective stated, whatever controls, related controls implemented, are they suitable or not, service organization will check and he will give a report on that, and that report is called as what? Type 1 report. Now they gave me type 1 report also. First, what they gave me? Description of system, the document. Second, what they gave me? On that document, is the report, are they genuine or not, auditor is giving report. Now service auditor will use that report. Now on that context, what are all you have to do here? That is what 402 says. Understood? Now suppose I also want to know whether these controls that are described in the document, whether the control objective is stated in the document, whether related controls implemented as per the document, are they operating effectively or not, also I want to know. In such a case, the service auditor has to give a report as per the type 2 format. Service auditor has to give a report as per type 2 format. What is type 1 report? What is type 2 report is what explained under 3402. Now, for whom which standard is applicable? I am auditor of Hindustan Unilever, which is outsourcing some activities to Amazon, or which is outsourcing some activities to ADP Incorporation, where they have given service auditor report. How to use that service audit report so that your overall objective of expressing opinion on financial statements will be smooth. That's 402 says. What 3402 says? Amazon appointed me. Amazon approached me. ADP Incorporation approached me. They are asking me, sir, we have so many third parties related businesses, process and all. We are being outsourced for. So we are only processing everything. Their auditors and all asking, how are we implementing these systems, functions, operating all that? You please come and do audit of all this. Give a report. That report we will forward it to those user auditors. Now here I am asking you to perform which engagement? Assurance on other than historical financial information. Assurance on controls at service organization. You are appointed as an assurance auditor. For you, which standard is applicable? 3402 is applicable. Are you getting the point? So an auditor who performed an assurance engagement under 3402 and gave an assurance report as per 3402, which may be type 1 or type 2 report, and that report the auditor of user entity is using. How to use that report? What are points you should consider? That is 402. Linked. Understood? This is not over. This standard is almost 4-5 hours discussion. I'll try to cover within another 20 minutes. Fine. So understood all this? All of you? So what is a type 1 report? Before that, no, I will just to show you assurance report. Without watching this, you cannot understand. Without watching this, you cannot understand. This is type 2 report. This is type 2 report. Just a week ago, I guess we covered this standard in our class. So type 2 report, you see. Here, the report format is based upon old format. I told, right? Until before 1718, until up to 1718, opinion will be there somewhere in the middle. Now opinion is there on the top. 800 series also amended, where opinion comes at the first top place. And I told you for November 24, it is not applicable. For May 24, wait for ICA clarification. Don't worry. Time is there. Just 2 minutes. Honestly tell me, how many of you have not seen this standard? Be honest. Not studied this standard. Okay. How many of you have not studied because you didn't understand this standard? Every time pakka question on this. 5 marks. Yes, let's continue. Like the main, we continuously complain saying in auditing 40 is enough. I think 70% of the crowd sitting here have this perception. 40 if I get in audit, that's enough. Why? Because they blame that auditing is not a scoring subject. Why it is not a scoring subject? Because they blame that we don't understand the subject. Whatever, no matter you read, you will not understand the subject. And when they see the time spent on audit paper is less than 50% of the time they spend on FR. If you can calculate. FR coaching number of coaching hours are 300. I don't think regular FR batch is less than 270, 250 of any faculty that is there in the market. Minimum 250 to 270. Minimum 250, let us assume. Even if you take fast track, it has 180. Crash course or fast track, it has 180, 200 hours. So mostly, let us assume you have spent approximately 250 to 260 hours minimum. On a minimum level, I'm telling you, coaching. You will read the FR subject for another 200 hours. You will read another 200 hours, revise everything, 200 to 250 hours. 500 hours you spent on FR. Keep that aside. Coming to audit. My regular class, right now which I'm taking face to face, where I spend extensive amount on each and every standard. There, by the time I complete the standard, I revise 4 times the standard in the class. Where I summarize the standard, and where after completing 4 or 5 standards, maybe I do again a revision of all these 4 or 5 standards briefly. And I also solve previous year questions, MTP questions, RTP questions, which are tough generally. Those questions which are not covered in ICA book but are covered in MTP, RTP, that I will solve in the class. And practical questions from ICA like illustrations, textual knowledge, all that questions I will solve. This entire process is less than 140 hours. Such an in-depth discussion I do. For example, for your reference, SA 260, right now I spend 17 minutes. I discussed the same 2.5 hours to 3 hours in class. More than 2 hours I discussed that in the class. What I discussed in that, it is not about in-depth. I discussed neatly and I revise it frequently in the class itself, so that you understand like how that point is different from this point is different from that, how like in different ways I analyze in the class and somehow make the student confident of the standard. Getting it? So such a complex process itself is 140 hours. Complete regular coaching of audit CA final is 140 hours. Students will spend 100 hours on audit. Again, subsequently they will revise. By spending, you can calculate how many number of hours you spent it. Don't say 3 months onwards I'm studying audit. Daily half an hour you're studying. Okay, daily 1 hour you're studying. In that time, half an hour you're looking at others, light, house, wall, all that. No. I am talking about number of effective hours you spend on audit is 100 to 120 later on after coaching. Assuming you have attended such a kind of comprehensive regular class which is 140 hours. Assuming. Plus, I know none of you would have attended that much. I'm very sure. Assuming UCFR, I am taking so lowest hours, whereas in audit, I'm allocating highest hours to you. For comparison, assuming you have taken highest number of hours of coaching in audit, FR lowest number of hours of coaching, lowest number of hours preparation, 450 hours FR, and highest number of hours, highest preparation amount, 260 hours audit. And you say audit is not a scoring paper, FR is scoring paper. You spend double the time. In audit, your expectation is 40, means in FR, your expectation should be 80. You're spending, then why are you spending 450, 500 hours in? What's the point of spending 450, 500 hours in? When you are spending 240, 250 hours, you are getting 40 means, FR you are spending 500 hours means you should get 80, right? But how many of you are getting 80? Last attempt, some repeaters will be there, na? Yes or no? I can say out of 100, 10 only will get 80. Remaining 90 will get 52, 55, 54, 58, 70, not even 70, sorry, 60, 62, like that. And audit, they will get 38, 35, proportionate only. Proportionate to the time you spent. This is called skeptical analysis. This is called realistic and logical analysis. Okay, when I ask a student why he don't spend the time on audit, no matter how much you study, you will not remember. First, you didn't study. You didn't put that effort. You didn't try to understand. You never analyzed anything. Without understanding that there is a possibility of understanding, you judge the subject, don't study the subject, neglect the subject, and say auditing is not a scoring paper. Spreading this to everybody. Correctly? So, how much time you are spending? Then again, this guy says, FR is scoring, that's why I'm spending more. Where? Show me 80 marks in FR. Show me 80 in FR then. That will not be there. 50, 52 only you'll get. So, this is just your mental thought process where you live in assumptions. Best example I'll tell you, which is costly, platinum or gold? You have to tell me. Half the sound is platinum, half the sound is gold. People never update their understanding. Gold price have exceeded platinum 10 years ago. 10 years ago. Right now, what is the platinum per gram cost? 3,500 or maybe 3,600. Gold per gram, 7,500. This is one live example where we live in assumptions. We all live in assumptions. We never update our understanding. We never update our knowledge. We never update our thought process. We live in the very old mindset. Because you judge, this is best example. How many of you spend really 400 hours plus in audit? Don't say, sir, I have spent from past 6 attempts, every attempt 150. No. That will not count. In one attempt, how many? In that way, in such a case, I will also calculate accumulated hours for FR and SFM from various attempts. So, in one attempt, if you deviate yourself by 50 hours for audit, means if you spend extra 50 hours for audit as a whole, your success rate can be enhanced like anything, which many are not ready because they don't understand this. They never understand this holistically. Yes, in order to master in audit subject, you require another 50-60 hours of additional time so that I can slowly understand and analyze, link the context, how that is different from this, how this is different from that. In both the sides analyzing, that takes little time. That analysis, many don't do that. Without doing it, they complain that it is not possible to understand. So that's it. If you ask me between FR and audit, audit is most scoring paper provided you spend the same time on audit. I bet you will not score less than 70 because the risk in audit is less. Risk in FR is high. Obviously, in FR and all, I will design. Right now, before I'll design, one day I'll design. Google Gemini, one question on FR, I'll design. You'll lose you'll lose mind. What is this question? I've never seen in the class. India which recognition principle is applicable for this? You'll struggle like anything in FR. But in audit, you'll not have that struggle. Everything is predefined concept, only that will be tested in exam. Provided you have to master that content. So same hours that you put for FR, you put in audit. Mark my word, 75-80 marks you will get in that attempt. That is the true reality. I hope you understood now. Don't never complain that auditing is tough subject or boring subject like that. Until now, I hope I didn't make you bored. No, right? And the same will continue till the end of the session. Every topic I speak very realistically, very lively. It's all about the exposure the speaker has, simply speaking. If I have exposure like this, I can make it interesting for you. If I don't have exposure, I will also make it bore for you, as simple as such. For that reason only, I also always update my knowledge by discussing with all my friends in Big Fours and all. Luckily, I have so many friends in every Big Four entity. All top 7, all top Big 6, I have friends which are in senior roles. So they tell me only the peculiar issues which they are facing in audit, where I have that analysis. So that is helping me to, make you understand the subject in a better way. Within this marathon, I hope you understood what kind of we are content delivering. So that itself is, this itself is a proof that auditing is not a boring subject. Just that you have to know how to read it. So look at this type 2 report. So I hope you all get 80 plus in FR so that you'll get 40 in audit. Okay. I will see how many 80s I'll get. I'll see how many 80s will be there, in this entire batch for FR. Because all of you spend more than 400 hours for sure on FR. More than 400 hours for sure you would have spent on FR. Next. This is a type 2 report. This is a type 2 report example. What is a type 2 report? In a type 2 report, we give opinion on 3 aspects. We give opinion on 3 aspects. What are they? Look at this. Opinion section, you look at this. Our opinion has been formed on the basis matter outlined in the report. The criteria we used in forming our opinion are described in so and so page. See here again, there is another document called criteria document. There is another document called criteria document. Like the service auditor has to verify whether internal controls and objectives are suitably designed or not, right? How do you know whether they are suitable or not? Okay, control objectives and all will be there. For all these controls, there are some frameworks available. For example, in risk assessment chapter, you would have seen something called COSO framework, COBIT framework like that. Yes or no? There are some frameworks which are there which talks about various processes to be implemented. For achieving so and so thing, what process to be implemented? For example, ISO standards were there. More than 20,000 standards were there. In ISO, more than 20,000 standards were there dealing with variety of issues. 20,000, not 20. 20,000. We have only 46 auditing standards. That's it. Where is 20,000 standards? Where is 46? So ISO standards, there are 20,000 plus standards were there which are talking about various things. Like suppose you want to establish a hotel, what points you should establish, what control points you should put. There is an ISO standard. You want to construct a movie theater, what points you have to keep in mind, what points, checkpoints and all you should keep. There is an ISO standard. The same way, a payroll company is processing payroll for various clients. What points should be designed, what objective should be achieved, what should be the controls that they should design and implement. Like that, some standard will be there. Based on that standard only, companies will design processes. Companies will design processes based on those standards. That standard is the criteria against which auditor will evaluate. Against which auditor? For example, we are doing audit of financial statements, right? Against what criteria we are evaluating? We are evaluating financial statements against applicable financial reporting framework. Applicable financial reporting framework means what? Depending upon the nature of entity, it may be Banking Regulation Act, Companies Act, or it may be Insurance Act, it may be Ind AS, Accounting Standard, whatever. So same way, service auditor should verify whether description of system of controls, control objectives by the management, implemented by the management, are they as per the suitable criteria? Are they as per the criteria, well established criteria? Auditor also, the service auditor will check whether these controls are against that criteria or not. Simple. The company will design as per the criteria. Auditor has to check whether that criteria is followed. So for us, when we are doing controls audit, we verify whether controls are listed out properly, whether the control objectives are listed out properly. We of course apply our judgment. In addition to that, we also see what criteria management followed, whether that criteria is achieved or not. So that is what the meaning. The opinion formed on the basis of criteria, we will verify. In our opinion, in all material respects, the description fairly present the system as designed and implemented, which means whatever management gave a description document, description of systems, whether the description fairly present the system as implemented throughout the period, whether controls related to the objectives stated in the description. The same description contains list of controls, control objectives, whether these are suitably designed and implemented throughout the period, and the controls tested. This third point will be there in type 2 report only. In type 1 report, third point will not be there. Further, in type 2 report only, the period will be there. In the type 1 report only, date will be there. As on a particular date will be there. Remember, in type 1 report, it is only on a particular date. Whereas in a type 2 report, it is for a particular period. Understood? So, the auditor, which by the way, I am reading which audit report? Service auditor's report. Service auditor is giving opinion on description of system that is given by the management, where the system is designed and given as a description based on some criteria. Yes or no? Whether the description fairly present the actual system designed and implemented, whether controls related to the objectives are suitably designed or not, whether the controls tested, are they operating effectively throughout the period or not. So throughout the period, operating throughout the period, suitably designed throughout the period, system designed and implemented throughout the period. Three aspects: whether system designed and implemented throughout the period, control objectives and related controls are suitably implemented throughout the period, are they operating effectively throughout the period. This is what type 2 audit report will contains. Not only that, in type 2 audit report, the auditor shall give description of controls tested, result of the pages, description, specific controls tested, and results of those tests. Even in a type 2 report, the auditor, service auditor, has to give an annexure. What annexure? What controls he tested, what result he got. That report also he must attach to the service auditor report. And this entire bunch, what is there here? Service auditor report is there, list of controls he tested, what is the result, it is there, management description of system of their description of system they designed and implemented, suitability of the controls and control objectives, whether they are operating effectively or not, management gave a report. That report, entire bunch, we user auditors will get. Understood? Now tell me here, and you see here, service auditor should give another disclosure. In the service auditor report, he must also give disclosure clearly. This service audit report is purely useful only for user auditors of the user entity. For their purpose only, service auditor is doing audit. 3402 standard is applicable for the service auditor only when his report is ultimately being used by user auditors as per 402. Only then. Suppose a company called me. They just called me to do controls audit. Sir, you just come, do various controls audit which we implemented. You give a report on that. I asked, for whom the report? No, sir, the report is for internal purpose, not for any outsider. 3402 standard will not apply to me. 3402 standard is applicable to me when the company called me as a service auditor, where my report is given to various user auditors. That's an assurance engagement. 3402 applicable. Suppose company called me to verify controls, just to give a report of test of controls and result thereof to the company. Company itself uses. Third party is not there. That's an agreed upon procedure. What is it? That's an agreed upon procedure. That's a related service. Because related service versus assurance service, what is the only difference? In an assurance service, third party is using a report. In a related service, there is no third party. Simple logic. Clear? Okay. Fine, right? Yes. Yeah. To know, like, I want to know whether you understood or not. So you can clap. Okay. Not this. Not that many. Just 2 or 3 claps enough. Okay. Yeah. Fine. Let's be active. Okay. Once we complete any topic, how, like, everyone are okay means you should reply me with clap. Okay. Yes. தேவையில்லாம ரிப்ளை கொடுக்கூடாது அப்படி. Yeah. Then, so service organization report, the heading you see, independent service auditors assurance report on description of control, their design and operating effectiveness. Whereas in type 1, operating effectiveness will not be there. Are you getting it? Scope, the service auditor explaining what is their scope of work. Service auditor explaining management responsibilities. The XYZ organization is responsible for preparing the description. Yes or not? So and so page means to this audit report some pages are there. There it is attached. What they attached? Description of system. Who prepared it? Management prepared it, including completeness, accuracy, providing the services, stating control objectives, designing, implementing them, effectively operating the controls. For entirely who is responsible? Management of service organization, management of Amazon, management of ADB Incorporation is responsible. Then what is service auditor responsibility? My responsibility is to express opinion. We conduct our audit, we conduct our assurance as per 3402. You know, our objective is to verify whether description present fairly, whether they're suitably designed, whether they're operating effectively. This is my responsibility. Then finally, here we are saying an assurance engagement is a report which is a reasonable assurance engagement. Reasonable assurance engagement is a high level of assurance but not absolute assurance. Even after we verify, some deviations in the controls will be there which we will not identify, like that some discussion, and we believe that evidence obtained by us is sufficient and appropriate. This is actually called as service auditor responsibility. Within this itself, basis for service auditor opinion is also given. Getting it? Then they are talking about limitations. Service auditors will have some limitations, that also they are talking about. Then finally, opinion. Are you clear? Now still now you see, in the example which I told, the company which is like Hindustan Unilever, they have to give employee master data and payroll data, attendance data periodically to service organization, right? Who should ensure that attendance reports, employee master are accurate and complete? Who should ensure? User entity, correct? Hindustan Unilever should ensure. Now, to ensure that this employee master data is accurate, to ensure that the computation of attendance, everything, that attendance and all reports are accurate, who should implement the controls? Management of user entity, Hindustan Unilever. Now, these controls are called as complementary user entity controls. These controls are actually called as what? Complementary user entity controls. Now tell me, entire payroll cost, whether it is rightly processed or not, it not only depends upon controls implemented by service organization, it also depends upon user entity controls that are complementing these controls. You are getting it? That's why you say complementary user entity control definition. Controls that the user entity implements, these are the controls the service organization assumes that the user entity implemented in design of their service. You're getting it? That's a complementary user entity control definition. If you understand this entire backdrop of the standard, you read the standard now, you will understand very easily. Like I will briefly discuss the key questions in the standard. So first, when the user entity where you're doing audit under 402, I'm talking about 402, or else I'll do one thing. 3402 will finish and then come back to 402. Three 543. 3402. The standard says introduction itself. The introduction itself, you see, object to scope of the standard itself. The scope of the standard itself says the standard does not deal with report only on controls at service organization. Where your report is not going to third parties, then the standard will not apply. Then which standard is applicable? Agreed upon procedure standard will apply. Or to report only on controls at service organization other than those related to user entities. Suppose service organization called me. Yeah, I have to report on operating effectiveness or design all that controls. But these are the controls not related to user entity, some other controls. Then also the standard will not apply to me. Are you clear? In other words, when the standard is applicable to me, if I was called for doing assurance on, if I was called for doing audit of controls that are relevant to services provided to user entities by service organization, then those controls are relevant. Yes or no? Now, what is a service organization? Service organization is a third party organization that provides services to user entities that are likely to be relevant to user entity internal control as it relates to financial reporting. For user entity internal control system, whatever service organization services are provided, they're affecting user entity internal controls. They're affecting the user entity business process, which is affecting the user entity financial reporting process. Now, so what do you mean by service auditor? Service auditor objective is what? What is the objective of service auditor? To obtain reasonable assurance whether in all material respects based on suitable criteria, service organization description is implemented throughout the period. Service organization controls are suitably designed throughout the period. Where in the scope of engagement, if it is included, controls operated effectively and were achieved throughout the period. If the engagement also include operating effectiveness point, then that also. Otherwise, only first 2 points. Correct? And finally, once you get the reasonable assurance, you have to report it. How you have to report it? Type 1 or type 2, depending upon the scope of the engagement. What is a type 1 report? Type 1 report, no. Type 1 report will contain opinion. Type 1 report, a service auditor's assurance report. Type 1 report is a service auditor's assurance report that conveys assurance on matters referred in the above. What matters? A written assertion by service organization. A written assertion by service means a written representation by service organization management that the description fairly presents, that is designed and implemented at a specified date. The controls related to control objectives are designed as at a specified date, and on the specified date, whatever controls they are saying that designed and implemented, whatever control objectives and related controls and and suitability of this, whatever they are saying on a specified date, whatever management is asserting this, is it true and fair or not? We have to give a reasonable assurance. Are you clear? 3402 standard is also reasonable assurance. 3400 standard is limited assurance. 3400 limited, there they use the word moderate assurance. They use the word moderate assurance. Then what is the difference between limited assurance and moderate? No difference, just a context alone is different. That's it. And what about type 2 report? In type 2 report, the management will give a description that fairly presents service organization systems as designed and implemented throughout the period. Management will give a description about controls that are stated in the description and are they designed suitably throughout the period, and whether controls are operating effectively throughout the period. So management will give all these points in the description. Now the service auditor has to give an assurance report on the above description. That's a type 2 report. Correct? Next. Now when service auditor is performing the audit, this is not required. This may be asked as a 4 marks question. Objective may be asked as a 4 marks question. Write about type 1 and type 2 report, that can be asked as a 4 marks question. Objectives of the service auditor can be asked as a 4 marks question. Anyway, this can be tested. 3402 standard can be tested in any way. Now, when service auditor when he is performing this engagement, just like us, he should also take some written representations, right? Of course, he will read the service organization controls which they designed and implemented. He will test the operating effectiveness, all that he will do. In addition to that, service auditor will ask for a representation. What points representation letter will contain? Service auditor may request the service organization to provide written representation regarding description of the system, that they has provided all the information to the auditor, that they had disclosed to the auditor all the non-compliances, that they had disclosed to the service auditor deficiencies, they have disclosed about controls that are not operated effectively, any subsequent events up to the date of assurance report, any subsequent event up to the date of assurance report, that also should be disclosed to service auditor. Whose responsibility to disclose all this? Service organization's management is responsible to disclose service auditor. What are the relevant information that is relevant for service auditor? Non-compliance with laws and regulations and frauds, design deficiencies, controls that are not operated effectively, subsequent events after the reporting period till service auditor's assurance report. That is what, right? After balance sheet date till the date of financial statements. Here it is after reporting period till the service auditor's assurance report. Whatever subsequent events were there, that also has to be informed to service auditor. For all this, we must get a representation from the service organization's management. Clear? So lengthy. Now, what are the elements of assurance report? This itself we have a concept in ICA book itself. What are the elements of assurance report? We have just now seen entirely. We have just now seen entirely. Now, you know, they'll give you this question. They'll give you this question in 3402. The objective of the service auditors is to give an assurance report. In case the service auditor has to give a report on operating effectiveness, what are the additional matters a service auditor will include in a type 2 report? They will ask you this question. What are the additional matters required reporting in type 2 report? What additional matters? Very simple. Service auditor's report, assurance report shall include a separate section. After opinion section, what you will put in separate section? What are the test of controls that were performed and result of those tests? Just now we have seen the format. Opinion immediately, test of controls are performed and result thereof. Correct? And while designing the while describing the test of controls, you need to put a list of test of controls, right? How service auditor give, you know, they will give it as an annexure. Just like how we give CARO as an annexure, they will give list of controls they tested as a annexure to the audit report, assurance auditor's report. Correct? They give it as an annexure. In that annexure, what they should mention? They should clearly describe what controls they tested, clearly state that controls were tested, identify the items tested represent all or selection. How you tested? On a random basis, 100%. What are the nature of test you performed? Like reperformance, inquiry, observation. How you tested? That and all you should give. If deviations are identified, service auditor shall include extent of test performed to identification of deviation. When you found the deviation, after how many repeated tests you found the deviation, that information, the service auditor shall report deviations, even if the related control objectives were achieved. Though there is a deviation, control objective is still achieved. Though control is not followed properly, control objective is achieved. Means the overall system is effective, person is effective. Though the control there is a deviation, the person working effectively, still control deviation is there, right? You must report the deviation. These are all the points the service auditor additionally has to report in case of type 2 report. This itself can be asked as a 4 marks question. Clear? Write about modified opinion in service auditor's assurance report. Like, will a service auditor give a modified opinion also? Obviously, just like us, he will also give modified opinion. Suppose, no? See, what is his objective? His objective is to obtain reasonable assurance whether description of system by the management, is it the real system that they designed and implemented? Whether the description of control objectives and controls that they implemented, are they suitable? 3, whether the controls are operating effective or not, you need to obtain reasonable assurance, right? If at all you found description is not proper, or control objectives and controls implemented are not suitable to each other, or third segment, controls are not operating effectively. In all these 3 cases, will you give a modified opinion or not? Yes or no? If either controls are not operating effectively, or controls were not suitably designed, or controls what they described in the document, what really existing or different, then also you will give what? Modified opinion. Not only that, you will give modified opinion in a case where you are unable to get this evidence. If you are unable to get this information also, you will give modified opinion. You see, there are 4 circumstances. They'll give you this 4 marks question. Under what circumstances the service auditor shall issue a modified opinion? 1, if the description is not fairly presented, if controls are not suitably implemented, controls tested are not operating effectively, or you are unable to obtain sufficient appropriate evidence. In all these cases, service auditor shall give a modified opinion. And not only that, whenever you are giving modified opinion, you should clearly describe the reason why you gave a modified opinion. The same reason is there for us, the same requirement is there for us in financial statement audit also. That's it. And finally, service auditor has to document the following. What are they? How service auditor has to document? In such a way, you should document in such a way that another service auditor who don't have any connection with this audit, By looking at your documentation, he should understand how you performed the audit, what are the results, what are the significant matters, what conclusions you reach, what professional judgment you applied. All that he should understand, even though he don't have any connection to audit. By just looking at documentation, he must understand how you planned to perform the audit, how you tested the controls, what are the results of the controls, conclusions reached, judgments reached, assumptions used. All that he should understand. In such a way, you should maintain documentation. Clear? Listening alone is not sufficient. After this, you have to read. 340T is over. 340T is over. Confident? Yeah. Confident on this? 40T is not over yet. 40T is there. Now, so we are the auditor of the user entity. We are the auditor of user entity. We are user auditor. Now, when I get to know that the user entity is using service organization services, like user entity is using services of so many service organization, cloud services they are using, third party services they are using, for supply of manpower, security guards and all, also some organization is providing services. That and all relevant to me. Yeah? Are they all relevant to me? No. What services provided by service organization are relevant to the user auditor? What services are relevant? If at all, service organization services are part of user entity information system, including process, if they are relevant to financial reporting, which are affecting the following. If the services provided by service organization is affecting user entity information system, related controls, and is affecting financial reporting process, including the following. If at all services provided by service organization is affecting significant class of transactions, it is affecting the way entity record the transactions and report in the financials. It is affecting accounting records maintenance by the entity. It is affecting the way entity captures events and conditions. It is affecting journal entries. It is affecting financial reporting process. Those services which are provided by service organization that are related to user entity information system, related internal controls, related to financial reporting, they are relevant. If the services are affecting significant class of transaction, if they are affecting accounting records, if they are affecting journal entries, if they are affecting financial reporting process, if they are affecting the way we initiate the process, record the transaction, any of this is affected, then only the services are said to be relevant. Ultimately, it's a matter of professional judgment of the auditor whether services provided by service organization are relevant to the auditor. For example, some manpower service, security guards are provided by some service organization for this company. Is that service relevant for the auditor? No. You are getting the point? Now, okay, you understood there are providing some services, you understood that they are relevant. What you need to understand now? You need to understand services provided by service. This was asked many times for 4 marks. Write about understanding of services provided by service organization, by the user auditor. Like you need to understand what service they are providing. Now you understood that they are affecting financials. Now what service they are providing? Nature of service, payroll, inventory maintenance, accounting records maintenance, what? Reconciliations, GST reconciliation work, what exactly they are providing? What is the materiality of the transactions processed? Okay, they are providing GST related. How much percentage or volume of the transactions, materiality of the transactions they are processing? Check out. Sometimes the transaction processed may not be material, but the nature of transaction processed may be significant because they are processing something related to law and regulation. So though the amount involved is less, non-compliance results in punishment. So that may be significant. Degree of interaction, how frequently the service organization and management are interacting, how our company and service, how far they are interacting in this service. Generally interaction will be more when the complexity is more. And what is the relationship? We should also analyze what is the user entity and service organization relationship between them. Are they related parties? Are they controlled by common ownership? Like, is there any such kind of link? We will try to identify. Why are we doing all this? To do risk assessment. To do risk assessment. So when you are understanding the entity and environment, you have to evaluate. You have to evaluate internal controls that are implemented by user entities. As a part of risk assessment, you are supposed to evaluate internal controls implemented by user entity. But on many business processes, they were outsourced to service organization. Therefore, controls relating to that user entity did not implement. Controls are implemented at service organization. So understand services provided by service organization by asking user entity. Where you will get this understanding? Above in the previous question, they said you should understand, right? You should understand. How do you understand? Ask user entity first. Suppose if user entity is not able to give you full clear picture, then do one thing, ask them type 1 or type 2 report. Type 1 report is called as SOC1 report. Type 2 report is called as SOC2 report. In 402 we use the word type 1 and type 2. International 402, 3402, ISA 3402, it uses the word SOC1, SOC2. You're getting the point. So obtain the report. Suppose report is not there, contact them. Suppose they are unable to respond, visit them. You don't have time to visit, send another auditor to visit to perform the engagement. Are you clear? Yes or no? So this itself can be asked as a 4 marks question. If auditor is unable to understand the services provided by service organization by interacting with the user entity, what the user auditor has to do? Obtain type 1 or type 2 report, contact them, visit them, or you arrange another to visit, to go there and perform the procedure so that you will understand services provided by service organization. Correct? Now, suppose I decided to use type 1 or type 2 report. Suppose type 1 or type 2 report is there. I need not go there. Happy. Type 1 or type 2 report is there. You want to use that report. What points you should check? You should check. Don't blindly use it. Who is this service auditor? You should check, right? What is his competence? What is his eligibility? What is his capability? You should check, right? Maybe service organization formality said they prepared some audit report by dummy user auditor, dummy service auditor. So you should check competence of the service auditor. Generally, this checking is not required if the service auditor is a chartered accountant like you. Getting it? And independence also you should check. What standards the service auditor is following in issuing the report. In the service audit report, he will mention whether which standard he followed. In the report of type 2 which I showed, we performed assurance engagement as per 3402, they said. Like that, some point they will tell. See that. Suppose you decided to use type 1 or type 2 report. You decided. When you will decide to use this? After evaluating his competence, after evaluating his independence, after evaluating his standards, what he followed, you decided. When you are using, evaluate whether description of the control is appropriate. Whatever control they described, no, service organization, is that control correct for payroll processing? Check out. And obtain sufficient appropriate evidence. Obtain sufficient appropriate evidence regarding the internal overall controls. Getting it? Further, no, when the service organization services we are using, no, our user entity has to implement certain controls. We have to test these controls also, so that payroll processing overall correct or not. Not only service organization controls, related to that user entity also should implement certain controls. Those controls are called as what? Complementary user entity controls. The auditor has to obtain an understanding of whether user entity has designed and implemented such complementary user entity controls. Correct? So when you decided to use type 1 or type 2 report, check whether what is his competence, what is his independence, and what is what standards using which he prepared these reports, he performed this engagement, to get an understanding whether description and design of control at service organization, is it okay for your purpose of audit? Is that okay, acceptable for you? 2, what controls user entity implemented, get sufficient appropriate evidence for that also. That's it. Finally, suppose you identified some risk. Suppose you identified some risk, whether sufficient appropriate evidence is there from the records available. First check out whatever records you have seen. Is it okay? Sufficient? Are you okay? Are you feeling sufficient regarding the services provided by them, controls implemented by them? If at all it is not sufficient, auditor generally perform further audit procedure. Auditor generally perform further audit. In some cases, In some cases, if auditor's risk assessment include an expectation that controls are operating effectively, when auditor generally will verify operating effectiveness, generally when there is a legal requirement under Companies Act, then he will verify. Otherwise, he himself feels that it is necessary. Generally, when there is a IFC operating effectiveness requirement, then you will verify. So what you will verify? You will obtain a type 2 report. You will see whether test of controls. I mean, you obtain a type 2 report. If type 2 report is there, happy. If type 2 report is not there, you go and perform test of controls to know operating effectiveness of controls at service organization. Suppose you are unable to go, then you will use another auditor to perform test of controls on behalf of the user auditor. Generally, if I want to know operating effectiveness of controls at service organization, ask type 2 report. If type 2 report is not available, you visit and perform the test of controls. If that is not possible, arrange another auditor. Very simple. Clear? Now, suppose you decided to use type 2 report. Suppose you want to know operating effectiveness of type, you want to know operating effectiveness, means you want to use type 2 report. If at all you are planning to use type 2 report, what points you should keep in mind? You should, of course, you should verify whether the description, design and operating effectiveness of control, is it at a particular date or is it for a particular period? Generally, type 2 reports are for a particular period. Whether complementary user entity controls are identified. If so, get an understanding of these controls, test their operating. Complementary user entity controls, whether they are operating effectively, and you should only test directly. Why? These controls are implemented in the organization you are doing audit, user entity. They are not implemented by service organization. And look at the adequacy of the time period lapsed. Suppose already company tested. When they tested last time, you see. When they tested last time, you see. If the time gap, is it okay? If no, ask management to test again or you test again. Finally, whether test of controls performed by service organization, are they relevant to the assertion that is relevant for auditor's risk assessment? Suppose service auditor verified controls regarding data accuracy. He has not verified amount accuracy and all, he didn't verify. Then that may not be useful for me. So determine whether service organization assertion addressed, is it relevant for auditor's purpose or not. Then finally, suppose after evaluating all this type 1, type 2, all these reports, you found some material misstatements because you found some mistakes, because service auditor gave some qualified opinion. If you investigated that, it resulted in material misstatement in the entity. What opinion you will give directly? You will give modified opinion, yes or no. So the auditor shall inquire management of the user entity whether service organization reported any non-compliance with law, frauds, uncorrected misstatements, all that. Because service organization is processing entire payroll, right? They may do frauds. There may be a possibility. In that case, service organization has to report the user entity. Even service auditor of service organization should get a representation from the management that all the frauds, non-compliances shall be disclosed to the service auditor. That service auditor will highlight in his service auditor report. That's how we will get to know. Are you clear? Should I refer about service auditor? Should I refer about type 1, type 2 report about that in the user audit report? No need. You are only responsible ultimately for the opinion you are expressing. Just because you are using service auditor report, you cannot blame him that he is responsible ultimately for the opinion. For the opinion, you are only responsible. If at all his workings contain something wrong, he will answerable. He is answerable. That's a different story. You prove that you followed 402 enough. He will prove whether he followed 3402 or not. Whether he followed 3402, that is not your responsibility. Whether you followed 402 is not his responsibility. Getting that? So suppose if sufficient appropriate evidence is not obtained, like type 1 report, type 2 report, nothing, you're not getting any data about controls implemented by service organization, then what opinion you will give? You will give modified opinion. In that case, you may feel like in order to explain people why you give modified opinion, you may talk about service auditor's report. Generally, if you are giving unmodified opinion, is there any necessity for you to explain that you have used a type 1 report, type 2 report, all that? Nothing. Now, what is the outline of this standard? Very simple. I have to do audit of the financial statements. In order to the audit of financials, I have to do risk assessment. If I have to do risk assessment, I have to test controls. If I have to test controls, many processes they outsource it to service organization, which means controls are not implemented by this organization. Controls are implemented by service organization. What controls are implemented, whether they're suitable or not, whether they're operating effectively or not, I want to know. If at all the process is done here, I would have got that evidence, but the process is done by whom? Service organization. So the same, whatever I ask for my client, I am asking for from service organization, and they give me type 1 and type 2 report. Before using type 1 and chairman type to report, what are we doing? Whether he is competent, independence or not, standards followed or not, is this evidence, whatever that report contains no data, is that data relevant for my audit or not? Like that I'm checking and concluding, correct? This is the over broad that you should keep in mind when you're reading the standard. Clear? 6 hours is what we discussed the standard and 3402 to understand exactly, because in this there are many references to CA intercontent. Many references were there regarding CA inter. Like suppose deviation in control means what? Like that we discussed very in depth. That's the difference. Clear all of you? I think 1.5 hours I spent. 1 hour I spent. 1 hour I spent. That's it. Thank you. Clear on this, all of you? Full matter clear in mind. So with this understanding, now you read this standard, for sure 5 marks. I am telling you, it will take for you at least 3 to 4 hours to master the standard. Minimum time, I'm telling you. Minimum 3 to 4 hours it will take to master the standard. Read, repeat it. You're not understanding, don't leave it. Repeat reading slowly. See, suppose you're not understanding a sentence. Break it in different way and read. Break it in different way. The sentence, break it in different way and read. You will understand. Then you're not understanding. Again, break it in different way and read. That struggle you have to take. Getting it? Then you will get an overall command. That process take 3 to 4, sometimes 5 hours. For that you are getting 5 marks. Getting it? Yeah. So we'll begin 240. Auditor's responsibilities relating to audit of financial statements, relating to fraud in an audit of financial statements. So auditor's responsibilities relating to fraud in an audit of financial statements. See, earlier the standard was there in CA Inter as a separate chapter. In the old scheme of CA Inter, you have a chapter called fraud responsibilities. Now there it was removed and kept it here with little more content. So entire that standard 240 is added in CA final with little more content. I can say entire pronouncement book 90% of essay 240 is copy pasted here. Almost 90% of the essay 240 is pasted here. So what is this fraud is about 240? Fraud means what? First of all, we know very well misstatements can arise either from fraud or error. Intentionally a misstatement might happen in financials, or unintentionally a misstatement might arise in the financials. If intentionally the misstatements are arising, we call it as fraud. If unintentionally comes, it is error. And fraud is again classified into 2 categories: fraudulent financial reporting, misappropriation of assets. Fraudulent financial reporting, misappropriation of assets. Now what is the objective of the auditor under 240? Are we supposed to identify the frauds performed by the management? No. Our objective is to do risk assessment. When we are doing risk assessment, we are liable to identify risk of fraud. We are liable to identify risk of fraud. Suppose if at all any risk of fraud you identified and assessed. You identified and assessed any risk of fraud. You need to obtain sufficient appropriate evidence for that particular, like you have to design appropriate audit procedure to address that risk. If you identify any risk of fraud, you assessed that risk, like high level or low level, you assessed it. Assessment of risk means classifying the risk nature. Is it high level or low level? What is the level of risk? Remember, whenever you are classifying the risk as a low, you must have evidence why you classified it as low. You must have evidence why you classified it as low. So the auditor has to obtain, obtain sufficient appropriate evidence with regard to assessed risk and respond appropriately. So how to respond if at all we identified a fraud or we identified a suspected fraud? How to respond? That is what entire 240 standard is explaining. You know, this 240 standard says, management is primarily responsible for prevention and detection of fraud. The management is primarily responsible for prevention and detection of fraud. Management primarily responsible for creating a culture of honesty, which can be achieved only by an active oversight by those charged with governance. Only if there is a top management supervision control, then only a culture of honesty can be inculcated, culture of honesty can be achieved. Then what is the responsibilities of auditor? Your responsibility is to conduct audit and see whether financials are free from material misstatements. Your responsibility is to conduct audit and see whether they are free from material misstatement. And we all know, because of inherent limitations of audit, we cannot detect all the material misstatements, whether due to fraud or error. That too, detection of frauds depends upon so many factors. Detection of fraud depends on so many factors. It depends upon the perpetrator's skillfulness. How the person committed the fraud, how skillful he is. It depends upon frequency of the fraud. It depends upon collusion involved. Suppose if there is a high collusion involved, it is very difficult to detect a fraud. Relative size of amount manipulated, how much amount they are manipulating. If the big amount is manipulated, it is generally easy to identify, but if small amounts are manipulated, it's difficult to identify. Seniority of the individuals, if top management performed the fraud, it's not that easy to identify. If a low level management performed the fraud, it is easy to identify. Seniority of the management who performed the fraud. So there are so many factors, that affect auditor's ability to identify frauds and errors. It is not that easy for the auditor to identify fraud. Errors are easy to identify comparatively. Therefore, what auditor has to do? You should identify potential opportunities for the fraud. You should do a risk assessment. You should identify fraud risk factors that creates opportunities, that creates pressures, that creates an attitude of an employee to commit a fraud. You should identify whether any such symptoms exist or not, where a fraud can happen. Fraud indicators, we call them as what? Fraud indicators or fraud risk factors. You're getting it? Now, and remember, the risk of fraud, the risk of not detecting management fraud is greater than employee level fraud, because management is generally in a top position to manipulate the records also. Now, this fraud is classified by the standard into two types, as I told: fraudulent financial reporting, misappropriation of assets. Fraudulent financial reporting means what? Manipulation of records, manipulation of accounting, manipulation of financial statements, manipulation of books and records and financial statements is called fraudulent financial reporting. Misappropriation of assets means what? Stealing of the entity's property, using the entity property unauthorizedly, using business property for personal use. All these amounts to treat, all these are activities are amounting to misappropriation of assets. Correct? Now, both of these leads to a material misstatement in financial statement. When you manipulate records, misstatement will be there in the financials. When you misappropriate cash, when you misappropriate inventory, when you misappropriate assets, real assets are lesser, but the balance sheet shows higher number because this fraud is not discovered. Therefore, the financial statements show overstatement. That will not show the real entity's assets availability, because the real assets are manipulated, real assets are misappropriated. Understood? So these are the two types of fraud. So what auditor has to, what is the responsibility of the auditor? What the standard says: since considering all these factors, please maintain skepticism. Please maintain skepticism that recognizing a fraud is difficult than recognizing error. Remember, fraud detection is difficult than error detection. Now, you know how the frauds will be done? Like I told, right? There will be risk factors. Auditor has to do a risk assessment. Like, our risk assessment means very simple. We need to understand the entity. We need to understand the functions, departments. We need to understand what are the roles and responsibilities, what are they doing, and what processes established, what systems they established. Within the systems and procedures which the company established, is there any way that people can manipulate? Is there any way where people can commit fraud? Like, you need to identify, is there any incentive and pressure? Is there any opportunity for the people to commit? And how the attitude of the people working in the organization. You should study all these three elements. Are there opportunities for fraud? For example, you know, you found out that there is a huge cash balance is there. There is a huge cash balance is there in an entity. Why that much cash balance is there? Okay, cash balance is there. How they are keeping this cash? They are keeping it in a normal drawer with a basic key, security key. The key is not that secure. Like normal computer tables and all will get racks. No, is that key that secured? Even if the key is lost, nothing to worry. You pull it strongly, it will come out. Yes or no? So in that kind of particular locker they are keeping so much of cash they are keeping. Is it an opportunity for anybody to commit a fraud or not? Identify that opportunities. Is there any such kind of opportunities? Now remember, the opportunities for fraudulent financial reporting is different from the opportunities for misappropriation of assets. Right now the example which I told is for misappropriation of asset. For fraudulent financial reporting, the opportunity is different. For example, related party transaction is there. Through related party, company can engage into complex transactions and manipulate the position and performance of the company. For FFR, the opportunities are different. For misappropriation, the opportunities are different. Same way, only if opportunity is there, a person may not commit a fraud. There must be a necessity for him. There must be some benefit for him. There must be some pressure upon him. So see whether any pressures are there, whether any incentives are there for any person to commit a fraud. See whether the management is under pressure. Whether the management is under pressure to achieve some earnings target. To achieve some earnings target, is the management under pressure? If so, there is a possibility they commit a fraud. They may commit manipulation of records. And if pressure is there, is there any opportunity for them to commit a fraud? Yes, they are transacting with so many related parties. So there is a high possibility they will inflate. And see whether their attitude supports it. By interacting with them, you will understand what is their perception about the entity, what is their attitude, history of complaints received on them. By looking at all this, you will understand whether fraud risk factors there or not. Now we have examples. Now, why fraudulent financial reporting is performed? Why people manipulate records? What is the reason? Because entities' performance and profitability, they want to show, they want to manage the earnings to deceive financial statement users by influencing their perception. Therefore, we can raise some additional funding. Therefore, we can raise some additional loans. Earnings manipulation, they may start with small actions, but pressures and incentive may lead to these actions to increase the extent of manipulation. And these situations, moreover, pressures from market expectation, analyst expectation, all these causes directors to choose some accounting policies that favor them. Getting it? And some entities, they may want to reduce the earnings in order to pay lesser taxes. They want to hide the earnings. How this fraud is permitted, how this fraud is conducted, how this FFR is conducted, how they manipulate? Very simple. They manipulate the records, they alter the records, they put false records, they record false transaction, they intentionally omit some expenses, they intentionally misapply the principles. Capital expenditure they charge it to revenue expenditure they won't charge, instead they capitalize. So many ways they do. Now, fraudulent financial reporting often involves overriding of internal controls by the management. Generally, fraudulent financial reporting will not be conducted by small level employees. It is generally conducted by big management, high level management. How they control, how they do this fraud? By overriding the controls. By overriding. What is overriding control? Very simple. The company, if they have to pass a purchase transaction, there is a voucher has to be prepared. That voucher has to be authorized by somebody. The voucher has to be prepared by somebody. For that, supporting bills and all should be there. After verifying this entire process only, the entry will be passed and the manager will approve it. Then only the entry will reflect in the accounting records. This is the control. Overriding means what? Not following this control. Not following this control. So management commit frauds by overriding controls. How they will commit? How overriding will happen? What are the examples of these frauds? FFR may be, FFR often involves overriding of controls, like by using some techniques. For example, recording fictitious entries, adjusting assumptions and judgments to estimate accounting balances, provision for bad and doubtful debts, intentionally calculating at a lesser level, vomiting some transactions, or preponing the recognition, delaying the recognition, or vomiting it at all completely, concealing or not disclosing facts to the auditor, or in the financials, engaging in complex transactions, altering records and terms and conditions that are significant and unusual, engaging in related party transactions outside normal course of business. These are all various ways frauds can be committed by management by overriding controls. Now, how auditor should verify this? How auditor should verify this? We have a separate question on that. 11th question. Audit procedures, you see in this. You have a concept called response to assessed risk of MMS due to fraud. You have a concept called response to assessed risk due to fraud. Inside that, one of the sub-concept is what auditor will do to the risk related to overriding of control. Suppose you identified a risk of overriding of controls by the management. How you will verify whether management overrided and recorded fictitious entries, omitted transactions? How do you identify? I will simply test the journal entries which they recorded. I will test the journal entries what they recorded. Whether they are fictitious or not, I can find out easily. I will review accounting estimates. How they may do frauds related to overriding of controls? They manipulate the estimates, they manipulate the judgment. That's what they do. Now what I will review whether the estimates are proper or not. For significant transaction outside normal course of business, what is the business necessity, what is the business rationale, I will verify of the transaction. Are you getting it? So you see the previous topic, 4th question, how management override the controls. Fictitious entries they'll record, they omit transactions and events, they prepone recognition or they postpone recognition, they manipulate accounting estimates and significant judgments, they engage in complex transactions. These are all the ways how management override the controls and commit fraudulent financial reporting. How do you detect this? I will review the journal entries, I will test the journal entries, what they recorded. I will test the vouchers and transaction. I will review the accounting estimates which they have chosen. For significant transactions, I will see what is the necessity. Suppose they engage in a complex transaction. Why you can directly buy from them? Why you buy from X to Y, Y to Z, and Z to the other party? Why you did this much big chain? At the end of the day, they are all related parties. Why you bought like this, such a complex transaction? Why? Business rationale I verify. Are you getting it? Both the questions are not same. Remember. Both the questions are not same. Don't confuse this and that. What are the auditor's response to address risk of internal controls overridden by management? That answer is this. What are the ways how internal controls can be overridden by management? Give you techniques. Answer is that. Understood? Clear? Next. Entirely I'll cover. Don't worry. I'll come to like that interlinked points. Now next let us look at how misappropriation of assets will be done. How misappropriation will be done. How they will do? Either they will misappropriate cash, or they misappropriate theft, or they record fictitious transactions and misappropriate the asset, or they may use entity assets for personal use. Correct? One is receipts related fraud. Another one direct asset fraud. Another one third party involved in the fraud. Another one, no, like I'm not misappropriating anything. I'm using it, the company property, I'm using it for my personal use. Which personal use? Authorized or unauthorized? Unauthorized personal use. These are the ways how misappropriation of asset will be conducted. Sometimes if misappropriation is with supporting evidences, suppose you made the entity to pay third party for the goods purchased for your personal purpose, but you recorded everything like for company purpose, all the transactions, stock records, everything tallied. It's not easy to identify. Correct? Next. I'll come back to that again. What are the examples of risk factors for MMS for misappropriation of assets? Suppose if at all misappropriation of asset is happening, how do you find symptoms for that? Like in a company, whether misappropriation is happening or not, will there be any indicators? If you don't know, don't worry, standard is giving explanation. You read the standard, see whether are there any such indicators in the real entity or not. Like for example, standard is telling you some opportunities will be there. Like what? Large amount of cash on hand. Why the company is keeping large amount of cash on hand? Inventory small in size, high in value, which means there is a possibility of misappropriation. Fixed assets with small in size and marketable, lacking identification marks of ownership. That is a fraud risk factor. Inadequate internal controls, very important. This was asked many times in exam. Inadequate internal controls. If internal controls are inadequate, that could result in misappropriation of asset. That could result in misappropriation. What do you mean by inadequate internal control? Proper segregation of duties are inadequate. Senior management expenditure on that no supervision. Inadequate oversight of employees responsible. Top management is not top management is not serious about employees who are dealing with assets. For example, store manager is careless, cash department manager is careless, inventory related maintenance, in all, whoever dealing with assets, no, management is not caring them, like management is not looking at how they are functioning. Inadequate record keeping, inadequate authorization and approval, inadequate physical safeguards. There are no cameras, there are no locking systems and all. Lack of complete reconciliation. That's why we need to check whether physical verification is happening at reasonable interval or not. If at all that is not happening, that's a fraud risk factor. Understood. Next, lack of timely documentation of various transactions, lack of mandatory vacations. Like especially in companies, no, store managers will be given 1 week leave. Rotation of duties will be there. There will be rotation of duties. Like another store manager will come and do. Why rotation and all will happen? So that frauds can be detected easily. Inadequate access over automated controls. Inadequate understanding of information technology. Today, most of the controls are implemented through systems. Most of the controls are implemented through systems. Best example, you are a self-service portal in ICA. Yes or no? You raised one request, articles completion or something, articles registration or something form. You raised a request. Your principal has to approve it in the online. ICA department has to approve it over online. That is how in companies also controls implemented. Suppose I want to place order, purchase order. You placed, suppose you are the purchase manager. You placed order. It will not go to the vendor. First it has to be approved by some CFO. It has to approve by finance manager. In their system it will reflect. They will see whether this purchase order is proper or not. Once they see, once it is approved, then only order will be placed with the seller. Which seller? Which supplier? Only the supplier whose name is listed in the company profile, company data. Only with that seller you can place. Okay, you placed order. You are receiving goods, right? How many you can receive the goods? Only that many ordered. Suppose the supplier, no, he sent, you ordered 100 units, supplier sent 120 units. You can't accept 20 units. Why? Your system will not accept. Now, once your goods are accepted, the store manager should give a GRN to the other party, right? Yes, I received goods acknowledgement. He can give acknowledgement only for 100, not for 120. If this kind of control is there in the automated system, automated control, we call them as what? Automated controls. If this kind of controls are implemented, what happens? Employee cannot purchase. Employee cannot purchase the goods unless all of them are colluded. Purchase manager, CFO and stores manager. Not just that. Once I gave GRN, then only I can enter 100 units. Then only accountant can pass a journal entry in books of accounts. Only when journal entry is passed, finance department will see the liability due on the due date and remit to the supplier. These many people are involved. Segregation of duty. Big companies will have these kind of sub-departments, sub-processes. We call them as what? Sub-processes. When a fraud has to happen here, all of them should involve. Are you getting it? Maybe you can manage finance team at last, but remaining this entire chain must collude. Only then purchase related fraud happens. Only then sale related fraud happens. You are getting the point. So if at all controls are inadequate on this, misappropriation can happen easily. This itself can be given as a 4 marks question. And I told right previously just now, write about overriding of controls by management. What are the techniques? That can be asked as a 4 marks question. Or they may ask you as a 4 marks question, what are the auditor's response to the risk of overriding of controls? Whether you assessed it or not doesn't matter. Whether you found overriding controls or not doesn't matter. You must test some sample transactions. You must review accounting estimates. That and all you must do, right? Whether the risk of overriding is there or not. Clear? 1 minute. Okay. We'll discuss simultaneously what are the opportunities for fraudulent financial reporting. What are the opportunities for fraudulent financial reporting? And I notice people who are watching my marathon at 2x speed. Super ultra legends. Like, they only focus on finishing the video, not learning from the video. So painful, you know, taking a revision session is. That's why I take only once in a year. Until I step out of this class, I will be very conscious. If I go down, gone. That's it. I'll go and sleep. You speak for 20 minutes, you will understand the pain. Not speaking, shouting. Getting it? Actually, no. Otherwise, how will you sit intensely? You'll be sleeping. I need to wake you up sometimes in between. Yeah, we'll continue. You know, right now we have seen opportunities for misappropriation of assets. The opportunities for manipulation of records will be different again. Misappropriation, what? Controls are not proper, somebody can steal. Cash is so much, somebody can steal it. These are all for misappropriation, which are generally performed by low level employees and middle level employees. But top level employees, they try to do, you know, fraudulent financial reporting. What kind of opportunities were there? Like, I would just like to give you this analysis. You know, in private sector, suppose Reliance itself you take, or you take DMart, Avenue Supermarts. Suppose in Avenue Supermart, CFO is there, or let's assume some executive person is there. DMart turnover is close to 1 lakh crore. Close to 1.2 or maybe some 80,000 or 90,000 crore. Approximately 1 lakh crore plus only it is there. Their purchases are close to 50,000, 40,000 crore. 35 to 40,000 crore. If at all the person who is dealing with purchases in DMart just increase it with 2% the prices of the purchases, he can make a fraud of 600 crore. You're getting the point. If a director who is dealing with particular activity, if at all the director is just influencing the prices of all the purchases by 2% with the vendors, and this director will take a kickback. In the sense, this director will settle that amount later on. You know, the company, I am just a director, I don't have any shares in the company. Based on my competence, this company appointed me as an executive director. But if I have this bad attitude, 2%, just 2% enough, or 1% enough, 35,000 crore multiplied by 1%, 350 crore fraud we can do. This is the scale of opportunities that is there in big entities. I'm just telling you. Private sector, the corruption is high, not the public government sector. Government and all 2 crore, 5 crore only, nothing. Private sector is so big. Reliance Company, Indian Oil Corporation, where the purchases and all are like thousands of crore. 1%, do you think they won't do? They definitely do. They definitely, see, at the end of the day, I have to approve you. My supplier, the director has to approve. The supplier has to be approved by whom? Director has to approve. That's why you see, that's why most of the directors, entire thing is monitored by SEBI. What monitoring? Nothing. You can't do. Will you tap my phone and listen? No, right? You tap it, I use another phone. That's the kind of directors do so many frauds which you can't even predict. Then what to do, sir? How to do? Nothing. That's the system. That's how the system. He will have his own thought process. He will have his own thought process. What thought process? I am bringing this much business. Without me, this much profit and all, people will not get. Further, you are paying 10 crore remuneration yearly. What are you thinking about me? That's the kind of attitude directors will have. I'm bringing this much business, thousands of crore profit I'm doing, bringing and distributing to all of you more than your market return, more than your market available returns. Your shares prices are increasing, value appreciation you are getting, and you're paying me 1% remuneration for profit. Company success, what? 11% of the profit is the maximum remuneration for all the directors put together. The directors do all this kind. Getting it? 1% fraud if they do, this is the size of fraud, scale of fraud they can do. Definitely opportunities will be there, not just real frauds will be there, but we don't find that. So that's why vendor system, vendor selection process, all the everywhere process implemented, but ultimately human being is the one who will control. You put like, tender mechanism will be there. For example, tendering process is there. See, in vendor audit, when we are doing vendor audit, we see tendering mechanism has been unbiased or not. The people who put tender itself will control. You're getting the point? The people who put tender, that itself will control. How come you will give public advertisement for tenders? I'll give advertisement. You will not find it. At least somewhere a small box in the newspaper. Who will read that box and place a tender? So the one who can put a tender, I can influence. In government audits, they will show. In government, some movies also they will show how government, like the contracts and all, they will get thousands of crores of dealing. Just 1-2% manipulation enough. Lifetime settlement. That's the kind of fraud they do, directors and all. Any company, listed company, these are possible. Next. So, opportunities. The nature of industry or the entity operations. What is it? Nature of industry. That gives some opportunities. Entity operations provide some kind of opportunities. For example, entity operations, significant related party transactions in not ordinary course of business. What do you mean by related party transaction not in ordinary course of business? Substantial discounts were given. That's an example of not in ordinary course of business. Terms and conditions were altered after the transaction is entered. That's not in ordinary course of business. So in all these cases, related party transactions is one of the most possible opportunity where frauds can be committed. Strong financial presence, ability to dominate certain industry that allows the entity to dictate the terms and conditions, non-arm's length transactions. This is an industry factor. This is nature of industry. Nature of industry is providing for you to do certain frauds. For example, I'm the monopoly or oligopoly. Only few sellers were there. We all can unite and decide arm's length price. We can easily cheat tax authorities. Are you getting it? By entering into transactions that are at non-arm's length price, we can manipulate profits and pay lesser taxes. Next, assets liability is subject to high judgments, high uncertainties. There are so many significant estimates, so many judgments are there. All these assets and all, I will take improper assumptions, I will take improper judgments and all, and do fraudulent financial reporting. I can show the profit of the company much better than the actual profit they have. Imagine when you are reading this audit, imagine these big companies like Reliance, Adani, these companies, they will have all this. They will have all this. Now, significant high complex transactions, especially close to period end, nearly at the end of the audit, near the period end to the closing financial statement, suddenly doing fraud. Next, significant operations located across international borders. Many transactions, operations which are at international borders where they are bringing some questions about tax laws applicability, all that. Business intermediaries you are using where there is no clear business justification. Why intermediary purpose? You could have directly purchased the shares, no. You could have directly purchased the goods from them, no. Why intermediaries you are using? Something is fishy. Getting it? Significant bank accounts where there is no clear business justification. You are operating, you're having so many bank accounts in so many tax haven jurisdiction. What is the purpose? Monitoring of management. Sometimes, there is an opportunity like this. Top management monitoring is not effective. Top management monitoring is not effective. For example, domination of management by a single person. For example, Reliance Group itself you take. Though there are 14-12 directors, only Ambani family will dominate entire decision making process. Getting it? And oversight by those charged with governance and financial reporting process where controls are not effective. There is a complex or unstable organization structure. For example, in the organization, who is responsible for what? You can't identify clearly. Unstable organization structure, difficulty in determining role of the individuals, complex structure, high turnover in top management means top management is frequently changing. All these are fraud risk factors, opportunities. These are all creates opportunities for people to commit frauds. You know, the standard is giving all these examples, right? You should see whether any of these symptoms there or not. If you don't know how to figure out fraud risk factor, you see these many factors. Here they have given 1, 2, 3, 4, 5, 6, 7, 8 plus 7, 15 opportunities described for conducting fraudulent financial reporting. Definitely in the company that you are auditing, some symptom will be there. Then if you find the symptom, how to investigate that symptom. Getting it? Next. So they'll give you questions like this. Internal control components are deficient. Internal control components are deficient. For example, the entire entity system, like how an entity functions. Big entities, they will have a system. That system is called as what? Internal control system. Internal control system is nothing but set of processes followed by the entity. What are these processes? These processes are broadly divided into 5 categories. 1. Control environment. 2. Risk assessment process. 3. Implementation of information systems. 4. Control activities. 5. Monitoring activities. You're getting it? Like, let us take this classroom as an example. This has a system. This entire classroom, this particular college might have a system. They have implemented a system, that's an environment. That entire system is described as what? Environment. For example, like they might have a policy document where every day what employees have to do, especially non-teaching people, what they have to do. Teaching staff, what are their duties? When they have to do all these duties, like some document might have been there. This is control environment. Top management must be committed towards a proper control environment. 2. Information systems, like they're taking attendance, they're taking who are attending, all that. Yes or no, all that. Now, how these information systems are generally developed? Based on risks identified. What is the possibility in running a college risk? A student who have not paid the fee but attending the class, that's a risk. For that, they will implement some control activities. Getting it? Like as soon as you're entering, checking whether you registered or not, checking whether you have an ID card or not. This is control activity. Whether this entire control activities, whether these systems, whether risk assessment, whether control environment, all these are properly working or not. There is a monitoring department, internal audit department, that's monitoring activity. Are you getting it? These are the 5 components of internal control. If at all any of this component of internal control is deficient, that's an opportunity for fraud risk factor. Correct? So deficient internal control component, like monitoring controls are inadequate, high turnover rates, accounting systems, internal control systems, they are not adequate, they are not proper. Metro rail you take. If you have to perform the journey in the metro rail, for example, I did around some 4 or 5 years ago, but still I think the same control is now also being continued. The moment you go, you want to travel from A to point A to point B, you need to pay the money and get a token, some coin, something. Are they giving coin or card access? QR code, very good. So QR code, you need to go at the time, barricades will be there, electronic barricades, you need to show the QR code, just like airport, something. Yeah, so you need to show this QR code scan and the barricade will open, then you can go into it, you can get into the train. And after arriving your journey, then you need to get down, again you need to show the QR code and and the barricades will open, then you can go outside. This is how the basic typical control. Now on the ticket, if the backside you see, sometimes they'll be printing 30 minutes only valid this is, 40 minutes only valid for this, 2 hours only valid for this. Why that hours or duration is mentioned clearly? So that you will not use the journey to meet another persons, another places, another metro station, and going to the other side of. I think this control is weak in metros even today. Like you can simply change the platform. Suppose I have to go to point A to point B, I have to get on at point D, but I will take only A to B, but I will go to D point, meet my friend again, come back in the same platform and come back to A and then come out. Yes or no? This weakness is there. But at the end of the day, what metro authority, though control is deviated, control objective is achieved. You should not get on it other than station B, after station B. This is the control objective. What is the ticket objective? What is the ticketing? The control objective is you took ticket from A to B. You should get on only at B or before B. But you cannot get on after B. Correct? Maybe you would have gone, roamed sometime, used the resources of the metro rail, all that and came back. But at the end of the day, you will get out where? B only. This is control objective is achieved. Correct? Though there is a deviation of control. Are you getting it? That also auditor has to report that also service auditor has to report. You see that service auditor has to report in 3402 what are the control objectives, whether the deviation is there, even though the control objective is achieved. Deviation shall also be reported. This is the example for that. You're understanding? Because in metro also they will do this audit. These audits will be there. The entire system audit will be there. Metro system audit, complete system. Now this is called operational audit. What is this called as? Operational audit or operating audit, we call it as. Next, attitudes. So this is opportunities. Understood? You need not at all the points. 4 points enough. 4 marks question only. 4 to 5. Preferably what we'll do is, if a 4 marks question comes, we'll write 5 to 6 points. If a 5 marks question comes, we'll write 6 to 7 points. What if in that question only 4 points there? You should write only that 4 points. You're clear? Next. Now, will there be any incentives? Like we found opportunities. That is one reason why people, the opportunity alone is not sufficient. There must be need for the person. There must be some benefit to him, or he must be under pressure. Any of these 2 reasons could be the reason for fraud. Like pressures. Why a person will manipulate the assets? Why a person misappropriate the assets? The pressures are different, right? Like he may have personal obligation, personal finance obligation, and he is a cashier. He can easily do the fraud. Adverse relationship between the entity and the employees. Employees and company has adverse relationship. For example, he knows that he will be laid off very soon, or his recent changes to his compensation was not proper. He was given a decrement, not increment, or he was given promotion but inconsistent with his expectation. This could be the reason why the employee was like what? Agitated. The employee would have been felt bad about the company and will do fraud. No matter how loyal amount, this company will never recognize, so I will cheat. No one words. Correct? That kind of attitude. See whether such a kind of incentives or pressures exist on the employee. Like now let's identify incentives or pressures for FFR. For people who are doing fraudulent financial reporting, for them the pressures are different, like high competition, high vulnerability to changes, decline in customer demand, operating losses where threat of bankruptcy is coming. I want an investor or funding persons right now. If I have to get a funding people, I have to manipulate my results. Recurring negative cash flows, rapid growth or unusual profitability, especially compared to other companies, new accounting. Suddenly in this company, rapid growth is there. Suddenly, that could be a risk factor. You should see why rapid growth is there. Unusual profitability compared to the industry, new accounting requirements, excessive pressure exists for the management to meet requirement, like due to trend level expectation by investment analyst, like third part, whenever a company quarter results are being published, it's like election result today, how it will be. The same way, stock market, you see all the CNBC, all these channels and all, NDTV, all this. So they'll be discussing continuously whenever a company results quarterly, results are as expected, results are not as expected. Expectations create a pressure on the management. Additional debt or financing requirement, companies having some additional or finance requirement. Marginal ability to meet listing requirements. Perceived or real adverse effect of poor financial results. They may be feeling poor financial results may bring negative effect on the company. They may perceive like that. Or really the company financial position is bad. So in all these cases, they try to do fraud. They will give you this question. Excessive pressure exists for management to meet requirements or expectations of third parties due to various reasons. Give examples of those reasons that results in fraudulent financial reporting. 4 marks question, they'll give you this. Understood? All of you? Information available indicates that personal financial situation of the management is threatened by entities. This is another one. Suppose a director gave guarantee to the company thinking company will perform very well so that he can benefit. But the company is completely bankrupt. I am the one who is becoming liable. So in order to remove the guarantee, provide an alternative security, I manipulated results. And somehow got some new borrowing, somehow like that. And relieved my guarantee. So significant financial interest in the company. Significant portion of their compensation is only from this entity. Personal guarantees, excessive pressure on the management to meet financial targets established by top management. All these information available indicates personal situation of the management is threatened by entity's performance. Suppose the director is too much dependent on this company and this director was told by the chairman, if you did not bring a new loan like this, I will fire you. Where the director monthly obligations and all will affect. So what this director might do, somehow manipulate, bring some funds and then satisfy the chairman, correct? So any of these ways can be done. That's it. So these are the incentives or pressures. Then now remember, not just incentive, not just opportunity, there must be, the person must have the attitude also, the person must have the character also to commit a fraud. Whether, see, you need to identify, is there a such characteristic? That's why many companies go for management audit. Many companies go for what? Management audit, to identify and assess management attitude. How are the decision making process? If you recollect, in SQC, the auditor has to verify before accepting the audit, before accepting an engagement, is management aggressively concerned about how are the business practices? Are they aggressively concerned about business practices? That's the nature. You need to figure out the nature of the management. Some managements are like, I don't bother anything. I should be always number one. For that, they would do all types of frauds in the industry. So attitudes are realizations. So auditor has to check whether any attitude, for example, changes in behavior of the employee or a lifestyle. The sudden changes in behavior and lifestyle might indicate he has committed some fraud. Tolerance for petty theft. In the company, thefts and all being tolerated, which means the company is not really implementing controls. Behavior indicating dissatisfaction with the company. Employee, when we are interacting, he is very dissatisfied with the company. That indicates, that he is trying to commit something wrong to the company. Disregard for internal control. Disregard for need for monitoring. Monitoring activities and all, companies not taking care. Whenever internal auditors are coming for checking, they are saying come tomorrow. Disregard for monitoring activity. Disregard for controls over assets. Whenever some controls, suppose security guard is asking ID card each and every employee. Director said, you know me, right? Don't ask me ID card. I will come directly. Disregard to control. Getting the point? So controls violation, monitoring activity violation, these are all various attitudes of the management, behavior of the management that indicates a fraud risk factor for misappropriation of asset. Understood? Same way, for fraudulent financial reporting, the attitudes are different. The attitude are different. Management, the way they are communicating, the way they are implementing, the way they are communicating, implementing, supporting, entity values are not effective. The communication of ethical values to employees is not effective. They are not communicating. They have not established any standard. When you were recruited newly by any company, from 15 days to 1 month or 1.5 month, training will be there. What is there in the training? They explain you code of conduct in the entity, what you have to do, what you are not supposed to do. They explain you code of conduct on a serious tone. They'll tell you, like, that indicates companies like, the top management is like committed towards quality, committed towards culture of honesty. You're getting it? So, for example, non-financial management is excessively participating in accounting policies. Non-finance people, what is their relevance for accounting policy? That indicates they want to do some fraud. Known history of violation. Excessive interest by management in maintaining stock market prices. Participation by the management where they are giving aggressive or unrealistic forecast. Management is failing to remedy significant deficiency in internal control. They know that there is a deficiency in internal control, but they are failing to remedy. That's why you see in 265 they say, once you communicated significant deficiency, you should follow up whether the deficiency is rectified by the management or not. We have to follow up. If they are not rectifying, which means something intentionally they kept the deficiency. Low moral among senior management. Disputes between shareholder. Recurring attempts by management to, like, they're modifying materiality levels frequently, all that. Strained relationship between the management and current auditor. This itself can be asked as a 4 marks question. This was asked once. Management and auditor, the relationship is getting strained. That could be the reason. Management attitude in that scenario is one of the proof that they're trying to do some fraud. How relationship gets strained? Frequent disputes with auditors, unreasonable demand on the auditor, unrealistic time constraint. Last year auditor didn't ask this information. Why are you asking? Have you seen this? Restrictions on the auditor, restrictions on the auditor that inappropriately limit access to people. Suppose I ask a company, I want to talk to external lawyer. No sir, they will not talk to you. They are very busy, all that. They will not let you. Domineering behavior. Management is dominating on you. These are all various indications that they did something wrong. You're getting it, all of you. That's it. So with this, over. Standard is not over, is there? Only half is over. Not half, 60% is over. So ultimately, what the standard says, you have to maintain professional skepticism. By the way, skepticism means what? Seeing the director as a fraud, that means it? No. Unless auditor has reason to believe, the auditor may accept records and documents as genuine. But if conditions, as I told before, fraud risk factors, incentives, opportunities, and attitude, if you identify those conditions, then only you need to be alert. Then only you need to be alert. Suppose, if at all, when you're talking to people, when you're talking to top management, you found a response which is inconsistent. Like director is saying one number, accountant is saying another number, means some inconsistency. Investigate the inconsistency. Yes or no? So write about risk assessment procedure and related activities so that you can obtain information for use in identify risk of fraud. Like now in the above entire discussion, they are telling you characteristics of fraud, how frauds can happen, what are the opportunities they'll have, entire discussion of the frauds. Now what auditor has to do? Now it starts. Here onwards it starts what auditor has to do. Like what auditor has to do? First, you should inquire management and others within the entity, what processes they implemented, what controls they implemented, who are the departments, all that. Get an understanding of how top management exercise oversight on the management process. I will ask the director, how are you monitoring entire this business? Like what are the MIS systems? What are the management information systems that you implemented? The internal control management has established. The auditor shall evaluate whether information obtained from other risk assessment procedures indicate any risk factor. You will be doing not only risk of fraud assessment, you will be doing normal risk assessment, right? You will do a specific risk assessment for risk of fraud, and you will do a normal risk assessment. Whether normal risk assessment provide any risk of fraud information, check out. Now, once you identify any risk factor, once you identify a fraud risk factor, you need to classify this. You need to classify this. Risk, fraud, the risk identified by the auditor will be classified at two levels. Financial statement level, assertion level. The risk identified by the auditor will be classified at two levels. Financial statement level, assertion level. Financial statement level means what? At financial statement level, if at all you identified any fraud, what you have to do, assign personnel taking into their knowledge and ability for the given engagement. Like if you find any financial statement level risk of fraud, assign competent person within your team to address this risk. Suppose, what is a financial statement level risk? What is the financial statement level risk? It is a risk that not a specific element will be affected, multiple elements will be affected. This is called pervasive risk. This is also called as what? Pervasive risk. Multiple elements will affect. For example, the director, main director who is authorizing transaction, his attitude itself is bad. Now tell me, where he will do fraud? Anywhere and everywhere. Correct? We don't know exactly where he will do the fraud. To deal with this kind of scenario, I should assign and supervise personnel having sufficient skill and knowledge. How to address that financial statement level risk? That one. Verify accounting policies. Are they genuine or not? Verify, incorporate an element of unpredictability in selection of audit. Nothing but surprise checks you perform frequently. Whenever you find a financial statement level risk of fraud, you assign personnel with sufficient knowledge and skill. You verify accounting policies. You verify accounting estimates that involve high judgments, and you verify, you make sure in your audit unpredictability exists. What do you mean by unpredictability exists in audit? Surprise checks you will be doing. Understood? Assertion level. What is assertion level fraud? Suppose inventory records are not maintained perpetual basis. What is the possibility of not maintaining inventory records on perpetual basis? Point number one, inventory sales and purchases are not updated in the record. That's why the record balance, books of accounts balance may be overstated or understated. That is one. Two, since reconciliation is not done at a frequent interval, managers and all temporarily can steal some goods. This is another fraud. Yes or no? So existence and condition assertion, there is a possibility of fraud. So if at all you find fraud possibility at this assertion level, what auditor has to do? Design external confirmation, if at all that will help you, or discuss with non-financial persons, The auditor shall design and perform further audit procedure. Nothing but what? You will go and do physical verification in this example. You will go and perform physical verification. Remember, physical verification is one type of audit procedure to get audit evidence, correct? Various ways: inquiry, inspection, confirmation, external confirmation, recalculation, reperformance. In all these ways we can get, correct? Next. And I already told what should be the auditor response in case risk is identified related to management overriding of controls. Whether you identified this risk or not, irrespective or not, you must test journal entries, you must review estimates, you must review significant transactions which are outside normal course of business. What is the rationale? You must investigate. Finally, once you perform these procedures, you will get the evidence, you will get the information complete, you will get the real data. You need to evaluate. You need to evaluate the evidence. Is not that important, okay? Not that important. It is bit lengthy also. Actually, the discussion is that the question is small only. The discussion is very lengthy. Not that important. Write about circumstances where auditor is unable to continue. You understood that one of the director is severely involved in every activity, every authorization process, and the director is a culprit. You understood this after you accepted the engagement, where you felt like no matter how many I verify, somewhere I will be manipulated, somewhere the issues will be concealed. I encountered a circumstance, I encountered an exceptional circumstance that brings into question ability to perform the audit. No matter how much I perform the audit, I will end up with not getting proper evidences. If I conclude like this, what auditor has to do? See, do you have any requirement for reporting to the persons who made appointment? Check, do you liable to report this point? Because you're deciding you're unable to continue. See whether you have to report to any person who made appointment. Withdraw from the engagement, whether it is possible and legally permitted. If you withdraw, communicate withdrawal along with reasons to the appointing people, not just to them. Sometimes you have to report it to legal and regulatory authority. For example, in a company, if auditor resigns, he has to file a form with ROC ADT 3 along with reasons. That's it. Understood? All of you. Finally, get a representation from the management. After doing this risk assessment, understanding all this, get a representation from management. What representation? Who is responsible for internal control system? Management. Whose responsibility to conduct risk assessment originally about the entire fraud? Management. Whatever result they got in risk assessment, they should show it to the auditor, right? That is whose responsibility? Management. Management is responsible to disclose the information about frauds to auditor. Management, not only actual fraud, even allegations, suspected frauds also management should disclose. They will ask you this question: what are the representations the auditor has to obtain in light of SA 240? What are the representations auditor has to obtain? 1. Auditor shall obtain a representation that management is responsible for designing and implementation of internal control system. 2. Management is responsible to show the result of risk assessment process to the auditor. Management is responsible to disclose the auditor identified frauds and suspected frauds. 4. Management has to disclose the auditor complaints, allegations received. Remember, in CARO you have clause number 11, third point, whistleblower complaint. Auditor has to consider whistleblower complaint. Correct? And finally, reporting. If at all you identify the fraud, what you have to do? First, you report it to the management. If at all management only involved, then reporting to the top management. Getting it? Then see whether that particular fraud resulted in material misstatement. In such a case, you may have to report it to. Write about communication to regulatory about the frauds. This itself can be asked as a 4 marks question. They will ask you this question: write about reporting of frauds to management and those charged with governance. That itself can be asked. In that case, you have to write this. Sometimes I'll ask you, write about reporting of frauds to outsiders like regulatory and enforcement authorities. If auditors suspect the fraud, you shall check whether there is a requirement for you to report. For example, in bank audit, if you find any fraud, you have a responsibility to report it to RPS specifically. Although you have to maintain confidentiality, that confidentiality will be overridden by legal requirement generally. Yes or no? If there is a legal requirement, you cannot say confidential, client data, fraud and all, I will not report. Also, in some entities, you may have to report misstatements to authorities where the management fails to take corrective action. In some clients, reporting of fraud, specific provision of regulation, some standards would have given you some guidelines. You have to follow that standards. Finally, you have to document. What you have to document? You need to document regarding risk of MMS. What important decisions reached? What are the risks that you identified and assess relating to fraud? What are the financial statements risk? What are the assertion level risk? You should document. Further, the auditor has to document, okay, you identified and assessed the risk and you documented. What you responded, how did you address this risk? How did you address this risk? And you shall document about communications about fraud to management and their response. To whom and all you communicated, what they responded, document. And most important documentation in this is fourth point, whenever you concluded that there is no fraud risk factor in revenue recognition. If at all you concluded revenue recognition, there is no fraud. On what basis you concluded, you should specifically document. This is the standard requirement. How did you concluded that there is no risk factor, fraud risk factor in revenue recognition? Document it. Yeah, that's it. Standard is over. SA 240. Understood? Actually, no. This particular standard is so lengthy, but not that complex. You're getting it? Now look at the structure of the standard once, like before we proceed to the next part. First, they discussed the meaning of fraud, correct? First, they discussed about what is fraud. They're explaining you so neatly that you can understand the standard. What is a fraud? What the standard is asking? How many types of frauds? Why the frauds are committed? Risk factors. How do you mean by fraudulent? What do you mean by reporting fraud? Why it is committed? How it is committed? They are saying. Then they are explaining what is misappropriation, how it is committed. Yes or no? Then whose responsibility for all this entirely? First of all, prevention and detection. Whose responsibility? Management. Then they are explaining what is your responsibility in the audit. Then they are explaining list examples of fraud risk factor. For fraudulent financial reporting, how the examples are, like how symptoms will be there. For incentives, how many symptoms? Opportunities, how the symptoms? Attitude and rationalization, how many symptoms? For misappropriation also, they are giving symptoms. So you just have to apply the standard in the real audit. See whether these symptoms there or not. Next, then you see, why this evaluation is so important. Without evaluation, you will not understand whether a fraud happened or not. Fraud risk factor is a primary result based upon which I can investigate fraud. Then you need to do risk assessment procedure related to fraud by inquiring management, understand, look at the controls, all that. Then whatever the frauds you identified, categorize them into financial statement level fraud and assertion level fraud. Once you design and implement responses to these frauds, you will be getting evidence. After evaluating the evidence, you will identify circumstances that indicate some possibilities of fraud. If at all there is a circumstance which indicates that there is a high possibility of fraud and you cannot detect it, you cannot perform the audit, what to do? And finally, okay, you performed the audit. It is not like you are not doing. You performed the audit and everything is over. Before conclusion and reporting, get representations. Once you got the representations, all that, finally you documentation everything, you set right. You found some frauds. What you have to do? You have to report the frauds sometimes to regulatory. How to report, what to report, exactly when to report, and document the entire process. Clear? So strategically it is arranged. That's it. Unless when these kinds of lengthy standards were there, you should first observe briefly what each and every subtopic is dealing with. Observe. Then read each and every subtopic thoroughly. Once you come to some 10 questions or 5 topics like that, immediately don't continue. Once recap what are all there, what is the objective of the standard why I am studying. Then recollect that, then go to 6, 7, 8, 9, 10, for example, remaining topics. Then read that and how these are interlinked with the previous 5 topics. Why are we learning this standard? Once again, bird eye view. So once you read each and everything, give a bird eye view of what exactly the standard is dealing with. Now again, read each and everything for memorization. You directly read for memorization, it will never work. This is how memorization works. Clear? That's it. SA 240 is completed. Confident. Now we still have, just a minute, we still have 500 series. 240, 250, 260, 402, 340, 5 standards we completed. Already 12 auditing standards we completed. Totally 17 standards we completed. Out of 46 we have. And out of this 46, some 6 or 7 I said I'm not covering, which are there in the CA into. So typically some 38, 39 standards I'm covering, half already over. Half already over. In the next session, I will be discussing 500 series, all that, and I will start specialized areas. I will start specialized areas. Then once specialized areas is over, then I will continue with related services, assurance engagement, all that. Once all that is completed, then I'll come back to ethics. Maybe if possible, before coming to ethics, I will do risk assessment chapter and strategy chapter. Then I will start ethics. Once ethics is completed, 80 marks syllabus pakka completed. Clear? Then internal audit, forensic audit, briefly I will discuss. That's the agenda for the next 3 sessions. Clear? Shall we wind up? Okay, yeah, take care. So let's begin the next standard, that is SA 540, auditing accounting estimates, including fair value accounting estimates and related disclosures. And this is one of the toughest standard that we have. Like in entire CA final, if you recollect, generally these standards you feel tough. One is 402, 3402 combination and 540, and we have SQC 220. These are the 5 standards, or mainly 4 standards, which generally many don't understand. 240 is lengthy. 240 is slight complexity, not so tough. 250. 240, 250, 260 are medium. They're not really tough. But this is one standard where the entire structure of the standard, if you don't understand, you will never, you will not connect to it. You feel like reading the same again and again. Without understanding, if you're reading, you feel like reading the same content again and again. So we'll discuss all those confusions, we'll try to clear. So auditing accounting estimates. Look, what are we doing? We are verifying accounting estimates. Auditing means what? Verifying. Verifying accounting estimates, including fair value accounting estimates and related disclosures. We are verifying all these 3. We are verifying accounting estimates, we are verifying fair value accounting estimates, and we are even verifying disclosures. You see, the objective of the standard, is very quite simple. Whether accounting estimates are reasonable and the disclosures are adequate. Only these 2. Whether accounting estimates chosen by the management are the reasonable. Means like generally when an accounting estimate is chosen, this estimate is generally based upon some methods. For example, this best example you take, environmental liabilities. To understand the total gross impact of the standard, this is best example. How to assess liability for environmental liability. How to assess environmental liabilities. How to assess environmental liabilities. For example, you have an accounting standard PPE regarding site restoration and decommissioning expenses. Somewhere after 15-20 years, maybe I have to close my factory and I have to change the place. At that time, I have to incur certain restoration cost, site restoration cost. I think parallel you have an income tax also, there is a deduction, 33 ABA. There is a deduction. The site restoration expenditure and even decommissioning expenditure. Like you have to decommission the entire plant and machinery and restore the entire site into its normal, nature, original nature, and you have to hand over back to the government which allotted to you. For that, you will incur certain expenditure. Okay, and that expenditure is generally so material. The expenditure is generally considered to be very material. The site restoration expenditure is material. That you have to incur after 20 years. Now, like how accounting standard says that expenditure, bring it to the present value. Bring it to the present value and add it to the fixed asset cost, as to the property, plant and equipment cost, and depreciate on the revised cost, correct? And we all know that every year this estimation will change, correct? The decommission expenditure related estimate, by the way, this decommissioning is an estimate only, right? After 20 years, I am going to incur some amount. Is this an estimate or not, first of all? Obviously, yes. This estimate is based upon so many factors. For example, right now if we do decommissioning, right now if we do site restoration, with the available technology, available vendors, available like whatever the equipment available, we know how much we incur today, but we don't know how much we incur after 20 years. How much we are going to incur after 20 years, first you need to calculate future value. How much we are going to incur after 20 years, like you need to take into account inflation rate, you need to take into account certain other factors, all that, changes in market conditions, all that you have to take into account, and then estimate how much future value you are going to spend and discount it at the opportunity cost that is available for you, discounted rate, correct? Future value is based upon the market conditions. Discounting is based upon the discounting factor. Getting it? And you bring it and then account it. Is this a significant estimate or not? Suppose a factory construction cost, the construction cost itself is somewhere around 25,000 crore. Let us assume the plant and machinery, that entire factory construction cost is somewhere around 25,000 crore. As on today, if you apply decommissioning, the cost of decommissioning site restoration will be somewhere 15 to 20% of the entire establishment cost. Somewhere it will be 3,000 to 4,000, 5,000 crores it will be. Considering inflation rate, future value, present, bringing it to present value, all that, it takes almost somewhere around some 3,000, 4,000, 5,000 crore will be the amount, correct? Some 3,000, 4,000, 5,000 crore will be the amount. This is a significant estimate. Here, this is a situation of high estimation uncertainty. This is a situation of high estimation uncertainty. When we can use the term accounting estimate? When we cannot figure out what is the actual amount, we take an approximation because precise means of measurement is not available. Correct? That's what the definition of accounting estimate. An accounting estimate is nothing but an approximation of monetary amount in absence of precise means of measurement. Because I cannot measure it precisely, I am only taking an approximation. Now tell me, every estimate, whether it is a normal estimate or fair value estimate or high certain estimate or low certain estimate, some uncertainty is there, right? Definitely uncertainty will be there. Some sort of uncertainty will be there for an accounting estimate. But there will be some estimates where the uncertainty degree is extremely high. The degree of uncertainty is extremely high. For example, how much warranty claims related expenditure a company can incur in the next year. A company can easily estimate approximately closure amount because based upon the past experience, based upon the industry data, we can assess it. But how much decommissioning liability the company exactly going to discharge after 20 years? Company is estimated, but the actual amount will be significantly different from the whatever the estimate. This is here, whereas in warranty, the estimation uncertainty is low, whereas in decommissioning liability, estimation uncertainty is high. So in 540, what the standard is asking us technically, check whether the estimates are reasonable or not. How do I check whether estimates are reasonable? First of all, whose primary responsibility to choose them? Board of directors, nothing but management. Whoever responsible party is there to prepare financials, they are responsible. So first I will look into what process entity has established. What process entity has established to identify areas requiring estimates. How the entity identifies accounting estimates. Then I will look into how they are making estimates. First I will look into their risk assessment process. Primarily risk assessment more than us, the management will be doing. So first I will ask entity, how are they doing risk assessment related to accounting estimates? Like how are they identifying areas of accounting estimates? Where and all in a company, an accounting estimate is required. Most of the times, the financial reporting framework itself gives clarification on that. The accounting standard itself tells you, that accounting standard itself gives you a list of items that require an accounting estimate. You just read each and every standard, it will have some reference to estimate, most of the standards. So you follow financial reporting framework, you can understand what are the areas that require estimates. Terms and conditions of various contracts. Terms and conditions of various contracts. Type of products they are selling. Events and transactions and conditions that are happening. All these will give a rise. All these items will give a requirement for the entity to create an accounting estimate, to recognize an accounting estimate, correct? And not only recognizing, sometimes entity might have to revise. Not only recognizing the estimate at initial level, they may also have to be revised. Accounting estimates requires revision in certain circumstances. Accounting estimates requires revision in certain circumstances. That also we'll see. That also we are going to learn. So first look at how the entity is identifying circumstances that requires accounting estimates, or look at the entity's risk assessment process, whether they are identifying changes in circumstances that require revision in the already estimated amounts. So what system the entity has implemented, what policies entity has implemented, first we need to look into it. Okay, we saw how management established internal control system for accounting estimates. We saw one of the internal audit department was given the duty, not internal audit, one of the finance department was given the duty. Internal audit is also monitoring that aspect also, which means there is a formal assessment process for accounting estimate. 2. Then what should I look into? How are they making these estimates? The second question that I should look into is what? How are they making this estimate? How people make estimate generally? Accounting standard will give you, for example, India 16 talks about how to recognize decommissioning liability. The method, the processes, the model is they're described, yes or no? So how they are making it? Sometimes they may use the help of an expert, they use some data, they use some assumptions. By taking all this into account, they make an estimate. Once accounting estimate is made, they recognize it in books of accounts. Once an accounting estimate is made, then they recognize it in books of accounts. So look at how they are recognizing, recognition and measurement, all that you see. How are they recognizing, how are they measuring in the books of accounts, all that. You need to perform substantive procedures now. Verify what workings they are used, what methods they are used. You need to test them. You need to perform audit procedures now. Then finally conclude whether there is an estimation uncertainty involved. Obviously estimation uncertainty will be involved. If at all estimation uncertainty is very high, that we generally call it as what? Significant risk. That we generally call it as significant risk. If at all estimation uncertainty is extremely high, whereas significant risk is involved, ask a company what they did to address this. What they're doing to address this. Suppose if estimation uncertainty company did not address, management did not look into it, they didn't consider about this, they ignored about it, they just did India 16 method, whatever followed, they just blindly did that. They didn't consider estimation uncertainty. You know what? When estimation uncertainty is there, you need to do a sensitivity analysis. The auditor the management has to perform what? Sensitivity analysis when there is a high estimation uncertainty. What is a sensitivity analysis? Like present situation of present value of future expected decommissioning liability. That the future estimated decommissioning liability, we calculated based on certain assumptions, right? And these assumptions, will it be constant? Whatever the attributes, inflation rate, market terms and conditions, will they be constant throughout the 20 years? No. So what if inflation rate changes? What if market terms changes? What if new advancement in technology comes and that became costly, decommissioning? Moreover, because of changes in climate conditions, all that, regulatory laws are becoming more and more vigilant, more and more severe. They are levying more and more penalties. So what are the side effects of all this? Management has to do a sensitivity analysis, like the decommissioning liability, one value they figured out, but that value alone will not be there. There is a possibility, if at all change in assumption, change in inflation rate there, then the amount will vary. If the inflation rate changes, the amount will vary. That why? You need to check whether company has considered alternative assumptions. Indirectly, what you need to verify? You need to verify whether company has considered alternative assumptions or not. This alternative assumptions is nothing but what? Changes in one of the factor that changes the estimated amount. The one of the factor is inflation. Suppose one of the decommissioning liability we calculated 3,000 crores keeping in mind inflation rate of 3%. What if inflation rate is 7%? Then how it could be the liability? How? 3,800 crore revised liability. Suppose if inflation is 0, then the liability will be reducing to 5. If at all inflation is 12%, the liability will go up to 4,500, 5,000 crore. Like this, did the company did a sensitivity analysis? If so, why they did not consider alternative assumptions? Why they capitalized only 3,000 crore? Why not 4,000? Why not 2,000? Why they capitalized 3,000? On what basis you concluded 3,000 is reasonable? You should verify that. This verification, sensitivity analysis and all is required when accounting estimate involves high estimation uncertainty. Suppose if company did not do that analysis, what you have to do? You should develop an accounting estimate. In fact, you can't develop an estimate just like that. You need to develop a range. You need to develop a range. Like lower limit, upper limit will be there. You need to develop a range. Auditor has to develop. And that range is called as auditor's range or auditor's point estimate. What is it called as? Auditor's range or auditor's point estimate. So you should develop that. And with that estimate that you developed, verify whether the management's estimate is right or not. That is how the standard recommends, the standard mandates, the standard requires the auditor to verify estimation uncertainty. Once you verified estimation uncertainty, all that. Once you verified how the accounting estimate is recognized, all that. You will get an idea. You will get an idea whether this accounting estimate is proper or not, whether this accounting estimate is reasonable or not. You will get an idea. Once you understood the accounting estimate is reasonable, then you will conclude, you will document everything and you will give conclusion. You will give conclusion whether it is estimate is reasonable or not reasonable. You will give a conclusion. That's it. With this, the standard is over. Entire 540. So we'll see each and every sub-element of the standard and then we'll continue. Just a minute. So let's look into the sub-elements of the standard. What is an accounting estimate? It's an approximation of monetary amount in the absence of precise means of measurement. I know in estimates, generally in accounting estimates, there is a possibility of management bias. Like management might choose accounting estimates unfavorable to them, which is one of the major fraud risk factor in terms of opportunities that is available to them. And for every accounting estimates, there will be an estimation uncertainty. Because of uncertainty in the estimate is there, we call it as estimate first of all. The possibility, susceptibility means nothing but possibility. The possibility of an estimate to an inherent lack of precision. What is an outcome of an accounting estimate? Whatever the estimate, suppose I have taken useful life of the asset is the estimate. What is the outcome of that estimate? Depreciation is the estimate. Depreciation is the estimate. Now, what is the auditor's responsibility? First, auditor has to do risk assessment procedure. Then he should understand how management is identifying the need for estimate. Then he will understand how management makes the estimate. Then he will has to verify estimation uncertainty. Then he will see how the management is recognizing and measuring it. Then we will obtain finally reasonableness of the estimate and will come back to reporting. This is the structure of the standard. Getting it? Now, so look at what is the risk assessment procedure related to this one, or else directly obtaining and understanding. This is important point. Inside this, the C point is very important. So what auditor has to do? The auditor risk assessment procedure. Why? See, auditor will do risk assessment procedure. What risk assessment? He will also try to identify where and all accounting estimates are required. Where and all accounting estimates are required, auditor also will try to identify. And he will then see what management did. That is what exactly risk assessment means. So first he will see what management is doing, and he will also try to identify what are all the areas where accounting estimates requirement is there. Then he will inquire the management. He will inquire the management. Are there any changes in circumstances? Are there any changes in circumstances? It may be in the business circumstance, it may be in the reporting circumstance, it may be regulatory circumstances, whatever. Are there any changes in circumstances in the business, in the regulatory, or in the environment? Are there any changes? Why? Changes in circumstances may lead to revision in accounting estimate. Not only this, these are the, because of the, these are the circumstances that indicate, yes, there is a requirement for an estimate. Like changes in circumstances means what? Whether entity has engaged into new type of transactions. Suppose company has launched a new product. Till date the company is not dealing with that product. For the first time the company has launched electric cars. Till date they are not using, they are only using like internal IC engines, getting like combustion engines, getting it. So till date they are using only the fuel based engines. Now the company first time launched electric cars. How much provision should be created on electric cars? Should it be the same provision for warranty claims, just like how my normal fuel based engines, how much I create provision? Should I go with the same norm? Definitely not. The new type of product is launched by the company, which means estimate making process for these products must be different. Correct? Whether terms of transactions have been entered into by the company changed. Generally for all the normal cars which the company manufacture, they give 2 years warranty or 1 lakh kilometers, whichever is earlier. That's a standard warranty. But for electric cars, company is giving 8-year warranty, 1.5 lakh kilometers, whichever is earlier. They are giving what? 1.6 lakh kilometers or 8 years, whichever is earlier. And for the battery, whatever is there, further they are giving 12 years warranty. So terms of contract have been changed, terms and conditions have been changed. Obviously, the warranty provision related calculations, all that will drastically affect. Whether accounting policy related to estimates have been changed. Maybe for fuel based cars, I use some different accounting policies for calculating, whereas for electric cars, there are some well accepted, generally accepted accounting policies that are there exclusively for electric cars. How to account electric car sales related thing, especially provision related thing, how to account, there are some international gap data is available. The company is following that. Regulatory or changes outside the control. Since the company is manufacturing electric cars, the company is liable to create provision for taking back the car after the expiry. In the sense, after the car life is over, this company who manufactured, they only have to decommission it. They only have to dismantle it. You're getting it. They only have to treat that waste. Regulator has made a condition on every company manufacturing electric cars. It is not the consumer who is responsible to dispose that electric car. It is your responsibility to dispose the car after the useful life of the electric car. So regulatory changes are there, or new conditions or events are identified. Some new conditions or events are identified that requires an accounting estimate. For example, cars are, electric cars are suddenly being stopped. So many consumers are complaining of non-reliability, or so many consumers resale is high. Like these are all various factors that results in either creation of a new estimate or revision of an existing estimate. Understood? A wonderful example it came. In the class also I didn't give this example, but in class the different example I give. Suddenly it strikes, electric car example suddenly give. Next, suppose if at all management failed to identify an estimate. Suppose if management failed. See here, what are we checking in this point? We are identifying how the entity identifies estimates. How the entity identifies estimates based on the circumstances. What do you mean by circumstances? What products they are dealing with? What are the terms and conditions? What are the regulatory requirements? What accounting policies? Are there any new conditions or events? Now, same way, we need to verify how changes in accounting estimates they are making. Generally, an accounting estimate change is required if there is a revision in circumstance. So, what do you mean by revision in circumstance? Whatever circumstances, there are changes in that. Changes in type of product, changes in terms and conditions, changes in law and regulatory framework, changes in accounting policies, changes in events and conditions, resulting of new events and conditions. What if, after analyzing this, you understood there are some accounting estimates which management failed to identify? There are some accounting estimates which management failed to identify. Upon inquiring regulatory requirement, I discovered that disposing cost of the batteries after the end of life, disposing cost of the batteries at the end of the life of the car, that is the manufacturer responsibility. But company did not create provision for it. They did not create provision for it. Then I need to look into the root cause of the reason. Why they didn't create the provision? Is it because they don't understand this framework or this requirement, or is it because of the negligence of some staff, or intentionally they did? Suppose if I find there is no such evaluation within the company to evaluate the regulatory requirements, like in order to create an accounting estimate, you need to see from where a requirement comes, we don't know. Framework may tell you, applicable framework may tell you to create an estimate. Accounting policy might tell you to create an estimate. Terms and conditions of the contract will tell you to create an estimate. Products that you're dealing with might create an estimate. But in that estimate making process, no, when I see the control document, no, company does not include regulatory requirement. The company does not include regulatory requirements or changes in regulatory requirements. They didn't include, which means it's a control deficiency. It means what? It's a control deficiency. And since this control deficiency is impacting a large item in the financial statement, it's called as a significant deficiency. What is it called as? Significant deficiency. They'll give you an MCQ on this. Management failed to identify an accounting estimate. What should be the auditor's response? Auditor will modify the opinion. Auditor will report to those charged with governance. Option B, auditor will consider that as a significant deficiency in internal control. Auditor has to evaluate whether whether failure to identify constitute significant deficiency. So the standard says determine whether there is a significant deficiency regarding entity's risk assessment process. Clear? Then, okay, I understood. I did risk assessment, where and all in this entity estimates is required. And I also verified how management is making estimates. I mean, in the sense, how management is identifying estimates. Sorry, how management identifies the estimate is this answer. How management is making estimates, that is a different answer. How are they identifying? How we identify whether an accounting estimate is required or not? Look at the products you deal with. Look at the terms you are offering. Look at the accounting policies. Look at the framework, legal and regulatory applicable financial reporting framework. Look at any circumstances, events, transactions that are newly arising. Yes or no? If they fail to identify, is the failure because of the control weakness? Determine that. If at all it is a control weakness, significant deficiency, communicate it to those charged with governance. That is what 265 says. And follow up whether they remedified or not. Yes or no? Now, having understood how the company identifies estimates. Okay, they identified decently, covering all the areas that requires an estimate. They're covering all the areas. Now, how are they making it? Now you need to understand how are they making it, what method they are using, what model they are using, what controls they implemented, whether expert has been used or not, what assumptions they are using, are there any changes in methods for making these estimates, whether management has considered estimation uncertainty, while making the estimate. And auditor shall review the outcome of accounting estimate. Auditor shall review outcome of the accounting estimate that is made in prior period. Further, see how management is making estimate means, if at all estimate is made during the current year of audit, you verify what method they are following, what model they are following, what assumptions they are using, whether they are using an expert or not, are there any changes in these particular methods and all. I evaluate all this, and I will also see whether estimation uncertainty considered or not. I will see. Definitely estimate is not an accurate, some uncertainty will be there. Whether uncertainty is considered or not, I will see. In addition to that, some estimates, they just brought forward it from prior period. And they are using it. They are using it the same estimate. They are continuing in the current year also. Whether re-estimation required or not, you need to check. Correct? Prior period decommissioning liability they recognized. At that time, whatever the liability is recognized, it is dependent upon the data available at that time. Now the data might have been changed, circumstances might have been changed, assumptions might have been changed. So re-estimating the brought forwarded estimates, nothing but. In this, on this, there is a previous year question on this, which is given in the ICA book itself. Here the company said, auditor want to verify whether re-estimation is required for an accounting estimate made in the prior period. So auditor is asking data from the company regarding prior period estimates. Management said, you are doing current year audit only, prior period audit, why it is relevant for you? Auditor for that, no, he is replying, look, I have a standard 540, as per that standard, the auditor shall review the estimates that were made in the prior period. I need to review that estimates, and if required, whether re-estimation is required for the current period or not, I have a duty to review. So you cannot deny me. Moreover, I need to tell them, look, this is an estimate only. Outcome will be real outcome will be different. So this is an estimation, the actual outcome might be really different. You know, I want to know, so like for some estimates, in the last year, there would have been actual outcome this year, right? The real outcome would have been there, right? Like in the sense, in this year, a transaction would have materialized, right? For example, I created warranty provision in the last year. This year, warranty expenditure incurred is substantially higher amount. I need to look into previous period estimates to judge quality of estimate making process. I want to judge quality of estimate making process. How are you estimating it? See, current year estimate, I understand. How are you estimating it? Previous year estimates, have you estimated reasonably? Current year, some actual transactions will give the evidence for that. Current year audit procedures will give evidence for previous period estimates. Like auditor will consider effectiveness of management's prior period estimation process, from which auditor can judge likely effectiveness of current period estimate. I want prior period estimate data to understand how logically, reasonably, realistically you are making estimate. So that estimate, it would have resulted into some actual settlement this year, right? Both I will compare. That will give me an idea whether your estimate making process is genuine or not. So that is the reason why I want to review prior period estimate. Further, whether I will also get information regarding whether re-estimation is required or not. Because last year you have used some data for making an estimate. Same estimate you are continuing. Is there any changes in the data? I want to see that. So audit evidence, like I also get what? Estimation uncertainty. I also get information about estimation uncertainty. Whether it is properly disclosed or not also I want to see. So therefore management is not correct refusing the auditor. Management is not correct in refusing the auditor. By the way, we are reviewing prior period estimate. Is it with an intention to judge, or is it with an intention to question management process? No. We want to see how effective it is, so that current year process effective or not, I will get an idea. I am verifying prior period data to understand whether re-estimation is required or not. For that reason I am taking. It's not to identify prior period item. It's not to identify an error or omission in the prior period. No, that is not the purpose. Clear? All of you. This itself can be asked as a question, and it was asked. Many times it was asked. Auditor is asking prior period data. Getting it? And management is denying. Fine. Then suppose how management is making estimate. One of the point you need to verify is what? Is estimation uncertainty considered or not? Suppose estimation uncertainty is there. Estimation uncertainty is there, and that too the estimation uncertainty is very high. The auditor has classified the estimation uncertainty as significant risk. The auditor has classified it as significant risk. Then what auditor shall evaluate? Auditor shall evaluate whether management has performed sensitivity analysis. Sensitivity analysis. Whether management has performed, I think in AFM you have this word. Sensitivity analysis. What is sensitivity analysis? Changes in factors leads to changes in the actual outcome, actual estimate. So whether management has considered alternative assumptions, why they rejected them, how present estimate is addressing the uncertainty, whatever present estimate you did know, how is this evidencing uncertainty? Significant assumptions, are they reasonable? Whether applicable framework related has been properly applied or not. Whenever an estimate involves high estimation uncertainty, once again check whether are there alternative assumptions possible, why they rejected so many other options, why they selected this option, whether applicable framework is correctly applied, whether significant assumptions chosen are they reasonable, genuine. You need to verify that. Suppose if estimation uncertainty is not answered, management did not answer, they did not conducted any sensitivity analysis, nothing, no workings. then you have to develop a range. The auditor has to develop a range, means auditor will design, auditor based on the data available, auditor will develop the estimate and see the reasonableness of the management's estimate. He will evaluate the management estimate. Like, what is auditor's range? What is auditor's range? Very simple. Auditor's point of estimate or auditor's range is nothing but it's an amount, range of amount derived from audit evidence for use by auditor to evaluate management's estimate. Management has estimated something which involves high uncertainty, which they didn't address. To verify whether it is reasonable or not, I will develop an accounting estimate and I will verify the management estimate. This auditor's range will be developed when there is an estimation uncertainty giving rise to significant risk. Management has not addressed it. That time only we will develop our range. Correct? They'll give you MCQ like this. What will you answer? Under what circumstances auditor will develop an auditor's range or auditor's point of estimate? When auditor will develop this? What will you write? This answer. When management failed to address estimation uncertainty. Getting it? Next. Then we will have to do, we have to verify recognition and measurement criteria. We have to verify recognition and measurement criteria. Like here we will verify very simple. We will verify whether applicable financial reporting framework, whether the applicable financial reporting framework has been properly applied, whether management decision to recognize or not recognize. Like some cases, they may recognize an estimate. In some cases, they don't recognize at all. It doesn't require. Is it okay under framework? You should check. And whatever management basis is there, like basis means nothing but the data, how the management is making estimate, check that. Specifically what I will check, I will test check the data used by management. I will evaluate whether methods used, assumptions made, are they proper in the circumstances? Whatever methods they are using, whatever models they are using, whatever data they are using, are they proper? Suppose the accounting estimate is based on some data, whether the data is accurate, whether the underlying data is complete, whether the underlying data is relevant for this entity. Sometimes they use external data. For example, insurance companies, while calculating provision for actuarial liabilities, they use market data. Whether that data, what is the source, what is the relevance, what is the reliability, and recalculate the estimate, whatever they made, right? You apply recalculation, whether the computations are right or not. Test check the controls, look at the internal controls. These are all nothing but what? Further audit procedures. These are all nothing but what? Further audit procedure. In this is compliance procedure. This is substantive procedure. This is compliance procedure. Test check the effectiveness of controls. That is compliance procedure. Testing the data, verifying external data, whether recalculating. These are all substantive procedures. Auditor will evaluate the methods, right? That is also a substantive procedure. Test check the data. That is also substantive procedure. Not only that. Identify, is there any subsequent evidence available? As on 31st March, they created some provision for some electric cars, some amount. But you are doing audit report, you are preparing audit report somewhere by July mid. 3.5 months gap is there. Within this 3.5 months, what are the claims were lodged with the company for warranty purpose? See how much claims they lodged and how much is the condition provision they created per car. You can calculate. See whether the provision is reasonable or not. Subsequent conditions, if at all they indicate that provision is underestimated, you ask the company to revise. Subsequent evidence also you have to verify. Up to which date? Up to auditor's report. Even occurring up to the date of auditor's report. Subsequent evidence also you should verify. This is substantive procedure to verify accounting. Or this I can call it as, this is nothing but response to the auditors. Response to the risk assessed. So whatever the risk you assess, now how do you respond? You are getting the point. Now you recollect the standard structure. First, you first do risk assessment of how the entity is identifying estimates. What are all the estimates that the entity did not address? How are they making the estimates? And is estimation uncertainty addressed by them or not? And now you need to verify recognition measurement in books of accounts by actually performing the audit procedure. Thereby you will understand whether the estimate made is ultimately reasonable or not. Finally, evaluate the reasonableness. Evaluate the reasonableness in the context of applicable framework. Are you clear? Finally, reporting and disclosure. What is the reporting and disclosure? I shall obtain sufficient appropriate evidence whether accounting estimates getting it, they are all made in accordance with the requirement of the applicable framework, and specifically estimation uncertainty related to significant risk, you must disclose it. You must disclose estimation uncertainty related significant risk and get a written representation that significant assumptions used in making estimates are reasonable. Whatever significant estimates they are making on assumptions, they are reasonable. You can also get representation for some other, whether data used by the management is complete, accurate. You can ask a representation whether assumptions used are reasonable or not. You can ask a representation whether controls implemented are sufficient or not. You can ask a representation whether controls are operating effectively or not. Are you clear? All of you. Finally, you need to document. What you need to document? What is the conclusion regarding reasonableness, and is there any management bias? For example, I will show you this Tata Motors. We'll see Tata Motors estimation uncertainty. Yes, you see here, estimation uncertainty is considered as a key audit matter. Remember, key audit matter, one of the factor is what? Significant assumptions, significant estimates, significant judgments. Yes or no? That is one of the factor. So they selected it as a key audit matter. So what they evaluated under Ind AS 109 financial instrument, where you need to provide elements for loan losses determined using expected credit loss estimation model. Means they are using accounting standard applicable financial reporting framework model. You have this in syllabus? Yes, sir. The estimation of expected credit loss involves significant judgments and estimates. The key areas where auditors will judge, will verify. First they verify the data, then they verify the model, then whether any adjustments, qualitative adjustments are required. Next, that's it. These are all the points that were involved. So what auditor verified? Auditor verified first operating effectiveness. Auditor verified controls over it. Auditor verified controls over application of the criteria. Then auditor verified some management's calculations, all that. Yes or no? Then the auditor verified controls. The auditor verified operations over technology. Like various details he verified. This is a separate matter, I think. Yeah, this one. So the same points, whatever we have seen here, the similar points only covered. Like here they are talking about really what controls are verified, all that. Next, like regarding this, there will be a disclosure requirement also. This is a notes to account. This is notes to account, usage of estimates and judgments. Like you see, in particular information about significant areas of estimation uncertainty, they are given some notes. Like what are they? Impairment of goodwill, PPE, recoverability of deferred tax, provision for product warranty, asset obligations, employee benefits, financial receivables, discounts paid to dealers, something, going concern assessment. These are all estimates only. These are all estimates only. So you will find disclosures for estimation uncertainty in these financial statements. That's it. The standard is over. Easy. Hardly 40 minutes we spent. Understood? Yeah. So now you see, like if you read the subject like this, why don't you remember? Without understanding, if you read 10 times, 20 times, you will still not remember. If you understand, like if I ask you now how management is making estimates, methods you need to evaluate, models you need to evaluate, data what they use, assumptions what they use, uncertainty considered or not, easy. You need to contextually understand. In that way, if you learn, easy to remember. Suppose management denied prior period data, we will not give you. You should convince them. First it is required under standard. Why I should evaluate prior period? Logically they explained. Yes or no? So considering like whatever the real situations we see, in an entire auditing is the most practical paper. People ruined it. It's the most practical paper. For every line I will show you a real example. For every word you give me, I will show you a real example. So it's like very, like, you know, because we are unable to connect to it, we classified it as a theory subject. The most practical subject. Very popular and practical subject. And in fact, for FR, you can't see some examples even for certain items. But audit, at least you can see 100 out of 100 examples you can see for 100% of the syllabus. So it's all about visualization, exposure, all that. Fine. So We'll continue just 2 minutes. After 2 minutes, we'll continue. We'll begin SQC and 220. Huh? If that is also completed, Pakka SQC 220, 10 marks. 5 to 10 marks weightage. And by the way, this standard 5 marks Pakka. Mostly either in MCQ it will come or in descriptive it will come. Standard on quality control and SA 220. Both the standards are highly interrelated. SQC, what exactly standard on quality control is talking about? You need to understand this background story. Without understanding which, it's impossible to understand this quality control standard. For example, I hope all of you are going for art. I mean, you all, majority of you have been to articles. You know, in audit firms, for example, you see audit firms. Suppose I started one firm, for example, and I'm the senior partner in the firm. If a new client approaches, on what basis I will accept the client? On what basis I will take up that particular client relationship? I evaluate certain parameters and then take up the client, so that I will not violate code of ethics. I will not make myself into a risky position. So I evaluate certain parameters like client integrity, client honesty, client credibility in the market, how he is dealing with accounting, how his business practices. So many I evaluate, so that at the end of the day my firm should not be in the news at the end of the day. So that's my objective. So I evaluate like this, and parallelly I also evaluate what are the ethical requirements I need to comply with. If I have to take up this client, I must not have some shares in that client. I must not have business relationship. Not only me, my relatives, my network firms. There are some guidelines which are there. I will have to verify that also. I verify that also. And I verify various other factors. And most importantly, I verify my competence first of all. This company is engaged in insurance audit, insurance business. And they are asking me whether can we recommend you as an auditor. I never did audit of insurance. So I need to check my competence also. Not only that, already right now I have team. So many members were there. Enough articles and all, paid assistants, managers, everybody are involved in audits. Already right now we are having shortage of manpower. Now again, this new client, that a very big company, insurance company, listed entity, I need to give 1,000 mandates. 1,000 mandates I need to allocate to them, which is impossible for me. So I need to check the client integrity, reputation. I need to check ethical I'm fit or not. Most importantly, I need to check whether I'm competent or not, whether I have capability, whether I have ability to satisfy the client, whether I can honor the commitment or not. All these points I will check. Suddenly, I went for some, some abroad for some family trip. Some 2 months I went. My another partner is there. And another client approached at that time. He's continuously calling me. Already I'm on roaming. Okay, he's continuously calling me. WhatsApp call, let's assume. So, he's continuously calling and asking what points I should ask. Then the client is replying, again he is calling me. Hey, what should I check here? The client is asking like this, what should I check here? Now tell me, like every time this issue arises, right? What if I design a document? What if I design a document and implement set of questions? Whether I am there or not, dear partner, you take this document. You ask all these questions to them. You get entire this data about them. And see, I prepare that entire checklist in such a way that you just see that point, yes or no, you decide. Out of 100, 80 plus yes, you got answer. Accept the client. Otherwise, reject the client. So I gave a checklist like this to him. Simple checklist I gave him. This is called establishment of a policy. What is this called as? Establishment of a policy. Here right now in this example, I designed and established a policy for what? Acceptance of a client relationship. Getting the point? This is one of the element in a firm, right? This is one of the element in a firm. See, ultimately, whatever you do in your firm, whatever the report you are going to issue, it should be appropriate. That's the primary objective. Whatever you implement, whatever you follow in your organization, in your audit firm, it doesn't matter to outsiders. Ultimately, the report that you are issuing, is it proper? That is what really matters. whether you are performing audit, review, assurance, related services, whether are you performing them in compliance with the professional, ethical, technical standards, legal and regulatory framework. That is what our responsibility. Correct? We need to check whether the firm, the services provided by them are in compliance with the standards, legal and regulatory framework. And ultimately the report which we are issuing, is it appropriate or not? The report we issue is right or not? To ensure this, there are so many ways you need to take precautions. First of all, when you're accepting client itself, from that moment itself, you should take precautions. Some clients know they're aggressive, very aggressive business practices, aggressive relationship with the governments, with bureaucrats. You can't handle that client that easily. Don't accept those kinds of clients. Now, in my absence, if other partner has to take a decision like this, how come he can take a decision? So what I am doing, I am establishing policies for this. Then he accepted the audit. He need to start the audit right. He need to perform the engagement right. For performing engagement, he is again asking me, partner, tell me what should I check in this? I am new to your firm. No, your firm policy I don't know. How do you verify? I worked in earlier another firm, 5 years I worked. I know how to verify as per them, but you will not accept me if I verify as per them. You have your own business style, right? He is asking me. Oh, which means for performing engagement also, I must implement policies and procedures. Fine, I implemented. Then he is asking me, I need to give engagement letter. I need to establish terms. I need to verify ethical requirements. He again called me. Tell me what are ethical requirements. I left professional ethics as choice. For example, he's again calling me. Tell me what should I verify in ethical requirements. Oh, fine. This fellow doesn't even ethical requirements. Let's do one thing. Whether they studied all the questions in CA final or not, I don't know. Let me design a document for verifying ethical requirements, compliance with ethical requirements. Getting it? Like this. Now again, another situation. Manpower is required now. Now they need to announce advertisement for manpower, paid assistance. We want all that. How to conduct this interview? How to recruit them? How much to fix with them remuneration? How to train them? How to promote? How to give them increments and all? Like entire all HR questions is asking me. So what should I do again? I should establish a document for HR. I should establish documents for HR. Then whenever he is verifying, he is again asking me. Should I save this paper? Should I save this paper in the file? Should I save that soft copy? I verified it. Should I document it? So for that also I should establish policies and procedures. So I should establish policies and procedures for compliance with ethical requirements. I should establish policies and procedures for acceptance and continuation of client relationship. I should establish policies and procedures for engagement performance. I should establish policies and procedures for human resources. Whether all these are working correctly or not, I must monitor, right? I should establish policies for monitoring. Understood? If at all entire this has to function well, I must take the leadership responsibility, right? Who should take leadership for this? For that I should establish policies and procedures. Understood the logic? That is quality control. Very simple. Today you are going to Domino's, KFC, McD, so many international franchisee food chain. Wherever you go, the taste is 95% same. The quantity is 95% same. The texture is 95% same. May not be 100%, but 95% accuracy they achieve. Why such a kind of quality is achieved everywhere? Because the pizza making process, McDonald's burger making process, the Coke manufacturing process, you know the Coca-Cola that you're drinking, whatever you buy in the nearby locality, that is manufactured in nearby locality. But the company Coca-Cola headquarters is in somewhere in the US. How come Coca-Cola is achieving that quality? Because the process of making that product is standardized. That's called standard operating practices, standardization. Are you getting it? The same standardization we are implementing in audit forms, so that whether partner A performs the audit, partner B performs the audit, partner C performs the audit, partner D performs the audit, article A, article B, junior article, senior article, doesn't matter. At the end of the day, they have to perform as per my document, as per the policy and procedure which I establish, so that whatever work they do, it is in compliance with the standards, it is in compliance with law, it is in compliance with regulation. Whatever report we issue, it is appropriate. For that reason, I should standardize the processes. Standardizing processes means establishing processes. Processes means policies and procedures. That's it. Are you clear? SQC talks about the firm should implement quality control policies and procedures to give a reasonable assurance that the firm and its personnel comply with professional, ethical, technical standards and legal and regulatory requirements, and the reports issued by the firm are appropriate. That's the objective. You see the objective? The objective of the standard is what? The firm shall establish quality control policies. First point you see, designed to provide it with a reasonable assurance that the firm and its personnel with the comply with the professional standards, legal and regulatory requirements, and that the reports issued are appropriate in the circumstances. See how we derived it? You are getting it? You should not remember entire auditing standard, entire accounting standard. We follow not because it is there in that. Whatever we follow, only there in that. You're getting the point. What we do is made in the standard, not standard says and we are following. What we do is implemented in the standard. So from us only standard is developed. We were not evolving from the standards. That's it. So SQC talks about designing and implementation, establishment of policies. That's why you see, if this entire practice is called as what, you know, quality control. This entire policy is called as what? Quality control. In order to achieve the quality, in the service that we provide, we need to control the processes that we are doing. Quality control policies and procedures. The firms should establish policies and procedures for leadership responsibility, ethical requirements, acceptance and continuation of client relationship, human resources, engagement performance, monitoring. Then what SA 220 says? SA 220 says, engagement partner shall take 100% responsibility for implementing the quality control policy. SA 220 talks about implementing the quality control policy that is established by the firm in compliance with SQC. In compliance with SQC, whatever the quality control policy the firm has established, SA 220 has to implement it. Whereas in assurance engagement, related service engagement, specialized areas, in these three cases, implementation of quality control point is discussed within the respective standard itself. They didn't discuss separately. Whereas in auditing standards, implementation of quality control is discussed separately. You are getting it? Because audit is the most, most important service that we provide among various other services. That's why auditing standards were drafted with much more care, where the vagueness is avoided to a great extent. Whereas you see 2000 series, 3000 series, 800 series, some vagueness will be there. You're getting it? Of course, they are all mostly, the users are limited users. Those reports are used by limited users, whereas audit report is used by wide range of users. Are you getting the point? So, normal engagement standards, auditing standard, review standard, assurance standard, related service standard, these are all talks about quality control, but they're talking about implementation of quality control. Whereas standard on quality control, this standard talks about establishing the quality control policies. So you see everywhere, SQC1 requires a firm to establish policies. Yes or no? Everywhere you see, a firm should establish policies and procedures for acceptance and continuation of client. So here also the firm should establish policy and procedure. Actual original standard starts with, but they directly discussed into the matter. So for everywhere, monitoring activities, everywhere, the firm should establish policies and procedures. This is also, the firm should establish policies and procedures. Engagement, finally, documentation, firm should establish policies and procedures. Monitoring, the firm should ensure that policies and procedures, nothing but establishing policies and procedures for ensuring these policies are followed. So these are all 6 elements of quality control. Sometimes, very rare, they'll give you what are the elements of quality control, which is a simple question, but don't expect like that. Okay? So mostly you will be asked questions. I will only discuss in the standard key questions, key provisions, not everything. So first let us discuss acceptance and continuation of client relationship. Acceptance and continuation of client relationship. In the recent May 24, first question is this only. And every time whenever I discuss this standard, first point I tell this only. Now, by the way, every element in the standard is equally important. So don't miss the, don't conclude this question is asked 10 times in exam, so it will come this time also. No. Yes or no? Like it depends upon the examiner mindset, paper setter mindset at the time when he's designing the paper. That's it. On the day of designing the paper, he made a fight with his wife, for example. That's it. You are going to get a rock solid paper. Okay, fine. Acceptance and continuation of client relationship. So what points we should consider while accepting client relationship? A firm before accepting an audit or engagement, like you see, by the way, in SQC, they never refer to any particular type of engagement. They generally refer it as engagement, because SQC deals not just with, you see the heading of the standard, quality control for firms that are performing audit review of historical financial information and other assurance and related services. So the heading. So quality control is for all engagements that you perform. Now, so a firm before accepting an engagement should acquire vital information, correct? Now tell me, is this not the information generally we obtain while we are marrying others? Integrity of them, ethical requirements, yes or no? Integrity of the client, I think bad joke. Promoters and key managerial persons, integrity of the client, promoters and key managerial. What do you obtain? What information you obtain regarding integrity? What is the identity and reputation of the client? What are the operations and their business practices? What is the attitude of the client to owners, top management? What is their attitude? Are they aggressively concerned about our fees? And is there any limitation on your work? Is the client involved in money laundering? Are there any reasons that firm should know? I mean, what are the reasons for they are appointing me? Why they are not reappointing the previous? All these points I should obtain. Whenever I'm thinking of integrity of the client, I should verify all these points. Further, second most important element, you should not just verify client is good or bad. You should also verify, can you do that work or not? Yes or no? You must know, you must have competence. For that, what you will check? I will check whether our firm has knowledge of the industry, whether our firm has knowledge of the regulatory, whether our firm has ability to gain the necessary skills or not, whether our firm has sufficient persons. Second point is competence, capability and availability of time and resource. So competence point you have to write, whether the firm has sufficient knowledge of the industry, whether the firm has sufficient knowledge of the regulatory. If not, do the firm have capability to get that knowledge? Third one, resources you need to check, whether the firm has sufficient persons with these capabilities. If at all I need experts, suddenly this is an insurance company, I need to do some actuarial verifications and all, whether do I know any noun actuaries can I discharge? So whether experts are available, whether individuals meeting the criteria to perform the review. There is something called engagement quality control review, for which engagements quality control review has to be performed. That is a question. For listed entities, audit engagement compulsory. The standard itself says, for audit of listed entities, engagement quality control review is compulsory. For other engagements, remember I'm not saying other audits. For other engagements, which may be audit of non-listed entity or assurance related service, all that other engagements, whether quality control review will be performed or not, firm has to decide. The firm has to develop a criteria. So generally quality control review is compulsory. Sir, what is this quality control review? Very simple. I am one of the partner. I have a team. We all completed the entire audit. Let us take an audit example. We completed the entire audit. And I, as a partner, whatever I told only, my team did that. As per my instructions, they worked on it. As per my instructions, they documented. Everything is clear. I want to take a second opinion. I will go to my another partner. Suppose I am a sole proprietor. Then I will go to my network firm partner. Suppose I'm not belonging to a network. Then I will ask some suitably qualified external person. I will ask a suitably qualified external person. I will call him. What I will ask him? You just come, see my working papers, see how I planned the audit, how I performed the audit, significant matters that I dealt in audit, significant estimates, significant judgments, what and all I have used. Check the independence requirement, whether independence is complied or not, ethical requirements complied or not. You check independently. Because you didn't involve in this audit, you don't know anything about this audit. If you check entire my working papers, whether I complied with the standards, whether my report is appropriate, you tell me. Only then I will sign the audit report. So this is called what? Quality control review. What is this called as? Quality control review, we call this as. So the person conducting this review, we call him as quality control reviewer. Quality control reviewer shall do an objective evaluation of compliance with ethical requirements, independence, shall do an objective evaluation of significant matters and decisions that we have reached, significant conclusions that we have reached. Quality reviewer will verify whether we have taken proper consultation or not, whether the firm, whether the team, engagement team have done proper consultation or not. Quality control reviewer will verify entire your process of audit, and he will give a no objection. Then only I will sign the audit report. That is called quality control review process. The quality control review must happen before signing of the report, before issue of the report. Are you clear? Now, for which engagements quality control review is required? Don't straight away say audit engagements. No. Quality control review is important, compulsory for listed entities audit engagements, and for other engagements as per the firm criteria. That's it. Understood? Now, so the auditor has to check competence point. In exam they'll ask you only competence point 4 marks question. One of the important element the auditor has to consider while accepting and continuing a client relationship is verify competence of the engagement team to perform that engagement. What points in this regard you consider? Examples. Whether firm personnel have necessary knowledge of industry, regulatory requirements, can we get those skills? Whether do we have necessary persons, sufficient persons, whether experts are available, whether quality control reviewer be recruited, whether firm is able to complete the engagement as per the deadline given by the client. Availability of time, resources you are checking, competence you are checking, capability you are checking, and final third requirement is what? Compliance with ethical requirements. What do you mean by compliance with ethical requirements? We have a separate element. What do you mean by compliance with ethical requirements? You have a separate element. There we can discuss. Clear? Now, when this information firm should obtain? Before accepting a new client or before continuing an existing client with an existing engagement? For example, I have been auditor for one of the entity, 5 years, 1 term completed. Now they are asking me to reappoint for another term. Should I say yes or no? This is a question. At that time also I should check all these points. Not only that, existing client is asking me to take a new assignment. Right now I am a stat auditor only for existing client. He is asking me, sir, can you do tax audit also? That time also I will see all these points. Are you clear? Next, suppose if there is any conflict of interest between the firm, if there is any conflict of interest between the firm and client, this itself they can ask as a 4 marks practical question. The firm has obtained data that if at all the data is available earlier, the firm would have declined. So how do you deal with this situation? Like you need to tell the firm should obtain necessary information before accepting a new engagement, or while continuing an existing engagement with an existing client, or while accepting a new engagement from existing client. Then if at all there is a conflict of interest between the firm and the client, like for example, what do you mean by that? If at all the information is obtained earlier, the firm would have declined it. They would have not accepted this audit. In that case, what the firm has to do? Look at the responsibilities that are applied to the circumstances. Look at the responsibilities do you have. For example, you came to know that you are disqualified. After being appointed as an auditor, after certain days, you came to know that disqualified. Here, what is the legal responsibility? You are vacated from the office already. Casual, deemed vacation. What is your responsibility? You have to report to the persons who made appointment. Sometimes you may have to even report to regulatory authorities and see possibility of withdrawing from the engagement, sometimes entire relationship with the client. See, if there is a conflict of interest between the firm and the entity, see what are your professional legal responsibilities, including whether you have to report to outsiders, whether you have to report to client, and see whether withdrawal is possible. All these possibilities you should check. All these possibilities you should check, keeping in mind the prevailing law and regulation. Correct? Now, suppose you decided to withdraw. You accept, like you see how beautifully the points are crafted here. First they spoke about when you can accept an engagement, on what basis. This basis you should consider when. Suppose you accepted, later you got to know that you are not supposed to accept. What you should do? You suppose you decided to withdraw. How you should withdraw? That also quality control policy is given. How you should withdraw? Just like that on white paper, I am resigning, you can't say that. There is a policy for that. What is it? Discuss with the client's management. What resulted in this? If the firm decided to withdraw, communicate to client management and those charged with governance about the withdrawal and reasons for withdrawal. Not only them, see whether do you have any legal regulatory requirements that you have to report the withdrawal to somebody. Consider that also. And document why you withdrawn, significant issues, with whom you consulted, what decisions you reached, and what is the basis for those decisions. Document. They will ask you a question on this. Like they'll give you a question. You have been appointed as an auditor of so-and-so entity. The auditor has accepted the audit after evaluating certain factors. After that, he came to know that the client is involved in the money laundering activities, and the audit firm decided, if at all the information is available to the firm at the time when they're accepting, the firm would have declined the engagement, and the firm now, after consulting with legal lawyer opinions, all that, decided to withdraw. For withdrawal, the firm should provide policies and procedures on withdrawal. What are those policies and procedures? They'll ask this question. This was asked. In one MTP or RTP, it was there. You need to write this answer. You're able to understand. Yes or no, quality control. It's not confusing. You have to get clarity. If you get a clarity, you will never confuse what to write for what. Understood? That's it. One of the important element and major element in quality control standard is acceptance and continuation of client relationship is over. Now, how to remember this point, I will teach you now. How to remember this? Your remembrance should not be the first step in your studies. In first step in your studies is first analyzing it, then summarizing it, then revising it, then remembering it. You're getting it? What I told? It's nicely came. Sorry. Analyzing it, summarizing it, revising it. What is the shortcode for that? Analyzing, summarizing, revising, remembering. ASRR. Nalla illa padam. Word is not good. Okay, fine. So right now what I did is I analyzed it to you. Now I'll summarize. You see how I will summarize. Acceptance and continuation of client relationship. Before a firm is accepting a client relationship, the firm should obtain information belonging to the client. What information? One, integrity of the principal owner's key management. What are they? Business identity, reputation. Better don't see it, like you see, because since I remember this, I will tell you. You see and read. You're getting it? Let us see and read better. Identity and business reputation of owners, key managerial person. What are the operations? What are their business practices? And what is the attitude of the clients' owners? How are they? Are they interpreting aggressively the accounting standards? Are they aggressively concerned with the fees of the firm so that it will be as least as possible? Is there any limitation? Whether the client is involved in money laundering? Why are they appointing us? Why are they not reappointing previous auditor? Yes or no? Then competence. The auditor has to check competence, including capability, whether you have a time, whether you have necessary resources. Competence means what? Of the industry, of the regulatory requirement, whether capability means what? Suppose I don't have knowledge. Can I gain the skill? That's capability. Correct? Whether do we have sufficient personnel? That is nothing but resources, right? Yes or no? Whether do we have experts? Nothing but resources, right? Whether we have quality control reviewer availability, that also a resource, right? Suppose if a listed company is ready to give audit, but I don't have quality control reviewers, I'm not able to find, I should not accept. Because I cannot sign an audit report without quality control review. If you sign an audit report without quality control review, that's a violation of quality control standard. NFRA also will punish you. Coffee day, this point also they highlighted. Quality control was there, but they didn't perform effectively. So reviewer is also fined, 50 lakhs fine. 50 lakhs I think fine on the reviewer. Or 25 lakhs fine on the reviewer. On the firm 10 crore, on the partner 1 crore, on the reviewer some 50 lakhs or 25 lakhs fine was there. Getting it? And I need to check compliance with ethical requirements. The ethical requirements means what? We'll discuss later. That's so indirectly this information when should I obtain? Before accepting the client relationship, before deciding to continue the existing client, before accepting new work from existing client. Suppose After accepting, I got to know something that if at all I know that information earlier, I would have not accepted, I would have declined. What auditor has to do? Can you continue or not? Look at your professional legal responsibilities, including, do you have to report the situation to any person who made appointment? Do you have to report the situation to regulatory authorities? See possibility of withdrawing. If at all possibility is there, you decided to withdraw, the firm should have policies and procedures for withdrawal as well. What policies? Discuss with management what action you're going to take. If you decided to withdraw, inform the top management about the withdrawal and reasons. Same thing you should inform to regulatory authorities also along with the reasons. And finally, you should document related to issues arisen in the withdrawal process, whom you consulted to resolve these issues, what decisions you have taken, and why you have taken that decision. This is summarizing. Now revise it. Getting the point? So by revising it, you will remember. Remembrance is a byproduct. You're getting it. If you directly without understanding all this, try to read what this firm, what the standard says, what this point says, I don't know, because it is important for exam, I'm reading. With this mentality, if you read, no, you will never remember. Questions are now completely logically framing. They are asking sub-elements, yes or no? They are asking sub-elements. They are not asking straight question, tell me these 3 points and if I will give you marks. No, they are not asking like this. Correct? So read the question thoroughly. What exactly they are testing. What exactly they are testing, you can map it only when you map the entire structure of the standard. Structure of the standard is important. Now one more point I will tell you. Whether you see from a flowchart, entire the standard is there in the single flowchart. I don't know how many of you analyze it like this. The flowchart is not a way for analysis. This itself is a proof that you can analyze better provided your understanding is better. So just because all the points are there in the flowchart, you will get a bird's eye view, but you will not understand without understanding this. Correct? So it's not flowchart, it's not some other book what you're following. Whatever you're reading, are you summarizing it before you revise? So summarize means this only. Suppose even in 540 I told what standard exactly dealing with. Then I read each and every element. Then I explained each and every element. After explaining each and every element, again I came back to bird's eye view and explained what are all there. So that's how you should read, learn the audit subject. Not just audit. This is the same methodology applicable for every learning. Whatever you learn, this is how you should summarize. This is nothing but a real life learning also. This is the same way we do the real life learning. Next. You implement this learning process, I'm telling you, you master any skill. Whatever the skill it is, you can master it. That's about one of the important element of quality control. Another element of quality control is human resources. Another important element is human resources. By the way, for acceptance and continuation of client relationship, 220 also contains the same matter. What 220 says? If the engagement partner should consider necessary information before accepting an audit engagement, that the firm quality control policies related to verifying integrity of the client, competence of the client, competence of the team, availability of the time and resources, compliance with ethical requirements. In case of previous client who is asking me to continue, my past experience also I will consider. What are they exactly? SQC gives detailed breakup. So SA 220, you see, that's why it's just a 4 or 5 points matter. Yes or no, in SA 220, acceptance and continuation of client relationship, it's a very small thing in SA 220, correct? Next, human resources. What human resources? Very simple. What is the objective of this element? At the end of the day, this element objective is what? I must recruit the right candidate. I must make sure he is competent. I must make sure he is aware of our firm policies and procedures, and then only I must use him in the audit. Correct? Not just that. Even in SA 220, what it says, selecting the right assistant. In SA 220, human resource is there. Actually, there it is like they have not addressed human resource separately. Within the engagement performance, I think somewhere they have addressed it. How they addressed it is the firm should select, the partner should select right assistant based upon skill, capability. Correct? In our firms, wherever we do articles and all, don't they do this? Senior article they'll take for big works, junior articles they'll take for clerical works. Correct? For any composition of engagement team. Exactly. So human resources. So the firm should establish policies and procedures so that the firm will have a reasonable assurance that it has sufficient number of people with the capability, competence and commitment necessary to perform the engagement, so that the firm and engagement partner issues the reports which are appropriate. Now these policies should address various HR issues. What are they? Recruitment process, compensation, training, career development, evaluation, all that. There should be an emphasis on continuous professional development of the team. That's why many firms periodically conduct training sessions. Every Saturday, once in 15 days, they conduct training sessions for their articles. Why? Continuous professional development. Are you getting it? So the firm should assign responsibility of each engagement to engagement partner. The firm should establish procedures. Responsibilities of partners are clearly defined. Identify and establish the role of the partner. Engagement partner has appropriate capabilities. HR policy should address these issues also. For so and so type of audit, which partner is suitable? Engagement team should be able to carry out its responsibilities with necessary skills and competence. The firm should ensure suitable people are available and groom their skills accordingly. And the firm should assess performance the partners and team members, keeping in mind their commitment towards the quality. These are all various things HR policy should address. Easy? Then another lengthy one and important one is engagement performance. Performing the engagement, it may be audit, it may be review, it may be assurance, it may be related service, whatever it is. Performing the engagement. Just 1 minute, okay? Okay, we'll continue. Engagement performance. Why we need to establish quality control policy for engagement performance? Very simple. Consistency in quality of services performed. Consistency in the pizza making process can be achieved only when the pizza making process is standardized. Same way, when we are performing engagement, consistency in quality can be achieved only by explaining team members what are their objectives, what processes they need to follow to comply with standards, how we need to supervise, how to train them. That's why you see in all big sized firms, they will have audit guides, they will have checklist items, they will have a questionnaires to do audits. Big Four and all, they have standardized questions to be followed for verifying any aspect. How to verify purchase, how to do going concern assessment. They will have some 2-3 worksheets on how to verify going concern. They just have to read that and check in the client, yes or no they have to tell, and the result will be given by the software. You're getting it? Consultation, like people are like worried about this automation on the profession of accountancy. Correct? People are worried a lot about this AI, artificial intelligence, and moreover Google itself is saying that, and people, especially our fraternity members itself, are saying tomorrow future CS and all will not require, because audits are being performed by AI itself nowadays, because that itself is throwing exceptions, all that. As long as you don't use AI, AI will replace you. You're getting it? So AI will replace a person who is not using AI. but it can't replace a person who is using AI. So you use all this ChatGPT, Gemini, Google Gemini, all this, all this, applications, and do much more effectively your audit. I use all this for my teaching. I use all this. Technically, I use whenever I have to research, I just use, hardly, it won't take much time. That is giving a beautiful results for everything. And adding to it, my understanding about the industry. I have some friends in many big four and all, so senior level role. I discuss with them, and that's how I update my knowledge. That's how I always give latest examples. Whenever the example happened, I can give latest example. So people connect to it. So as long as you are using AI and developing your skills, whatever service you are providing. Nowadays, what I'm doing, my English is actually poor. Basically, yeah, I'm a Telugu medium student, and I have a vocabulary. I don't have that much great vocabulary. I don't have. So what I do is, if generally, if I have to post some announcement on the YouTube or anywhere, whatever it is, I'll just announce it here. I'll just put it in the ChatGPT or somewhere, refine it and give me. I'll put command. It will give me beautifully. I'll just edit the names and all. I'll post it. It will give very beautiful. If at all it is not conveying exactly what I want, no, I'll just reply. Can you keep it in 15 lines? Can you keep it in 10 lines? Then it replies in within 10 lines. Can you make it as a letter format? It will give it in a letter format. This is called prompts, giving prompts to it. There is a course called prompt engineer. So popular it is becoming now. The prompt engineer course is becoming so popular. Pay is also very high for them, prompt engineers and all. What I did is not a prompt engineering. It's a basic level. Not even basic of the basic. Okay, so you can use it like this and make your presentations all that much more impactful. Fine. So consultation in difficult. No, fine. You see, engagement performance. Even ICI is now designing MTP questions, RTP questions, MCQ questions. Everything is based on ChatGPT. This one only, Google Gemini only. 100% I'm telling you, with accurate data. Right now I can create a question on this for you before you in Google Gemini. I did it in my regular class. Actually, it thrown a beautiful case study. It thrown a beautiful case study. Like I think I'll see. Shall I try now? Okay, fine. On this one question, we'll try. Like if at all you don't find a practical question, this should be the way. This should be the way. For example, right now what we have studied, acceptance and continuance, right? I have to create a case study on that. Fine, I'll do that. See, within 5 minutes, I'll try to finish a case study with 5 MCQs, very big case study. 5 to maximum 7 minutes, I can generate a case study. So what's the page number, by the way? This one, acceptance and continuation of client relationship. 4 not? 4. Okay, fine. Yes. Hey, it's not copying. Wait. I'll find. It's not an issue. I'll copy from your phone. Four not 4, right? Yeah, ready? Yes, just I'm pasting it. Yeah, I keyed in the data. Now I will ask, design a detailed case study to test 2 marks MCQs of 5 marks, sorry, 5 MCQs for my CA final students writing November 24 exams. Yeah, the case study. ABC Limited is a manufacturing company that produces electronic components in preparation of upcoming financial audit. The company management has noticed a significant discrepancy between the physical inventory count and recorded inventory. Key information: physical inventory, recorded inventory, sales, production records, all that gave. I think, just a minute. Okay, I think I need to again, just okay. Hey Gemini, you did wrong. Look at the matter I told. Look at the matter. I mentioned it first. Sorry? That's okay. Gemini will understand. I apologize for the oversight. Please provide me specific matter. You mentioned it first. Look at the first message I posted. Design a case study on, I will once again key in the data. Following. Yes, I think, now give a detailed case study. Best. Now give a detailed case study. There is something now, at least. Okay. I think now it is ABC Tech, a newly found startup, approached your firm to provide audit and advisory. The company had experienced rapid growth in the recent year, but facing challenges in financial management, internal controls. Key information: financial performance. The company has reported consistent losses in the past 2 years, but now there is a rapid growth. Internal controls. A recent internal auditors identified significant weakness in the company. Management team. The company management team is relatively inexperienced. Industry trends. The tech industry is experiencing rapid changes. I think let's appreciate it first and then ask MCQs. Yeah. No, they didn't ask. They asked direct theory questions. That's a good case study. Now give me 5 MCQs. 5 MCQs. Okay, first it will give MCQs. Yeah, given the company's financial performance, internal control weakness, what most likely reason of the previous auditor resignations? Probably lack of expertise, disagreement over accounting principles, concerns about the company financial. I think we need to read the full case study now. Correctly. So financial performance is like this, internal control is like this, Management team, the company management team is relatively inexperienced. Industry trends, the tech industry is experiencing rapid changes. The company previous or resigned due to concerns about the quality of the company financial reporting. But the answer question level irukku. Concerns about the company financial reporting. Correct? Option C, that's an easy question. Which of the following factors should the firm consider when assessing integrity of the management? Experience in the industry, previous employment history, financial interest in the company. Yeah, probably all of the above. Which of the previous employment history, it's generally not relevant, right? Financial interest in the company. Financial interest in the company is relevant. Ethical requirement. Yes or no? You remember acceptance and continuous client relationship. Third element is what? Ethical requirement. So interest in the company I should check. Previous employment history I should check. Means previous, suppose I'm already auditing this entity, for example. To address the identified weakness, the firm should recommend which of the following action? Implement a robust system, hire a qualified CFO, increase all of the above, all of the above answers only. If the firm accepts the engagement, what safeguard should be put in place? Require management to implement correctly, limit the scope of action. Hey, these are so easy MCQs. Give tough MCQs. Not easy. Wait, we'll see. Revised MCQs. Which of the following factor include given MCQ which does not contain all of the above option? Which does not contain all of the above. That's okay, it will understand. Now it gave. No. Again, it came the same. Like, you see, this is like a, actually, we have another GPT, CA GPT. CA GPT, of course, they use the same server. Questions will be same like only. Getting it? So you got a good question. WhatsApp beta. In that also you'll get, by the way. In WhatsApp also we have beta AI. They implemented very recently. You can put a direct query, and in that also it's nothing but ChatGPT integration only. That's it. So you can generate a case study like this. Sorry? Okay. Okay. I mean, I said ChatGPT general term. AI integration. That's what I mean. Okay, fine. See, you can ask here any point if you don't understand. If any point you don't understand, if you ask here, it will give you a real example. Practical example it will give you. You can use that for learning. But that much patience, why students will have? I want only 40 marks in audit. For that, why I should use AI? That's the response of the student. You ask it, oh, I want 40 marks, what should I do? It will reply saying study first. Yeah, fine. I'll complete this and then we'll take a break, okay? So fine. Engagement performance. So consistency is achieved only when the quality control is properly implemented. And obviously, on any difficult and complex matter, engagement team must consult, right? An engagement partner must provide such an environment where team members can raise their concerns, consultation, all that, correct? So there must be proper consultation on difficult and contentious, nothing but complex matters. What is consultation? Consultation is nothing but discussion with a person within the firm or outside the firm who have specialized knowledge, so that it improves the quality of judgment, decision making. Internally consultation can take place or externally consultation can take place. Whatever, to whomever you consulted, you should document the results of the consultation. In exam they'll ask you, write about consultation in difficult and complex matters. They'll ask you this question. Define consultation. Inside that you can consult within or outside people. The consultation will give you quality decision making. Internal consultation means what? External consultation means what? Document the consultation. Now the question is, quality control reviewer. Quality control review. By the way, can we do consult quality control reviewer also on any audit matters? Can we consult with him? Yes, you can consult, as long as he does not participate in the audit. He does not dictate the audit, process. As long as the consultation is to such a level, reviewer can be consulted. But if at all reviewer involvement in audit becomes too high, reviewer should be changed, or the person to whom you are consulting should be changed. That's what given. You see, What is engagement quality control review? Very simple. Significant judgments made in engagement should be reviewed by reviewer before report is issued. And the review depends upon complexity of the engagement, risk that might involve, engagement risk. To what extent quality control reviewer will review it? It depends upon the risk involved. It depends upon the circumstance of the engagement. And most importantly, this point, engagement quality control review, see, the third point actually says engagement quality control review is mandatory for all audits of listed entities, whereas in respect of other engagements, the firm should develop the criteria. And for listed entities, engagement quality control review is compulsory, right? What reviewer has to verify? He should verify independence. He should verify team's evaluation of independence. Who will do evaluation of independence? Team would have already performed. Reviewer has to verify whether the team evaluated properly or not the independence. What significant risks identify, what decisions they have taken, whether consultation has taken place on complex matters or not, whether corrected uncorrected mistakes identified which are uncorrected, whether they are properly answered or not, matters communicated to management and other regulatory bodies, whether they are all what are all the matters requiring communication, they are all communicated or not, whether working papers reflect work performed, whether report issued is proper. What engagement quality control review should cover? One, engagement quality control review, the review process should address whether firm has considered independence, whether significant risks identified or addressed, whether significant judgments made are reasonable, whether consultation has been taken place on complex difficult matter, whether misstatements uncorrected, corrected, all that were properly addressed, whether working papers are reflecting the actual work performed, means whether documentation is proper or not, whether the report issued is proper or not, he will check. Means he will check the entire audit process. And when he says, okay, your report is absolutely okay, then the partner can sign the report and issue to the client. Clear? Who will do this review? Review will be performed by reviewer. Engagement quality control reviewer. Who is a reviewer? He is a partner of the firm or another person, but he is a member of the institute only. He is a CA only, or maybe external person. When we will go for external person, if at all we don't have a partner or we don't have a reviewer, yes or no? So who has necessary capability and competence to act as an engagement? He must also be having the same eligibility like a partner. That fellow only can review. Not only that, in case of listed entities, engagement quality control reviewer must be an individual who has authority to act as an engagement partner in listed entities. Remember, for a banking company, engagement partner has some qualifications, number of years experience, number of years bank audit experience, like that some qualification are there. Same qualification must also be there for reviewer. Which means, just because the standard and quality control says another partner can review. Bank audit, I performed 20 years experience in bank audit industry, only I am eligible to do partner role. Same, the person who is reviewing must also have similar experience, right? So the ability of an engagement quality control reviewer in case of listed entities must have the similar abilities like engagement partner. You're getting it? Then it is necessary to maintain objectivity of the reviewer. Obviously, reviewer is only for review, reviewing your work, how you perform. Objectivity should be maintained. Therefore, participation in decision making process and the engagement, consulting him and all should be avoided maximum possible. If at all nature and extent of consultation with the reviewer becomes a significant, like we are unable to avoid, we are consulting with him on various issues, because in firm there is no other partner to consult. He is only one available to consult for doubts. If at all reviewer participation in audit becomes significant, change the reviewer or change the person to whom you are consulting. That's what this point says. The firm, in such a case, the firm policies and procedures should provide an option for replacing the quality control reviewer. Correct? Suppose if there is a difference of opinion. So reviewer has reviewed all the elements. Who is a reviewer? What he need to verify, what he should not why he should not participate in audit, all that we have seen. If at all he should not participate, but he already participated, firm should have a replacement option. Then if at all finally after review successfully completed, reviewer is not agreeing for the report you are issuing. Whatever the report you are issuing, no, reviewer is not okay with it. He is not okay with that. Can a partner ignore reviewer and give the report? No. If there is a differences of opinion between the partner and the reviewer, and engagement team and others, those with they consulted, If the engagement team and others with whom they consult, if there's a difference of opinion, or if the partner and reviewer, if they have a difference of opinion, within the team they have some difference of opinion on various issues, it should be resolved properly. Especially if the difference of opinion is between the partner and reviewer. Reviewer says adverse opinion, partner says qualified opinion is sufficient. It should be resolved by quality control practices. Look at what firm says. Look at what firm says. So it should be resolved by established policies of the firm. What firm will tell? Firm might say consult another CA or consult the network management. In case of network firms, they'll say go and ask the network management, they will tell you what should be done. Advisory board is there in the network, ask them, they will give you advice. Institute advisory board is there, audit advisory board, ask them, they will tell you what to do. Clear? This element is over. Engagement performance element is also over. Now tell me, an engagement is effectively performed only when it is effectively documented. Only when it is effectively documented. Therefore, the firm should establish policies and procedures to complete the documentation of various engagements in time. Correct? Especially the standard says if it is audit engagement, the entire documentation should be made ready. Assembly should be completed within 60 days from the date of audit report. So assembly point, they are dealing with what? Assembly of documentation. First 2 points are dealing with assembly. Then not only assembly, documentation once assembled, it should be freezed properly, it should be secured properly, confidentiality should be maintained, nobody should access this without authorization, nobody can change this documentation without authorization. Correct? Confidentiality and safe custody. Then the firm should retain the documentation right. The firm should retain the documentation right. This is talking about retention of engagement files, retention of files. For how long the firm should retain? It is decided by firm quality control policies. The number of years to ensure that monitoring activities are performed successfully. You see, in quality control, whatever works the firm is performing, no, they all should be reviewed again. That process is called as what? Monitoring. Whereas in listed entities, no, audit of listed entities, no, review must happen before signing the report. Whether audit is properly done, review happened, again this entire process followed or not, again firm monitoring people will assess. That is monitoring. Now engagement documentation shall be retained up to that time limit so that the firm can discharge monitoring activities functions. What is monitoring? You know, generally we completed audits, right? Audits, various other works. Once we completed, we will have some quality control department inside the firm. Big four entities will have quality control departments will be there. They will take up your working papers and they will see whether the big four, the firm's quality control policy is reflected here. Whether whatever policy is established followed or not here. They will review. And if they identify any lapses, they will levy penalty on the member firms. Network, some firms will be there, right? They will levy penalties on them. They will levy fines on them. If at all the member firm is not adhering to it, they will disconnect with the franchisee. They will remove them from the network. They will remove, KPMG will remove the auditor from the network because you're not complying with our norms. They'll remove it. So in network firms, this monitoring process is clearly evident. You're getting it. And further you see, in listed entities, 2-level monitoring. One is before signing the report, reviewer is monitoring. After signing the report, quality control team is monitoring. Again, external monitoring is there. Peer review board, quality review board, NFRA review. So many external reviews were there. Yes or no? And for audits, the standard says not less than 7 years you should retain an engagement. Minimum 7 years. From which date? Date of audit report or group audit report, whichever is later. Group audit report means if consolidated financials are there, then the consolidated financial statements audit report is there. From that date, 7 years. Then the firm should have monitoring process. The firm should have monitoring. Inside this itself can be given as a 4 marks question. The quality control of engagement has to be monitored. Like what you need to decide whether quality control system is implemented, whether new developments in the standards are reflected in policies. Nothing but first whether policies are implemented, they have to check whether policies require updation. Whether policies require updation, that they need to check. Conduct monitoring by putting that responsibility to a this particular partner. This entire monitoring should be taken up by one partner. Responsibility should be taken up by one partner. And in this monitoring, the monitoring team should also check what complaints, what allegations are there against the firm and employees, how to deal with it, taking actions on the personnel who did not comply, quality control policies, taking action when deficiencies are identified or when non-compliance are there with the quality control policies. So monitoring will have, first they will see whether established policy followed or not. 2, whether the policy requires updations or not. 3, is there any complaints and allegations received on the firm. 4, taking punishment on the persons who failed to comply with it. 5, implementing the revised quality control policies, looking into deficiencies in the existing policies. Easy. Yes or no? Most of the elements over. Remaining elements are ethical requirements, leadership responsibility. These 2 you study on your own. Understanding this, keeping in mind this, study them on your own. That doesn't mean they're not important. By the way, because I can only cover maximum extent possible. Yes or no? Like, briefly I will give you an idea of what is there in ethical requirements. The firm should observe independence. The firm should observe what? Independence. The firm should communicate independence to their persons. If at all any threats to independence are identified, the firm should take actions. What action? Implementing safeguards to reduce the threat to acceptable level or to eliminate it. If at all reducing or eliminating is not possible, the firm should not accept the engagement. So there should be a mechanism in the firm. There should be a mechanism in the firm before accepting the client, obtain information about the client. Like what information, what relationships we have with the client. Yes or no? We should obtain that information, and every partner should give that information to the firm monitoring team, like firm quality control team. Actually, no, in many big firms, they will have a separate quality control team. They'll have a separate quality control team. There will be a one partner exclusively held with the quality control. We call him as quality control partner. So whenever a new audit comes, new engagement comes, all the partners has to give an information about relationships they have with the proposed client to the quality control partner. They should give this information. Then the quality control partner will evaluate acceptance, relationship, all these parameters. Then he will give opinion. He will give confirmation. Then the client will, then the partner, other partner will confirm. Are you getting it? That's why the quality control standard says in this, the persons with the quality control responsibilities and the persons with managerial responsibilities must be different. Managerial responsibility means what? Should I accept a client or not? That's a managerial responsibility of the partner. Whether the client is accepted in line with the quality control policy or not, quality control partner has to check. So there must be a difference. So that's why here they say, here they will tell you this point. Probably I think managerial responsibilities, there is a point, leadership, I think in the leadership it might be there. That point is there in the leadership. This is connected point to the leadership. You see, persons assigned with operational responsibilities, getting it, should have sufficient knowledge and the firm assigns its management responsibilities so that commercial consideration do not override quality. In the pronouncement, they clearly tell managerial responsibilities must be given to some other, and quality control evaluation responsibilities must be given to some other, so that right client will be accepted. Clear? Now here one more point, in ethical requirements, one important point is, this fifth point is important. In ethical requirements, I'll tell you important question in this. This fifth point is relevant. Can the firm use the same senior personnel on the assurance engagement over a prolonged period of time? Can the same person be used? It depends upon nature of the engagement, public interest. It depends upon the length of service that person is involved on this work. Rotating senior as and when required for quality control review. Familiarity that is particularly relevant in case of listed entities. That's why SQC says for listed entities, engagement partner must be rotated once in 7 years. Clear? Suppose in case of sole proprietor, there is only one proprietor. In such case, 7 years logic will not apply to him. He can do audit of, by the way, for a listed entity, sole proprietor will do audit only for one term of 5 years, right? Forget about 2 terms of 5 years. He can only do one term of 5 years. So obviously he will be retiring after 5th year. Said there is no possibility of 7th year into the question. Correct? Huh? Listed entities rotation of auditors is applicable. As per that what? 5 years only. Getting it? In case the same firm is appointed for 2 terms of 5 years, can same partner continue for 2 terms of 5? No. That time up to 7th year one partner, 8, 9, 10 another partner. That's it. Clear? Now SA 220 is drafted on the same line. SA 220 is clearly talking about implementation of quality control policies and procedures. Only if SQC is understood thoroughly, 220 you will understand. And in exam 99% of the cases, quality control, first chapter in CA final is quality control. These 2 standards only, entire first chapter in CA final. Getting it? So SA 220 they generally will not ask any question because entire 220 is there into SQC. 220 is just formality they kept saying in audit, quality control is implemented on it, specifically check. What are all engagement quality control reviewers shall check, all that is there in 220 also. Now just once, no, in that one point I just want you to observe. You see this sentence, engagement quality control review is there, right? Inside that, engagement quality control reviewer shall evaluate what? He shall objectively evaluate discussion of significant matters. The engagement, the evaluation, engagement quality control shall evaluate. What he will evaluate, what it will involve? He will discuss significant matters with partner. He review whether financials and proposed audit report are matching, like are they suitable. Review of selected documentation, he will review just selected documentation and then see whether it is proper or not. He will evaluate conclusions reached for proposed audit report correct or not. For listed entities specifically, you need to evaluate firms independent, whether consultation taken place correctly or not. Documentation he should select for certain significant issues and then verify that. So this is for listed entities. This itself can be asked as a 3 marks question. All these points we covered in SQC already. This is not something separately newly covered. Clear? All of you. That's it. Difference of opinion also already covered. With this SQC and 220 is over. Understood? 220 dealing with what? Quality control for audit of financial statements. SQC dealing with what? Designing and implementation of quality control policies for the firm. It is applicable for the entire firm. Whatever service you are providing, it is applicable. Clear? That's it. Okay? We'll take a break and come back. Yes. Yeah. So let's continue the remaining standards. You know we have completed 240, 250, 260, 402, SQC 220, 540, correct? In this chapter we completed. So I am going to discuss 501, 505, 510, 530, 550, not even 530, 550, 560, 580. I am going to discuss these standards. 530, 320, 500 I am not covering. Because actually in your book it is not there first of all. 530 is also there, at least as a diagram they gave. Or else I'll do one thing. 530 also I'll cover. Whichever is there in your book I'll cover. 500 they just gave it as a diagram. For that I ask you to watch CA Inter Audit Evidence Marathon. CA Inter Audit Evidence topic will be there. That marathon you need to watch. 320 also CA Inter Marathon you need to watch. 320 also CA Inter Marathon you need to watch. Where we discussed neatly, in-depthly we discussed. Okay. So 320, 500 you need to watch CA Inter. Even entire this complete segment, 500, 501, 505, entire this segment is covered in CA Inter only in depth. In CA final 320 discussion itself is not there, but exams questions will come. You're getting it? Exams questions will come. So all these items, in-depth discussion itself is not at all given in the ICA book, but questions are completely in-depth. They are asking in-depth questions only on all these elements. Fine. So we'll begin with 501. Okay. We'll begin with 501. So 501 is dealing with audit evidence, specific considerations for selected items. Specific considerations for selected items. What are the items that are selected under 501? They have selected 3 items: inventory and litigations and claims, segment information. Inventory, what we need to specifically consider? You need to consider existence and condition of inventory. You need to consider existence and condition of inventory. Whereas for litigations and claims, you need to consider completeness of disclosures. Completeness of disclosures. For segment information, you need to consider presentation and disclosure requirements. You need to consider what? Presentation and disclosure. Like, segment information, I will cover it first. What auditor has to do? What auditor has to check? He should simply check. See, by the way, objective is what? We need to obtain sufficient appropriate evidence for existence and condition of inventory. We need to obtain sufficient appropriate evidence for completeness of disclosures related to litigations and claims. We should get sufficient appropriate evidence for segment information presented as per applicable framework or not. Correct? Now, when you are verifying segment information, what you will verify? What methods management followed for determining segment information? What methods they followed? Are they following methods that are recommended under accounting standards? Methods given under applicable framework? That we will check. Where, if possible, we will also test what? Application of those methods. We will see how that methods are applied. We will test that. How many reportable segments management computed? When we test those methods, how many reportable segments we are getting? We will cross verify. And we do analytical procedures regarding how many segments they reported last year, how many segments they reported in current year, is there any discontinuing operations, whether any new product has been launched by the company. Like that, we will do some analytical procedure. Clear? Now when you are verifying the methods, whether these methods are in accordance with applicable framework, there are some points you should keep in mind when you are verifying these methods. Whether the methods are resulting in applicable financial reporting framework, you need to keep in mind the following. What are the sales transfers that are happened? Elimination, comparison with budgets, allocation of assets and cost among the segments, consistency with the prior period, All these points you should verify when you are evaluating methods followed by the management for segment. They'll give you this question itself directly. Auditor has to evaluate methods used by the management in determining segment information. While using these methods, while evaluating these methods, what are the few examples which what auditor evaluate? Give few examples. We simply evaluate transfers that are happening between segments, budgets versus actuals, how allocation happened, how consistency is maintained in comparison to previous years in the segment information. These are the points which we will verify when we are doing audit of segment information. That's very simple. Segment information element is simple in this. Next element is what? Litigations and claims. Next element is litigations and claims. Like what is involved here? Litigations and claims. The auditor has to check. Whether litigations and claims involving the entity. Whether all these litigations are disclosed by the entity or not is a question. How will I verify this? One, I will inquire management first. What are all litigations you are having? I will review legal expenses account. To know what expenses they paid. What are all the charges they paid to lawyers, retainers, all that. Legal expenses account I will verify. Then I will verify. I will communicate with the company internal legal counsel. Every companies, especially big entities, they will have a legal compliance team will be there. Compliance department will be there. They'll have a legal department. I will talk to them. What are all the litigations that were there with this company? What are all pending against this company? I will ask them and get the data. If required, you see here, I may go for direct communication with external legal counsel also. I may go for direct communication. If required, I may go. When I will do direct communication, if auditor assess risk of litigation is identified, if there is a risk of MMSN, some identification of litigation, I will discuss with external lawyers what exactly they are dealing with. For example, in legal expenses account, they said some amount is paid to lawyer, a very bulk amount is debited. And narration, if I ask, sir, that is some legal fee and all, no, we don't, like, that is some legal fee, It's confidential in nature, they said. I am asking the details, the accountant does not aware of. I ask the director, he is not telling me. Then I will directly ask the other lawyer, sir, is this amount is paid for what purpose? I asked him. Getting it? This is called direct communication when the risk is identified. Getting it? Or when audit procedures performed indicates some material litigation may exist. I will be verifying legal expenses account. I'll be talking to people, right? When I'm talking to people, I understood that company is facing some severe challenge in some court. What about that particular challenge? Which lawyer is dealing with? I will directly communicate with him. And for getting more understanding of existing claims also, I can directly communicate with external. Some cases are pending in the court which are handled by various law firms. To get a more better understanding, I will ask them. Are you clear? This direct confirmation. How this confirmation auditor will do? Through a letter of inquiry. Through a letter of inquiry, management will prepare and sent by the auditor requesting the external counsel to communicate directly to the auditor. And you know what? In the CA Inter, this letter of inquiry has two types. General letter of inquiry, specific letter of inquiry. General letter of inquiry, specific letter of inquiry. General inquiry means very simple. Dear lawyer, I am the auditor of so and so entity. You are dealing with various cases. Please give me the list of cases. How much amount involved? What is the status? That's a general inquiry. Specific inquiry. Some lawyers know they are prohibited to reply general inquiries because of their requirements, because they also have a bar council, they also have code of ethics. They are prohibited to reply for some cases. In such a case, I will specifically inquire him. I got to know that these cases you are dealing with, this is the amount involved, this is the status of the case. Can you please confirm is this correct or not? This is specific letter of inquiry. What is this called as? Specific letter of inquiries. And in some cases, if at all management and external counsel, no, they both are disagreed on particular things. In those cases, auditor will directly visit. Auditor directly visit the external legal counsel. He will directly visit the external legal counsel in certain circumstances. In exam, that also they can ask. Under what circumstances the auditor can visit external legal counsel? That can be asked as a question. Are you clear? All of you? Suppose management is refusing, sir, no sir, not possible. With the lawyer you cannot talk. The lawyer initial itself, he said, I only deal with the case, I only talk to people relevant in the case, I will not interact with anybody, be it your auditor, be it anybody else. The lawyer clearly gave that kind of instruction to the company. Only then I'll take up the case. Yes, lawyers put these kinds of conditions. General, that is very quite common. If management is refusing, sir, this is how the lawyer put a condition, so I cannot allow you to go for external confirmation. Look at the reason and evidence. Look at the evidence, whatever management saying, no, look at the evidence, whether the reason is correct or not. In such a case, if the reason is genuine, reasonable, you should get about the case information through alternative way, right? Where the case is pending, some Supreme Court. Supreme Court has a site. Inside that pending cases list will be there. Inside that your case will be there. What is the argument till now happened? You can find a case document. Open to it. Alternative way you get evidence. Suppose management refusal is unreasonable, or you are unable to obtain evidences alternatively, what you have to do? Evidence is not available. What you have to do? Modified opinion. That's what. Finally, ask a representation, ask a declaration from the company. What declaration? Yes, we have disclosed all the pending litigations to the auditors. List of the litigations and claims are the following. Except this, there is no other litigation existing. Like this, management has to give a declaration. Correct? That's it. Litigations and claims is also completed. Confident. Then inventory. Here what auditor has to deal with? Existence and condition. We are not concerned with valuation under 501. When we are attending physical verification, we are concerned with existence and condition of the inventory only. We are not concerned about valuation. Therefore, like what is this? What exactly we need to see? The standard says at the end of the audit, at the end of the financial year, at the end of the financial year, auditor must plan visiting the client premises where physical verification is carried out by the management. You must visit at the end of the financial year to the client's physical verification process. Okay, you will visit there. What you will do there? I will evaluate what instructions management give, what procedures they are following for inventory counting. I will see how the management people are counting. I will also go and inspect the inventory for checking its condition. I will also do test counting. I'm observing their counting. They are saying some number, somebody is recording. I will go and say how much number is it, whether that number is there in the track or not. I will do test counting, and then counting is over, right? At the end of the day, I will see whether that count is matching with the records, inventory records or not. Now, if the inventory, suppose, if inventory counting is carried at some other date, not on balance sheet date, some other date, you can go on that other date only. Most of the entities, it is not possible to do inventory counting on 31st March only. Some other time it is possible. Sometimes it is not possible for us to attend on 31st March only. Some circumstances, some like unexpected circumstances, we may not go. I have 10 clients. We are having 10 premises in 10 states. How can I go attend physical inventory at all 10 states directly? It's not possible. Plan at alternative date. Okay, I am planning at alternative date. That time also what I will do? I will see how they are counting. I will inspect the inventory. I will test count the inventory. I will see whether records and count results are matching or not. All that I will see. In addition, I must also see between 31st March and the actual count to date, what are all the transactions happened, whether they were recorded properly or not, so that I will get an evidence about 31st March inventory correct or not. Correct? Suppose if inventory verification becomes impracticable, if inventory verification becomes impracticable, there in CA interbook they tell that general inconvenience of the auditor, general inconvenience of the auditor cannot be considered as impracticable. Just because you feel in the go down AC is not there, I won't go. No, that is not treated as impracticable scenario. Impracticable means what? Nature of inventory is like chemical. For example, it is dangerous for the auditor, or the location where the inventory kept is in the some like hill areas. Okay, hill areas where entire snowfall is going on. It is difficult to go there now at this moment. In such a case, or floods were affected in that area, then you can classify that inventory verification is impracticable. Okay, if it is impracticable, what will you do? I will try to obtain evidence regarding existence of inventory in that go down by alternative procedure. What alternative procedure? I don't know whether inventory is there or not right now, but I am after few days, if any sales were happened from that go down, any outflow of the inventory is there, definitely inventory is there only. Also, I will evaluate before inventory reaches there, some purchases and all will happen now. When it was happened, when the delivery happened, when e-way bill and all was generated, all that I will verify to know whether inventory is existing in that go down or not. Suppose if alternative evidence is also not possible, give a modified opinion as per 705. That's it. Inventory is also over. Are you clear? One more point is there, sorry. If at all inventory is with third party, if at all inventory is held with third party, do direct confirmation from the third party regarding quantity of the inventory held, condition of the inventory held. You're getting it? I'll give this example. How students write an exam, I'll tell you. Suppose if the same question comes, since it's an easy one, I can tell you exactly. In the easiest one itself, how I write. In tough one, you can imagine. If inventory is held with a third party, what should be the auditor's procedure? Getting it? They'll ask this question. Student will write like this. If inventory is held with third party, like he'll put question number, everything super fantastic, he'll put. He'll put facts of the case, something like that. If inventory is held with a third party, the auditor shall ask direct confirmation. First point. He'll be expecting 1 mark for this. Second point. If at all, that is 1 point. Second point, he can arrange another auditor to physically inspect this inventory. He can arrange another auditor to physically inspect the inventory, and he may inspect, if at all he remembers this point, he'll write 2-3 points like this. He will inspect the documentation regarding inventory held at the third party premises. This is the answer which they will write. With given analysis conclusion, some conclusion they will write. In the given case, auditor performed that or not, all that they'll write. Very good. Suggested answer will be like this. When the inventory is held with a third party, the auditor shall obtain confirmation regarding the auditor shall apply direct confirmation procedure, where auditor will obtain confirmation from the third party regarding quantities of inventory held and condition of the inventory held. These 2 points he will not write. You are getting it? He'll write correct answer but not complete answer. Second, perform one or more of the following procedures if there existed doubts about reliability of the confirmation or auditor otherwise want to get the data. 1. Attending or arranging another auditor to the physical count procedures performed by third party. 2, obtaining another auditor's report. Here actually there is another word. Obtaining another audit report or service auditor report. What is it? Service or original standard contains that one also. Obtain another auditor's report or service auditor report regarding adequacy of the count procedures at third party. Whether third party is maintaining the inventory in a proper condition, or the physically verifying reasonably or not. You directly send another auditor and get a service auditor report. Amazon warehouse and all example. Inspect documentation regarding inventory held by third party or the inventory belonging to the entity. In case if the inventory is kept as a collateral, get a confirmation from the collateral party, like whoever the lender is, a confirmation from them. This is the suggested answer. And what you wrote 2 marks answer, actually for 5 marks answer. You are getting the difference? This is how mistakes will be done. Why this kind of mistakes are done? Primary reason for it is you are reading short notes. The short notes will be same thing. If I put it in short notes, how it will be? If inventory is with third party, 1 box, get a confirmation, another box, attend another auditor, attend directly the inventory counting procedure, obtain another audit report or obtain a service auditor report, inspect the documentation, over. Are so easy, the standard. You also wrote the same answer and came. Wonderful, but you'll get 2 marks. You're getting the point. Read always complete sentences. But when you're revising, revise only the keywords. Revise only the keywords. You're getting it? Like this conception. How should I revise the day before exam this much material? You will revise. How I am revising now? How am I revising now? Whatever point relevant only, I'm watching it. Whatever point I feel, now it is not required, I'm not reading it. Yes or no? Do I have a chart book for easy revision? No. You give me a pronouncement book. There also I can filter the data like this. You naturally have inbuilt filter in your mind. You know how to filter. You need not have a separate filtered document. You can easily filter it. You see, almost I have covered more than 200 pages matter. More than 200 pages content I covered till date in the past, just how many? 10-11 hours, hardly. So you can naturally filter. Day before exam, you are having 1.5 day time, right? Let us calculate it as 20 hours time. Sleep, everything you excluded. 20 productive hours is what you are having. Within 20 hours, you can solidly revise. If at all you are having a command on the book, whatever book you follow, if you have a command on the book, you can solidly revise 450 to 500 pages easily. 450 to 500 pages you can easily revise. Very comfortably, slowly, neatly you can do that. If you are following chart book and all, what happens is, the result will also be like that. Because you will not write complete sentences. You cannot understand sometimes MCQs also. Because you studied a short form. There they are asking full length sentence. So you can't identify. You can't you can't connect to it so easily. If you read proper book and read that question, it's easy for you. To understand it is easy. To write also very simple. If I read 100, I can present 70. If you read 70, you present 40. You're getting it. So put that extra efforts in this coming exam itself, so that you need not sit another exam. That extra efforts, 40-50 hours, whatever it requires, you add it now itself. Extra 40-50 hours put now itself, rather than once again spending 200 hours. As simple as such. 501 is over. Confident all of you? Yes. Thank you. Yes. Let's begin. 505. In 501 there are few important questions also. We have given it as an illustration, which are there in the ICA book itself. Under 501 illustrations were given. Compulsorily read them. The illustrations are very important because they have discussed some 1 or 2 extra concepts also. Very important. 505, external confirmation. So what is external confirmation? It's a direct written response to the auditor from third party. If third party is directly replying to the auditor, that's called as external confirmation. Like what is the external confirmation process? The process is 4 steps, very simple. First, determine the information for which you want confirmation. The information may be outstanding balance as at balance sheet date. The information may be terms and conditions in a contract. The information may be some sale agreement related one. The information may be related to a significant transaction that happened during the year. In respect of any of this, you can get confirmation. You can get confirmation for any of this. There is no necessity that you must get external confirmation only for year-end balances. No such rule. You can get confirmation for everything. Yes or no? Wherever third party is involved, there you can get confirmation. The transaction is already settled. Still you can get confirmation. Okay, you understood information. Where you want confirmation, then you need to select the appropriate conforming party. You need to select what? Conforming party. Now, within the third party organization, who is the right person to give me this information? What is external confirmation? Obtaining information from third party. Agreed? Obtaining information from third party. That is only external confirmation. So, select the appropriate conforming party. What does it mean? In the third party organization, who is the right person to give me this data? Select that person, obtain their address, obtain their email address, and send confirmation to them. Nothing but the standard says the person, if in a financial institution, knowledgeable person means the person who has knowledge of transactions and arrangements. So confirmation requests are sent to conforming party where the auditor believes is knowledgeable about the information to be confirmed. Getting the point? Conforming parties are generally willing to respond to a request which is favorable to them rather than non-favorable. Further, conforming parties' ability to confirm is one of the important factors. Conforming parties' ability to confirm is one of the important factors. Some third parties, no, they will think, by giving a confirmation, it might bind us for a legal obligation. If at all we give a wrong confirmation, it might be a legal obligation. Like that, they will misinterpret. So there are, on that, no, we have some question. On that, we have some question. How external confirmation can be used as a substantive procedure? It depends upon ability of the conforming party to respond. This itself, this sub-point itself can be asked as a 3 marks question. On what factors ability of a conforming party is determined? Examples. What are the factors? Examples of ability of the conforming. Conforming party may not accept responsibility. No, I will not give confirmation, because if I give, it may becomes like I am responsible for it. He may think like responding is unnecessary, too costly, time consuming. He may think like a legal obligation might arise. Or he may operate in an environment where responding to confirmation is not a valid as per their company policy. So in these situations, the conforming parties may not respond or may generally respond in a casual manner. So whether can I go for external confirmation, if at all the question is asked, it depends upon the auditor may determine external confirmation performed. Like, by the way, one more thing, it depends upon what assertion we are verifying. External confirmation can I do as a substantive procedure? It depends upon what you are addressing. For example, you want to know whether company has calculated a provision for bad and doubtful debts correctly. You send a confirmation to debtor whether you have to pay this much or not. That will not give evidence for provision. Whether provision for bad and doubtful debts is reasonable or not, you should see the correspondence of follow-up of amount. Company debtor has to pay, company following it up or not. What the debtor is saying, when the debtor purchased, when it was outstanding, this is right evidence. Sometimes existence of support external confirmation for debtors, what it will provide evidence for? It will provide evidence for existence of the outstanding amount. It will not provide evidence for recoverability. It does not provide evidence for recoverability. What assertion you are addressing, that is an important factor, whether to use external confirmation procedure or not. Next, conforming party knowledge. Another example is conforming party knowledge. Responses are generally reliable if it is provided by the person at the conforming party who is having requisite knowledge about the matter. And another important, can I use external confirmation as a substantive? It depends upon ability of the conforming party. It depends upon the ability of the conforming party and objectivity of the conforming party. Whether the third party will give me an objective confirmation or entity is controlling him. Like entity is telling him, like whatever auditor asked, say agreed. Is there any such indication? Is there any such risk factor? All these points you should keep in mind whether to use external confirmation procedure or not. Correct? So that is what we call it as conforming party, determining appropriate conforming party. Then the third step is what? Designing the request. Designing the confirmation request. When you are designing the confirmation request, you should specifically, the following factors you should consider. What is the risk involved? What should be the format, layout and presentation? What is your prior experience with these particular customers and suppliers? What assertion you are addressing? Are you addressing existence assertion, valuation assertion? What exactly you are addressing? Method of communication. How are you sending this? Through a registered poster, through a mail, what? Generally through a mail they respond faster, not through post. Getting the point? So what is the mode of communication? Whether management is encouraging the auditor to do this or management is discouraging this, and ability of the third party to confirm. How far third party will have the ability? All these points you should keep in mind and design. That's why we have two modes of designs: positive confirmation request, negative confirmation request. In a positive confirmation request, we request the third party whether he agree or disagree with the information we provided. In the confirmation request, we provide them some information that what we have in our books. So we will ask him whether do you agree with this or disagree. Whether you agree or disagree, both you should reply within 3 days, awaiting for your reply within 3 days. Like this, if I send, that's a positive confirmation request. Suppose I sent a request like this. In our books of accounts, the outstanding balance as on so and so date is stood at so and so for a transaction executed on so and so date. Please confirm, please reply if you disagree with the above information. Ignore otherwise. Absence of non-receiving reply within 3 days, we assume you are confirming this particular outstanding balance. Like this, we specifically put and then set. And if third party he didn't reply within 3 days, we naturally assume that the amount is matching. But there does not end your responsibility. If at all to a negative confirmation request, you didn't receive a reply, that is not explicitly giving an assurance that confirmation balance is agreed. Absence of reply, non-receipt of reply from a third party, non-receipt of reply from a third party to a negative confirmation request. Does it provide evidence explicitly that third party agreed? No. I impliedly assume that third party agreed, which will be less persuasive than positive confirmation request. In a positive, if he agree, he'll reply agreed. I have a more assurance, more confidence than no reply for NCR. I will have lesser confidence. I will have like whether third party received it. Did he saw this? Why he didn't reply? He saw this and since it is matching, he didn't reply or he didn't see it. I will have this benefit of doubt. So I will have a lesser confidence, less persuasive than positive confirmation request. In such a case, what auditor has to do, auditor has to verify subsequent settlement of transaction when happened to know whether the third party balance is matching or not. This was asked in November 23 or May 23 exam. This one, illustration 12, that's nothing but not this, sorry. I think it is there in the question bank. I think it is there in the question bank. It is there in our question bank. It is there. So in that note, they will clearly discuss. They will clearly mention negative confirmation request to non-response to a negative confirmation request. Getting it? How to interpret that? A non-response does not explicitly indicate third party confirmed. 2. Negative confirmation request to non-response will provide less persuasive evidence than positive. In a negative confirmation request, if auditor does not get the response, he will evaluate whether the balance is correct or not, whether the information is reliable or not, by doing alternative procedures like verifying subsequent payment, subsequent settlement, correspondence between the third party and this after balance sheet date. Through this, auditor can decide whether third party balances are correct or not. Through this, he can get sufficient appropriate evidence. So wherever we are using negative, we should do this alternative procedures. First of all, since negative confirmation is this disadvantageous, should we use it? If so, when we can use it? Can a negative confirmation request be used as an audit procedure, as a sole substantive, only procedure I want to do negative in a particular scenario? Can I do that? Yes, you can do, unless all the following are present. Means only if all the following conditions are satisfied, all the conditions are satisfied, then only do negative. Like condition number 1, the risk assessment is low for that account balance. For that account balance or transaction, the risk you assessed as low. The items are so many items but are small, immaterial, homogeneous items. There and all you can obtain negative. Means immaterial outstanding balances, immaterial transactions you can get negative. Third one, exception rate is low. What is an exception? Exception means there is a definition again. In the standard itself, there is a definition. What is definition of exception? It's nothing but I sent a request to the third party. I will send a request based on what? Information that is there in the client records. That information I sent to third party request. Third party replied, but he replied differently with a different number. Now, response of the third party and the information I requested there in the records of the entity, mismatching, right? That's called exception. It is not misstatement, correct? Can I say, suppose third party said, no sir, outstanding balance is not 10 lakhs, it is 8 lakhs only, he said. Client financials are materially misstated, give modified opinion. Will you do that? First you will investigate where the mistake happened. Whether the mistake is in client records or third party records, you will check it or not. So, when third party replied with a different number, it is called as exception. Exception means what? Generally my records and his records should match. That is usual. But if it mismatch, that's unusual. That's exceptional. Are you clear? That is unusual. That is exceptional. So that's called exception. When exception is identified, what auditor has to do? Investigate whether the exception is resulting into material misstatement. Are you clear? Now, if exception possibility is low, exception possibility low means what? The possibility that third party records and my records will mismatch is very rare. In that case also, you can send what format? Negative confirmation format. And in another fourth condition is there. Fourth condition, auditors are not aware of any circumstance that would cause the recipient to disregard. What does it mean? I don't have any knowledge that third party will ignore this. Means non-response possibility from third party is low. The possibility of not responding by him is low. In that case also I can send negative confirmation request. Risk is low, items are huge, immaterial, exception rate is low, and non-response possibility is low. If all these four are satisfied, to them you can happily send negative confirmation request. Clear? That's about PCR and NCO. Suppose we send a PCR. Third party didn't reply. What we do generally? We do send a follow-up request. Fine. We send all that is over. Suppose this is the external confirmation procedure. How you can get information, all that. Suppose management is refusing. They are saying, sir, we and with the third party we have a dispute going on, or some negotiations going on the recently conducted transaction. Until that negotiation gets completed, let us not disturb the third party, sir. If at all in between you go and ask third party like so and so, what is it balance and all, it will disturb our negotiation process. Better don't involve. The management refusal reasonable or not, check out. If it is reasonable, try to get evidence regarding by performing alternative procedure. Remember, external confirmation is only one of the method of obtaining audit evidence. We can obtain evidence regarding outstanding balance, we can obtain evidence regarding transaction, we can obtain evidence regarding terms and conditions through correspondence, through various other documents we can get information. It is not necessarily third party confirmation. So perform alternative procedure. Suppose if management refusal is unreasonable and if alternative procedures are also not possible, then you will give modified opinion, qualified or disclaimer depending upon the scenario. Correct? Suppose if you have a doubts about reliability of the third party, suppose third party replied, but I felt that reply is being manipulated by the client. If you have a doubt about the third party, you do one thing, you do apply, you do try to perform alternate procedures and get the evidence. If that is also not possible, again same logic, give modified opinion, qualified or disclaimer. That's it, and entire 505 is over. Clear, all of you? Yes. One important clarification with respect to 500 series standards, I recommend you to watch CA Inter Marathon, because in 500 series you will get in-depth like complete discussion on that, especially 501, 505, 510, 550, 560 not required, 580, 501, 505, 510, 550, 580. Okay, 530 sampling you want to watch or not, that's your choice. That's not okay, it's okay, not an issue, but there is a possibility of MCQs, you don't know. So in CA Inter you will find my audit marathon. I have to arrange the order, this one playlist we will arrange later, that's not an issue. Inside this playlist you will find part 1, part 2, part 3 audit marathon. You can observe this. Suppose here you see this, I can't even zoom it in YouTube app. So this is part 1. Okay, like inside this I think I'll see whether what standards we have. Yeah, inside this 501 is there, 505 is there. Getting it? That you need to watch. Then you need to watch part 2. Then just a minute. I think probably in this it is not added. In this playlist it is not added. I will add it. So open part 2. I will add it. Okay, just a minute. Just 1 minute. Okay, I'll right now add it and show you. Yeah, it's not added to the playlist, that's why. Yeah, now it will be added. Yeah, you see this one is part 2. Yes, just a minute. Inside this you see timestamps were there. 510 is there, 550 is there, 580 is there. These standards I request you to watch to identify what are all concepts that were missing in your idea material. Better you listen to this. This is minimum assurance, limited assurance. You want to get reasonable assurance, CA Inter class you need to watch. Okay, and part 3 is also there. Just a minute. In CA Inter Marathon we have even uploaded part 3. That is also I'll add it to playlist. Yes. So part 3 is also there, which is just a 4 hours marathon. Inside that 320, 450 you watch. 320, 450. Just watch and leave it, so that if an MCQ comes you will not miss out. You're getting it? So that's it. Like this entire whatever I'm asking you to watch in CA Inter, this entirely will be less than 2 hours. Less than 2 hours. This entire whatever I request you to watch is less than 2 hours. But you will get a reasonable assurance that you will perform well in the exam, if at all any question comes from that. I am telling you, in-depth questions are being asked from all these standards. Why? Institute book itself says refer CA Inter book. That's why they are daringly testing all these questions in depth. Understood? Yeah. So that's one important clarification. And whatever until now happened, no, we are uploading it as a part 1 in the YouTube. Whatever until now, whatever I'm speaking. The next discussion onwards, where I will discuss remaining standards, they will all be there in the part 2 in the YouTube itself, in CA Final Audit Marathon. Clear?